Frankie, it's the first episode of the new series, the Flamingo Property Investing Show. Mate, we've gone from the In the Know Property podcast to the Flamingo Property Investment Show. And the reason for that is because it's all around our strategy. You know, I think the In the Know Property Show was generic in nature, where we just spoke about, you know, all facets of property investment, where this show we're really going to hyper focus in on why we invest the way we do, what we invest in, the properties we buy, the results we get, and mate, hopefully we can bring a lot of wisdom to the listeners.
Looking forward to it. Let's get into it.
Mate, today's episode is all about you don't become a flamingo by following everyone else. So essentially, you know, you don't become a part of the wealthiest 1%, which is our goal for all of our clients, by following the 99%.
True.
And if I sound congested, folks, I'm a little bit...
Winter is here.
That's exactly right. So you don't become a flamingo by following everyone else. And the premise of that is the majority of people, you know, 70, 80, 90% of the population, if you were to look around, probably don't live the life that most people aspire to live life. And the majority of people do the same thing. You know, especially when we're talking about property investment, they have the same premise around money. They look in the same locations. You know, they think that the strategy, and most people's strategy, is buying positively cash flowed property, so it doesn't impact your day-to-day lifestyle. Most people think that's the right way to do things.
Well, they follow the crowd, so to speak. And I think the reason they do that is because as human beings, I think there's some sort of comfort in that.
Absolutely.
But you know, what's the saying? You got to be comfortable becoming uncomfortable, or be comfortable being uncomfortable.
100%, mate. And you know, the mindset that I've always had around the property investment strategy that we use, which is the Flamingo investment strategy, and the mindset around money and you know, building the life that you want to build, is follow the people who are in the position that you want to be in.
True.
So
yeah.
You know, if you look around and the people who are living the life that you want to live are investing the way that, you know, you invest, then great. But if you're investing like people who don't live the life that you want to live, then the reality is it's probably not the right thing to do. And that's the whole mindset around it, is look around, look at the wealthiest people in Australia, or go to the wealthiest people in the world, look at what these people are doing, and there's a reason that they do what they do, and you want to, you know, follow the money.
Yeah.
So,
and a lot of the time when you watch and listen to what these people have to say, it's really not that complicated. Yes, like, they've worked hard, and you know, yes, they may have, you know, millions of dollars and a multi-million-dollar property portfolio, and you know, I'm not going to talk. There's obviously others who have hundreds of millions and billions, you know, but in general, you know, they really can nail it down to 3 or 5 points that they have stuck to in their life, whether it be the personal life, the career, you know, handling money, etc. So it is quite interesting to see, you know, how they have achieved it and what structure they have stuck by.
Absolutely. And I think the word that we're looking for is simplify. You know, a lot of people, a lot of wealthy people, they don't overcomplicate things.
And they don't overthink it.
That's right. They try and keep things as simple as they possibly can. They want to, you know, I guess go with a method or a strategy which has a proven track record.
Yep.
You know, the majority of people are not trying to reinvent the wheel. They're not trying to go where, you know, the new hot thing is, whether that's in property or business or in other parts of their life. You know, you look at it like dieting, for example. Dieting's exactly the same. You know,
well, it's all about consistency, right?
That's right.
And it's about a method that you know, these people have you know, can replicate. So they're not going off the track. You know, they're sticking to the path, and they're just simply replicating it over time.
And weight loss, and I think, you know, health and fitness it really relates to most things, right? And investing in particular, because you look at the majority of the people who are at the top of their fitness peak, they've got the best bodies, they live the healthiest lifestyles. They're not looking for new fad diets, or they're not looking for a way where instead of working out 30 or 40 minutes a day, they can go and work out for 3 minutes a day.
Yeah, 7-minute abs, I think it was.
Yeah, that's right. You know, these people know that you have to eat less from a calorie perspective to lose weight than, you know, what you exhaust through your exercise.
Yeah, calories in versus calories out, don't they say?
Exactly right. You know, you've got to eat, you know, the healthier foods, more fruit and veg, you know, less processed foods.
And they're not looking for a shortcut at the end of the day. They know what's worked for them, and they know it works, it achieves results, so they stick to it, and they're
Exactly.
just consistent at it, and they replicate it.
But then you look at what the majority of people do, and the majority of people are always looking for the shortcut. They're always looking for, that seems a bit hard.
As they say, it's easier said than done, and that's with health and fitness, and whether it be dieting or working out at the gym, and it's the same with property investing, like it is for a lot of things. It's easier said than done, but it can be done.
100%. And one of my mentors always said that the strategy that he used was always too simple for smart people, because smart people always want to reinvent the wheel, right? They're always looking for how can we do things quicker, faster, better.
Yeah.
And as we know, quicker, faster, better is not always the best way. So with the strategy that we use, the reality is it's not that sexy. It's following.
Can even be classified as boring, some would say.
Exactly. It's following what's happened in the past. We're looking at historical data. We're looking at the properties that have performed for the last 30 to 50 years. And what we're saying is, well, if it's performed for the last 30 to 50 years, there's a high probability, a much higher probability that they're going to perform for the next 30 to 50, as opposed to trying to pick something that hasn't done that for the last 30 or 50, and you're hoping and praying that based on external factors, it's going to do that for the next X amount of years.
Yeah, which brings me to the statement, get rich quick. People are always looking for that next suburb, that next area, that next hotspot that is going to take off and give them, 30 to 40% growth in 12 to 18 months or 2 years. When in reality, if you just wait and, like we say, a long-term, a minimum means holding a property for a minimum 10 years, history shows that, like we've just come out of with a boom, the established suburbs with a proven track record will hit, have those years or period of 30+%.
Exactly right. So
you don't need to go chasing the next hotspot.
Exactly right.
And more often than not, it ends up being not a hotspot.
Mate, I couldn't agree more. And we see, we see the amount of investors that are out there in the marketplace. There's literally millions of investors, and naturally there's a lot of other firms and a lot of other property companies out there that a lot of them do great work, but a lot of people are pushing towards, well, I would say the majority of investors, from what we see, are pushing towards things which are, more shiny. They look sexier. They look like they're going to make money quicker. A lot of it is, like we've spoken about on other podcasts, the off the plan, the new, the regional locations, and some people can do really well out of that in the short term, like some people probably have over the last 3 to 4 years.
I compare that to a car. If you're trying to convince someone, or somebody showing some interest in, I want to buy a car, and they go and see somebody and say, what car shall I buy? They're not going to try and sell them a 30-year-old Holden Commodore, are they? They're going to try and sell them the brand new, Range Rover, Lexus, Mercedes, whatever it is. Whereas with property, we're looking for that 30-year-old, or that older established house, as opposed to the brand new and shiny one that's just been built or just off the plan.
Exactly. Which again is all about standing out from the crowd.
So it makes sense that people are attracted to the brand new and shiny, because that's what they do for a car. Now I know that's two completely different things, but it's just human nature that people would say, why would I want to go and buy something that's old and run down or an established, probably missing the point that they can manufacture equity when it comes to a property and make some real money out of it that way.
100%. Let's look at some numbers, which if you're an avid investor, you probably know these numbers, but these are from a couple of years ago, so they're probably slightly different now, but 71.5% of property investors hold only one property, which essentially means 3/4 of all investors in Australia have one property. There's probably a multitude of reasons why they only have one property, but if 3/4 of the investors in Australia only have one property and probably are not living the life that they set out to live when they envision property investing, then that probably means 3/4 of investors are not doing the right thing. Now,
they're doing better than those who have zero properties. I'll give them that.
Potentially.
But those who have zero properties are not property investors, right?
18% of investors hold 2 investment properties.
So that's a dramatic decrease.
So you look at 71.5 plus 18, or let's just do 72 and 18 for round numbers.
Yep.
We're talking 90% of all investors, and there's a couple of million of them in Australia, only have 2 properties. Now,
And Jack, just to clarify, this is investment property, so this doesn't include the principal place of residence.
That's
this
right.
Is in addition,
investors. So this is based on the ATO's data of
yeah.
who's submitting tax returns and
and
claiming
it's
for
having
investments.
one investment property.
So
or
we're
two.
talking 90% of the Australian population that invest in property only have 2. Now, only having 2 good quality properties is actually totally fine, because if you've got an owner-occupier property and 2 really good quality investments and you invest over the long term, you'll actually do extremely well out of it. But the majority of these people, I would say, and we've spoken to many accountants and many financial planners and people who are dealing with huge amounts of money on a daily basis, the majority of people don't do really well out of investment. They do really well out of their owner-occupier properties, but not their investments. So 90% of investors hold only 2 properties and probably don't live the life that they set to live when they started investing. So if you want to become a flamingo and stand out from the crowd, probably don't follow the crowd of people, right? Because they're the crowd, so 90%, which is the vast majority, only have 2 properties. So if you use the same strategy that the 90% use, you're probably going to get a very, very similar outcome. Now, we go on to 3, 4, and 5 investment properties. 9.7% of investors hold 3, 4, and 5 investment
Well, I was going to say, it had to, with that dramatic decrease from 1 to 2, it has to drop down into single figures. So it's under 10%.
Less than 10%. And then 0.8%, or 19,900 people, hold 6 or more properties. So my mindset around this is, do I want to be like the 90%? Probably not. So let's scrap them, because I don't want to invest like them. Do I want to be like the 9.7% that hold 5 or 3 to 5? Yeah, maybe.
Well, you'd be doing very well to get in comparison to everyone else in that stage. Yeah,
that's right. But do you want to live the life of the 10%, or do you want to live the life of the 0.8%?
Yeah.
Now, for some people, living the life of the 9.7% is totally fine. That you're above the average. You're not a part of the wealthiest 1%, which is what our goal is for our investors, but you're a part of the wealthiest 10%. Or do you want to live the life of the 0.8%, so the wealthiest 1% of Australians, and invest like they do? And if you want to invest like the wealthiest 1%, then the whole idea is you need to follow what the wealthiest 1% of people are actually doing.
Not what the majority at 90% are doing.
Exactly. And Frank and you and myself, I'm not saying that we're better than anyone else, but we sit in that category. We have 6 or more investment properties.
Yeah.
So when we talk about our strategy, when we talk about what we do, you've built the portfolio by spending 20 or 30 years investing.
30 years this year.
Slow
literally.
and steady wins the race. You've got $15 million or 14 to 15 million in assets. It's proven. It works.
It's worked, and it's something I've done on the side. I didn't make a career about it. I had my career. The property investing was something I did on the side. So it's not like it took up hours of my time on a week or monthly basis.
And you were, working a job which you had to progress through the ranks. You're an accountant.
Right. I started at the bottom, mate, doing the banking and handing out mail for a big insurance company, and just,
And when did the big money start to come in your career, before you obviously moved into the property sphere and started to wind down on working the huge hours?
Not till later in my career. Literally not until I became a CFO and a CEO in the industry I was working in. But I always, had the attitude throughout my career is just work hard. Don't worry about the money. The money will come later. Because if you work hard, work consistently hard, put in the effort, do the right thing, you will get promoted through the ranks. You'll, at some stages, you'll change companies, you'll change industries even, and that hard work will eventually get rewarded. So I had that attitude from the outset of work hard. It's a long-term thing, your career.
Yep.
The rewards will come later, and they did for me.
And when you were going through that journey, you were probably not looking at all the shiny things that were around you and all of the, you probably could have had a few more properties earlier in your career at lower dollar value properties, but
possibly, yeah. But especially earlier on in my career, I was more focused on my career. Even though I did buy property initially when I was young, starting at 19, there were stages there where my career and obviously family and things in your life in general took priority, and the property investing was put on the back burner. If I could go back and do it all again, I would have probably, knowing what I know now, and
Yeah.
it's always easier to go, well, I didn't know what I didn't know back then, and the internet, was only new in the early 90s, and the amount of freely available information it was just not around then. But if I knew now what I knew then, yeah, I probably would have been a bit more acquisitive and purchasing properties earlier than I did, because later on, my wife and I, we then sort of pulled our money and went on a buying spree, and I think I bought 4 properties in 12 months or something like that. So I could have purchased them earlier, if I was to do it again, purchase earlier as soon as I could have.
Yeah.
And then that would have just given me more time in the market.
And let compounding do its thing.
And yeah, that's right.
But the reality is, when you went through this investment journey, I'm sure you looked at many different strategies. You used buyer's agents, and
I did, yeah. Not all the time, but I did.
But the buyer's agent that you used, was following the same strategy, right? They were investing like the wealthiest 1%. They had the 6+ properties. They had
weren't getting caught up in where we were in the cycle and what interest rates were. It was all about financing and affordability, and then with having the budget in hand, going out, which is something that we profess, with that budget, what is the best area, location, and the best quality property we can buy? That
you can buy, 100%. And for my journey, it was exactly the same. I didn't want to live the life of the 9.7% or the other, 90% of people. I wanted to live the life of the 1%. Now, I didn't grow up in an area where there was the 1% of, the wealthiest population. I didn't have those people around me, but I sought those people out and followed what they did, which takes me on to my next topic, which is you need to follow where the money is going, because that's the reality. If you understand what the wealthiest are doing, you research them, you know where they're putting their money, you know how they've gone about. You look at people like Warren Buffett.
I was about to say it's no different to the stock market. Warren Buffett's a great example. What companies is he purchasing in? Now he makes I think Coca-Cola. He owns.
He's their largest shareholder. Yeah,
he's their largest shareholder, and he earns so much more than the CEO does just by sleeping at night and holding the stock. So he always, it's so funny. He goes, "You don't need to be the CEO of the company; just invest in the company." So people,
just tell the CEO what he can do, what he can and can't do.
So people who are into the stock market, same thing. They just need to follow where the top investors are putting their money, who they're investing in, and follow them.
100%. And you look at the wealthiest people, and there's a reason that as people become wealthier through their life, they get better jobs, they earn more money, they want to upgrade their house, they want to send their kids to the better school, they all gravitate towards certain locations inside of their states that they live in. You will find it very hard to find someone who's worth a significant amount of money living in a very strange location or investing in a very strange location. It just doesn't happen.
Yeah.
So if you understand, okay, well, this is where all the money is. I want to follow where the money is going. Where are they putting it? Why are they putting it there? What's their philosophy around it? That was my methodology behind it. And you look at it's funny. You look at all the people who run a lot of these big property companies. That's what you need to look at. What are the people in the big property companies doing? The heads of the largest firms. Research them and look at where they live. Look at where they invest.
Yeah.
Not where they invest for their clients, because there's
everyone has different budgets.
But look at the people who run these firms and own these companies, because this is a property investment show. Where do they live? Where are their houses? Where are they personally putting their money? And one thing that I can guarantee is that it is not where they're telling their clients to invest. And that's just fact. I'm not telling you who and what, but if you look at all these people, when they start to make money through property, through their business, they're not going to invest in, a regional location or in Perth or, in regional Queensland. They're moving to the biggest cities in the country. They're moving to where all of the other money is. They want to be surrounded by wealth, and they're part of the 1%. But the information that they give to other people is very different from that. And the reason for that is because it's not as sexy if you say to people, hey, it's going to take a lot longer than you think. You're not going to be able to buy heaps of properties. You're not going to be able to get the little sugar hits,
There's a journey there as well. And those wealthy people living in those wealthy exclusive suburbs would have gone through a journey as well.
Absolutely.
Throughout their career.
And the journey that they went through, I could almost be certain, if they got it through property, is not investing in locations where the 99%, are likely to invest.
Yeah.
And what you'll find is that a lot of their wealth and a lot of their income is built from them working hard, increasing that income, and then moving that money that they trade their time for into really good quality assets. So in summary of this episode, to kick off the Flamingo Property Investment Show, it is, you need to understand that if you want to become a part of the 0.8%, the wealthiest 1%, look at where all of the wealthiest 1% put their money, because they're not investing where the 99% are. And then you need to understand that if you want to be like that, you follow where the money is going. You understand that where there is a will, there is a way. It's not about getting there fast. It's about getting there for sure. And you really want to be curious around why is it that people are doing the things that they're doing, and why is it that the majority, or why is it the wealthiest do what they do, and why is it that the majority, not the majority, not the minority, we want to be a part of the minority, are not living the life that I want to live, and why is it that they've followed all of these other strategies? Like we said, 70% of investors only hold one property, 18% only hold two properties, so 90%.
And I'm sure as we go through these shows, Jack, in future weeks, we'll unpack, there's obviously a stumbling block there for most people, for those 70%, why they're getting stuck at one property, one investment property, I should add, and why then, increasing that to 90% are getting stuck at two. Absolutely.
It's got to do with a lot of things. It's got to do with structuring. It's got to do with asset selection. It's got to do with focusing on the wrong things. And we're going to unpack all of that. So, in one of the episodes, I'm going to break down why earning $60,000 a year and trying to build a passive income is just not reality. That's just the fact, and trying to do that fast. You may be able to do that over a 20-year journey, but doing that fast is just not reality.
No, and that's one of the things about, us, Jack. We're always realistic in what we talk about. If something is not realistic, people need to know. We can't send them down a garden path and go, you're going to have, 500 grand's worth of passive income when you're currently earning a 60 grand salary. Exactly. You're going to hit, your financing is going to stop you at some stage.
Absolutely, mate. Frankie,
it's been
short
a
and
pleasure.
fast, mate. We'll be back next week.
Thank you.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Frankie, we're back. The Flamingo Property Investing Show.
Beautiful.
Mate, we've had a couple of weeks of hiatus due to a quick trip I had to do overseas, but we're back now.
We were here slaving away, but that's all right, mate.
Mate, absolutely. I can tell. You've actually faded away to a shadow. It's all that yoga you've been doing recently.
I did a yoga class today.
How was it?
It was very good.
Was it? A couple of downward-facing dogs?
As flexible as a pretzel, as they say.
Mate, today what we're going to talk about is the myth around being able to earn $60,000 a year and retire and have passive income within 10 years. As we know, there's a lot of information and potentially misinformation out there, selling people the dream and, or selling people the world, I should say. And when they actually get it, they're given the atlas as opposed to what they were
as the saying goes,
promised.
Yes.
And we just want to be able to give people context around what actually goes into building out a portfolio, all the different variables that count towards being able to get to a point where you can retire on passive income, which is, something that you've been able to successfully do, how long that actually takes. And if you did want to do it in a short time frame, what you would have to be able to do that. So mate, let's not wait around anymore. Let's jump straight into it.
Let's get into it.
I guess the first, the thing you really want to start on is to get an understanding of, what does retirement look like for an individual? Most people want to retire on passive income in quotation marks, but what does passive income actually mean? And it means something slightly different to everyone. But most people, when they retire, they want to retire to a similar lifestyle to what they're currently living.
Yeah,
right?
Similar or better.
So yeah, most people are actually better, right?
Yeah.
When you retire, people want to
Because you
retire.
probably want to take more holidays because you've got more time,
Exactly right.
given that you're retired. Yeah.
So, and I would say the most people who want to retire quickly and get out of what they're doing are people who hate their jobs because they're not fulfilled in what they do, right?
True. Because there's, a lot of people who don't want to retire quickly. Very
That's right.
happy with what they're doing. It could be their passion or their business, and don't want to retire at 40, 50 or 60. Happy to keep working as long as they're still happy doing what they're doing.
Exactly right. So I guess the thing is to outline, what does retirement mean? How much income do we actually need in retirement? Obviously, in retirement, when we're not actually at retirement age, that the government defines as retirement age, we can access your super, you're still in a normal tax environment as well, so you've got to account for tax. But let's say you were earning $60,000 a year and you wanted to retire on the same amount of money of $60,000 a year. 60 grand after tax is what, 45 grand?
Yeah.
And if that's $60,000 of passive income, for example, is coming from property,
Yeah.
the $60,000 is slightly different to earning it from a job, because when you earn it from the job, the only cost you have of earning that money is your tax that you pay the government.
Yes.
Although when you own property, you also have all the costs associated with owning property that you get income from, right? So you've got not only your tax that you'll have to pay, standard tax rates, I say 30-ish%, you've then got to pay your rates every year.
Council rates, water rates, strata if it's a unit.
That's it, management fees.
Repairs and maintenance, management fees.
So the reality is to have a similar amount of income, hypothetically speaking, you've got no debt or your interest costs are covered.
Yeah.
You're probably going to need to earn another $15,000 a year to cover all those costs. If you wanted $60,000 a year, you're probably going to really earn 75 because 15,000 thereabouts might go to all the other stuff like your property management fees and everything else.
Yep.
And if that's our target, we go, okay, well, we need to earn 75,000 a year. How do we actually do that? Well, let's hypothetically say that we have a property that's yielding 5-ish%, which is a pretty good yield in today's market. So we go, okay, we need a 5% yield, and let's assume that we have no debt in retirement. So we essentially need to have about $1.3 to $1.4 million of unencumbered assets to be able to have our, 50, 60, 70, 80 grand a year in income.
Passive, yeah.
Okay, sound about right?
Yeah.
Sound about right. So then we go, okay, well, to be able to get there in 10 years, what does that actually look like? Now, as we know, the biggest thing that restricts property investors in any marketplace, but especially in today's marketplace, is serviceability.
Yeah, the financing.
And on, let's say 60 grand a year, the bank will probably lend you 250, 300, I would say, 5-ish times your income.
Yeah.
So then you go, okay, I've got a $300,000 property, and then you're capped with serviceability. So if you want to retire in 10 years and you're earning this sort of dollars, and it's the same at all income, right? If you're on 60, we're just retiring at that same income. If you're on 600, you're retiring at that same income. It's just not possible to be able to get from $300,000 of a property, then for that property, let's just say it doubles in 10 years, which is a good property. So that property doubles from 300 to 600, and you pay all of the debt off in that 10-year period. So you've literally lived, we're not counting any living expenses here, but you've essentially lived as cheaply as you possibly can. Try to retain 50% of your income, for example. You're living on beans and rice, and you've paid 100% of that debt down to zero.
Yeah.
You've now got $600,000 worth of unencumbered assets. So you're halfway there, and you still haven't got anything to live in because you've only got one investment property, right? Mm-hmm. So the concept that people get sold, or the 10 properties in 10 years and all the rest of it, it's just not reality.
No, not unless in that 10-year period their incomes, increase substantially overnight, whether that be via promotion or
they dramatically increase, right?
Go out on their own. They could be working for someone, then decide to go, I can do this on myself, and go out on their own and start their own business. And, then just start, that business just takes off. But it's all about, I think you're alluding to, the income.
That's the thing.
The income needs to grow substantially and continue to grow so that your borrowing capacity can continue to do the same, and you can keep on investing.
That's right. And that's what it's all about, right? When trying to debunk the myth for people, is the reality is if your income stays the same, you're not going to be able to get there on that same income.
Yeah.
So what everyone forgets to talk about when we're talking about property investing and growing these large portfolios is when you look at the people who have grown the largest portfolios, what has grown in parallel with the portfolio value is their ability to earn. It's their cash flow coming in, right? And the cash flow that is looked at best by the banks is cash flow that you earn from a job or for a business. Because like I said, it's got no cost associated with it, right? Profit from a business is money essentially you get in your pocket, and cash flow from your job is money that you get in your pocket because it's post-tax. Yeah. So the emphasis that we want to put on is like if you have an end goal of whatever it was. I spoke to a guy yesterday or last night, on the phone, who wanted to have $100 million property portfolio. That's what he said to me. He wants to see $100 million.
Not in 10 years, I hope.
Yeah, well, he was, in his late 30s, and I said, well, I'm a believer in anything is achievable, but to get to that level,
this is what you're going to have.
That's right. Like it's this is all the things that need to go with it to be able to get there. This number's possible, but to be able to hit that goal, this is what you need to do. So I think it's important when we're talking about passive income and understanding, how long it's going to take to be able to get to our passive income goal. That's what most people invest for is income. How long have I got to be able to get there?
And I think that's the thing. The big thing is time. You need to have time on your side, and hence, what I always profess is start as early as you can. I bought my first property when I was 19. I think you were 18 when you started. You've got to start as early as you can, because let's face it, if you're buying your first property at 20, you're probably not going to want to retire at 30.
That's right.
So you're going to have a good 10, 20, 30 years on your side. And, having that time and the compounding effects of property and capital growth is a great thing to have on your side.
Absolutely. And it's a thing that's going to be able to get you there, right? Because the reason most people invest in property is for financial freedom.
Yes.
But they don't understand the time it takes to be able to get to that financial freedom number. And whether you start at 20 years old or whether you start at 40 years old, the timing thing's going to be the same, right?
That's right, yeah.
You're going to get to your
30 years is 30 years, yeah.
Yeah, that's right.
You start at 40, you might take you to your 65 or 70, but for some people that's okay.
That's right. So essentially the big thing to look at is like, what is my overarching end goal? And this is usually where we start with our clients. It's like, okay, well, if my passive income target is, let's say, $100,000 a year. You
have to know what your goal is and then, once you've ascertained that, what your exit strategy is going to be.
Exactly. How do we actually then get that income, which we're going to talk through. So if we've got that as our income target, a passive income target, we go, okay, well, this is where we are right now. This is what we've got available to us. And there's some predictions that need to happen, right? Because you are probably going to have a stronger income as life goes on. You're probably also going to have a family. You're also
you could be, when you're starting in your 20s, you could be single. One of your life goals will be to meet someone and get married. So you go, well, okay, well, they're going to have an income. Hopefully they got a job that, they probably want to, live in a nice house and have similar, if you're going to marry someone, you'd hope you got similar interests and long-term life goals in regards to, property investing could be one, or financial freedom. Therefore, you're going to have two incomes coming in.
Exactly.
So that's going to obviously double what you initially had when you started in your early 20s.
And these are all the things we consider with a strategy, right? So we go, okay, we need $100,000 a year. First you need to go, okay, well, how do I actually fucking get that? Where does $100,000 come from? And we always look at, well, for every $1 million of unencumbered assets, meaning assets with no debt associated with them, so you've got no holding interest cost, you're getting about $50,000 a year of income from that property. That's gross income.
Yes.
Okay, so if we go $100,000, we need to have $2 million worth of investment assets, unencumbered.
This is excluding your principal place of residence.
That's right.
If you decide to buy one or rent one, either way, it's investment.
Exactly, to be able to get our $100,000 a year.
Yeah.
Now, that $100,000 is gross, because out of that $100,000, just like we spoke about, you then have to pay your land tax, you then have to pay your council fees, you then have to pay your property management fees if they're managed by a property manager.
A bit of a buffer for
your
repairs and
maintenance fees. If you've got $2 million of assets, you've probably got $20,000 a year just in maintenance for both of those properties, because we usually say about 1% per year of the property's value in upkeep. So you take off all those numbers and you're netting down probably to 70, 65-ish thousand dollars a year.
Then you got to lodge your tax return.
And then you got tax on
pay
that,
tax
right?
as well.
So then you've earned $100,000 a year of income, and your net income figures maybe 45-ish thousand. So then you go, okay, well, if I've got to earn $100,000 gross to be able to get to $50,000 ish net, and I want $100,000 of net income, $2,000 a week in my pocket every week, you really need double that, right?
Yeah.
So you really need $200,000 a year in gross income to then have $120,000-ish of net income.
Yeah.
So that's our starting
And that's
point.
quite substantial if you think about, what if people were to look at how much they're actually living on now, and then compared to that, they'll probably go, yeah, that's okay.
That's right. And you think like that income then is your lifestyle, because when people are retired, they don't spend less money, they spend more money.
Well, you got more free time, so you got to think,
right.
you're eating out more coffees, more lunches, more dinners with friends, more holidays.
You're enjoying life.
Yeah, of course, as you should be.
So then when you start to look into these numbers deeper and go, okay, well, if I really need X amount of property to get that net income, then it all starts to, contextualize and go, well, do I really think that's achievable in 10 years? Really, it takes 1 year to buy one property. Finance, the search, settle, get tenants in there, things need to stabilize again.
Yeah.
It's a year, in the reality, 6 months to a year. And then all of a sudden you go, okay, wow, well, I need more time. And then when you start to add in then on top of the net assets you need, you're okay, well, to get that amount of assets, what income do I need to be able to get that, right? And it's a very easy question to ask a broker, because this is what a lot of people are getting stuck on at the moment, is serviceability.
And it's going to be dependent on the point in time, as we're seeing now. 12 to 18 months ago, it was a very different landscape. Interest rates were super low. Now, what have we had? 11 interest rate rises in 12 months. It's a completely different ball game at the moment. So
Exactly.
It's going to depend, if we're talking about in the future, well, we don't know what the interest rates are going to be in 10 years' time, but let's take a conservative approach and let's just say they're 7%.
That's right.
And do your calcs on that.
That's right. And then you've got, what will the banks lend at different times? Debt to income ratios are all counted in that. So this is all the stuff that goes into building out an overarching portfolio. So what we want to educate people on is, like, if you're getting sold this dream, if you're going to be able to generate all this income
And retire in 10 years.
in 10 years time.
When you're starting with zero investment properties,
Exactly.
10 years is just...
almost zero capital to begin with.
Yeah.
Like I said, a relatively, not low income, but an average income.
Yeah.
You need to understand that average incomes and if you're not over the top and this extraordinary person, then you're not going to be able to have, when I say an extraordinary person, I mean your earning capacity.
Yes.
Then you're not going to be able to have explosive growth, right?
Not in 10 years anyway.
portfolio.
It's going to take a good 20 to 30.
Exactly right.
Yeah,
So
and I think it's just about being realistic,
100%.
It can be done, definitely. There's no time like the present to start. I never think it's too late to start investing in property or any type of investing, but it does take time. And like we always say, it's a long term. That's why we're talking. It's a long term goal. Property has to be a long term hold. Or it doesn't have to be, but to achieve this long term wealth and financial freedom, long term goals and is your aim.
That's right. Long term planning, and you. The thing that which both of us have faced in our investing journeys is that serviceability cap, right?
Yes.
And they're the things that really hold people up. So you might buy one property, quickly on your income. You could bang, deposit, bought my first property. That property may have some growth.
And it could have super growth. You might time it so well and you go straight into a boom, and that property, increases by 60% in 2 years, for example. And so you've got all this equity there. So you go to your broker or your bank manager, my property's just gone up 60% in 2 years. How great's that? I can go again. And he says, or she says, no, you can't, because your income hasn't gone up substantially. In fact, your income hasn't changed in 2 years. So you're capped in regards to, you won't be able to service that loan, so I can't lend it to you.
That's right. And that then is what I tell all of the clients and the investors that we work with is there's two focuses, right? You've got the focus on the investment portfolio, but then there's going to be times where you actually can't progress that because you're hitting roadblocks of which are out of your control. And what is in your control is then getting over those roadblocks. So it's like, okay, well, I've hit a serviceability limit. Now my focus needs to be on how do I increase my income? How do I earn more money so I can then put that extra money that I'm earning into more servicing to then buy more property.
And like, Jack, you and I were speaking to a client this week, and, we were explaining that a part of the long-term game, if you like, is a period of waiting. Yes, Properties are, might not be growing at a phenomenal rate at the moment since we've just come off a boom. So for the next, 2 to 3 years might just be a waiting game until your serviceability increases, and that could be via a couple of ways, via incomes increasing, rates coming down, some capital growth happening. But at times, I know over the 30 years I've been investing, at times there's been times that I've just had to wait, and that's okay. That's just all part of it.
Part of the journey, right?
Yeah.
You look at companies or a company's share price, for example, and most share prices over a long period of time are not just in this upward trajectory.
No,
the company is growing, and then they have a period of stabilization, potentially some
decline. But
then,
at the end of the day, you just want strong and steady growth, or slow and steady growth, I should say.
Exactly right. So I guess the important thing which we're covering off here is how critical having the strategy at the start is, and having context around that strategy.
Well, being realistic, not having any dreams of grandeur that it's going to happen in the first 10 years and you're going to have this financial freedom, that you know what you're getting into from the start.
That's right.
And I think if you'd go in with a realistic point of view, knowing this isn't going to happen overnight, it's not going to happen in the first 10 years, but if I follow the plan and I'm patient with the plan and let capital growth do its thing, if you're in a job, work hard, try and get promoted, keep my salary growing. If you're a business owner, keep growing your business. So there'll be times when you're concentrating more on your business or more on your career. You've got one property or two properties over here that are doing their thing. The time will come when all of those things align and you're ready to go again. And, there were periods in my property investing career where I was able to go and buy, I think I bought 4 properties in under 18 months.
And let's talk about that. So what aligned for you? I
found a wife. and suddenly our salaries was double.
That's critical, right? So
it happens. It's a reality.
Yeah, you had some properties.
I had some properties.
And you were probably at a serviceability limit where the banks wouldn't lend you any more money?
I don't know off the top of my head, but probably. I met my now wife. She had a property, a principal place of residence that she was living in. She didn't have any investment properties, but she had been heavily paying off that property, so it was nearly debt free. So she had plenty of equity in it. She works in corporate. She's earning a very good salary. Coupled with, I was working in corporate at the time, so I was on a very good salary. And the time came. We met with a broker. Put our funds together, put our equity together, and he said, how much do you want to borrow? Away you go. And then we just went on a very quick acquisitive stage because we were able to. We didn't worry about where the market was, whether it was at the top of the market or the bottom. I couldn't even tell you whether we were in a boom or not. We were able to purchase, I think, 4 properties, like I said, in under 18 months, very quickly.
Because you had the servicing, you had the capital available, and
then boom, we had to stop because we were capped on all those things, and that's okay. We didn't just waited some more years. A few more years went by, and then we can purchase one more. Where we went again.
And that's about having the long term vision, right? And that doesn't happen in just 10 years.
And your life can change very quickly like that. I went from. It's no secret. I was married. I got divorced. I obviously then had several years by myself. And then at that time, did I know I'm going to meet someone and fall in love and get married again? Who knows? I was just getting on with life and just working. But your life can change like that. You do meet someone, you get married. Suddenly your borrowing capacity is double, triple what it was before.
And all of a sudden you've got a portfolio like Frank Raiti.
Well, I'm sure there's plenty of people with much larger portfolios than me, but for me it was never about hundreds of millions. I've achieved more. Now with my wife, more than I ever thought I would, and it's just about being happy and comfortable. And
that's right. And when you're trying to save 50 cents on a coffee every day, mate, you live frugally, right?
No, it's all right.
which is another critical thing about
you've got to save,
investing, right?
Why pay 50 cents extra for a coffee when the place next door's got a 50 cents cheaper, mate?
The another key element about these portfolios and getting to that area of passive income is you can't live above your means throughout that journey, because that again has an impact on.
This is a big thing in life in general, and it's a whole nother topic. But people living off their credit cards and then paying credit card interest of 18 to 20%, and then that's living beyond your means. I think you have to have the mindset in regards to money in general that you can't live beyond your means. You know, if you can't afford to pay off that credit card on the due date, then you can't afford to purchase whatever it is you're looking to purchase. And for some people, that is coffee and breakfast and things like that. That's
right. You gotta live on the Trent Muffet diet, which is beans
and lentils,
rice and lentils,
and he's healthy for it.
That's right. He's a triathlete. So I think the key elements here about, you know, debunking these myths around retiring early and building huge portfolios is the concept sounds great. The reality is very different. Things you need to consider. What is your overarching end goal? How much income do you think you'll need in retirement? What does that look like on a net basis? Not, I want to earn $60,000 a year, because that's not what you get in your pocket. What does that look like on a net basis? Then look at how many assets do I actually need to buy to be able to get to that net asset value? What is the exit strategy at that point in time? And then all the variables that come during that time. What income do I need to earn? What are my living expenses? What sort of lifestyle do I want to live? Et cetera, et cetera, et cetera.
Yeah.
And then that gives you context, right?
And be prepared that, yes, you can plan out your next 20 to 30 years, but I think one thing you need to get your mindset around is things are going to change. There's going to be roadblocks. You're going to have to stop going up this road, stop, retract, go to the side, come up this street. Things are going to change. Be aware that life is going to throw you curveballs. You don't know what they are. They could be personal. They could be worldwide things. They could be, you know, just restricted to the property market or the financial markets. But there are going to be things that are going to throw you off, you know, off track, so to speak. So, and I think if you go into it knowing that I don't know what these things are, I don't know when they're going to happen, but something's going to happen at some point in time. When it does happen, you're like, okay, well, I knew this was going to happen in regards to, I was told to expect things like this. And then you don't panic and you don't start selling off properties and things like that. You're more able to adapt to whatever those things are.
And then you have a longer vision as well, right? Like obviously, depending on where you are at in your life, you're going to have different amounts of time, but it's being realistic with yourself and going, well, if I've only got 10 years, you know, of my investing career left and I want to retire at 60, you're probably not going to be able to achieve what someone who has 30 years can.
Yeah. So
it's understanding what your timeframes are, what is your overarching end goal, being realistic with that, and then once you're clear on those things, it's being able to execute on those, and that's why we talk about the Flamingo investment strategy, is about executing on buying the right assets in the right locations. Are you going to get long-term consistent capital growth? You're always going to have tenants, and they then fit into the overarching portfolio plan, which if followed correctly, you'll get to your goals.
And I think at the end of the day, you know, don't worry too much about it. You still want to be able to sleep at night. If property investing or any type of investing is keeping you up at night, then you're doing something wrong. So find out what it is that is keeping you up at night and address those concerns. Speak to the relevant people.
The Jack Henderson model. Just keep going.
You obviously have no trouble sleeping.
I have some trouble.
Yes, but it is, you know, about enjoying it and enjoying life, and it has to balance with your personal life and things like that. But by all means, it shouldn't keep you up at night. It may sound difficult, but, you know, speaking to the right people and following the people who have done it before, and, you know, the right advice is the first step, I believe. Couldn't agree more, Frankie. Until next week, great man. Thanks, Jack. Be good or be good at it. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. All right, Frankie. Hello. The Flamingo Property Investing Podcast. We're back for another. Mate, this is the most consistent we've been with our podcast. It is. I don't think it's even been 7 days. And it's good to see you. What you've just got, what's the outfit you got on today? What's that called? Mate, just some casual chinos, you know, some Adidas shoes. It looks like you've just come off the bowling green or the golf course. I don't do either, actually. You look just good. Just the gym, mate, straight out of F45. Straight out of F45. Will you just serve the water there or something? No, or you actually train? I actually train, yeah. Well, today, Frankie, what we're going to talk about in the Flamingo Investment podcast is around the asset selection process we go through
with a Flamingo property, right?
Okay.
We've spoken about it before, like we just said. It's something we've
Yes.
spoken about a lot, and we continue to speak about a lot. But as we know, getting the asset selection right is the thing that can make or break your wealth creation
it's
journey.
crucial. It's crucial. Hence the reason we do speak about it a lot.
And the properties that we buy, we call Flamingo investment properties because they're properties that stand out from the crowd, right? If you think about a flamingo, and I actually saw about 250 flamingos recently on Richard Branson's island.
Wow.
Mate, first time I've seen them.
I've only seen them in the zoo, mate, not
Have
in the
you?
wild.
Yeah,
I saw
well,
some in Vegas, actually.
In Vegas?
Yeah.
What were you doing in Vegas?
Partying.
Could you imagine Frankie partying?
Back in the day, mate.
I could just imagine you on the dance floor, Frankie. Anyway, back to the flamingos. They're very different from most birds.
Yeah.
And Frank, let me tell you, when you see a flamingo in the wild and you see another bird in the wild, they're very different.
Yes.
And that's what we want to do with property. We want to make sure we're buying properties that are very different. Also, fun fact, if anyone has my phone number, you should call me. And I'm going to hang up on you. I was going to go to my answering machine.
Oh, your new voicemail.
Every Sunday, folks, I release a new voice message and it has a flamingo fact for that week.
Oh, wow.
That's right. The one for last
Do you really
week.
want everybody calling you?
No, well, I'm not going to answer. If I don't know your number and you're not
okay.
saved, you go straight to my answering machine. But if you leave a nice message, there's a good chance that I'll call you back. And you'll also find out a fact. Like
Right.
the word flamingo actually originated from the word flamenco, which means fire in Spanish.
Spanish, yes.
Yes,
All right.
that's right.
I heard that one last week when you
There we
didn't
go.
answer my
Have you
call.
heard this week's? Have you heard this
No,
week's?
I haven't. I'll go home tonight and call you about midnight.
Mate, please do. Please do. My phone will be on Do Not Disturb. So, mate, we have three pillars to our Flamingo properties. The pillars we look at when we select all of our assets, regardless of the asset we're selecting or where it is.
Yeah.
Comes down to the location of the asset. As we know, that does 80% of the heavy lifting when it comes to the performance of a property.
Location number one.
That's right. And we break location down into two facets. The macro location being the state and the region that we're buying in. And then the micro location, which is the suburb, the street and the neighborhood that we're buying in. Then we've got the owner-occupier appeal of a property.
Okay. Number two.
That's the second pillar. And the owner-occupier appeal of a property. And the reason we want to go appeal to the owner-occupier buyers is because they make up 70% of the Australian property market in terms of buyers.
Yes.
So if you appeal to an owner-occupier in a marketplace, you're going to be appealing to the majority as opposed to the minority.
Which I don't know if it's a little known fact or not, but there's a lot of people out there who think it's investors who make up the bulk of transactions out there, and like you just said, it's circa 70% of all transactions are actually conducted by owner occupiers, not by investors. So,
That's right. And we want to think with that mentality to win in the marketplace
Yes.
as an investor, like a chameleon, And the last pillar is scarcity or uniqueness. So
Yep.
what makes this property different from all the other properties in the location? So a buyer will want to buy my property more, right? That's what we want. We want someone to be attracted to the property because that's obviously what's going to make the property perform and outperform into the future.
Yeah, well, the more people who want it, the more demand, the higher they can push up the price.
Exactly right. So, Frankie, let's unpack the location element of a Flamingo investment property. Now, we talk about macro location being the state we're investing in and then the region we're investing in. We break regions down into SA3, which is a statistical area 3.
Yep.
You love your SA3s,
Yeah,
Frankie.
it's basically a sub-region as such. So, a good example is the eastern suburbs of Sydney is a region, but then that's actually been broken down further by the Australian Bureau of Statistics to this SA3 level. So there's eastern suburbs north and there's eastern suburbs south.
That's right.
So they've even broken it down further.
The rich people live in the eastern suburbs north, and then
let's not cause arguments. I think if you're living in the eastern suburbs north or south, you're doing quite well.
A lot of disparity, Frank. A lot of disparity.
Investing in that area.
Let me tell you, there's a lot of difference between a property value in Darling Point than there is in Matraville.
Of course.
Both classed as the eastern suburbs.
Yes.
And this is why understanding your regions is so important, because you can say the eastern suburbs is a great area, but I would argue not all of the eastern suburbs.
No, well, like every area, there's pockets of or different suburbs of varying degrees.
I agree. So when we look at locations, one of the first things that we look at is a proven track record of performance.
Yes.
That's one of the first things. Now, I know there's a lot of investors and there's a lot of people who talk about property out there that don't necessarily think that the past indicates the future, and that's totally fine. For us, Frank, I don't know, or our mentality is, I don't know too many people or too many areas that were in fashion for 20 years and then went out of fashion.
That's right.
Not too many areas. And a matter of fact, potentially no areas unless it's somewhere like a Hiroshima because you can't live there anymore. Right? But if we talk about a location, usually a location that is in demand for lifestyle drivers, for good school catchments.
Stays in demand, or the demand gets even greater.
Exactly, because our population grows in time. And as population grows, areas become more densely populated. And when areas become more densely populated, things become more in demand because there is a limited amount of supply. So that's one of our big targets is let's find an area where we can look at 20, 30, 40, 50, ideally as much as possible. So the most established areas are where we're going to find the most data. The most data we can find and see consistent performance, because that gives us confidence that the future will likely be as good or better than the past.
Yes,
that's our first thing. So we go, tick, we've got a proven track record of performance. Now, that's just not enough for a proven track record, because then we want to understand the demographic inside of that location. How much do these people earn? And we just compare that to the median income.
Yep.
What do they earn? Then what do they do to earn that money? What is the sectors that they work inside of, right?
Yeah.
Because if you just track median incomes, mining areas are going to look exceptional because people earn very strong incomes in mining areas, right? But unfortunately, that's made up of one sector.
Yeah.
And that is mining. And when something is reliant on one thing, that becomes vulnerable.
Yes.
So we're looking at a proven track record. We're looking at strong incomes. We're looking at an imbalance between supply and demand. The inventory levels. You track inventory. You love that data, Frankie.
Yeah.
How do we look at inventory overall, and what do those numbers mean?
Well, the inventory is that relationship between supply and demand. Now, it doesn't necessarily mean that, when we say there's low inventory, it doesn't mean that there is just simply no stock on the market. What it means is that, there could be plenty of stock on the market. There could be 100, let's talk houses, right, as opposed to units. There could be 100 houses in a particular region on the market. And those 100 could be purchased within, say, 1.5 months.
That's right.
Or you could have a combination of, so we would say that's a very low inventory level.
That's right. So we're tracking average days on market.
Yeah.
How many properties come to market? Then how long do those properties stay on the market for? And if there was not another property to come to market from today, how long would it take to sell all the properties currently on market?
So it's not necessarily about, there is just little stock on the market. There's a lot of stock, but it's going super quick.
That's right.
So that still is classified of what we call as low inventory. On the other hand, you could have, like we are in a situation now, where across the country, we do have literally low number of listings, and hence inventory is very low because whatever is coming onto the market, demand is still pretty, demand is exceeding supply. I wouldn't say demand is super high, but it's still high enough that it's exceeding the supply of listings coming onto the market. So that's also keeping inventory levels low as well.
That's right. And we're not just tracking inventory in a micro period of time or a small period of time. We're tracking inventory over long periods of time. Because if you've had a consistent theme of low inventory, that means there's consistent demand regardless of market conditions. And the theme that you'll get from Frank and I with our Flamingo investment strategy is we're looking for consistency, not inconsistent. We're looking for things that happen all the time and things just tick along and we always get performance. So they're probably the three big tillers. We're looking at proven track record of performance from a growth perspective. We're looking for strong median incomes, and those people have an income that's diverse from a diverse range of sectors. And we're looking for inventory levels where we can see consistently there's been an imbalance between supply and demand. Yeah,
so and just to add to that, Jack. So those low inventory levels, if they remain consistently low, and by low we mean under 2 to 3 months, then what that is doing is putting upward pressure on prices.
That's right.
So that you're continually having growth occurring in those properties in
the
those
marketplace.
Regions. Yeah,
that's right. So we go that's high level macro location, and then we've got, okay, this looks like a great area, and then we go into the micro location. And a really good example of micro location is what Frank and I were just talking about with the eastern suburbs. We've got the eastern suburbs north and the eastern suburbs south. Both the eastern suburbs, both classed as micro regions. The difference between a performance in a property in Wallara, for example, and Matraville, very different.
Very different,
Very different price points, very different demographic of buyer, very different availability of land. Still the eastern suburbs though. So that's why it's very important not just to generalize and say, okay, well, it's great that I invest in Brisbane.
That's right,
Or
of
it's
course.
great that I invest in Newcastle, or it's great that I invest in Adelaide. Where are you investing in these locations? Because there's a significant amount of difference. I mean, if you would have bought a house in give me a region, Frankie, and I'll tell you an example.
A region.
Give me a region.
Let's talk about the Leichhardt region.
Leichhardt. So if you would have
Which is a
bought,
very small region. I think it's only made up of 6 suburbs, and it's Leichhardt, Balmain,
and it's
Annandale.
classed as the inner west.
Yeah.
So the difference between buying something in, say, one of the best streets in Erskineville, or a property in Dulwich Hill, for example, or Summerhill, probably a slight difference in performance and a slight difference in price growth. And as time goes on, that difference is going to become greater and greater. You look at Balmain and Dulwich Hill, for example. That's why Balmain's median house price continues to soar. Yeah. And there's houses in that suburb worth 10, 15, 20 million dollars, and there's not houses like that inside of Dulwich Hill. That's just one example. You look at any different region in the country and you're going to have that. So we need to make sure that we understand it on a micro level. What are the best suburbs inside of the region? And then inside of those suburbs, what are the best streets? What are the best neighborhoods? Like in lots of affluent suburbs, you have east and west sides of the suburb. You have like north of the railway or south. There's all these little...
there's a main road dividing the suburb.
Yeah, and that's human behavior. That's human psychology. It's bizarre as to why this happens, but that's what happens. So it's about understanding the nuances of all of these different locations that you're investing into. Because if you get it wrong, you can have an asset that underperforms, but if you get it right, you can have an asset that will continue to outperform.
Like you mentioned Balmain before, and like you said, you could buy a house in Balmain, but depending in which pocket you're buying, there could be, up to 5% per annum of differential in capital growth, which, over 10 years would be millions
and millions of dollars.
Over 20 or 30 years would be,
that's right.
even more.
Significant. So that's how we go about it. It's like, okay, well, we've got the macro location down pat because we've got high level data that gives us an understanding. But then when you go into micro location of a suburb, you need to understand all the different nuances and intricacies of a location. So where are the cafes? Where are the streets people want to live on? What style of houses are on these streets, and why do people like them? All these little 1%ers.
School catchment zones.
School catchment is a huge difference. You could be on the same suburb and on one street, and then the next street over, there can be hundreds of thousands of dollars worth of difference.
Draw the line somewhere, don't they?
That's right, because you're not in the catchment. It's crazy. So all of these things are things we have to consider. So that's our location pillar. That's where we start. So we go, bang, we've got the location, we've got the micro location. Now it's about understanding, okay, well, when we're inside of these locations and we want to think like an owner-occupier, what do owner-occupier buyers want in their properties? And the reason we target the owner-occupier buyers is because these are the buyers that buy regardless of the market conditions. They're not worried about interest rates. They're not worried about, what's happening in 12 months' time.
And they're buying primarily on emotion, not on
because the interest rates
figures.
don't change what school their kids go to, for example. The interest rates don't change that they want to be close to the water. The interest rates don't change that, they want to be close or walking distance to their favorite park and cafes, right? They're buying these for lifestyle decisions. They're usually making the decision on a long time horizon because they're going, who cares if I have to pay a couple of $100,000? I'm going to be here for 15 years.
That's right. Well, the kids go through school, for example.
And the other thing is when you buy in a location and think like an owner-occupier, owner-occupiers are known for buying and living in their houses, and Australians are living in their houses longer than they ever have, which also then puts bigger constriction on supply.
They're tightly held.
That's right.
Which tightly held suburbs, for example.
Which then increases prices. So we get in the mindset, we're an investor, but we want to think like an owner-occupier. And if we can think like an owner-occupier and buy a property which will appeal to these people, we'll always have a strong buyer demand. The comparable sales of that property, which the bank will use to value our property when we're trying to refinance and release equity, they'll be compared to all the other owner-occupiers which continue to buy and push prices. So we're getting the uplift just based on the fact that our property is similar to what owner-occupiers buy. And we're going to obviously appeal to 70% of the buyers in the marketplace as opposed to to 30%.
And I think what's important there as well is that, you know, during boom times, anything will sell. You know, you see the house on the main road, you know, will sell super quick, right? Now, it's that house on the main road that doesn't appeal to owner-occupiers that will sit there when the market is down.
Well, because they have more time, right? They don't have to make irrational decisions.
True. But it's also not as appealing to owner-occupiers.
That's exactly right, yeah.
Whereas, you know, when the time is, when the market is down or flat, you know, good properties that have this owner-occupier appeal will still sell. So you know, they're still in demand,
and they will usually sell. That's why you're still seeing in the last 12 months, you know, it's a very, very uncertain time, but you're still seeing record prices for houses in certain suburbs. Because when a house comes up that hasn't come up for 20 years and someone wants to be in that street, they want to have the north facing rear, they want to have the level lawn, they want to be on that, you know, premium address, they will pay what they need to pay to get into it. Because even though, you know, regardless of you know, economic times, when the macro environment might be shithouse, there is still people doing extremely well when times are not good. And you know, the prime example was a house that recently sold in Bronte, set the records of it just under $30 million. You'd think, wow, why are people spending that sort of money on a house right now? And there's, you know, the US is about to, you know, exceed their debt ceiling, or they already have.
Yeah, but this is, you know, this is where the headlines and the media can be a bit misleading, because these are macro events, you know, or they might say the Sydney property market in general is flat or declining. But everyone's personal situation
is different.
Not only financial situation, but just personal situation on where, you know, the kids are about to go to school, or they're leaving school, or, you know, people are where they are in their careers. And obviously the financial situation as well is very personal, and therefore they will act independently, and they will act on the micro level of what's important to them and their family, not what's going on in the whole Sydney property market, because they're not buying the whole Sydney property market.
And it's happening everywhere. You go to Brisbane, you know, the Brisbane record was just set 20,500,000. You know, the guys at Greyer who do incredible builds, very inspiring to me, just built a property in an area with a median house price of $3.5 million. The property was for sale for 7 days, sold for $10 million. Never lived in. The reason these are selling for that money is because they do not come up.
No, and they are very rare and extreme cases, if you like.
But that's what we want to emulate. Even though we're not talking about these dollars when we're looking at properties, you know, our average purchase price for an investor over the last sort of 12 months has been mid 800,000s.
Yeah.
But we want to emulate what is happening at that end of the marketplace.
That's
right.
Yeah, the figures are somewhat irrelevant.
That's right. So it's the owner-occupier appeal of a property. And again, this is about understanding the nuances of the location you're investing in. If we're investing in one of the great suburbs in Brisbane, you know, north side or south side, within sort of 10 to 15 Ks of the CBD, people, or the owner-occupier buyer in that market, wants a character-style home. They want a level lawn. They want a north-facing rear. They want a Queenslander style of property.
A large block.
All of these things. That's what an owner-occupier wants there.
Street, yeah.
You pick that, you know, same mentality up and drop it in Newcastle, for example. They want something different. They want a different style of home. They want to, you know, they want to be close to different things. You pick that up and then take that same owner-occupier buyer to Adelaide, to Sydney. It's always about the market that you're investing into. So the great thing about the Flamingo investment strategy is it's about understanding the fundamentals and then just implementing them into the marketplace in which you're investing into.
Of course, yes.
So that's the important part. What you just have to think to yourself, what do owner-occupier buyers want most in my market? And the best place to get that information from is to go and speak to a local agent. What are the record sales in the area? Why have they sold for that? What was it about this property that made it so competitive?
What was it about this street? What was it about this pocket of streets?
And that's it. You find the information and just make sure you can try and tick as many of those boxes as you possibly can. And that then leads us on to our last pillar, being the scarcity pillar. And again, you look at our strategy, it's got 3 pillars to it, and you think it's probably, and Chris Gray says this, it's probably too simple for smart people. You know, because everyone's trying to reinvent the wheel. Let's track this metric. Let's look at this data
Everyone's
point.
always looking for the new and.
But this is tried and tested. This is
not get rich quick scheme, but the new shortcut, so to speak. But,
that's right.
You know, these are tried and tested principles.
This exact principle is the reason that there is $130 million homes that are, you know, selling in Point Piper. It's because that's it. The location, best suburb in Australia, best street in Australia, owner occupier appeal. Who bought it? Not Mike Canberra, but Scott Farquhar. Owner occupier, big block of land, views. Properties like this never come up. They come up What do I have to pay to buy it?
Yeah.
And the scarcity element, which is what we're on right now. So you've got the fundamentals that owner-occupiers want. What are the non-negotiables that they want? 3 bedrooms, character style home, blah, blah, blah. Now, what are the things they pay a premium for? What are the things that they...
Views.
That's right. All of these things, right?
What's the saying? What price of view?
In certain suburbs, it is views. In certain suburbs, it's streets. On certain suburbs, it's north or south of the rail line, for example, walking distance to... All of these little 1%ers are things that then owner-occupiers will just get super emotional about and pay an emotional price for. You actually can't put a dollar value on that.
No, there's... A view is a classic one. It always cracks me up because, that saying, like I just said, what price of view? Nobody can put a price on it. The price is what someone is willing to pay for that Harbour Bridge view,
perception.
For example.
That's right. You think of things like what's the average block size in the area? 450 odd square meters. What do people pay for 600 or 700 square meter blocks, right? Because there's not many of them around. If there's an area where there's a certain style of home where there's very few of them anymore, like a post-war home, for example, or a Federation style property, Edwardian, there isn't many of these properties around anymore. They don't build them anymore. They're from a certain era in time. What will someone pay for
favourites,
that?
Art Decos.
That's right. So all of these little elements that make something more scarce. And again, in every location, it's different. You look at the eastern suburbs, you wouldn't think it, but parking, parking is a scarce thing, right? Not every property has parking. So when you have it, people will add hundreds of thousands or sometimes millions of dollars to a property value.
Another great saying, what price for a for an off-street parking spot or a lock-up garage?
So if you follow those 3 key fundamentals, you will get a property that stands out from the crowd.
Yeah, and like you said, it's about then the principles are the same. It's then about applying it to, like you said, whether you're in Adelaide, Perth, Brisbane, or Hobart.
Right. The location you're investing into. Yeah. That's the thing that it needs to be tailored to.
Tailored, that was the word I was looking for.
Mate, we're all about tailoring things here at Henderson.
That's right.
So that's it. You think about what's a property that stands out, and it's so simple. It's so simple. Look at an area that has a proven track record of performance. There isn't heaps of them, so you can eliminate a lot of areas. If an area is new, for example, up and coming, it's not going to have a track record. For us, it doesn't count.
That's right.
Sayonara. Owner-occupiers, what do they want? How do I think? Bang, do your research. Speak to agents. Go and have a look at open for inspections. Why do some properties have 10 buyers through them and some properties have 150 buyers through them and sell within 3 days?
Yeah.
And then
the natural light aspect, that's a major
Huge.
one. Like you said, the north-facing rear. That's great if your entertaining area, living area is at the back. I sometimes look at houses or units and I'm like, okay, the bedrooms, the agent will sometimes say, well, the bedrooms are north-facing. I'm like, well, I'm not in the bedrooms during the day. I want my living room and lounge room or dining area to be north-facing. Bedrooms can be south-facing or, ideally east-facing. So things like that.
Exactly.
And things like that can be very applicable to the house itself. Like we look at a lot of properties in Newcastle where, obviously older properties where the living and lounge areas are at the front of the house.
Disjointed floor plans.
Yeah. Now, a lot of these floor plans, people are planning just to move in, don't have the money to renovate immediately and may want to live in the house as it is and have no plans of renovating, and a lot of these houses don't. So if it's north facing to the front, and you are going to buy that house as an owner-occupier and are happy to keep it as it is, then that's a tick in the box.
Exactly right. Frankie, I reckon that wraps up a very, very good summary.
Very concise, very
You follow those 3 fundamental pillars on every property selection and purchase that you do, and you will be sure to be buying a property that will outperform the market. And that's the thing. It's very easy to track this. You look at what the marketplace does as a whole. What's the median growth or the average growth for that suburb, and then we track our individual properties, like some high level data which I collated the other day. Average purchase price over the last 12 months of $845,000 at an average deposit of 20%, which is say $170,000 thereabouts. The return on the Australian property market went back 2% last year on the whole. Our return was just under 15% on the properties, or 100% return on our equity. So we put in 170, we got 340 worth of growth.
Yeah.
And that's the difference when you buy a Flamingo property to the average punter.
Very good.
See you next week, Frankie.
Cheers, Jack.
Be good to your mother. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Frankie! Mate, we're back.
We're back.
You look good.
Another week.
Have you been training?
Yeah.
What are you
doing the
doing?
push-up challenge, mate.
What have you been doing?
We're doing the push-up challenge for mental health.
Are you?
Everybody should get on board, yeah? F45 Glades.
How many push-ups are you aiming for a day?
Mate, you got to do about 100 or so.
100 a day?
Yeah.
For how many days?
Well, we do it during the session, so it's even harder.
Yeah, right.
23 odd days.
It's virtually what you're almost at that age, aren't you? So you do one push-up for every year you've been around.
Nearly two.
You're almost 100, are you?
No, mate, no. I don't know if I'll get to 100.
Doing what I do and continuing to work, mate, it helps with what we're going to talk about today, which is increasing your income so you can continue to invest in property.
Okay.
Now, having the best strategy, there's Mr. Perry just there, he's popped in. Having the best strategy, which is the strategy we talk about, the Flamingo investment strategy, is great. Buying the best assets is great. Buying in the best locations is great. But one of the things that will restrict any property investor is not having the income to continue to sustain building a portfolio.
Sure.
Because if you don't grow your income, unfortunately, the banks are not going to lend you any money. And if the banks don't lend you any money...
No, you want to keep borrowing money from the banks. They want to ensure that you can pay it back
Exactly.
eventually.
Exactly.
Or at least be able to, not necessarily pay it back, but keep making the repayments while you hold the property and allow for it to grow. So that one day you will sell it and pay it back to them.
Exactly. And even though you might feel like you can make repayments, the bank, has this beautiful thing they call serviceability, which is the way that they calculate whether you can make repayments under stress tested levels. And that's very important because...
Well, look what we've just gone through.
Exactly right.
In the last 13 months, 12 interest rate rises. That I think that's even broken some of the banks and ASIC's stress testing there, where they
we're in uncharted waters.
We
at the
are
moment.
because they put out a buffer of 3%,
2.5 to 3%.
and what's the rate's gone up 4% now, right? Yeah, they were at 0.1 and they're at 4.1 now.
That's right.
So, we're up exactly 4%.
So we're in uncharted waters.
1%
Frankie,
over the buffer,
which is very interesting. So the unspoken truth in any form of investing and any form of growing wealth is someone's ability to continue to earn an income, and hopefully an income which will be ever increasing as opposed to capped.
Yes, and this may obviously, and we'll probably delve into this. This will, slow down your property investing journey. Hence the reason we spoke about last week that you can't go from 0 to 10 million in 10 years, so to speak.
Unless you've got an incredible income to support that debt,
or come into some money, win the lottery or something. But, most people, if they're, a corporate or not even corporate, whatever career they're in, could be a tradie, have their own business. The income is unlikely to, let's say, double in 10 years. Actually, I saw something the other day or read something where people's wages had gone up like 27% in, let's just say, 10 years, but properties had gone up 127%.
Exactly.
So, the wages aren't keeping up with inflation in a way, but, with property growth over the long term. So,
and that's why the banks are allowing us to borrow more money than they ever have, right? Because if they didn't and they kept the same restrictions when property prices were 300 grand, then we'd still be only be able to spend 300 grand. So something that we always have to think about is whenever if we're talking about meaning the person listening, increase my income or have the capacity to earn more income, that's a perfect time to think about then scaling the portfolio, because getting from 0 to 1 properties is probably the easiest.
Yeah.
Saving the deposit's very hard.
The saving of the deposit's the hardest, obviously, but
getting the money is easy, right? Because you've essentially got no liabilities.
Yeah, you're
debt. About to get your biggest liability being even though it is an asset you're buying, the debt is a liability. But getting from that level to the next level is usually hard, and usually that comes when people potentially find a partner.
Yep.
They then go to two
As
incomes.
A way of doubling your income overnight.
Increases, or in your case, Frankie, potentially quadrupling your income. Then we have the more capacity. We go and buy another property. Right now, for example, if people are borrowing money in today's environment, being a 4-ish% cash rate,
yep.
If the interest rate went from 4% to say 2% cash rate, then all of a sudden that's freeing up capacity. So even though you might be earning the same income, we've gone down 2 percentage points, and all of a sudden now we're freeing up our capacity.
So interest rates, obviously, you know, are a big part of this. They do take a lot of well, they're a major factor in your affordability of servicing, and hence the reason we've seen with these last 12 interest rate rises, people's affordability or, you know, servicing levels have dropped dramatically.
So as investors, Frankie, we really need to be thinking about, like I said, not just how to grow the portfolio and what to buy, but then all the little things that are going to add to that, right? So if we look at your own journey, 30 years of investing, I'm assuming what you were earning at 18 years old is probably slightly different to what you were earning at 40 years old, right?
Oh, very much, mate. From 17,000 to a lot more than that.
So you at 18, you were earning 17,000, and then I think at 40 you were on the dole, weren't you?
You're probably earning $17,000 now. It's gone full circle. Yes, but as you mentioned, like, you know, I was earning 17,000, so I could only afford what I could afford, which at the time was a $83,000 two-bedroom unit. But, you know, throughout my career, I obviously progressed. At times you change jobs, you know, you know, they always say you're not going to go to the next job for less. So sometimes you get a bump in your income like that. You get promoted. There's another bump in your income and your salary.
Your debt, you're probably reducing some debt over that time.
Yeah, reducing some debt, although, you know, most of my loans were interest only, but saving, you know, saving hard along the way. So it is, you know, a big part of it is in regards to helping with affordability and serviceability is how you live your life, and, you know, not going it out and blowing it on cars and boats. I mean, that's great if you want to do that, but not if you want to grow your property portfolio pretty quickly. So by all means, it's all part and parcel of it.
Exactly.
But it doesn't happen quickly.
And then over that 30-year journey, when you hit your serviceability limits, then there would have been, you know, years where you probably didn't buy property for 2 or 3 or 4 years, right? Because you were, you know, going through the motions and potentially getting those raises or potentially decreasing some debt. Potentially getting a partner, for example, where you might be in a relationship and not wanting to join incomes for the first, you know, 3 or 4 years. You've been through one divorce.
Yeah, well, not until you get married. No, but you make a good point. You know, part of the journey or the long-term investing plan is sometimes just being patient and not doing anything. And by that we mean, you know, you're capped out. You know, your broker, your bank manager has said, can't lend you anymore. You're going to have to wait till capital growth does its thing. So you might have to wait 2 to 3 to 4 to 5 years, depending on where we are in the growth cycle and where your properties are investing. You know, obviously, you know, the Sydney growth cycle is different to the Perth growth cycle, which is different,
non-existent,
which is different to the Adelaide or Victorian growth cycle. So you might have to just sometimes wait, you know, and during that time, you know, I took the opportunity to save hard. So I'm like, okay, I've got to wait for my properties to grow in value. I'm also going to compound that, if you like, by saving hard. Then
we'd always say put that saving in an offset account.
Yes, so back then there wasn't offset accounts, but now definitely in offset accounts.
Your offset account was just a nice brown paper bag that you put under your bed, wasn't it?
No, I didn't save any money.
No cash
under the bed, but definitely, you know, compounding it by saving hard, getting revaluations annually on my property. So when I saw some substantial growth there. Then going, you know, just touching base with the broker every 12 months or so and saying, how am I positioned now?
And that's what's really important. So, you know, what a lot of people would have learnt, especially people who are avid investors and wanting to continue to grow their portfolio, is, you know, you might have been trying to time the market recently with all the news coming out that the market was going to drop. But what we didn't factor into our little mental capacity there was, yeah, sure, the prices might come off, but my capacity is going to drop, right? Exactly. So all of a sudden, interest rates are 0.1%. We're adding a 3% buffer to that. So you're calculating at 3%. You know, you would have had a huge amount of serviceability potentially. Prices were probably, you know, slightly higher than what they may be right now. But all of a sudden you've waited. You've lost that serviceability because rates have gone up. You're earning the same amount of money, but with a quarter of the capacity. And now you can't actually buy. Yeah. So, you know, I think increasing your income is one thing, but then always assessing your position is number 2, right? Because if rates now drop by a few percent over the next couple of years, just by doing nothing, your capacity increases because the rates are lower and what the banks assess you at is lower. Yes. So you might have the same income, you might have, you know, an amount of equity, but then all of a sudden, just with the rates coming down, you've increased capacity and then you can go and buy again. So I think it's, you know, constantly being on top of where you're at in the journey. Every 6 months, like you said, speak with your broker, get your properties revalued. It doesn't cost you anything. And just look at where you're at. And, you know, it's a conversation to have to go, okay, well, if I wanted to go buy another $500,000 asset or another $1 million asset, what would my income need to be on the current rate? You can have these conversations with your broker.
Of course, and with that, you might say that might give you the motivation to go out and get a second job. You know, do something. Okay, well, if I need to add another 30 grand to my income, what can I do to get there? Maybe I'm going to go and get a second job at nights, on the weekend, you know.
Exactly. And the reality
Whatever
is,
it is, depends
adding
how motivated
30
you
grand to your income, you don't actually have to add the $30,000 to your bank. You have to add $30,000 of annual recurring income, which is just by getting a job, right?
Yeah.
So you could go get a second job. This is not advice. This is just a hypothetical. You could go and get a second job where you might do that for 3 months. Get the property,
pay slips.
You know, get the property, get the pay slips, and then go, okay, well, I can afford this on my current income. Just because the bank said I couldn't doesn't mean I can't.
Well, that's true, yeah.
And then you don't necessarily need that job.
Need the second job, yeah. It's all about, as long as you can keep making the repayments, the bank's not going to come in and check in with you, how you're going with that second job, are you still doing that? You just got to keep making the repayments, like you said. And if, you know, you can afford to do that with only one job, so be it. I mean, the second job is always good just to...
Or you might, Frankie, you might be a single lady or a
buffer.
single bloke, and you might go, I've hit my capacity. So, you know, you might spend a couple of bucks and get down to the sheaf in Double Bay and just try and pick yourself up a high income earner, you know, and double your capacity overnight. So...
It's all possible.
Mate, everything's possible. Where did you pick yours up from? Your high income earning wife.
Oh, I met my wife online, actually.
Did you?
Yes, one of the reputable websites, I must say.
What's it, Grindr?
No. I'm not familiar with that one, mate. you might have to tell me about it. No, RSVP, actually.
Oh,
yeah,
very good. And you actually, you had your filters in of $500,000 a year income.
No,
tip,
there was no filters on salary, mate. My wife is very hardworking.
That's a debatable topic. You know, you should be able to filter, but not only, you know, the sex that you'd like to, you know, talk to, you know, the looks, what they do for sporting, but also how much they earn. This is a very important thing.
You'll be very popular if you put your property portfolio value up there, mate.
Apparently so. Yeah, apparently so.
Anyway, we digress.
We digress, but it's always a good laugh. So that's the thing, is increasing the income, assessing your situation at all points in the journey. You know, if I reflect back on my own investing journey, you know, I was on the income in the construction industry. That was because I just started in the construction industry. The first sort of 3 to 5 years of that, my income went from, you know, the 70 to 80 grand, then to 100 grand, then from 100 to 120.
Yeah. So you would have got capped at some stage before you opened this business?
When I bought the third property, that was me then sort of capped.
Right.
On the income that I was earning in the construction industry.
And interest rates were at record lows then too.
Yeah, so when I bought my first, the actual rates, like the bank rates, were about 5%. I remember, and then they were coming down, right? So that was the combination. It was lowering interest rates, which was freeing up capacity, rising income, so that capacity gap was just growing, and then I was able to buy.
Yeah, the perfect storm, so they say.
Yeah, exactly. And then it's also the lending, right? Because I went to ANZ first, bang, got the first property. Went to ANZ second, bang, got the second property.
Yeah, they cross-collateralized you.
Yeah, that's right. The bastards. Went back to ANZ for the third property. They said no shebang. Their serviceability calculator didn't work.
Yeah.
Went to a broker before. I just went directly to the bank for my first two. Went to a broker for number 3. He said, yep, you got to bang, get out of there. Ended up getting the third property through Liberty, which is a non-bank lender.
Yeah.
Different serviceability calculations. So they, you know, were more favorable for me. And then, same thing, bang, I hit a two-year window where I couldn't buy any property.
And you make a good point there, which is probably something we'll talk about in a future podcast episode of, you know, you said you went to ANZ, was it, for your first 3, and then they said no more. Now, this is quite common that, you know, people say, well, once one bank or financial institution, you know, maxes you out, but you can always go to possibly another. And although you have to disclose the loans you have and the properties you own and say, look, they're mortgaged by ANZ, another bank may still lend you money because they've got no exposure or risk to you, whereas ANZ, you know, probably doesn't want to lend you too much, as an example.
That's right. And you know, gone are the days, you know, I remember Chris Gray's a person we both know. Like I remember them when they used to talk about finance, like because they didn't have technology back in the day, ANZ wouldn't necessarily know the debt that you had with NAB, and they wouldn't know the debt that you had.
But now they all know.
Well, there's the all of the technology that's out there now, and the responsible lending. Like
It's
every
all
bank
shared.
knows
The
everything.
information is shared. Yeah.
No,
So
gone are the days now where you could hide, some lending at this bank and hide some lending at this
and
non-bank.
I'm spread across 2 banks. All my lending's with HSBC and NAB. So yeah,
Now I'm spread across. I'm with Judo. I'm with CBA. I'm with Westpac. I'm with Rams. I'm with Bank West. So I've got 5 different lenders.
Yeah. So what we're trying to say is, like with me, HSBC and NAB, as a client to NAB, I don't. My whole portfolio, so to speak, is not at risk with to them.
That's right.
I'm a lower risk to them, even though they know I have loans with HSBC. They say, well, we've lent Frank X amount. That's all we have to worry about, and we've got security over those properties. Yes, we know he's got other lending with HSBC, which we take into account because of servicing. We need to ensure he's going to pay back our loans.
But they just see all the commas in your bank account and they go, "Oh, this bloke's okay."
I wish, mate. I wish.
So I think again we digress, Frank. We're digressing a lot in this podcast.
Mate,
We've got a lot to talk about.
Day.
Maybe you only just got up a couple of hours ago, didn't you? So we not only assessing our serviceability. Back to what I was talking about is I went that 2-year period where I couldn't buy anything.
There you go.
Because I hit the serviceability limit. No bank would look at me, and during that time, that's when I went. Okay, I've hit with my current income. If I project into the future, how much can I earn? Maybe another 30 or 40 grand. How much debt would 30 or 40 grand get me at a 5 or 6 time debt to income ratio? 300 or 400 grand.
Yeah.
Not going to get me very far. So that was actually one of the things that I did. It was like, let's max my servicing on my current income. And then let's transition out of my income that I'm earning here and start the business.
Yeah.
And then, when I started earning the income with the business, naturally there's a grace period where they want to see financials.
Of course, yeah.
But then that opened up a lot more lending to me. And then, another thing that people can look at while also trying to increase their income, while also being active on knowing when there's opportunity, when they can buy, when they've got serviceability gaps there, but then also being strategic with, structuring. I think for a more sophisticated investor, using vehicles like trusts and companies to hold assets inside of them, having a good broker on your team to then go, okay, well, this lender won't look at the debt that's in this asset if it's self-servicing and it's not costing you any money to hold.
Right.
So then you can start potentially
you
having
can
some debt in assets.
Creative, as they say.
That's right. I mean, you still have to have the income to be able to support these properties if they don't have tenants, right?
Yeah.
So you still need to earn money. You still need to earn a lot of money if you're getting more and more debt. But it just is a more creative way to continue to grow. Because some people can be on $300,000, $400,000, $500,000 a year, $1 million a year, and still hit serviceability limits.
Of course.
But the serviceability limits really aren't realistic. They could be on $1 million a year. They could have $400,000 of surplus income a year, and the bank goes, no, sorry, we're not going to be lending you any more money. When the reality is, you've got all this income that you could be carrying all these.
And like we were saying, especially if that's all with one bank, and you say, I want to be loyal to that bank, to ANZ, for example. At some stage, someone's going to go, we've lent out, $5 million to this person, although they have the equity and meet the affordability criteria, it doesn't tick their internal box of individual loan exposure to the one person.
That's right. Exactly right.
Yeah.
So that's obviously when you need to have a good broker on your side, and you probably need to better understand the finance world and how that works. But I guess in summary for this episode, mate, and we'll wrap up now because I'm very tired and I've got to go and eat a nice big 1 kilo steak in Surrey Hills, is don't just get obsessed with the kind of properties you're buying and where you're buying those properties. Become obsessed with also the financing side of things and how you can continue to invest along your journey. And if you build out a portfolio plan like we do for our clients, we can very much predict when you're going to be able to buy and when you're not going to be able to buy, based on all those variables that come into it. So then we know, like if we got the third property, all right, guys, the reality is for 2 or 3 more years, probably not going to be able to buy. So let's worry about hammering down some of this debt. Let's worry about increasing our income. Let's worry about maybe getting some other income generating assets like shares, etc., to put some more cash flow onto the balance sheet or onto the P&Ls. And then we can buy the
Yeah,
next
because I think
property.
what a lot of people talk about is obviously buying a property, capital growth, you'll get great equity, and yes, that's true. But you can only utilize that equity if you have the income to support,
Be able to do it.
to support the borrowing. Otherwise, that equity will it's great because hopefully one day your income producing capacity will increase rapidly. Then you can go, great. I've already ticked the equity side of the equation. I've just been waiting for the income side to catch up. It now has. Now I can go out and you could possibly go out and buy a couple.
Exactly.
All right, Jack.
Always a pleasure.
Very good.
Mate, don't get lost on the way home. You
No,
are in
it's dark.
Paddington. It's not very far to Drummoyne, all right?
It's dark.
See you, mate.
See you, bye.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Flamingo Property Investing Podcast, joined by a very special guest. He's travelled far and wide to be here today. Ryan King, Three Kings Wealth Management. Hey, welcome to the podcast.
Thanks, mate.
First official guest on the Flamingo Investment Podcast.
Look out, let's go.
I know, mate. We're going to chat through a lot today. We support each other's clients and in each other's businesses. And I think, property and the wealth management side of all different assets inside of that banner, not just property, is something that I very rarely talk about. So, mate, it's going to be interesting to hear your perspective and how your clients don't just use property, but all the other asset classes to build.
We're trying to get too controversial, eh?
Yeah, that's right, mate. I reckon we unpack it. Let's go deep. Mate, before we go into your expertise and what you're best at, let's chat through your background first, give some context to what's brought us to be sitting here today, and then we'll unpack all the exciting stuff.
Yeah, sweet. So, like I said, I told Jake not to actually mention that because I go through this a bit. So, quick background. I guess I'm a kid from the West. I grew up between early on out west at Mount Druitt. My old boy's family's from Mount Druitt, but mum and dad split up, and she moved up to the Central Coast, which I've just recently moved back to raise my own family. But I spent my time between the two. So, I guess growing up, I came from a good family, but I didn't come from money at all. I always had everything I sort of need in the way of hand-me-downs and that kind of stuff. But I got to experience, I guess, the pros and cons of not having money, I guess, and what that sort of looks like. And I grew up my own way, did my own thing. You can watch on other podcasts going into a bit more depth of some not so favourable activities I got involved in. Joined the military. I was a pretty fit fella and wanted to get amongst that. It's a bit of family tradition. So I joined the military. And at this time I was, before that I was making money doing like traffic control and I had money and I was just like everyone else. I was just, an ego kid wanting to make money, thought money was the answer to everything. Joined the army. You don't make a lot of money in the army, but still was spending and had no idea. And I got injured in 2014, I think, maybe 15. Not bad, but I discharged to try and rehab. Wanted to open a gym, and I started selling insurance to make money. I had all these people tell me how much money they're making selling insurances. They're full of shit. So they're making nothing. And I started, and I had this driven purpose to open this gym. And in 3 months, I was the number one sales rep in Australia, and I was making stupid amounts of money I'd never seen before.
Just selling gym memberships,
No,
essentially?
insurance.
Yeah,
so I was
right.
selling insurance to put money in the bank to buy this gym.
Yeah, okay.
And the gym's still around. I didn't end up buying in, but it was actually them, and I was one of the first potential investors of F45, which is a bit controversial. So I had Rob Deutsch when he was still involved, and Dan Conn fly up to Townsville, and I was brokering deals for them, and got them in touch with actually an American who I think ended up getting in touch with Mark Wahlberg as well. So got them in that sort of market as well. Had some heavy involvement there. But anyway, I made lots of money in the first 3 months, and by the time it came to the point I had money for the gym, they pretty much said I was making about $250 a year. Like on that point, I never made anything close to that, and I was going to make $45 a year as a gym owner. And I was like, they said, "You ready to go?" And I was like, "Nah, jam it. Let's go." And funny thing is, looking back in hindsight, the moment that goal went out the window, I'd made no money. didn't have a purpose, a drive. I was making normal money, not that kind of money.
So the driver to make the money was to get into the gym, and then when you realised that you didn't want to go into the gym and you wanted to keep the money,
I thought just making money was the thing, and it wasn't enough. It just wasn't. This didn't click till when I was doing what I was doing now. But
it was just before this podcast it clicked.
yeah, just right then. But I kept trying my hand at it. But what did happen was I started. I was saying to you off air before that why did I start there? That was the reason I started it. But what ended up happening, I wanted to stay down that route, and I had to do this study, and it's not published. It's not not a doctor. My future employer, to get a job, asked me to do this study to develop a community of people I want to work with, and it was really forefront or forethinking in his mindset there. That's what everyone sort of does now with their business's relationship. And I was in that first transition. Like, you got to remember, selling insurance, I was the last age of cold calling and door knocking, and it was shit insurance. It was accident policies, the old school stuff, not this new. And I was against that, and I was really successful at door knocking and cold calling and old school sales right before sales turned into real relationships. Like, you can't cold call and door knock much anymore and get the same success you can as building a network, right? So and that looked really good on my resume. It was like working at Macca's. People see a successful cold caller and they think, sign him up, this is old school. So
that's how all my staff get jobs.
Yeah, that's right.
They all used to, literally, all my guys used to sell Hello Fresh and Marley Spoon, door to door, or they'd be in the shopping centres.
Yeah.
That's the hardest way to sell these days. And I'm like, if you can do that, you can
definitely. That's right. Literally, I had no degree, nothing. And then my employer, he's an old insurance salesman. And he was like, I can work with you. But he made me do this study. So I did 52 hours, an hour a piece. So 52 people across a week. I interviewed them to find out what the relationship was between their financial health and their mental health. And to give some context, at this time, so it was 2016, maybe just late 2015, we'd had quite, everyone would have heard about the veteran suicide and veteran mental health. There's been an inquisition into it and everything. A royal commission, should I say. And at that time, I was 24.
And this is off the back of you coming out of the army.
Yeah, just a year or two after. And then by the time I was 24, I'd lost 10. There's about 6 mates that are really close to me and 10 in total that I knew that had lost to suicide from the veteran. I was like, fuck, surely I can make a difference here. So I did this study to link, for veterans, to link the link between mental health and financial health. And long story short, it was roughly 50%. So just over half of them said to me at some point, they said to me that their mental health was kicked off from financial stress. And whether that be, we can define financial stress as whatever, but it's basically a lack of money, right? Like not having enough money to live your required life. And whether that was because of drug addiction, gambling, high debt levels, divorces, whatever it was, it all come back to that. It was the money that caused the stress. And that's what started their mental health journey. And then of the other 50%, although just under half, about 80% of those, so just over 3/4 of those, said to me that at some point during their mental health journey, which started another way, financial stress pushed them further and spiraled them deep. And I thought, shit, man, this is me. Like, I can help here. And in that time,
and what was your financial capacity at that stage? Like, were you comfortable? You made decent coin?
Not at all. No. So like, I still at that point, like, I come from a bit of the street life, I guess you want to call it, and we made fast money, spend fast money. I've always liked nice stuff. I used to go through weeks where I'd spend, at 17, 18, I'd spend $1,200 a week on Louis Vuitton sunnies and clothes. I had a shop in Greystanes. I've become really good friends with her. We found it, and me and my mate supported her entire business, getting in Nina Pasadena and stuff before it was big, and we just go in there and drop $1,000 each a week, and that was me. I always, I never had debt. I owned everything outright. I'd walk into when I got my first apartment, like a rental, like I walked into the Bed and Beyond or whatever and dropped like 12 grand cash on the table. And was like, give me everything. Like, I always backed myself to make money. And I always had like 10 grand in the bank, but I didn't have any aspirations. My thing, and from my father's side, the King side, they're Mormons from Mount Druitt, and we're all salesmen. That's our thing. We're always known for that, and we can always make money.
That's where your door-to-door salesman comes.
They're all like that, and that's the thing. And so we'll get into this a bit later, but where my journey has come from is I consider myself an earner, and I believe everyone's either an earner or a saver. Like most people inherently are one or the other, and earners think that the answer to all their problems is earn more money, but they don't have the foundations or the traits to stop the bad habits that inflate as long as the income. And that's where I was. That was me. And then savers, they think that they're doing right by squirreling everywhere, living tight, but you can only save so much in today's economy. You've got to earn a certain amount to be okay, and you can only cut so much out of your budget, right? So they're at the same time. So both have got these pros and cons. Everyone thinks right. And my mum is a saver. Bought a house, paid it off. We lived on hand-me-downs our whole life, and in the same token, she hasn't invested hard enough to live the life she wants. And my dad has earned more money than you ever made in your life. He's got nothing to show for it, right? So there's this balance. There's this dichotomy of two people that I got to grow up with to say, I should be in the middle. There's got to be a bit I can take from each, right? So
that's interesting. Earners and savers.
Yeah, and when you come from a bit of the I guess the dodgy life on the side, everyone's an earner. You're always looking for an earn because you come from a suburb or a family that has no money. You've got to put food on the table, and everyone thinks they're an earner. But the bottom line is, if I can't give you a target to say what you need to go and earn, you're not confident you can do it. You're not an earner. You might just have a good job, know. So, and that's one thing. One of our target markets with Three Kings is it actually started out. The target market was legitimate gangsters, people who, hey, they come from the life or whatever, and they want to. They want to get legit, or people who are legit, but they like flashy stuff. You look at them, you think, oh, they could be a drug dealer, maybe not, but they're not, right? And everyone looked at me and you're mad. That's not going to happen. And
mate, that's niche. That's a blue ocean strategy.
It was, right? and it's transitioned to. I looked at that. I actually come with after reading The Purple Cow. And I was like, okay, so, and then I was like, well, it's hard to market that at the moment. People don't want to be known as gangsters, I guess. So, I changed it to ambitious hustlers. And that's our market to today is young, ambitious hustlers who are willing to take what it requires to get what they want. And that doesn't just mean earn. It means save. It means invest. It's required people because I worked with a lot of millionaires, and we'll get this later as well, on the east side that come from money. And I'd say to them, hey, this is what I can do with you with what you have. Here's how far I can take you. But you got to earn more to hit your goals. No, that's not good enough. Get me a better return. So, bro, I can't control returns. You've got contribution, risk, and time. They're the only three things that matter in any investment outcome. And you're focused on the one thing that you can't control. I can try and get your best returns, but I can't guarantee it. But if you get this much money, I can guarantee it. Let's go. And they weren't that, no, get me a better return. Whereas you're out west and they're like, hey, bro, we can do this. That's really good. But if you go and earn a little bit more, we can do better. Yeah, sweet, I'll make it. Let's go. How much do I need? And I was like, that's me. That's what I need to be. So went from there, did that study, applied for that job, got that sort of stuff, and I got the job in Sydney as a financial planner, started studying financial planning properly, working with cash flow. And then that's the first, so this would have been 2016 and a half, maybe close to 2017. I moved back to Sydney from Brisbane because I moved from Townsville to Brisbane with this company that was the insurances and was supposed to go big, become a manager and stuff. Made no money, had huge amounts of credit card debt. I was living on debt. They were living that whole fake it till you make it. So I was wearing nice suits and driving nice cars. Had no money. The reason I actually went for another job was my wife, who was my girlfriend at the time. She said, it's an ultimatum. We're living on her income. We're barely scraping by. And
was this because you were comm only at the time?
Yeah.
Yeah, right.
Comm only, no salary. And I was a manager, so I was relying on everyone. The only way we ever made money was when I had cracked the shits and went out and sold myself. And that was frowned upon because you've got to manage the team. But they were all shit. They were rubbish. Cold calls were dead. It was dead at that time. And they were coming into the industry when it was gone. And I only made money because I had a network and I could do it. And it just wasn't sustainable. And she said, look, we're either done or it's this job. And you just keep the job, we're done. Or fun. I said, fuck, right, yeah. So then I, applied and did that stuff, got to Sydney, started studying and learning, and immediately changed my own habits. Got a budget in, but did the basic stuff. I realized I was on 45K a year. I went down, I had a job offer at Perpetual for 95 a year as a junior analyst. And then I had a job offer here as a junior financial planner for 45K a year. And I was like, I'm taking it. So
it was a similar salary to what you would have been getting paid if you went down the gym route.
That's correct. But there was a career mentorship pathway and stuff that as an advisor, I would get a lot more money, but I had to do the hard yards, start there. And so I did. I took the 45K and we moved down. My wife, she was probably on something similar. And, we were living in Western Sydney. We had cheap rental. I got a budget in place and we paid off all our debt on 45, two lots of 45K a year, paid off all our debt, started saving, bought an engagement ring, bought new cars, and I was putting money away in super, I was investing, I was doing everything. That's where my journey started. I finally got good at what I was doing. And then, went from there to basically, we got an offer to buy out a portion of that business. I was only 2 years in the game and I was running that whole practice at that time. Still studying, doing all my financial planning stuff. Wasn't ready to jump out on my own, and got an offer from one of the other big businesses in the licensee to go into the city and work in a city office and big business. And I thought, I'll take that for a year. a year, and then that was the agreement. I'll do it for a year, and then I'll go to my own. Went there, and it was again all fakes. All it was, people were just coming in, and they were like big money, and they were like, make me more money, and that's all it was. We were investing money, and we weren't doing shit. The market was doing it all, but we were making it out like it was us, and I hated it. I couldn't stand it. I just it just wasn't, because they were miserable. These people making all this money, and they were miserable, and I'm like,
The staff, you mean, or the clients that you're investing for, right?
Like they thought we were doing this great job, but they was just okay. Like you make some people millions, like, and they would be like, right, what's wrong with you? Like, sling us a fitty. Like, what do you mean? And so
never took you down to Jackson's on George for a steak or something? And
we went to like, and that's the other thing. Like every night there was a piss up. Like these people had families, like all the staff all had families, and every night they'd be there till 11 p.m. on the beers, and I'm like, bro, I just want to get home. I'd be in there at 4 a.m. I'd be out of there at 8 p.m. Like transit from West Sydney into the city, and like it's just this life. I was like, there's got to be more to it than this. Like I just don't love it, and ended up, there was a few. I don't handle conflict in an office environment very well. I can sort of, I only know one way to deal with that conflict, and it's to throw them. So we'd get to a point where these
back to the mission, right? It's like the gangsters.
That's right, and it's like, and the people like, and because like, even in the military, like you have people. We saw that I was that last era of the military where you fuck around, you find out kind of thing. And the new era wasn't. It was, I've got a better picture on my chest than you do. My rank's big. And I was like, I don't give a shit about your rank. Like, treat me like a human being. And then move into the corporate world. It's the same thing. I've been here for this long. I'm like, it won't stop me kicking your head off your shoulders. Like, I just couldn't stand. I can't handle that world. Like, treat people like human beings. And a client will come with more money than another client. They get priority. I'm like, why? It's not their fault. Like, why and I just can't stand that whole vibe. And so I was like, stuff it. I threw it in. I had enough. And I was like, I'm going on my own. I shouldn't have. We just got married. I had about, $250,000 in the bank, ready to buy our first home. I was on the journey. We're doing really well. I had big share portfolio, had lots of money in the bank. Gemma and I just got married, paid for our wedding, paid for a honeymoon, everything, really expensive engagement ring, like wedding rings, everything. We were doing really, really well. And I just had this brain snap, just a little tism kicked off, boom. And I was like, right, I'm gonna start my own business.
He's out.
Gemma was like, whoa, like Gemma's my wife. And I was like, whoa, she's like, what's going on? And so I went out on my own, started from scratch, absolutely nil, which in our industry, you either start or you take some clients or you buy a book. So you take over an existing business. And that's the easiest way to do it. But I was like, no, I'll do it from scratch. We got heaps of money in the bank. It's fine. I chewed through that pretty quick. So we started the business and started out under the licensee of the company I was working for. And I was like one of their golden childs at the time. I had a big shareholding in their business, and they sold me everything under the sun. And within 3 to 6 months, there was nothing. I barely heard from them. I didn't know how to start a business. I know how to do financial planning. I said to them, I don't know what I'm doing. Can you just give me ideas on how everyone else does it? Nothing. So we started off good. We organically started and was starting to sort of make money. And then within 6 months, we had a big disagreement, and we parted ways with the licensee. And when you part ways with the licensee at that time, it was really hard to get a new one.
Sounds similar to my journey.
Yeah. So I spent like 80K. I got like a 20K website. Like I went all out. I was like, we'll cash, make this thing mad. Got the black and gold theme. Like we'll look mad. Thought I was doing good. And then I couldn't take a revenue for almost 18 months.
Due to non-compete or something?
No, due to the licensee, because I wasn't licensed. So I had all these clients, and I had, we in the first 3 months I took on like 20 or 25 clients, lost a bunch of those, couldn't take revenue from the others, still had my outgoings. People don't realize it cost me about 65K a year at the time just to stay open with license fees and everything, right? Not including rent, all that stuff. So I'm chewing through cash.
So this is 2019-ish?
Yeah, 2019, chewing through cash, burning through a lot of it. In the same time, then I got my new licensee. It was really good. Got my new licensee. Started off slowly, but and then I had to redo the website. Because you got to put all the new licensee numbers, change all your documentation, change all your portals. All my information's held on their portal.
And this is also in the financial planning industry as well as going through a huge amount of changes to Royal Commission.
Yeah, and I started my journey. Like I was lucky. There's this big thing about commissions, and I don't really have a big play in commissions. It's more of a marketing tactic. I don't charge any commissions. Like anyone I refer, I just say do a good job. I don't take any kickbacks. I don't receive any money other than the monthly retainer my clients pay me. That is it. I don't charge insurance commissions, nothing, not a cent. And we used to charge 6.6 at my old firm up front as a fee, and then take all the commissions. You make 20K a year for a client in the back office, right? I make like 3 to 5 off a client now, which is fine. I run my business on it, but If I'd done it the other way, the start would have been a lot easier. I would have got a lot more upfronts, but I held it out and did that way because I wanted to be that transparency. I wanted to be transparent. I wanted to be simple. I wanted to be flexible. That was my business motto, and I wanted to go that way. So we kicked off and started, and been a slug through, and then we sort of got to a point where I thought we were good. Like I got to a point and I had two of my best mates ripped me off about 150k. Paying off debts from and stuff like that, being the guy I am. And that almost sunk me. Because we were pretty much at the point where I started money in the bank. It's like, sweet, that'll last us enough to get the revenue turnover, and be sweet. Did that, didn't get the money back. It's like, whoa, we're in deep water here. And it was pretty much at the time, like I pretty much was looking down the avenue of closing up shop, which I never would do, but was going to go down and throwing them, go down fighting, trying to survive. And I just got the hustle back into me, and did the old, what I need to do. And got through that period, did some ridiculous number of clients in that amount of time, put the revenue through, and now here we are.
Here we
are with the thriving business. I've got 3 kings, and we've got the coffee business launching. We've got the back office staff. I've got a sports memorabilia business and a couple other things on the side as well. So we made it.
We love to hear it.
We made it.
It's just the beginning. So throughout that journey, not only from where you come from, having great parents, a great upbringing, but not necessarily having the financial means to do everything you want to do, then struggling through your personal life, financially, then getting the business running, then having issues with friends that you helped out financially. Yeah. So you've had a lot of issues with money, and then you've also seen the other end of the spectrum where you have really wealthy clients who are clients of big firms making a lot of money, but then not understanding and not being grateful for the money they're making, and just having the mentality of that's not enough. We need more. So after learning all of that and going through everything that you've gone through, what does money mean to you now?
So this is where I sort of differentiate from the others, and I have this philosophy that is the fastest way to be unhappy. The second fastest way to be unhappy is to make money for the sake of making money. The first way is to do nothing. So we often say, if you're not doing anything, starting the journey by trying to make money is fine. But if you maintain that forever, what is money at the end of the day? Money at the end of the day is just a vehicle to buy and do things you want to buy and do. And if all you want to do is put zeros in the bank account, that's not going to be. There's one person in the world I know that does that because that's what they want to do, and that's Warren Buffett. How do we know that? He doesn't spend shit. He's got a shit house, a shit car, and when he dies, he wants to leave it all to charity, right? Like, that's the only person.
Just loves the game.
He loves the game. Everyone else, and there's probably Charlie Munger and around him, but everyone else I even met, and we talk about Grant Cardone, we talk about everyone else like in other industries. You go, why? If you dive into the depths of why do you want that? I want the Range Rover, I want the nice house, and people get really weird about saying that because it's materialistic, and they think it's better to say I just want more money. No, it's fine. If that's what you want, that's cool. But put a price on it, right? What does that then cost? So then you know what the fastest way to get to that number is, not just keep chasing zeros, because then it's never going to be enough. I'll just get it. The next 100 grand, I'll do it. Oh, wait, hang on. If I did another 100 grand, I'll do it. It's like, you're never going to get there. It's just the vehicle to the goal. So what does that look like? And so ours is money fit for purpose, right? It's about we've got a three kings, 3 steps to success. Is find out what your dream life looks like, figure out how much it costs, and then put the plan in place to get there as fast as possible with the lowest risk needed, right? I
love that. So essentially reverse engineer the end goal from where you are right now.
100%. And people, when I say that lowest risk needed, they go, oh, especially in the crypto phase, right? People sitting there going, oh, lowest risk doesn't mean low risk. It means what is the lowest risk required? And that, if your dreams are super ambitious, you got zero money, guess what? Your lowest risk is super high. Like, leverage up, brother. Like, that's it. But it doesn't need to be. That's all it is. It's not about, well, what's the best asset? Well, what's the goal? What's the purpose, right? If I want to live a life from tomorrow that I can just pull money out left, right, and center, I'm not going to go and buy a big audacious unit block, right? Like, I can't sell the lounge room of that unit, right? I want to have some liquidity. Does that mean that shares are better than property? No, but for that goal, it does. If I want to leverage up and generate huge amounts of wealth over the next 30 years, I'm not going to do that on shares. I'm going to leverage it 2 to 1 max, whereas I can get property and go 9 to 1, right? Like, that's the difference. Like, it's about looking at what is your goal, what's the purpose, what does the end goal look like, and how to exactly reverse engineer it to get there.
And then how about something that you said, what I thought was quite profound before we jumped on, was around how you see money and time and how they correlate. So we trade our time for money.
The manifestation.
Yeah. Run us through that. I thought it was really good.
So the thing that we run with our business realistically is what's the purpose, right? We say fit for purpose money, and everyone thinks they've got these crazy goals, but when you dive down, it's all very similar, right? And the process is very similar with slight contextual differences, right? But the bottom line is, like, and this is what we sell our service on, is you need to be able to make sure you're okay tomorrow, right? but enjoying the present at the same time. So that's our thing, is helping your ambitious hustlers get what they need for tomorrow while still not sacrificing the present to get there, right? Because that's sustainability. Because at the end of the day, we're not all promised tomorrow, right? That's a guarantee.
And we're reminded that every day usually, right?
Yeah,
There's always,
that's right.
there's always something happening in the world.
That's right. So why would you put all your squirrel everything away for that future that's not guaranteed? What you can guarantee is that you can have fun today. But then that's where people go, this or that. Well, I'm saving for tomorrow. That's not guaranteed. But also, if you're just living today, being able to survive tomorrow is not guaranteed. So let's figure the balance, right? And the way we come up with that is you hear everyone always talk about what's the most value, and having children will, I've got a 2-year-old now, and we're 2 months out from number 2, and you want to put price on time, have children. It's off its head, right? It's ridiculous. But we say time's the most valuable commodity, and every motivational YouTube video ever says that, right? Time's the most precious commodity, and it is.
But when you said what you were about to say to me, you always think time's the most valuable thing, but there's often things that we do in replacement of getting back time, which is stupid, right? Which it's hard to contextualize. It's easy to say time's the most valuable thing when you've got heaps of cash in the bank and you can buy as much time as you want.
That's right.
Then when interest rates go up, it changes.
Yeah, that's right. And then now
you start mowing your own lawns.
Yeah, that's right. I'll never do that. But that's the thing, right? Is that we say time's the most precious commodity, and then on the flip side, we're constantly looking at a lot of people's lives. Our lives we put money on a pedestal, and we're controlled. And one of our big things with our clients is immediately the money mindset goals is to take power back from money. Because if you're letting money control you, and that can be from an earning capacity or from a saving capacity, you're too much on a saver because it's controlling you, or you're spending too much so you're trying to earn more, it's controlling you. People go, you've got to stop putting money on a pedestal. And my mum used to always say it. Love you, mum. Mum used to always say, money's not everything. It's not, but it's a huge component, right? And especially you live in Sydney, you live in the modern day world, just to survive, there's a huge amount of money. Like look at the income ratio to housing costs right now, factor in the fact of how many more extra subscriptions, internet, cars we now have that didn't have 30 years ago just to be on the bottom line of above the poverty line. It's wild. You need a substantial amount of money just to survive, right? So it is a huge component. But we also say you've got to be happy without money to be happy with money, right? And this is where it comes in. And the thing is, it's not money or time. They're the same thing. People don't realize this is if we break it down and go, well, if we all know that time is the most valuable and precious commodity, and we're reminded that every day, and when we're on our deathbed, it's one thing we'll all think about. So how does that then correlate to money? Well, what do you spend to make money? That's your time. It's a physical manifestation of your time. You're going to spend your time to make money. So we put so much purpose and put it up on a pedestal because it's that thing we can hold. Same conversation about why do people like properties over shares? You can touch it, right? You can't touch time. You can just spend it, right? But you can touch money. You can see money. You can actually have a physical manifestation of your hard work and time. But that's where we all stop. We focus on, well, that's the outcome of my time. No, it's supposed to be the intermediary, right? It's supposed to be that you spend your time to make money so then you can in some time future buy time back. And we do it every day, whether it's, you go and have a slap on the pokes, or you go to the pub, or you take your kids to the theme park. Like that's getting time back, right? Taking your kids out for ice cream or going on a shopping spree, that is you doubling up in that moment. You're spending your time plus time you saved on the side, right? And that's what it needs to be, but we forget that. And if we can understand that, that's why we prioritize money, but then put the real purpose behind money, which is to get time back. We can change our whole money mindset to really appreciate the process a lot more.
I like that. So when you're actually spending money, I know for me moving forward now after hearing that, when I spend money, it's going to be a conscious thought to think that what I'm really spending is time that I put the effort in to get this moment right now.
And savers understand that really well. You think you see posts where a lot of really successful people, you're spending same. I got no drama with it. But the thing with savers as well, and you see this in post, a lot of successful people talk about my life changed when I stopped thinking about that I was spending $10 and I was spending 30 minutes from work based on your hourly rate, right? Same thing, but it just stops there. Everyone just stops it at the money point. You got to understand that that's why you find money important, but what's its real purpose, right? Don't stop it at just money, because then now money's on the pedestal. If you can keep time on the pedestal, change that whole formula around to be more powerful for yourself.
I like that. And for the clients that you look after now, they're the young hustlers, ambitious at heart, and you're not just helping them with managing their money and creating more time in the future, but you're also helping them around that money mindset, right?
That's the first thing we do. Yeah. The first step we do with every client that come, we do a 3-month cash flow money mindset strategy. It's about...
what does that look like?
So the first
Let's
month...
hypothetically say that you're 23, 24 years old, just got out of uni, or you've got your first job, you're earning 80 grand a year or 90 grand a year. and you're like, I don't want to
And you
be.
got none left over because it's all in rent in Paddington.
I don't want to be poor.
So the first thing we do with every client that comes aboard is our 3-month cash flow money mindset strategy, and anyone can do this at home. And I put this out on social media all the time. The only difference I add is accountability, right? But in the first 30 days, so we do a budget, assess their budget, assess everything. The first 30 days, I go, right, we're going to allocate what is a necessity, what are your real necessities, what are luxuries, and what's left over. The first 30 days, we put a halt on anything that's not a necessity, and any necessities that are a bit wanky, we'll change them up. We'll get a look at
Netflix
necessity, right? So I believe I'm pretty loose with my necessities, like gym, subscriptions, things that can keep your minimum happiness level of lifestyle. Like that's thing, right? That's necessity. So I'll take it back a step. In our first meeting, we do an exercise to say, right, and I'll ask this question. You can all do this at home as well. Is if I said to you, in the next 12 months you're going broke, you run out of everything, right? If you don't change shit, in the next 12 months you have no money. You're going to sell all your properties.
That's what the RBA is virtually saying to me now.
That's right. Screaming down your throat. And I said to change that, we've got to stop spending anything that's not a necessity, right? And I keep this vague to try and gauge what people's level of necessity is. And I say you can only spend money in the next 12 months on things that are classified as a necessity. What are the top 3 things that you think you would miss out on the most that don't come under that category, right? And people come through and you listen to what they say, and it'll be often something like gym. And I'd classify as a necessity, but I don't give them that gauge. I say, okay, the gym, maybe Netflix. Often it's dining out and beers with the boys or golf or something like that, right? Coffees, right? Little things, whatever. And it can be a little bit, maybe a getaway. And so we label all that down and say, right, so in a 12-month period, if you could get away twice, you could go out for a dinner once a week, you had your Netflix, and you could maybe go for a beer with the boys once a month, you could sustain that for 12 months. Sweet, you add those up, that's not expensive, right? So then what we do is we roll that into the necessity and say, right, that is now your necessity. So at any given time, if we need to prioritize where your money's going, and let's say we've got interest rates are going up, we already have a list of the things we can cut down before we get stressed. Because when you say to people, what's financial hardship? And they say, if I can't pay my mortgage, bro, that's way past financial hardship. Like you should have known way before that point, right? And this gives us a gauge because now we can cut everything else out. And if we start to cut on the dinners a week, get away, we go, well, now something needs to change now.
I like that.
And so then what that leads into is we then have the basic. We then create a necessity list. Everything plus those things is your necessities. For the next 30 days, this is the first 30 days they come aboard. Next 30 days, I want you to not spend anything. And that's why I say I don't give them gauge. What about this? I don't want you to spend anything. Spend as little as you possibly can. We give them a spending journal that each week tracks. Every Friday they sit down, they track, what did I struggle with this week? What did I find really hard? What was easier than I thought? And the questions change every week and then get a summary at the end. At the end of the 30 days, we then catch back up and we would have set a target to say, well, if you didn't spend anything, here's how much should be in the bank. And then we gauge that against what is in the bank, and then we have a discussion. The most important part isn't the numbers, it's the discussion. What did you struggle with? Well, you know what? I actually didn't mind having coffees at home. And I'm not someone that sits here and say, you want a house, stop buying coffees. I own a coffee company, like load up. But it's not about that smashed avo or the coffee. It's about what do you prioritize? What actually gives you the most amount of value for the dollar you're spending? And for me, I love coffee, but I had to do this for myself because I was buying 2, 3, 4 coffees in the office every day. The money wasn't a problem. I was still saving, investing. It didn't affect me. But every coffee became a habit, and I didn't taste the coffee anymore. And so the dollar per value I was getting was minimized. So I cut it out. And then all I did was every Wednesday morning, every Saturday, I went to the cafe, I sat down and had 1 coffee, right? Didn't change my bank account, but the value I got per dollar spent on that coffee was tremendous.
I like that, yeah.
Much more consciously spent. And that's the thing we're trying to get. In the first 30 days, we're trying to develop a conscious mindset. If you can take anything away in your money journey out of everything, become conscious. Just stop before everything and think, is this the best thing is this going to make me the happiest of what I'm doing right now? And if it is, spend it, never think about it again. If it's not, stop. Because what we want to stop is those spending times where you spend and then you go back and go, fuck, I shouldn't have done that.
Unconsciously spending.
Yeah. So,
and what I've found in my own journey is that unconscious spending increases tenfold as when the income comes.
100%. It's that inflationary period, and in our process, once we do that, so we do that 30 days, then we assess and we say, okay, we figure out what you struggle with. Then we set on the next 30 days. Next 30 days, I then give them a budget. I say, well, here's your luxury budget. We set up a luxury account. You're allowed to spend that. And I make it less than what is there. And now we're overlaying consciousness with discipline. So now you're allowed to spend, but you got to stop. Once it's gone, it's gone. So you got to prioritize and choose effectively. In the third month, we then reassess and they make some tweaks. We do 1 month of what we think the perfect budget might look like, and then we roll on from there, right?
And is there, high level, everyone's going to be slightly different, but is there rough percentages when you're like, okay, let's hypothetically say that you're trying to get into, your first property, is there roughly like a percentage of savings, a percentage that goes to your necessity living expenses that you talk about, and then a percentage that goes to your luxuries?
Yeah. So the big thing with money is balance. Balance is the worst word. You got to take kind of an industry super fund approach to balance. Where they say it's balanced and it's 80-20. Yeah, it's 80% growth, 20% defensive, and it's balanced apparently. That pyramid will tip over, wouldn't it? So balance we think of as 50-50, right? But we have this wealth triangle that we talk about, which is 3 pillars in life that really to be happy you need to be is you need to have health, you need to have money, and you need to have lifestyle. And when we think of balance, we think 33, 33, 33, right? But you got to understand...
Kings.
Hey?
3 kings.
Yeah, 3 kings. Everything I do is 3. You'll hear 3 kings, a lot of 3 things. But everything you do, when we say balance, sometimes that means something needs to be 20, something needs to be 80. All right. So this is where the journey comes into with percentages is when you're trying to get into a certain thing, you might need to go 20-80 on the spending for a bit, but then we can flow it back out, whatever it is, right? But balance is fluid. Balance needs to be fluid.
So it's contextual to the point.
Yeah, correct. But if we're looking at an assessment, and we do have this in our budget, we have an automated sheet that comes up and analyzes is, if we break it down to 3 things, necessities, luxuries, and tomorrow, because at the end of the day, you need to survive, you need to be able to enjoy yourself, and then you need to be able to look after tomorrow. Where we sort of have a flag is our minimum structure for someone when we put red flags up is if they're more than 60% on necessities, right? Because if you have a 60% on necessities, so living costs, that gives you 10 to 20% on living, which we usually break that up into 10% on holidays, 10% on just day-to-day spending. And then the last one is that gives you 20% to get ahead. Now, if you can't save/invest 20% of your income, you're going to struggle to get ahead. I don't care who you are, right? It's in today's day and age, even 20% is not enough, but that needs to be the bottom point. So that gives us a flag to say, okay, if you're over 60%, we need to either earn more money or spend less. And ideally, we do a mix of the two, right? Either you go, well, if you don't want to make changes, then you need to earn this amount to make that become under 60%, or you need to cut down under that number. We try and blend the pattern together. Also tells us in current environment has been really helpful for us is from a leverage point of view. If your necessities are over 60% based on your leverage position, you really need to reconsider going
And a
above
necessity meaning your mortgage repayments, for example.
Correct, mortgage repayment, right? So the principal component of your...
It's super interesting, actually, because I had a guy reach out to me yesterday on Instagram, run me through a scenario, said, I've got this property, it's worth X. If I sold it now, I'm going to cash out X amount of dollars. If I hold it and my rate goes from fixed to P&I, it's going to start costing me $400 a week or something it was. And he goes, what would you do? And I said, well, what I would do is probably not contextual to what you should do, right?
Leverage up, double down, get a personal loan.
So I said, look, if you feel like when this loan comes off your fixed period that it's going to send you in a bit of a spiral, you should sell that right now.
Yeah.
But I said, that's what I would do. I would sell it right now. But what I would do in my own position right now is I would just focus on, I need to make more money. Yeah. I don't need to sell anything because I know when good times come again, it'll be fine. But that's a really good rule of thumb, right? If that person that reached out to me said, okay, is this going to take up more than 60% of my necessities?
Yeah.
Yay, then you should look at making some adjustments. If it doesn't, then, maybe you're in the...
Yeah, and I have clients, like sometimes we push to 80. Sometimes we will push to 80 for a certain thing, right? But the other part is that, and this is like, I run that as a very basic rule of thumb, but then you got to break down what's the principal, what's the interest component. Because, you say rent money is dead money and people want to show me their rent versus thing. But at the end of the day, your interest and your rates and your insurances and your renovations are all dead money as well, right? So you got to factor that in. And that's what usually pushes people over. If you take the principal component and that fits into that 20% of investable amount, that's okay, right? That's not bad as long as you're then going to use that equity to invest later on and create that. That is your wealth piece. The rest is the necessity, and same as the investment portfolios as well. You got to factor in if you've got all this debt and leverage and it's pushing you over out of that 20% and then out of that 60%, you're going to be in strife with interest rates. Then what we try and do is work towards our first, so we have a savings target or a budget target, and then we have an earnings target. And we say, right, here's what we need to get to now, here's what we maximize, but we really need to focus on getting to a 40-20-40 split. If you want to live the best life possible, try and figure out how you can earn enough or spend less to get your necessities under 40, your luxury stay at 20, and your wealth at 40. If you can do that, crush it.
That's a net income.
Yeah, net income. Yeah.
I like that.
And that's the other part. People want to look at...
So that's the pinnacle. If you can hit that,
40-20-40 is crazy. And I have another one that's it's 30-20-50. And I'm like, if you're there, it's too much. Like spend some more money, bro. Like that's for most people. It doesn't need to be, but it's like that. You're a bit tight.
And what sort of lifestyle can you live on a 40-20-40?
Depends on the income, obviously, but we still have that 20, right? So let's say we got 200k net income, right? 200k net income. You take that into account. That's 80k on necessities a year, which is that's not a lot. So even on 200k, that's a pretty tight budget, right? I expect someone 200 to be around 120.
Spending 220.
So, but that'd give you, like on 200k, that'd give you 80k in necessities. They'd give you 40k. Sorry, no, it wouldn't. What's that? Numbers
Yeah, that's right. 20%
80K.
would be 40.
And then that would give you 40k a year in luxury. So if we take, that's the living component, right?
Which works out to be about $800 a week.
Right, and break that down. If that's 40k a year in luxury, that's 20k a year in holidays. We break up 10 and 10 for most people. If you like holidays, you can do whatever. That's 20k a year in holidays, which is great. Most people don't spend. Most people,
20 grand's a good holiday.
That's brilliant. You could do two, like we did. My wife and I do 24k a year, right? So we do two 12k holidays a year. That's a family holiday. Like that's a decent whack. I don't know many people who come to me with that budget, right? They're happy with 10 to start with. So that's 20k a year, and that's 20k a year. Which do the maths on that? It's $400 a week on spending whatever you want.
That's right.
That's $1,600 a month that you can go and splurge. Like that's brilliant, right? And then that gives you 80k a year in investable savings. Huge.
Massive. That's net. So you got to be making what, 300-ish gross,
roughly. But then that's the other part. People come to us with their existing budget, and they are over the 60-20 or whatever. What's our biggest expenses, people? Tax. People forget it. Because the government reports on net income and our employers pay our wage, we just go, it's just an expense. It doesn't need to be. And there is only so much you can do, right? There is only so much you can do. But that's like when we talk about taking non-deductible debt, turning it into deductible through debt recycling strategies, getting, even if you can't afford to scale up and leverage more, taking out a small amount of leverage into shares or maximizing superannuation, doing all these strategies you can do. The easiest way for people to take money, put it back in their pocket, is try and find some tax strategies.
That's right, because what's your minimum tax in the country for most people is 30%. Thereabouts.
Correct. And
so
for
if
most
you find
people,
a way to grab back 10% of that 30.
Yeah, that's right. And that we just wipe that number off. But so that's the part we can start. When we talk about, you either need, the only way you can put more money in your pocket for this scenario is to earn money or earn more or spend less. There's no other way. You got a tax strategy, you got an investment strategy, that's earning more. You want to cut money out, that's spending less, right? Like everything is either earning more or spending less. You need to use as many of each tools you can, where most people fit, I'll just earn more or I'll just spend less. Well, do both. Do both. Get there.
When's enough? You've worked with people
Never.
at both ends of the scale, right? You've obviously worked with people where you probably think in your head at the time, you're not happy with X amount of millions of dollars per year. And there's other people, at the other end of the spectrum who are just getting started that we're talking about, that, the first 30 days, it's working out your budget, et cetera, et cetera. For your clients, for people that you work with, when usually is enough? Everyone has that end goal that we're reverse engineering and working towards. What does that usually look like? Maybe not as a dollar value, but as a lifestyle. And then what dollar value does that end up being?
So for the only people that enough is not enough, for people who've never sat down and they see money as the goal, not the vehicle. That's it. The solution, the answer to that is enough is the amount of when you figure out what that does for you and you work towards it, right? But from a strategic point of view, say a retirement goal, for people from passive portfolio, from the time when they want to have the choice to stop working to earn money, 80k is comfortable net, and 80k net a year, and 120 is very comfortable, right?
No debts, that's all you
No debt, no children, just that. So if you think about that, the average retiree today needs about $1,000 a week to survive, and that's what the government puts out as comfortable. That's no holidays, nothing. That's surviving. Because people think, retire, everything goes away, but you still got to buy groceries, still got rates, insurances, petrol, and you got more time to spend it. Like you got to be. So if we say 60k a year in net is surviving, that gives you 20k a year, 10k for holidays, 10k for life, 120 gives you a lot more, right? You'd probably inflate your necessities up to 80k on that. They give you 20 on travel, 20 on. So I've never seen anyone need more than that. I've seen people we do 200, 300k a year in retirement, but they don't need it. That's their lifestyle they're managing with.
Do they usually have, let's hypothetically say, those 300k net, which is big money when you're in retirement with no expenses outside of personal and discretionary? How much is usually left over? Are they still doing their their budgeting, or is it just
Yeah,
like...
yeah. So I've never had an abundant. So we've got two classifications or three. You got financial security, financial freedom, financial abundance. Right. Financial security is basically saying you still have to get up and go to work every day, but if something goes wrong, your family's okay. So that's having estate planning, insurances, superannuation, like a house in place. Like that's security. That's what it is. And you need people skip that and try to become financial free. You need to be financially secure to be financially free. You don't need to be financially free to be secure. So start there. Get that ticked off. That's a good place to be. Right. Financially free is you can choose whether you got time to work or not, but you've got a budget. So you might be 100K a year, but if you go over that and spend 200, you could be in trouble. Financial abundance, it doesn't matter. Get up and do whatever the fuck you want, right? It don't matter, right? So that's where we need to establish where does that sit. I've never had an abundant client ever. Even the 300K, they're not abundant. Like if I let them, they'd buy Rolls Royces and like they'd buy boats and shit.
What do you reckon? What number is abundant in today's dollars, from your perspective?
So this is the thing, right? And I do this with everyone when we figure out that number, is if I say to you, how much do you want in retirement? I get people all the time, $1 million a year. And I sit there and go, cool, spend it. And they go, I'll give you 100K a year to live on. I'll give you 100K a year in holidays, right? So that's 200K straight up. I'll give you that 100K to live on, 100K to spend. So you got 200K. You've still got 800K left. What do you got for me? Oh, I don't know. All right, okay. Well, let's give you a new Rolls Royce every 3 years. Let's give you a boat, right? And you factor all that in. We're talking like people struggle to spend 600K a year, right? Like struggle if you let them go at it. Yeah, of course, you give me $1 million, I'll spend it. But every year 600K, it's hard. The number really that I've seen that net is about 2 to 240. So 200 to 240 is that's I've struggled to see people spend over 250 is like the cap.
So that you own your house, you probably own your car, for example.
Well, even that I factor into that like a new car every couple of years, like in a nice car too. Like you remember, Rolls Royce only $7 grand, $8 grand a month, like if you lease it, right?
And you're getting, if you're 240, you're on what, 20 grand a month thereabouts.
Yeah. So yeah, 240, 250. I think anything above that's abundant. I think that's the cap on budgeting. If you're earning over that, you've got money to blow. Like you're buying G6s with that.
So essentially, there's a 3 tiers to when enough is enough, right?
Yeah.
Like if you're in that first tier, then you've got work to do.
I don't think so. I think financially free is the tier that's enough. But at the end of the day, enough is enough at financially free. And I tell everyone I speak to, the best way to get there, to do that in the least path of resistance, the best way to get there is to find something you love doing, do it every day and get paid for it. Because what do I see in retirement? I don't see people playing golf and kicking back. They start doing shit they should have done 30 years ago.
Well, my dad literally just gone into retirement 2 weeks ago. He retired, 63, and he had 1 week at home. Now he's set up an ABN and he's contracting back to us.
That's what I mean. Like
do little handyman jobs. Not because he needs to, because he's like, fuck, I'm bored as
That's what I mean. And so I try and tell everyone, like, I've never seen someone go into retirement just kick their feet back and be like, this is the life.
And usually if they do, they die.
100%. So, and they might do things like they travel or but they always start a hobby. And so I always impress onto my clients now, we always try and start a side hustle and find something you love doing that you can get paid well for and do it. Because if that's all you do and that you do that every day and that's what you would do not getting paid and you get paid enough to survive, that is financial freedom. You're going to do that anyway. Like, why not try and do it now where we all think, I'm just going to make heaps of money so then I can pay myself to do that. Let someone else pay your retirement. And so we look at that and, the problem is you say call it your passion, which I don't. It's not always a passion, but some jobs you can do and get paid for, some you can't. So, but being able to understand that early on, so that you can go to something you're good at that you earn money for, that then the reason you're going there consciously because it supports the thing you love doing, and then try and start a YouTube channel or something, do it on the side.
Like those people who mow lawns. Mowing lawns used to be not a great job, but now, mate, if you mow lawns and you've got lawn porn on social media...
Shout out to Damo from the Hills Hedgeman.
That is just like, mate, like those lawns where it's just looks like a bowling green, the edges are...
One of my best clients and mate, and he's actually a business partner in 3628, it's our coffee company. He's a Hills Hedgeman. Look him up, Hills Hedgeman. He just does hedges. Man, we built that. Like, he was working, he was a landscaper, and I was like, what do you want to do? He goes, I love hedges. I was like, let's go. And we started the business, killing it, crushing it.
Mate, that's a proper thing.
Yeah.
Lawns, hedging.
Yeah. Just even got another client whose mum does, she's retired, but she from home, she's got the wooden hammer on Instagram, and she makes chopping boards out of trees and that, and that's fucking mad.
See, Gary Vaynerchuk, which most people who follow me would know, he's a huge advocate for that. You know, if you're earning 200 grand a year doing a job that you hate, which sounds like, you were at that stage in in insurance and then also in the corporate financial planning, earn 50 grand a year and do what you love.
Yeah.
Because that's going to give you a lot more fulfillment than the 200.
And I get like in our industry, especially in my area, like I'm not a huge social media influencer, but everyone in the industry knows me.
It's coming.
Yeah, everyone in the industry knows me because look how I dress, right? I turn up to conferences where everyone's in a 3-piece suit and I'm like, what's going on? I got me a man bag, I've got a bum bag on, I'm kicking around in TNs, I don't give a fuck. But they so they all know me. They know who Kingy is from Three Kings, and because I'm the only one in my industry doing this niche, right? No one, everyone else, you look after retirees, you make millions. And they always ask me because I've got such a nice business model that I love and I've done it from day one, but it's not profitable. Like it is now, but if somebody else was to replicate what I do, they don't, because everyone says I love what I do and they just want to flip their business. They do it so they can flip it and they don't want to sit back. That's not me. Like I started the business that every dollar I earned, I threw back into a staff member to take off the table something I didn't like doing, because I know what I love doing. I love doing this. I love educating. I love chatting with my clients once a month, once a week. Like my business ain't profitable. I charge clients for 2 meetings a year. I speak to them almost weekly, most of them, right? Like, what do you want to talk about? Yeah, let's get in, let's go, let's start hustling, let's do this. And we're just chatting, we're talking, we're spitballing. And that's what I like. And I've got 9 staff. So to give you an idea, most advice firms will have 2 advisors to 1 support staff. I've got 9 support staff to me, right? Like that's how I roll, because I want to take everything out of my plate. So all I do every day is what I love doing. And everyone else, like, they sit there because I rock up and we're making money and we're having fun. I've got a nice car. I wear nice watches. I'm going on holidays. And like, how do you do it? I'm like, don't copy me. Because you'll hate it.
Yeah. Because
you won't make the money you want to make. I could make so much. My personal income could be humongous, right? Like, we'll do $1 million this year. If I was a normal advisor, I could take 80% of that myself. But I'm not. I just take a small salary, a couple of dividends here and there where I need it. Got my other businesses on the side.
Hublots.
Got my other business on the side, and I turn up to work every day because I love it. I'm not going to flip it. I might sell my business when I want to retire, but I doubt I will. I'll probably all my clients are my age. They'll probably retire until. And
you'll be like Warren Buffett, just annual general meetings every
AGMs.
year, 95, just going. This is what's going on this year, boys.
So I practice what I preach. I sit there and I say to people, just find something you love doing, do it every day. If you can't get paid doing something you love, do something you're good at that can support the thing you love, so you can build into that.
Mate, it's gold. Last question, only due to time, and then we're going to do a part 2 of this. The question that I have, and this podcast is very pro property, right? It's called the Flamingo Investment Podcast. Yeah. You're sitting behind the greatest Hender-ingo in front of, I should say. Sorry. We're very pro property. Leverage up, especially if you're a young person. You've got time. Let leverage do its thing. Grow some wealth, and then chill. On the other side, you're neutral on all investments, and your strategy is tailored to the individual. What do you need at this point in your life? And that's, like you said, the 80-20 rule, the 50-50 rule, whatever it is for that client. What's your high level take on investing? If you're trying to build wealth, let's say that someone listening now is between 20 and 30 years old. They're at the start of their journey. And this is not advice. This is just generally nature. And they're looking to build wealth. So outside of you need to put aside your percentages for investing. Like where should they be, and how should they invest?
Yeah. So I guess the bottom line is we've talked about this a bit, and we'll do a bigger one on this, is that people have got to stop being this or that, right? You got to stop saying property's better than shares, or an accountant's better than a financial advisor. Like, everything has their role, and everything has a pro and con. And when you're weighing up your journey, you got to look at the pro and con, and how does that fit what you want to do the most, right? If we take into consideration, let's just do the typical property versus shares debate. We love both, right? But at the end of the day, property and shares over the last 30 to 50 years, net returned roughly the same. Shares just slightly outperforms because it's got a net benefit over costing from property, right? But that doesn't mean it's better. What is the pro and the con? Well, the pro of property is that you can leverage the shit out of it. And that's the real benefit. People don't love property, they love leverage, right? And that's its benefit. What's its downside? Like I said before, if I retire and I've got 2 properties, right? And this is where people get wrong. Property is great when you have 10 plus from a retirement portfolio. But when you've got 2 properties, you want to go on holiday for 100 grand, you can't just sell the lounge room, right? It doesn't happen. And if you've got one tenant out, you got some tenancy risk, you're cooked, right? So its problem is liquidity. Right, it has that liquidity, and it's got pretty rubbish yield from a bottom line. Its pro is growth on leverage, right? Shares, on the other hand, can't leverage as hard, but it's very liquid, and you can get good dividends, good income out of it, right? So that's pros and cons. So when we're looking and saying, well, what do I need to do? Well, where in that piece do you fit? Do you need income? Do you need liquidity? Do you need growth? What do you need? And factor it in and going from there. And we talked before, if we're talking just a young person our age, right? A young person wants to start. My favorite strategy, and this is not advice, but if you did this, you'll be fine. you go out, the first thing you should do is try and find your home, right? Now, you should start a pathway towards what your ideal home looks like. And if you can't afford that, purchase something in line with that. So if the market goes up or down, you're in the vicinity of what's happening. You're not priced out down the track, right?
So you're not going backwards.
Yeah, and also have that first place. If it's not your ideal home, it should be something that's a decent investment. Potentially, you could even buy your future retirement home, the thing you're going to downsize into. If it's an apartment or something like that, start there. So that if everything else falls to shit, you're still happy to live in it. You got a roof over your head, right? Because everyone needs money to live on and a roof over their head at the end of the day. That's what they need. Get into that. Get some, pay down some non-deductible debt, generate some equity, and start, using that equity to leverage into property or continue your growth strategy. Make sure your foundations are in place. Top up your superannuation to look after you from 60 onwards, because at the end of the day, if you're going to be retired at 50 or 40, you're still going to need money at 60. It's the only place you can generate tax-free income. So keep that going. It's also protected from creditors and liabilities, so it's always going to be there. So if everything else falls to shit, you can afford to take more risk because it's safe over there. It's good to go, right?
Is that true?
Yeah,
so
correct.
if you ever went into liquidation or bankruptcy, your money inside of superannuation is protected?
Two structures. So this would be a hot tip. This is why business owners who say to me, I'd rather manage my own money and they're morons for not going to super, is you can run your business hard and funnel some money into super, and if you go into bankruptcy, it's still there. The other one is an investment bond. So child bond or an investment bond is the same thing. After 10 years, it's tax-free. So we use that for a lot of pre-retirement strategies. Let's say you set up your super from 60 and you're an investment bond from 50. Retirement at 50 on 200k a year is not a bad worst case scenario.
How does an investment bond work?
So an investment bond, so you got bonds like government bonds or credit bonds or whatever, which is basically lending money to the government. An investment bond, they come under usually like a child bond, like an education bond or whatever. They're just basically a similar structure to super, like a trust structure. You put money in it, you can invest it, you can keep it in cash, or you can invest it in the market, whatever you want. They got rules, but you can invest it whatever. It's internally taxed. So for people who have a high tax rate and you take shares and that hits your tax bracket, that's bad. You're losing money. Where this is all internalized at 30%. So it stays in there, it doesn't hit your tax bracket. After 7 years, 33% of that, if you take it out, is tax-free. After 8 years, in the 8th year, so it's 33% tax-free. In the 9th year, it's 66% tax-free. And in the 10th year, it's all tax-free.
And can you keep adding to it?
You can keep adding to it up to 125% per year from what you did the year before. But you just flow it out. So you structure different things, right? And you don't take it out. You leave it there and you draw down the capital or draw down the investment on it tax-free. So if you did that from 50, you could have 200 grand a year tax-free. And this is an example we say for example, property. You want a 200k a year from property tax-free. You've got to have approximately 4 to 5 mil in debt-free assets by 50, and you work that out how much you need to grow each year. That's a big number, right? Debt-free.
Huge.
But if you did that, you could say, well, then from 60, we've got super looking after us at, let's call it, to get 200k, you probably need about 2.5, right? So 2.5 from there. But you've got a longer time to generate that compound. So it's a lesser amount to get in there. And then you said, well, then I just need my bond to take care of me from 50 to 60. 200k a year over 5 years maximum, right? Over 10 years, sorry, maximum you need 1.5, 1.6. So now we're at, maybe 4 mil, but to get there is a lot slower. And then everything else is bigger. You drip down the investment bond until you hit 60, then super kicks in. They're both protected from creditors. They're both internally taxed. They're both tax-free, and they're both protected from creditors. If that's all you did on the side...
Imagine if Sam Bankman-Fried did that.
So actually,
he should have spoke to you.
One thing we do with business owners, which I love, is one of my favorite strategies is what's one of the hardest things as a business owner, taking income, right?
Yeah.
Cost your business arm and a leg, plus payroll tax, super, etc. You take income for the first few years, pump all your dividends into a bond, right? Into a bond for the first 10 years. At 10 years, you start taking income from the business, from the bond, live on that, let the business internalize all the income at a lower tax rate, 25% for business. Money for jam. And it's protected.
There we go.
Right, so you do that stuff. So if you got the home, right, so you set up your foundations, make sure your estate plan, your insurances, your superannuation is good, and decrease your insurances as your assets grow. You get your foot into a home, start paying down that equity, get down to 70, 60% LVR, then take 10, 20% of that LVR, leverage it into either more property or into shares, and repeat that process. Probably go into property till you're at serviceability. Then once you're at serviceability, drip down into shares. You do that, repeat that process, add the bond and the super onto it.
Money for jam.
Easy. But then this is where we then say, that's the money, but were you happy? And so overlaying what the purpose behind is, well, maybe I don't invest in more and I just commit to a 50-year-old retirement, but I enjoy myself between now. So instead of investing that extra 20k a year into the bond or super or into the property portfolio, well, maybe I just put that on a holiday. Like that's where it comes down to. That's what the strategy needs to be. That's the overarching bit people miss.
Gold. Part 2.
Part 2.
Three weeks
go.
from now, we're going to do it. All right. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. We're back, Frankie!
Yes,
Mate, it's good to see that you wore your colours today.
Not as colourful as you, but just trying to keep warm, mate. In this
You
cold
look
weather.
good. You got your blue sneakers on.
Yeah, you've got to coordinate,
At
mate.
Lowe's. You get them at Lowe's?
Mate, there's a Nike, mate.
What about your jumper?
No, this is from Oxford, probably.
From Miller's. That's for women.
I'm not familiar with Miller's, mate, but I think it is women, yes.
And what are those jeans? They'd be Hugo Boss, wouldn't they?
No, I'm not sure, mate.
Just jeans,
I'm not
mate.
big into the brand names.
Mate, we got a big episode today.
Okay.
We skipped an episode with you weren't on that. That was with Ryan King, the financial planner.
Oh, okay.
Yeah,
Very good.
he was at home that day.
You didn't invite me to that one. There's only one seat, so
That's right. There's
small
only
room.
one seat. And mate, we spoke about all things holistic wealth creation.
Okay.
Not just property, but how you can leverage other asset classes to end up getting to whatever that end goal is
Okay,
for
nice.
yourself. Because obviously we've spoken about serviceability and the impact that has, and not everyone's going to have unlimited servicing. So when you hit those limits, what other asset classes can you continue to invest in, and
Sure.
what are the strategies you can use, mate? Today, what we're talking about is the four main considerations when you're defining your goals on where you want to get to and how you're going to get there. We've got a lot of young people, Frank, that hit us up as to, I want to have a big portfolio, I
Yep.
want to have this passive income, or I want to be a full-time property investor. And lots of people have the grandiose idea of what they want to do, but very few people understand how they're going to be able to get there.
Sure.
So in this episode, we're just going to break down the 4 simple steps that I think was worked for yourself and myself, and we'll unpack each one of those things.
Yeah, well, it's important to have a plan.
That's right.
And your plan doesn't have to be too detailed, but it needs to start like with any type of plan, whether it be a business plan or whatnot, at the highest level. Start with those, like you said.
What was your goal
four
when you started, Frankie? Obviously, just your dad just pushed you in there and said, "Get in there, son."
Yeah, he
and buy a
planted the
property.
seed, and basically said, you're 19 now, sort of about to be 20. You'll thank me when you're 40, sort of thing.
And now you're 80, and you.
I hope I'm still around when I'm 80, mate. Let's hope that. But yeah, so look, it really wasn't too much more consideration than you're now working full time instead of going out and blowing your money as a 19-year-old on booze and God knows what, on partying. Put some money aside.
What would fall into the God knows what category, Frank?
Oh, mate. Whatever 19, 20-year-olds were doing in the early 90s.
Yeah, right.
Long time ago, mate.
So VT Commodores and.
Oh, not for me. I wasn't a big cars person. But yeah.
But what about the second time around? So you might have had goals when you first started, but you went through a bit of a divorce there.
Oh yeah, as you get as you go through the decades, I suppose.
But what happened the
years.
second time around? Why did you buy property again? Because you could have just went, oh fuck that, I've tried now. And
Yeah, well, I think because I did start so early, at 19, and I held that property for 10 years. So. And to be honest with you, it was doing the same thing. It was always rented. I never had the impatience to worry about the capital growth and go, well, it's not doing enough. I need to sell it. So I never had this get rich quick thing. My dad said, hold it till you're 40. So to
I
speak.
reckon the reason that you never had that is because you would have been too lazy to actually sell it. You would have been like, fuck that. That's too.
No, not at all.
That's
Not at
too
all.
hard. I'll just leave it sit there and hopefully next year
Not
it
at all,
grows.
because my dad basically said it's a long-term thing, property investing. So just let it do its thing. But when I eventually did sell that first property, it was 10 years later, and the thing did more than double in value. So I was like,
And that was that first apartment that you bought, huh?
yeah,
Out there in Croydon.
in Croydon Park. So I bought it for like 83, call it, and I sold it for 180. So I'm like, geez,
Double in a
I
bit.
just made 100 grand in 10 years. Now, when you look at it, you've gone, well, you only made 10 grand per year. But
10 grand per year back in
then,
the early 20s.
in the 90s was a lot, right? It's all relative. So I was like, wow, I've really done nothing but hold this property, and it's doubled in value. So I could see how, easily you could just generate some wealth there by doing nothing.
By doing nothing other than holding it.
Right?
Yeah.
A lazy investment, you might call it.
I reckon that we'll call it the Frank Raiti special, that one. And the second time around, you just thought I can make money out of it. It makes sense.
Yeah,
you met the current wife, and
second time it was more about, well, I can really ramp things up here. Got remarried, both on very good, corporate incomes. We had the incomes, we had the equity, and it's like, let's go hard. I think that's where I mentioned before, where we bought 3 or 4 properties in 15 to 18 months.
Yeah, exactly.
And it was all about, wasn't matter of it was the market was down or the market was on the rise. It was about had the equity, had the income, the serviceability, the affordability. Just get in there and do it. We're comfortable to do it. So if you've got those things, there's no problem in going and buying 2 or 3 properties at once.
Why didn't you go buy 2 or 3 more Lexuses? You could have had a bit.
Mate, why would I buy a depreciating asset? You're talking to an accountant here. Hey, never buy brand new.
Well, I think a lot of people, when they've got high disposable incomes, think of a lot of other exciting things to do with them outside of buying assets, right?
Oh, look, don't get me wrong. We still went on holidays, and I still like to go on holidays now, because I do feel like in life you have to have a balance. You can't just be 99% investing in whatever it is, property, shares, or whatnot. You've got to enjoy your life too. You've got to take holidays and relax and see the world. There's
plenty to see out there.
So but for other people, they love their cars, they spend money on cars. That's great. If that's what makes them happy, I say go for it. It's all about whatever makes you happy. For me, it's seeing the world.
And getting up at 9 a.m. to do the 9:30 F45 class.
That's it.
So the number one thing where we start is identifying the motivation. So what is the motivator, right?
Yeah.
Because just like I was asking you, why didn't you go buy 3 or 4 Lexuses? Your motivator, like you said, wasn't cars. You're not motivated to have the flashy car. So you really need to understand what is the actual reason that I'm doing this for. Because one thing I can assure you, in high interest rate environments like we're in right now, there's a lot of other things I'd like to be spending my money on.
When you see all that interest going out of your bank account.
It's like, fuck me.
But like we said, you've got to see. You've got to believe in the long game, and that it is going to generate wealth for you. Like I said, I saw that I bought a property for 83, sold it for 180. It more than doubled in 10 years. Now, like I said, it wasn't a material amount of money. I wasn't able to retire at that stage, but it was enough to give me the inkling to believe in that. If I keep on doing this,
you got supporting evidence, right?
Yeah, that it will highly pay off in the long term.
Exactly, and that's the thing that you need to get clear on. Is like why I'm actually doing this.
Yeah, and that was that when I got to then the age I'm at now, I will have choices in my life. I won't have to work full time. I won't have to work at all. I can take more holidays if you like. So. I'm living proof. If you say, you're like we always say, Jack.
Frank chooses which client.
Here's one you've built before, so to say.
Frank chooses which clients he wants to work with. Does he actually want to drive out 40 minutes from his house, or just stay?
The luxuries of life, eh?
That's right. But I think it's super important is identifying what that is. And obviously, if you're a young guy or a young girl or a young whatever, you're probably going to have your goal's going to evolve. What you want right now is probably not going to be the same as in 10 years time and 10 years after that, right? But it's about understanding what are the goals and how much am I actually about them?
Yeah.
Because it's easy to buy one property, but if then you go to buy your second, third, fourth, fifth, however many it is, and you're earning the money to be able to do that. There's a lot of very exciting and shiny objects out there, which
there is. And for young people in their early 20s, I totally understand that. They're like, I think I read something the other day that, the average person doesn't start thinking about retirement or even, like how much do I actually have in super till they're like 36 years old or something like that. So, that just goes to show that, the average person is their thoughts in their 20s are like, I'm living life to my fullest, geez, I'm not even thinking about my 30s. I'll worry about them when I get there. And that's fine, all well and good. I suppose what we're saying is that's all well and good to do that, maybe, but if you can sort of think a bit about your long term as well, you'll get the benefits is what we're saying.
The sooner you think about your long term, the closer that's going to be, or the easier it's going to be to get to whatever that goal is, right? Yeah. And just an FYI, from my perspective, I think retirement is all a fugazi. It's not actually a real thing.
Well, that's a whole different debate.
People live their whole life for retirement, and then when you actually get to retirement, it's not actually a real thing.
What do I do with the time now? I've got too much time in my hands. And that's a whole different debate. You know, people say they'll never retire. They'll always want to keep their fingers in the pie, so to speak.
The thing is not retirement. I think it's all about financial freedom. It's like, well, it's just a thought, you know, knowing that you don't have to do something because you don't want to.
Yeah. If, you know, for a lot of people, they're stuck in a job till they're 60, you know, a job that is, you know, probably not giving them happiness or not giving them great job satisfaction. And, you know, they can't tell their boss to go and get stuffed and walk away because they don't have the financial capacity to
A job
do
at
so.
Henderson Advocacy until you're 60 would be a pretty incredible job if you ask me, personally.
Let's see if I'm here when I'm 60.
What do you mean? Aren't you 70? Mate, number 2, once you're clear on whatever that goal is, then it's about getting clear on the timeline, right? If you're 20 years old and you say, I want to retire by 30, you have to go, okay, I've got 10 years to achieve my goals. Is it actually realistic?
Yeah, well, we've spoken about that in previous episodes, you know, that it's probably not. And, you know, unless you've got some, you know, I don't know, something extraordinary going on, but you've got to be realistic.
That's right. Yeah. So it's understanding, well, what is that timeline? If it's a 30-year timeline in which I want to achieve this and I want to have X amount of dollars passive income, chunk that down, break that down to, you know, your
every
5 years or
your,
you know, and then your 1 year goals. And again, this is going to form part of, if you're a goal setting orientated person like I am, this will form part of your yearly goals that you do.
Yeah. And it's not a hard thing. It's not like your full-time thoughts and your full-time job is going to be breaking down the next 30 years of this property investing journey. It's just, like, I still had a full-time career in corporate world.
Well, it's investing in general, right? That's the thing. It's like
investing in general.
If you go, okay, well, I'm 25 right now. I don't want to be working past 50. I want to have the option to go and travel and...
Or, you know, cut down to part-time or casual work.
Exactly. So you go, okay, well, what do I need in today's dollar value? And you say, I need $150,000 net in my bank, $3,000 a week and no expenses to come out of that. So I can travel, I can eat at nice restaurants, and I can drive a Lexus like Frank. And then you just reverse engineer that and go, okay, well, what is it that I need to do to be able to get to that goal?
Buy the first one. That's what I say.
That's step number 1. Exactly right. And that's going to vary based on the age in which you're at, right? Like you said, if you're starting to think about retirement when you're 35 and you've done nothing for the 15 years prior, then it's also being realistic with yourself and going, okay, well, what does the next 20 years look like for me? Do I need to have a longer time horizon? Can I have a shorter time horizon? How much risk am I open to taking? And
I think, you know, you make a good point. Well, you know, we spoke about it before. A lot of people aren't starting to think about that until they're 35 to 40. You know, probably by that stage they've settled down, maybe with a family, you know, probably purchased their first property as a principal place of residence, going, okay, I'm starting to do some serious saving now. I'm 35 years old. Maybe I've now thinking about property investing or investing in other assets. It's not too late. You know?
Not at all.
If you think, you know, whether it's all true that the average age is going to be 80 to 90 years old or not, I suppose, you know, most people want to think positive and think they're going to live as long as possible. But even if you're 35, 45, 55, 65, that's 30 years. Well, there's a lot of capital growth in 30 years, I'll tell you.
Absolutely, Frank. Absolutely. And then once we understand what that is, you really need to understand the income you need, right? Because that's the most important thing. It's like, it's not about how many properties you have or how big the portfolio.
But even if you just start with the first one, okay, this is what I can afford, go to a broker, bank manager, you know, let's see what your maximum affordability is. You might not want to invest all of that, but see what it is to do the first one. Just get the first one, get the ball rolling. Then worry about, you know, your career or whatever business you're operating and that's
what I think. I always say, I say it all the time in a lot of videos around, like, they're like, oh, what would you do if you were to start again? Whatever it is, like, at the questions all the time on my TikTok and that. And like, if I was a first time buyer, that'd be the first thing I'd do is like, not worry about buying 20 properties, just go and buy one.
That's it.
Put it bang, straight back in there, take advantage of the schemes that you can get advantage of, put a tenant in that property eventually. And that's literally just something that if all shit goes bad in your life financially and, you know, your business doesn't succeed or your career doesn't do well or whatever it is, you've always got this little thing in the background there. It's like a retirement fund.
Yeah.
Because if it's covering itself, you bought it while you're young and you've got your whole life for it to grow.
And it's getting some capital growth along the way.
Similar to the one you bought, right? 80 grand, 10 years later, it was worth 180. You did nothing. You probably didn't even realize you had it. And
that's it. And I think too, a lot of people might get caught up in the, you know, the micro of, oh, well, you know, maybe I can't chase this goal of owning 3 or 4 properties or a certain value, $5 million worth of properties, because I'm not confident I will have the income to support it to get to that stage. Well, don't worry about that. Nobody knows, what the trajectory of their income is going to be. You just keep working hard, and it should, look after itself. Get the first one done, the first property purchased, invest in that, and then, the second one will come when the time is right.
Exactly right.
Don't forget, you hopefully got that first property. If you bought in a quality property in a quality location, you've got some capital growth there, which is going to give you the equity
Probably
side
make
of
more.
things.
It'll probably make you more money than you do from your job.
Oh, bloody oath. But you've got the equity side of things there. Well, that's that tick in the box. That's one side covered. Then at that stage, when you think, you've got another equity that it gives you a deposit for your second one, then worry about the income, because the income's going to be what it's going to be at that point in time.
Exactly. And I think what a lot of people do, just before we get on to the next point, I think what a lot of people do is they won't focus at all. And we've spoken about this on their career. They just think that like property or investment is going to get them out of not having to worry about a career.
No.
But they need to go hand in hand, right? It's not
yes.
like you can't just go all in on one thing and, just chuck all your money in that and really struggle. Like I think it's about doing one and then focusing on the other. And I think your career and your business or whatever it is needs to have the most focus, and your investing is a part of your focus.
Of course, yeah. Totally agree.
Because that's what's going to unlock everything else. Number 3 is once you're clear on what your motivator is, you're clear on the timelines in which you want to achieve your set goals. Number 3 is just understanding, well, what assets do I need to own, not net asset value, do I need to have to be able to get the passive income that I require?
Okay. So now you're talking, if that end goal is passive income, which
most people's goal would be, right? If they're like, I want to retire by this age, I want to be financially free.
Just holding $10 million worth of property is not putting money in your pocket.
That's right. It's probably taking money out of your pocket.
You need to get the income out of it, or for it to be income producing.
Exactly. So then it's like, okay, well, I know when I want to retire, you need to put a number on that, so you can work towards it, right? Because a goal, what do they say? A goal without a number is fucked if I know something.
No, I know they say, what is that? A plan? A goal without a plan is just an idea?
Yeah,
something like that.
that.
We'll coin that one.
That's the Frank Raiti one right there. Yeah, so then it's like, okay, well, if I want X amount of income, what is the net asset value do I need to have? And then how many properties would I need to buy to get that net asset value based on Australia's long-term historical growth rates over the long term, right? If you go, okay, I need to have, or actually, before you go, I need to have, you just go, what does one property look like right now over the next 30 years? If I was to buy this one property, nothing else, what value would that be at?
Yeah.
And what income would it potentially be generating? And now, if I did 2, what would that look like? 3, what would that look like? And naturally,
it's simply just a little bit of a forecast and creating a few what-if scenarios.
Which is what we do when we bring on our investment clients, is building out that overarching game plan to say, well, if you just do X, Y, and Z, this is what your target will look like in 10 or 15 or 20 years' time.
Let's add another property. This is what it looks like now.
Exactly right. So it's understanding, well, when we spoke about it, if the goal is 150 grand, for example, which is a common number here, 150 grand.
It used to be 100, now it's 150 with
That's
inflation.
right, inflation. So it's like for every 1 million of unencumbered assets, thereabouts, either side of that, you're generating about 50,000 a year. So you got 3 million, you've got 150,000, you got 4 million, blah, 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 blah. And it's how do we actually get to those numbers?
Here we talk about afternoon naps.
There we go. I need to have a kip, don't I? Mate, I was very tired this morning. And there's a few ways to get there as well, which we're going to chat through as step 4, which is formulating the strategy. You could just buy 2 properties, for example, at 500,000. Those 2 properties go from 500,000 to $1 million. You got $2 million in assets, but you pay down those $500,000 assets to 0. And that'd be the same as buying $2 million worth of assets, having those $2 million double to $4 million, and then selling some of those assets down and paying it off.
Yeah,
right?
there's various ways, isn't there?
So it's going, well, what is that end goal? What is my risk appetite? How many properties do I need to buy? Do I like carrying debt, or do I like to buy properties and pay the debt down on them? And then, following that. So, our strategy has very much been about acquiring assets and letting growth do its thing.
Of course, yeah.
I feel like, and you feel like, that's the fastest way to get there, because properties can grow much faster than we can pay down debt usually.
Yes.
And the debt is also relative to income. So regardless of what income you're at, if you've got a really high income, you're going to have a really high level of debt. It's, as a percentage of that, the properties grow much faster than you can pay down the debt.
Of course. And, the more free cash flow you have, and we've spoken about before about, why we prefer interest only as about principal and interest. And we hear it all the time, but I'm not paying down the principal. And, when we paint the picture for people and go, yeah, but, okay, you might have started with the, $1 million property that had $800,000 debt on it. So your loan to value ratio is 80%. If you keep that debt at 800 and that property goes from 1 to 2 and from 2 to 4, suddenly, 800,000 against $4 million asset doesn't look so big. So you don't have to worry about paying it down. And when you've got a second and potentially a third, if you want to go full on even more than that, then you can sell one or two and pays off the debt on all of them. So although you're not paying it month by month, that principal, you're going to pay them all off at the end.
Because the growth in the assets then makes the debt less and less
immaterial.
relative.
That what you started at an 80% LVR will go down to 70 to 60 to 40 to 30 to 20, and it'll become irrelevant.
Exactly right. And that's essentially what you've done with your portfolio, right? Like you've
always been
focused on paying down the owner occupier properties, but then you just let the
investments be interest only.
And never so essentially all of the debt across your investments would be the same as what you paid for them. Yeah. Outside of the equity.
At times
releases.
then I increased, I cashed out some equity to create a deposit for the next one. So in fact the debt's always kept rising, or that the debt levels kept rising.
But the debt off those properties is then essentially attached to the next property. So you've got 100% debt on those properties.
That's right, yeah.
But you've never paid down the investment debt, and as that portfolio has just continued to grow and grow and grow and grow.
The only investment debt I have paid, investment property where I have paid down some investment debt is where it's originated as my principal place of residence. And I changed principal place of residence and decided that this property was a good asset in a good location. So would make a good investment.
You just held on to it.
And so I've held on to it. And, the debt is low on it because while we were living in it, the interest was non-deductible. So
well, let's just talk about that asset, for example. And it's a great example. How much debt do you think you would have paid down? Like, what did you pay for the property originally?
Actually, so we're talking about that house in 5 Dock. We paid 1.75.
Mm-hmm. And what would the debt be on that house now, roughly, if you didn't factor in any equity releases? If you've taken any,
I think the debt on it, the loan associated directly with that property is only about 450K.
And what's the property grown to?
Geez, probably 3.3.
So has it grown by more than you've paid down the debt?
Has the property grown?
So it's gone from 1.75 to 3.3.
Yeah.
Which is about, 1.55 of growth?
Yes.
And how much debt have you paid down on that property? You would originally, what was your original loan on that?
I'm not sure. That's the thing, because I don't think I borrowed the full 80%. We would have had a bit of a cash saved up from sales of previous properties.
So let's just say you borrowed 1.1, 1.2?
Yeah, it would have been at least 1.2, I'd say.
There you go. So you've gone from 1.2 to what would have been now? About 400?
Yeah.
So you've paid down 800,
800,
but it's grown by 1.5 in that same time frame, right?
Yeah.
So it's grown by almost double what you've been able to pay down the debt on it. So imagine if you would have used that 800,000 not to pay down the debt, but to use that 800,000 then to service more debt of exactly the same property.
Yeah.
All of a sudden now you would have had 2 properties that would have the same amount of debt, but you'd have $3 million in equity. As opposed to just paying down the 800,000 in debt. Yeah. And that's the concept behind it, right? Yeah. It's like, well, can this money be used for a smarter thing?
Yeah.
Which in our eyes would be servicing more debt attached to a property, because that property is going to grow by a much more significant rate than you're going to be able to pay down.
That's right. And it even comes down to, where you hear about people paying off, there's theories out there, and it's not theories, it's fact, that you can pay off your principal place of residence in 7 to 10 years. And the theory with that is, instead of knocking down that non-deductible principal place of residence debt as quickly as possible, go out and buy an investment property, let that investment property grow and hopefully double between 7 to 12 years, 7 to 10 or 12 years, sell it, pay your CGT, and with the profits then just knock off the non-deductible debt on your principal place of residence, and you can effectively pay it off
faster,
depending on how much you borrowed originally. But you could knock off a good chunk, if not all of it, depending on the value of your principal place of residence. So that's that theory quickly.
And that all comes into the strategy piece, right? It's like there's all these different things we can be doing, and at the end of the day, strategy is really just saying, how do we maximize our dollar to go further?
Yeah, because someone else will say, well, don't sell your investment property. So paying off your your principal place of residence debt as quickly as possible is a good thing. I mean, these days you don't even have to pay it off. You just sit it in an offset account and negate the interest.
I guess the only thing an offset account doesn't do, though, it's a much better use of the money, but unfortunately, the bank still looks at you being 100% liable.
Of course, because you always got it there available to spend. So yeah, it doesn't help you with serviceability.
That's right, but it does free up the cash.
Yeah.
So Frankie, look, I think in summary of what we've covered off, there's 4 main objectives of this, which is identify what your motivation is, what is that driver behind what you want to achieve, set a timeline on when you want to achieve it by, how many years in which you want to get there, and obviously make that timeline realistic. And if it is an aggressive a timeline, just know that your investing has got to be as aggressive as the timeline. Understand what the asset value needs to be, or the returns on those assets need to be for you to be able to get the return that you want. And then it's about formulating a strategy on how you're actually going to make it happen.
One step at a time, I say.
One step at a time. Frankie, as always, mate, it's a pleasure.
Very good.
Mate, enjoy yourself, and I hope next week you come in something a little bit more colourful.
Will do.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Frankie, we're back.
We're back.
You're back in the hot seat. Fuck me. What happened then? You just...
I was on a slight 7-second delay.
The brain took a few seconds to kick off.
That's it. We're back.
Mate, you all right this week? What'd you do this week?
Very good. Very busy, mate. Very busy week.
Were you?
Yes.
Where'd you get those shoes from?
Oh, mate, I don't know. I bought them many years ago. They're not
Where
fully
from?
depreciated yet. 10 years.
Did you get they're from Vinnie's or something, are they?
They're from Oxford shop, mate.
Oxford?
Shop, yes. One-stop shop.
You buy them at end of financial year sales because you wouldn't have paid full price.
Oxford's always on sale, mate.
Mate, this week, mate, we've covered off a few episodes so far. It's
Yes.
probably the most consistent we've ever been with podcasts.
It has been, yeah. Very informative.
Mate, this week, here we go. I got someone calling me. This week, we're talking about the 3 biggest mistakes property investors make on their journey to building.
And they can make plenty, but we're just talking about...
Probably one of the biggest ones we've been
threes.
employing you. I said. But we're going to just talk about 3 today, because there's a lot of big mistakes you can make, but we're going to try and wrap up what we think the 3 biggest mistakes are.
Okay.
And maybe we can reflect on our own journeys and we could fall into some of these mistakes.
Well, this is probably not going to be one of them, but I think the biggest mistake is not investing in property.
That's right.
But we're talking about people who have made the decision to invest in property.
Exactly. Not starting at all is probably a pretty big mistake, and always trying to time the market. So. But mate, the 3 big ones today. The first one we're going to kick off is buying a property in the wrong location.
Yes.
That's almost potentially worse than starting, because you can become.
If you go backwards, then you would have been better off not starting. So
if I look at many people we've helped over the journey. I look at my own parents' journey.
Yes, that was a prime example. Yeah.
Buying 2 investment properties, one of them doing much worse than the other. 11 years they held it for. And sold it for less than what they paid for it, plus all the holding costs.
And a lot of people, I'll just stop you there, Jack. A lot of people think that that's unheard of. That can't happen in Australian property. That if there's some people say, well, throw the dartboard at the map, go buy the property and hold it for 10 years and you'll be sure to make money. But your parents are a prime example that that's not always the case. And I'm sure there have been many people who have fallen into that trap, bought in the wrong location, held it for 10 years, and not only not made a profit or not made any capital growth, but gone backwards.
That's right. And it holds all the opportunity cost, right? You buy the wrong asset in the wrong location and it does go backwards. Many people won't cut their losses because they just keep waiting. Oh, it'll perform, and potentially never does.
Yes.
And you never get your money back. We're working with a client at the moment, similar thing. Bought a property in a suburb in Brisbane. I can't really remember where it was, but they held that property for God knows how long, ended up same thing, selling it for net less than what they pay for it. Fortunately, they put down a 20% deposit. So they did have some money that they got back,
right.
But they held it for long, the last 7 or 8 years. And they've got an owner-occupier property in Sydney that they've done exceptionally well out of. So that's probably, one of the main issues with investing in property. It is good to start. Absolutely, most people would do much better by starting than not starting at all.
For sure, yeah.
But if you start and you buy the wrong property to begin with, it's going to put you a very, very long way back. Because by the time you realize you bought the wrong property, what are we, 24 to 36 months in at a minimum?
Yeah.
Because you're not assessing a property's value every day, right?
No, it's not like a stock on the share market where you can see, you know, after a month whether, you know, it's gone backwards or not, and even a month is too short for something like the stock market. But you're going to have to wait at least 3 to 5 years.
And you've still got that, you know, within the first 12 months, it's super exciting. I bought a property, we've got tenants in there now, and then, you know, you get 2 years down the track, and you probably, you know, may or may not even get it revalued at that time, right? And then you might get 3 years in, you're like, okay, let's buy another property. You get it revalued, and you go, oh, fuck, it's much less than what I paid for it. It's at the same level.
Yeah.
And if it's at the same level than what you paid for it, and let's hypothetically say the rent's covering the mortgage, but you've still got some other expenses, you would have been better off just saving because you've paid stamp duty to get into the property.
You could, but if, you know, there would be instances where a property has done nothing over 3 years and then boom, you know, gain 60% in the next 2 years.
Yeah,
so
that's right.
It is all about just
uncommon though.
Holding, yeah.
So buying the right. Gabs, is there any I guess instances you can reflect back on your journey and say that you potentially bought a property in the wrong location, or people that you know have bought a property in the wrong location that's been detrimental to what they've been looking to achieve?
Nothing that's detrimental. I am still holding a unit that I bought that I used to live in. That's, you know, when I look back at the average annual growth rate, it's probably only doing, you know, 3.5%.
Which one is this?
This is in Newington. So it's only doing about 3.5% per annum. And again, I'm cautious to sell it because, well, one, I don't need to. It is paying for itself. And it's a 3-bedroom penthouse apartment, which they usually track pretty closely to 3-bedroom houses in that apartment.
And if you ever go through another divorce, it could potentially be a bachelor pad.
Yeah, well, it was the bachelor pad when I got divorced. And the gap between the 3-bedroom houses in that suburb and these 3-bedroom units, which are pretty few and far between, has really widened. So I'm assuming as the 3-bedroom houses become more unaffordable, that people will revert to the 3-bedroom.
And let's talk about what made this property potentially underperform. Newington, for people who don't know, is in the inner west of Sydney. It's not a bad location.
Not a bad location. It's I don't know if you would call it the inner west. It's around that Sydney Olympic Park area.
That's inner west. Roads.
Yeah. Without being in Sydney Olympic Park and in the high density there. Look, I think it was just that it was a relatively new suburb. You know, it was built around the time of the Sydney Olympics, so it's now, you know, 23 years down the track. You know, why it hasn't performed, you know, I'm not exactly sure, but you know, I'm only talking about my one in particular.
Yeah.
That's sitting at around that 3.5% mark. So look, in hindsight,
it's performed probably similar to inflation at the end of the day.
Yeah, I could have put that money elsewhere, but look, I bought it to live in. Like I said, I went through a divorce. I needed somewhere to live. I bought it. I liked it, and thought, well, the transactional costs of trying to sell it, you know, was I might as well just hold it.
Yeah.
And away we go.
To be a fly on those walls, huh?
So yeah, so like I'm holding it. I do feel like, you know, I'm lucky that I'm in a position that I can afford to hold it. I don't need to sell it and try and put that money into something else. So happy to hold it. I'm certain it's going to catch up, you know, or close the gap between the 3-bedroom houses.
Eventually, yeah. And, but it's a good example. Imagine if you bought that one for your first property, for example, and had no other assets to be able to leverage off.
Well, then, you know, the growth of the second and third would be a lot slower for sure.
Yeah, well, you wouldn't have been able to get that second or third.
There's not
right?
not much equity in it to release.
Exactly. That's a prime example. I think the number 2 biggest mistake that you can buy is, and I guess it follows on from buying in the wrong location, is buying an underperforming asset. And I guess Newington is a good example of that, right? You can buy, and I have an example of buying an underperforming asset. You can buy in the right location, but you can buy an underperforming asset inside of that location. It comes down to the asset selection. And that's why, you know, a lot of people really focus on getting into the best quality location they can get, which is great, but their budget allows them to get the lowest quality asset inside of that location.
So it might be on a main road. It might be too close to the train
station. May not have parking, may have privacy issues with apartments looking into your backyard. Yes. You know, you could have noise issues. You might have issues with sunlight, for example, because it's you know, shaded. All these little things mean that sure, you might be in a prestigious suburb, or you might be in a suburb that's growing, but if you buy the wrong asset inside of that suburb, you're going to have a property that is then underperforming. I've got a property myself. similar to yourself, I bought this for more of a lifestyle asset for myself. It was a sentimental thing. I always wanted to have a property on the river. So it come up for sale and I bought it just because I wanted to have a property on the river and I can afford it. That property hasn't done that great.
Yeah.
It's a block of land. It's in an area now which is classified as a 1 in 100 year flood zone. It's literally right on the Hush River, but I'll buy it and I'll never sell that property and I'll enjoy it for the rest of my life.
Yeah.
But that's a great example, right? Could I have put that $1 million of servicing into another property that would have performed better? Absolutely, I could
but
have.
like you said, it was a bit of a lifestyle decision there, and people make those decisions, more with the principal place of residences. They buy in locations or suburbs or regions that they want to live in. Yet they might those suburbs or regions might not perform that great, but they don't care because they're going to live there for the next 30 years of their life.
Yeah, but if we're talking purely investment, that's a big mistake you can make. Is buying an underperforming asset. And I literally hear this every single week from different investors. We want to be in this suburb, we want to buy here. I just got off the call from someone in Brisbane, wants to buy a 4-bedroom house in a certain pocket of southern Brisbane, and his budget's not going to afford him a good home in that suburb, which means he's going to be on a shit street, he's going to be in a shit pocket of the suburb, and sure, that suburb might do well, and a rising tide does to an extent lift all ships.
It does, yeah.
But you could probably do much better if you were potentially 1 or 2 suburbs out and buy the best or a much better quality asset inside of that suburb, because a location does 80% of the heavy lifting, but the property, is the thing that the buyers are attached to, right?
Yes.
Because there is buyers inside of every suburb. If you look at where we're sitting right now, the eastern suburbs of Sydney, you can have a Paddington address, or you can have a Bronte address, or you can have a whatever address, Mossman address, but if you're on the worst street in that suburb, it doesn't matter. Because the buyers inside of that location don't want to buy the worst suburb. And you see it all the time, right? They sit there for sale for ages.
This is the thing. Down
ages.
the track, you try and sell it if that's what you choose to do, and it sits on the market, even though it is in Mossman. Let's use that as an example. If you can't sell it,
yeah, exactly.
Therefore, I say, what's the use of having it, sort of thing? Or if it's always going to be valued well under the median of other properties in that suburb, is that the best thing for you? Whereas, like you said, go a couple of suburbs away and get a premium asset.
And we talk about your Newington property, Frank. It's asset selection, right? You've bought in the right location, but you've bought the wrong potentially asset inside of that location if you were purely going for a performance-based property, right? My parents, same thing. They probably bought in the right location. The Sunshine Coast of Queensland is a great location. Maroochydore and Coolum and all those places is great, but they bought the wrong asset. They bought an apartment in a high-density block. Sure, it was on the beach, but there's lots of apartments in there. Wasn't a lot of infrastructure spend going on around there. And it was a holiday location, so very reliant on tourism. And when there wasn't tourism, that they really struggled. So again, it's buying the wrong asset. It's the asset selection
So what
process.
do you suggest to listeners out there? Because it's time. It's over time. You look back and you go, well, at the time I thought this asset would perform well. It's now obviously not. So how can people,
avoid that? Well, I think the main thing,
mistake?
right, is looking at the track record. That's the easiest way to safeguard yourself. With Newington, new suburb, no track record. With where my parents bought, they bought in a place called Marcoola. No track record. It's a new suburb. You look at apartment track record there, and there was none. So the easiest way to safeguard is to go, what asset am I buying? Whether it be apartment, whether it be house, let's look at the data into those locations. And if it's done 20 or 30 years worth of consistent performance.
So the first thing is let's look at established suburbs.
That's right, because that's how you're going to safeguard it. Now, we're not a big advocate for new areas, and that's the main reason. Because sure, you may do well there, like you absolutely may, and there's probably people who have done exceptionally well.
And there might be that initial uplift, but at the same time, you're possibly paying a premium.
There's just a lot of risk.
Yeah. Now we look at the Badgerys Creek new airport. Going in there, and a lot of new suburbs and house and land packages being sold in and around the new airport. Thousands
and thousands and thousands. And those people, if you look at them in 3 or 5 years, they probably will do well. They'll probably get growth. They're still in Sydney. They're close to a lot of stuff. There's a lot of hype around that area.
Now, the majority of those people purchasing in those areas will be owner occupiers. It's a highly affordable area, southwestern Sydney,
relative to the rest of Sydney.
Yeah, relative to the rest of Sydney. What is it, 50, 60 Ks from the Sydney CBD? I'm not exactly sure. But you will still have people with cash able to borrow who will go and think that is a good place to invest.
Many. I have a client who's done that. He's bought a property in Austral, which is out that way. dual occupancy, and it's going to be a strong earner. But for me, I'm just not comfortable doing that because I can't look at a track record. I can't look at research and data, and it's essentially like investing in a company, right? Or everyone's, well, not everyone, but a lot of people are into crypto. Like,
yes.
There's just so much risk. With risk can potentially come reward.
Of course, yeah.
But with risk can also come the other way, which is not where you want to be when you're just getting started out.
Yeah, and I always ask myself the question, why take that risk when there are so many other options to purchase in established suburbs? Why take the risk on a brand new suburb, so to speak? Now, I did buy in one of those brand new suburbs. First when I moved to Newington, it was for looking for a principal place of residence, and I bought a unit first, and then sold the unit, bought a house off the plan, then got divorced, sold the house, and I sold that house for a good profit, mind you, and then bought the unit to live in by myself. So that was very much a lifestyle decision because I liked the area. It was close to family and friends and things like that. So I just decided to hold onto that property, and turn it into an investment. Now it's always been rented. It's always been rented well. And I think it would, sell well. It just hasn't had that, amount of capital gains that I thought would have had after holding it for, nearly 10 years.
Yeah. Frank, did you get a haircut today?
Yes, man. Got a haircut.
You're looking sharp. You're looking very fast. Did they use wax on your hair at all?
No wax, mate.
Not to polish the forehead either? It's very shiny.
No hair there to put any wax or gel in anymore, mate. I'm saving lots of money on gel.
Very shiny. Very shiny. Did you wax your shoes this morning? Those toes of those Oxfords look like they need a nice polish.
That's all right.
What do you reckon, Joel? Yeah?
All right, let's move on to number 3.
So I just got so distracted by your haircut.
What's the third biggest mistake, Jack?
Well, there's a few, but the one that I think will probably complement, buying in the wrong location and then buying the wrong asset is then overpaying.
Oh, of course. Yes.
If you go into a transaction and you overpay for that transaction, that's going to cost you. Even if that property does grow, it's potentially only going to grow to.
And there's a lot of people who say that you make money on the buy. You make money on the buy, and they talk about below market value, and we can go on about that as to what true market value is. But you're right. If you're overpaying, that's not a good start, is it?
No, and you see it a lot with new property. You see a lot of overpaying that happens when valuations come in under, right? There's probably a lot of that kind of stuff happening right now where people may have bought 2021, 2 years later, 3 years later, they're settling in 2023, 2024, different economy, different sentiment out there in the marketplace by the valuers who are going to give you the valuations to settle, more conservative in nature, and the valuations come in under, which is scary because then you've either got to top up that gap between what the val is and what you paid for the property, or you've got to rescind on the contract and lose your deposit and potentially face repercussions from that. And you also see it in established property as well when people
when we get emotional, boom times and they go emotional at auction.
People get emotional about things.
People going crazy at auctions.
They combine all three. They buy in the wrong location, they buy the wrong asset inside of that location, and they overpay. And
you'd hope
that's a disaster.
You'd hope people wouldn't do that.
Mining towns, they don't really get spoken about too much anymore because people, I think, have learnt their lessons. But
no, but not even mining towns. You can talk about,
Perth.
Any CBD, any Melbourne, Sydney. What did I say? Melbourne, Sydney, Brisbane. Units in the CBD. I just recently did a report on the region of
let's pull that up.
The inner city of Brisbane and units, and they've only been doing 1.5% per annum over the last 10 years.
Let's pull that up.
We've spoken to people who have purchased in a one bedroom, one bedroom, one bath, no car unit in a high rise in Melbourne CBD, and actually the value has gone backwards.
And then they can't.
Not even getting 1.5% per annum growth, but just negative growth as they call it.
Well, let's pull this up, Frankie, because you've done a lot of reports here. So I'm just gonna. Where are we here? Brisbane inner units. Now, this is actually a really, really good example. Now, Brisbane inner as a SA3 combines 3 of the best suburbs in all of Brisbane. New Farm just had the record broken, 20 million and 500,000
for a house, not a unit.
That's right. Now, Kangaroo Point, probably pretty densely populated with a apartments.
Yeah.
But, you know, the houses
West
there.
End, I think it includes West End, which
That's
has a lot of
South
apartments,
Brisbane,
a lot of new apartments.
Highgate Hill. It's on the border of Paddington and Red Hill. So all of these areas, these suburbs, the best suburbs in Brisbane. Okay. But what they've done is you've bought the wrong asset inside of
Bought
those
a high
suburbs.
density apartment, yeah.
Well, just an apartment in general. So we go the household income. If we look at the numbers, $1,900 per week. That's extremely high compared to the median in Australia, probably somewhere around $1,600. Distance to Brisbane CBD, 0 to 3Ks.
Yeah,
Ticks that
right in
boxes.
there.
Now this is an interesting one. 83.5% of properties in the region are actually units.
There you go.
So there we go.
it's
We've got a huge amount of supply. Houses are very scarce in these areas, obviously. 64% of all properties in the region are occupied by renters. Extremely high, which means...
Not much owner-occupier appeal there.
That's right, for the apartments in the region.
Yes.
Occupation's not really relevant. Now, this is going to be the interesting. We've got a median price of 520,000. That's combining 1, 2, and 3 bedroom apartments. And if we look at the 12-month growth, it's almost non-existent. So
I think it's about 4%, isn't it?
4%.
It's been better than this.
which is lower than inflation was over the last 12
but
months.
better than the long-term
But then let's look at if you would have bought one of these things in 2015. So in 2015, the median price was 505,000. That's up from 2013 being 450. So we've had just over 10% growth in those 2 years. Now from 2015 to 2023, the median has not changed.
It's still 505.
It's gone from 500,000 down to its low of 475,000, which was in 2020. So you could have held that property for 5 years and you've gone backwards.
Yeah.
Prime example of overpaying for a property during that time. Now from 2020 to 2023, during one of Australia's biggest ever booms, it went from 475 to 520, which is, again, 10%, almost less than 10%.
Yeah. Well, the boom was primarily
to
housing,
50%.
and it was primarily housing led.
Potentially, but if you look at apartments in the right locations, let's go to the eastern suburbs of Sydney, you probably would have made 50 or 60%. So this is a great example of buying the wrong asset in the right location, but the wrong location for that type of asset.
Yeah.
And then overpaying for it. So if you would have bought in 2015 and not looked at what we look at being a proven track record of performance, you potentially have only just made back your money over the last 8 years. And during that time, if you would have then, let's compare that one report, and we'll chuck these reports in the show notes for people so they can read them as well. So,
Now, what's happened over that period as well in regards to Brisbane is, and those suburbs, 0 to 3 kilometres from the CBDs, they've continued to develop and build new unit blocks.
That's right.
So
And
the
what that
supply has
continued.
increased. And obviously, as more supply hits the market, that's what keeps prices down.
Now, Frankie, you're going to love this, mate. I'm telling you. So let's go back. When did we say? 2015 is when it was. 2015, you could have bought an apartment in Brisbane for 505,000. You bought in Geelong in that same time. Okay, you would have bought a house in Geelong for 368,000 was the median in Geelong. Now, prior to that, Geelong had a very strong track record of performance as well. Since 2014-15, 368,000. We've had 9.6% per annum over the last 10 years. The median house price has not been lower one of those years than the previous year.
So what's it at now?
We've had consistent performance. Now, the median's gone from 368 in 2015 to 685 in 2023. So it's almost doubled in 8 years.
And you could have got in
At
cheaper for a couple of
cheaper.
Yeah, 150 grand cheaper than Brisbane.
So, and then if we look at the numbers around Geelong, we've got a median household income which is slightly lower, being $1,600 per week, so just the median of Australia. 96% of properties in this region are houses, which means houses dominate the area. Rental ratio is significantly lower at 30%, which means 70%, which is
Our
in
owner
line
occupiers, yeah.
with the Australian average, our owner-occupier buyers. And it shows that if you buy the right asset in the right location and you don't overpay, you're going to be okay. So there we go. There's some live data for you. What do you reckon, Frankie?
Very good. It's always good. I love my data.
We'll chuck the Geelong report and the Brisbane unit report in the show notes. So
Yeah,
there you
it's very
go.
good.
So
they're the three things.
Mate, let's just recap on that. So number one, buying in the wrong location. That is going to be a significant issue if you do that for you. Number 2 is buying the wrong asset in that location. Okay. And number 3, got to count 1, 2, 3 fingers, is overpaying for the property. What do you reckon, Frankie?
Very good, mate. I think that's a wrap.
I reckon we shine those shoes and we get a little hop, skip and a jump straight down there to Grappa and Leichhardt and have a feed. What do you reckon?
Yes.
On you,
Sounds
Frank.
good.
See you next week, team. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Frankie!
Hello.
Mate, we're back.
We're back for another
And I
week.
was actually just commenting on your shoes.
Yes, very
Give us a look at them.
Mate, these are just back on the navy blue
They're your
Nikes.
wife's, aren't they?
Not my wife's, no, they're men's.
Mate, they're
What
very...
about you? Your pink socks, are they your girlfriend's?
Mate, they're nice, huh?
Flamingo socks, of course.
And that shirt, you've still got the stain on it from dinner last Friday night. That's garlic bread on the front, is
it?
it?
In between, mate. It's been through the cycle.
That's your going out shirt, isn't it?
Yeah, one of.
See, folks, that's the biggest lesson you're going to get out of this podcast. When you have lots of cash, the way that you get there is you spend very little. They're on the sale rack, weren't they, those shoes?
No, mate, they were quite expensive, actually. I'm trying to help the inflationary causes, mate.
Are you?
Trying to keep inflation down by not spending. That's the
That's
lesson
right.
of the week.
Just
you want
save it.
inflation to come down, stop spending, people.
Well, mate, the way to stop spending is just carry as much debt as I do, and then it just evaporates all of your disposable income as the interest rates go
You've
up.
got no choice. Well, that's the aim, mate. That's what they're trying to do.
So, mate, it's working.
Very much so.
It's very much working. Now, Frankie, today what we're going to talk about is something that you and I have been very good at throughout our investing journeys. Your investing journey over the last 70 years and mine.
70.
and
You're going in dog years now.
and mine over a shorter period of time. But it's about leveraging equity and, at the end of the day, being able to maximize the bank's money, essentially, and what I call fake money, because at the end of the day, it's not really real, right? It's numbers on a bit of paper or numbers on a screen.
I don't think you ever see the real cash, but it's the numbers are there in the bank account.
But it's very, very good. It's very good. And to be honest, it's something that a lot of normal mum and dads or people who maybe buy one property and then sell it and buy another one don't really understand how it works and how to leverage equity and why actually growing your equity is the fastest way to be able to get to passive income as opposed to trying to earn a little bit of income along the way and pay down the debt.
Yeah, I think, look, the most, let's call them mum and dad investors understand that, yes, you can go out, the bank will lend you up to 80% of the value of a property, but then that property grows in time, just say over 5 to 10 years, and not quite understand what equity is and how you can leverage that equity without actually needing to sell the property.
That's right. A lot of people think that obviously they save the deposit for their first property, and the only way that they can buy their next property is either to save another deposit or to sell that property down, realize the gain,
cash, the gain,
and then use the cash again for a deposit.
That's right.
And it wasn't taught back in the day.
No,
when
they don't teach you this stuff in school. Maybe they should.
When you were going to school, I mean, they wouldn't have had computers. You were probably still.
They didn't. This is not a joke.
Homing pigeons.
Definitely no computers, and computers came in later in.
Was it still horse and cart when you were going to school?
No, not quite.
So look, essentially, let's define equity from a property perspective. Essentially, equity is the gap between what your current mortgage is on the property, and if you have a mortgage, and the actual value of the asset or what the bank values the asset at. That gap is your equity, which is essentially, what they calculate to generate your net worth, which is what your net asset value is. Obviously, net asset value being gross assets minus all of your debts or liabilities, and then getting you that net number. And then, that's your net worth essentially. So the equity is the gap between the mortgage and the property value. We can't access 100% of that. The banks,
No.
if we
So there's
want.
equity and then there's usable equity.
Yeah, that's
which
right.
The usable equity is obviously 80%
For the most part, yeah.
Yeah.
For the majority of people, you can access up to 80% of a property's value. And let's hypothetically say you've got $1 million property or a property that's valued at $1 million. You've got a $500,000 mortgage on that property that you may be paying down. Essentially, you can access 80%, which means that'll allow you to access up to $800,000 of that property, and the gap between your current mortgage being $500,000 and that equity value being $800,000 will allow you to access that $300,000 of usable equity, which essentially still means then you've got $200,000 of equity in the property, but you can't touch that because that's the bank's buffer.
And with that $300,000, you take that as a deposit on maybe 1, maybe 2, maybe 3 additional properties.
Exactly right. So with that $300,000, most brokers or bankers will tell you to do a thing called an equity release. And what that essentially is the bank going, okay, here's the $300,000 in equity. They will give you that as essentially a cash out amount. They'll put it in, a cash.
Well, it's a separate loan.
Yeah, that's right. It's cash of which you then use that cash for a deposit. Some bankers or some brokers will do a thing called a cross collateralization, where they use that equity to collateralize, or as collateral, I should say, for the other property, which means both of those properties are essentially locked together. Obviously get advice on this from a broker or a banker or someone in the finance world, but for you and I, that's not how we do it. We get equity release loans or cash outs, and you then use that cash as the deposit. So essentially what happens then is you go from having a $500,000 mortgage on that property to an $800,000 mortgage. Probably they'll be split into 2 loans, one of 500,
you
one
get
of
a loan
300.
split because the purpose is quite different. Like that original $500,000 loan, let's assume that was the original loan amount and you hadn't paid anything down, could have been for your principal place of residence, where the equity release of the additional $300,000 might be for your first investment property. So the purpose is quite different.
That's right. One has now become an investment debt, which is tax deductible, and the other is non-deductible debt.
That's right. Yeah.
So you've got $800,000 of debt now against that one property, and then you use that $300,000 that you've cashed out as the deposit for the next property, or split them, multiple deposits, like you said. And essentially, what this means is the only property that you really have to save cash for is the first property.
That's right. Yeah.
Any property after that then just becomes about recycling equity of which that property is generating. And this is why we're so big on not paying down debt, but trying to actually increase your debt levels, because as you increase your debt levels with assets like property that grow in value, what you're essentially increasing is your ability to be able to grow your wealth. Because if you've got debt which is attached to properties, the more debt you essentially have usually means the more property that you own, or the larger the value of the property that you own. And as we know, properties grow in value over the long time. So if you've got $1 million in property growing at 10%, you're making $100,000 a year. If you've got $5 million in property growing at 10%, you're making $500,000 a year.
Yeah, and I've spoken about this before about, even in my own property journey, yes, your first, second, sort of third property is the hardest, but once you've got 3 properties in the market, and they could be split across 3 different states, and they could be a combination of houses and units, but let's just talk about property in general. When you have 3 properties in the market growing, and they might not all grow at the same time, but that's a hell of a lot of equity or capital growth that you are creating, as opposed to just having one. And like we said, from the equity you release out of, let's just say 2 properties or 3 properties, it means you can quickly leverage into property number 4, 5, and 6, and it creates a snowball effect. And once you then got 5 or 6 properties, now this is all obviously subject to affordability and servicing criteria, but let's just say you have the income to support this. Wow, then you've got 5, 6 properties growing, and you can really catapult.
It's the compound effect.
It is a compound effect, yeah.
And being able to leverage your equity is the fastest way to actually get to a passive income. So I think the misconception out there is, let's buy a property that's positively cash flowed. The theory is that positive cash flow will pay down the debt, and eventually the positive cash flow, because every dollar we pay down generates more positive cash flow because you've got less debt.
Yeah.
Eventually that positive cash flow will pay the debt down to 0, and I have a property that's unencumbered. Hopefully it's grown in value, and now I've got the income that comes off that.
Yeah.
But what we find is, and we find this with our own owner-occupier properties, is it takes us a very, very long time to pay down debt.
That's right.
Most mortgages are 30 years, and you pay that down over a 30-year period. And at no time during that 30-year period do we think, wow, our mortgage is so cheap. Because usually we stress ourselves to a point where we're like, fuck me, mortgage takes a majority of my surplus income.
Yeah.
So it takes a long time to pay it down to 0, and some people never get there.
No.
But what we know is what happens much faster is that property growing in value. So let's use that same $500,000 example. That $500,000 property, let's say that we bought it, we got a $500,000 loan, and that $500,000 loan is now 30 years. Standard loan term. You've got 30 years to pay that down. And if you're spending 500 grand, that 500,000 is probably going to, take 50, 60% of your income, usually your surplus income.
Yeah, depending on what rates are.
Yeah. So it's going to take you 30 years to pay that down to zero, which means if to get to a passive income of having zero debt.
Well, 30 years, let's just say you started at 20, you're now 50.
That's right.
That's your whole investing journey just about done.
Exactly. But during that time, the same property is probably gone from 500,000 to 1.5 to 2 million over 30 years.
Even more, yeah.
Hypothetically. You've probably seen this in your time. Yeah. You've been investing for 30 years.
Yeah. Well, I haven't held a property for 30 years. But
Well, what would that same $80,000 apartment you bought be worth now?
I think I looked it up. I think it's worth close to 500,000.
There you go. So in 30 years, it's gone from 80 to 500,000. That's 5x its value. So let's use that on a $500,000 property. That same property is worth $2.5 million.
Yeah.
So in the time it's taken you to pay 500,000 to zero, that property's gone from 500 to $2.5 million. So it's 5x its value in the same time that it's taken you to pay down to zero.
Right. There is no way you can possibly save as quickly as capital growth can eventuate.
Exactly. So if that's the case, instead of trying to make a small amount of income over the journey, because the reality is you need to get to, if you're trying to replace your income with a passive income target, it's going to take you a long time to be able to do that through trying to pay down debt.
You need multiple properties, don't you?
So our concept and what's worked for you and what I'm on that journey doing is let's not worry about paying down any of the debt. Because, and I've said this online before and people say, no, that's wrong. It costs somewhere between 75 to 100% more to pay P&I on a property than interest only. And what I mean by that is it doesn't cost 100% more from a actual mortgage repayment standpoint. Your mortgage doesn't go from $3,000 a month to $6,000 a month. No. The 100% difference is what an interest only payment is say $3,000 a month. And let's say the rent on that is around about, let's say $2,800, $3,000 a month. So it's costing you $200 a week. P&I repayments make that $3,000 mortgage go from $3,000 to say $3,600. So the gap then is another $600 of which you've got a cash flow.
Yes.
So it's an extra 100% of cash flow out of your pocket, not necessarily the whole mortgage.
And people go, but that it's paying down principal. When are you ever going to pay down the principal? That's a whole nother debate.
100%. And so we say, instead of using that extra $300 or $400 a month to pay down the principal on the property, use that extra $300 to $400 a month to go and service one more $500,000 property on interest only. Because if one $500,000 property was costing you $200 or $300 a month to hold, for example, these are the example numbers, then two properties would cost you $600 a month, which is the same as paying one property of P&I.
P&I, that's right. And now you've got two in the market that are growing in value.
That's right. And if we know that a $500,000 property grows to $2.5 million over a 30-year period, that means two properties would go to $5 million over that same period. Yep. And it's cost us exactly the same amount of money than it would if we owned one $500,000 property and paid that to zero over 30 years.
But we still haven't paid down any principal, Jack. What about that?
That's right. So if we have one property over 30 years, pay it down to zero, we've got now $2.5 million of equity or unencumbered asset because we paid it down to zero and it's grown to $2.5 million. No debt. But let's say we did the strategy where we buy two properties, pay no debt down. So we still, at the end of the 30 years, have $1 million in debt between the two properties. Yep. But we've got $5 million now in gross asset value. So let's hypothetically say we sold one of those properties down. So we sold a $2.5 million property down, paid off the $1 million in debt that we have. So we're left with now net $1.5 million in cash plus a $2.5 million property that has no value. We've now got $3.5 million of net worth, with exactly the same scenario by paying exactly the same cash flow out of pocket for the last 30 years, and we're $1 million richer. So which would you prefer?
Exactly. And the debt becomes irrelevant over 30 years. $500 grand on $2.5 million. It's irrelevant, so to speak. Your LVR has dropped to
25%. Exactly.
Versus where it first started. So,
and that's the whole thing about leveraging equity. So instead of paying everything down to zero or worrying about using the cash flow in the short term to give you little drips and drabs, have a little bit of delayed gratification and to work out what is your passive income target. And let's say it's $100,000 a year. Yep. If it's $100,000 a year, you need $2 million in net assets or cash to give you $100 grand, 5%.
5%.
Roughly, net. So what's the fastest way to get there? Is the fastest way to get there to be able to buy a property, pay it down to zero, and let it grow to that level? And if we use the example like we just did with the 500,000 growing to 2.5 million, work out what that does. Or is it faster to buy 2 properties, pay down no debt, get to a certain point, sell down one asset, pay down the debt on the other, and then turn that from a growth focused strategy into a cash flow focused strategy? And that's what we do.
Yes.
It's how much growth do we need to get to a point to go, okay, now I've got my passive income target. And numbers are different for every single person. But if your target is $500,000 a year, you work that out. What is my net asset value need to be? Bang. What does it look like if I try and pay the debt down over time? What does it look like if I just leverage up, let those properties go from X to Y over that same period of time, sell down some assets? Oh, you got to pay capital gains tax of 22.5%. Big whoop, and then live off the passive income.
Yeah.
And that's all that whole strategy is just around leveraging equity.
Yeah. And I think the important thing there is, you don't need to sell the asset to realize the capital gain. Like we said, the bank will lend you up to 80% of the property's value. So leverage that equity. Yes, you can't, if you sold the property, you would access 100% of the equity. But geez, being able to access 80% of it is pretty damn good.
Absolutely.
So, keep the asset, because as soon as you sell that asset, yes, you access that extra 20%. But you've lost the future capital growth of that asset. You've lost the rental income, and all you're going to go, you're now going to pay some capital gains tax. And all you're going to do, if that's your aim, is to take that capital gain and go and reinvest again.
Exactly.
So why go through the transactional costs of selling, what hopefully is a good asset in a good location? Leverage up to 80%, take the money, use it as a deposit for number 2 or number 3, and over time, number 2 and number 3 will create equity, and you go again.
Exactly. And then
it actually becomes easier. I found it actually, the more properties I had, the easier it was. One, I was more experienced. And 2, like I said, once I had 3, 4, 5 properties in the market growing, wow, you went through a boom period and literally you're making, $1 million in equity in a year or 2. And then then equity's not an issue. It's affordability and serviceability.
That's right.
That's the other side of the equation, as we know of.
The pendulum swings, right? Like a lot of people would have known a time where equity was what banks really cared about, and they didn't really care about servicing, right? Where now it's swung the other way. You can have millions of dollars worth of equity, but if you don't have an income, they won't lend you any money.
That's right.
And that's bound to change again. That's bound to swing another way. So it's all about just being in the market for a long period of time. And at each point in the journey when you're going to buy or when you're going to, change tunes, you need to assess the market at that point in time. And like you said, you get more experience, you talk to more people, you understand things in more detail. And usually when you do that, you can access more stuff, right? Because when you are at a novice level or a beginner level of education and knowledge, you access novice and beginner products.
Time is key. Like we said, if you've got 30 years to invest, that's fantastic. Because the longer that you're in the market, the more capital growth you're going to realize. But the thing is, for you buy your first property, then you might have to wait for that growth for your second, then you might have to wait again for your third. But like I said, once you've got 4 or 5 in the property, your wait is actually shorter to get to your number 6, 7, and 8.
That's right.
Because you've got multiple properties.
And even if they're only growing at 5%, 5% across the whole portfolio gives you another deposit.
You don't have to wait till you're getting 10 to 15 to 20% growth. You only need 5% on each of them, and suddenly you've got enough equity there to say, hey, I've got now another deposit for property number 4 or 5.
And that's happening right now. Like everyone thinks the last 12 months we've had no growth, but I went and valued all the properties that I could. Bang, another deposit. I'm not going to spend it on another property right now. But there's another deposit.
It doesn't take much. It doesn't take much. And that's what I've realized, that having multiple properties in the market growing, they don't have to grow that. You don't have to have a boom. You could just be getting a nice, steady 3 to 4 to 5 to 6% growth per annum. And as we know, that anywhere around the Australian property market, what's the average? 6 to 6.5%. So even if you're only getting 4 to 5% in the quiet times, the boom times will come at some stage during a 10-year period. You'll get that 18 months to 24 months of boom, and that's really then when if you've got 4 properties in the market, you're going to see some real quick growth in equity. But in the quieter times, you only need to see 3 to 5%, and you've got enough deposit to go again.
Exactly right. And then when you get to that stage of, okay, now I've got enough, it's time to kick back like you're essentially doing now, there's many different ways to do it. Like I was speaking with a good friend and a mentor recently, and he was talking about, well, he's at a stage now where he's not really doing a great deal inside of his business. He has, $25 odd million in assets. He was carrying a relatively low level of debt on that, like circa 10 million.
Yeah.
And which essentially means let's say he's got 10 properties all valued at 2.5 million each, and they've got $1 million in debt on each of those properties. He said to a few of the lenders, well, you've got an asset that's worth 2.5 with $1 million worth of debt. Let's say you've got 3 of those. How about I leverage up 80% on 2 of those assets and take the title deed back on another one?
Okay, yeah.
So now you've got an unencumbered. You've still got the same level of debt, but now you've got an unencumbered asset.
So they just restructured it across the
That's right. So now all of a sudden you haven't actually paid the property off, but you've been strategic in a way where you've had 3 properties that have grown in value. Across those 3, if you leverage 2 of them back up to 80% and use the equity off those to pay down the debt of the other one to 0, now you've just got a property that's unencumbered. And you actually haven't paid the debt off. You've just moved a few numbers on a page and a screen.
You restructured it, haven't you?
Which now means that that's sitting there in the side. So if something ever happens, no one can come and have any recourse on that because it's got no title deed on it. And then you can be even more strategic and go, okay, well, if I haven't got great serviceability right now, I've got a property with $0 debt. There's a lot of private lenders out there that'll give you 50, 60% leverage, capitalize the interest and give it to you for a 10-year period. You go and access, 50% of 2.5 million. They'll give you $1.25 million in cash.
Right.
It'll be a big interest rate to be able to do that. But the interest rate's just got to be less than what the property's growing in value for you to get to the end of that period and then sell it down and be in exactly the same net position. Yeah. Plus then you've just got 1.25 million in cash to be able to play with. So in that scenario, and this is obviously getting very sophisticated, but in that scenario, $2.5 million property, the private lenders give you 50%, so you've got 1.25 million in cash. They're probably going to charge you, let's say they're going to charge you 10%. So it's 125,000 a year they're charging you, but you've got a $2.5 million asset in the marketplace growing at say 7%. So you're making 200,000 in growth. You're still $75,000 net better off.
Yeah.
Over the next 10 years, you've got to spend that money before they're going to want their principal paid back and their interest. You've lived on $125,000 a year of net income, which is like earning 170, 180, because you've lifted off the equity.
Yeah.
You get to the end of the 10 years, that $2.5 million property now is probably worth 5. You've now got, $2.5 million on debt. You could potentially do that again. And that's the living off equity strategy.
Yes.
So, and the way that the living off equity strategy works best is when you've got a long runway. So living off equity doesn't work as well when you've only got, say, 2 to 3 years worth of equity sitting in the bank. So let's just say you've got that same example, $2.5 million asset. You've got, $1 million of debt on that. That $1 million of debt costs you 60 grand a year to hold. And let's say you've got $200,000 of equity that you've released from that property sitting in offset. That's only 3 years worth of servicing on that property, right? And let's say you come out in a time like this, you can get stuck. And when you get stuck, you might have to sell an asset. But let's say that you've got 10 years worth of buffer sitting in an offset account of which you're living off. You've got time. You can work out when is the right time. When are the banks easier to, get money off? When are the interest rates slightly lower? So you can time all these things because you've got such a long period.
So essentially you got more choice. You got more financial freedom to, either muck around with restructuring like that and, living off equity if that's what you want to do, or like you said, just, go again, purchase another one, or like you said, restructure so you can have one.
Mate, there's so many strategies out there. And the great thing about living off equity is that it's tax-free money.
Yeah, that's true.
You pay interest on the money, but it's tax-free. You tax when you're earning 180 plus.
You just can't use the interest as a tax deduction if you're living off it though.
That's right.
It's not for investment purposes.
But you can be a little bit creative with that. So for example, what you could do, this is not financial advice, you could use that equity to go and invest it in something
buy shares,
which is called debt recycling, which then pays you an income.
That's right. And the shares are an investment.
That's right. So that does then become tax deductible. You could then, that income needs to be dispersed into, a family trust or something like that. Yeah. Family trust then disperses the income out. You could disperse it to 3 or 4 different people paying the 18,000 tax-free threshold, and all of a sudden you've got tax-free income. There's many different ways to skin a cat, and obviously the right experts can give you the advice on this. But the thing that we need to understand here is it all starts with leveraging your equity. It all starts with buying a property, having that property grow in value, leveraging the gap between the mortgage and what the bank will lend you, so the usable equity, which is 80% of the property's value, and then recycling that into another property and into another property.
And if the properties are performing well, there's no reason to sell them. Don't sell them. Like I always say, I could sell some properties now and pay off all my debts, but the properties are pretty much paying for themselves now. And as soon as I sell a property, I lose the potential, the future capital growth, and I lose the rental income. So then I've got an issue of what am I going to do with this cash now? Come stick it in a term deposit at 5%.
You could go and buy 18,000 pairs of those shoes.
New shoes. So whilst they're paying for themselves, I don't necessarily. I've got to a stage now where I've consolidated. I'm really not looking to purchase another property, although I may in my self-managed super fund. I'm just learning a bit more about that. Just let them do their thing now. Just let time continue to roll on and let the capital growth continue to grow.
That's it. And keep wearing those blue polka dot shirts, Frankie, and those shoes. Where are they from again? You said Miller's.
No, man, Nike. Direct from Nike. All right, Jack. That's it. Equity.
Mate, it's good to see you.
Very good. Thanks for coming.
Good stuff. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Mate, it's very good to be here, Frankie. It's good to fucking see you back in the office, mate.
Welcome, mate. You had your birthday, big birthday this week.
I did, 27 years old. I turned on Monday.
That's not big, but anyway.
Mate, you should tell everyone when you come out and we thought you were going to pay for dinner, and then you made everyone split the bill.
Oh, mate. This wasn't the agreement.
And then he comes into the office today and says, I thought dinner was only meant to be $110 a head, and it's $140.
It blew out to $140. It blew my budget, mate.
And that's what happens. See, when you've got more money than you know what to do with, you just like to look at it and not actually spend it.
I budget quite detailed, mate.
Talking about money, mate, did you get those jeans from, was it your wife's cupboard?
No, these are not jeans. These are chinos, mate.
Oh, chinos.
Yeah.
Okay, and what, you've just got the one roll up into the white socks and sneakers.
Mate, the white socks. At least I wear socks, mate.
He's come back at me this time.
Yeah,
well
there
done.
you go.
Well done. Now, Frankie,
right.
I thought
get on with it.
Today what we're going to talk about is why we don't make investment decisions based on variables that are out of our control, and we only make investment decisions based on assets and locations that have a proven track record of performance.
Yes.
And look, this is where I guess property investing does differ slightly to business, because if you look at the biggest businesses in the world over the last 100 years, very few of them are consistently in the top 100 businesses in the world as time goes on, because the world changes and evolves and business changes.
Technology changes, yeah.
But with property, it's a little bit different to that, because what we see is the properties that were expensive 100 years ago are now the most expensive properties and continue to be the most expensive properties. So
even more expensive, but still probably in the same order, I would say.
Yeah, that's right. So that's what I mean. Yeah. With business, that usually changes, but with real estate, it doesn't change, because if you're in a really good quality location 100 years ago, that location would be an even better quality location now. It would be more scarce. It would be more in demand. There would be fewer properties there, and the price point naturally would be significantly higher.
An ocean view or a beach view doesn't change, does it?
Exactly.
Unless you get blocked out.
Yeah, but when our population was maybe 10 million, not as scarce, right? Because there's a lot more space to go around for 10 million people. Now we're at 26, 27 million people.
Yeah, we're busting at the seams.
That's right.
And bringing in more people, so it's even going to be more packed.
And that's what we want to talk about. We want to talk about why we don't make decisions based on variables that are out of our control. And this week, I guess the catalyst to this podcast episode was the Commonwealth Games that were confirmed for Victoria. You know, we're talking $6 to $7 billion worth of infrastructure and event spend when they're doing the Commonwealth Games. And then all of a sudden, it's that's a bit hard. We'll just can that. We'll spend that 6 or 7 somewhere else.
Yeah, well, they probably didn't have the 6 or 7 to spend in the first place.
and we're hearing it a lot at the moment about people. Why don't we buy in Brisbane based on the Olympics that are coming up?
Yes.
And look, there is a low probability of the Olympics not happening, because it's an event that is on a global scale as opposed to a local scale. But what happens if the Olympics doesn't go ahead?
And you've based your purchasing decision just based on that.
Potentially, right?
Yeah.
So the issue with basing your decision on a variable or something that is out of your control, like a infrastructure spend, for example, that may get squashed. We were talking prior about the fast train between Sydney and Newcastle.
Yeah.
About the tunnel in the Northern Beaches coming to Sydney. And there's millions of them all around Australia that have been spoken
Badgerys
about.
Creek Airport, I can tell you, Badgerys Creek Airport has been spoken about for the last 30 years plus. People older than me, Jack.
Well, I wish when I was born, just quietly, Frankie, that my dad bought me a nice block of farm at Badgerys Creek.
Yeah, but you would have been holding on to it for 50 years.
And that's right. When it got rezoned, it would have been a good outcome.
But Badgerys Creek is a prime example. They were speaking about it 30 plus years ago. Older people than me tell me, yeah, geez, when I was a kid, they were talking about Badgerys Creek. And look, finally it's happened. But had you purchased way back when they first announced they're gonna put an airport out at Badgerys Creek, and then they just kept on deferring it and deferring it and deferring it.
Exactly right, and you would have done much better in other locations.
Exactly, yeah.
So, and it's not just with infrastructure; it's also with things like squashing negative gearing. People are making decisions based on a tax outcome, for example.
Yeah.
Everyone, depreciation and negative gearing. Mate, this chair's got a little bit of a squeak to it, doesn't it?
Sit still. You got to sit still.
They're making decisions based on tax outcomes, of which the government controls. They will, but based on Liberal or Labor.
Well, tax can change, right?
Exactly. So you make a decision going, I'm going to get depreciation, or I'm going to get negative gearing, or I'm going to get X, Y, and Z, and then that changes, and all of a sudden your decision that you made, or the investment that you made based on this thing, is no longer relevant.
And that's why we always say, okay, negative gearing, if you think that's a positive, for you, okay, that's great, but don't base your property investing decisions on that. That is a tax outcome. Likewise, in regards to positively geared properties, there's many properties that were positively geared are now turned into a negative situation after what have we had 13 interest rate rises.
Exactly. So it's not really a strategy, is it?
No, it's a tax outcome. You'll see whether you're positively or negatively geared after you do your tax return.
Exactly. We talk about recently in Brisbane. What was the big
land
thing?
Tax.
The land tax.
in Brisbane.
Everyone was, should we? And I did some commentary on this, talking about the Brisbane land tax and how it's going to impact people. Victoria's just changed some legislation that was
land tax as well,
so all of these things are out of our control. We can't change what happens to infrastructure. We can't change what happens to legislation on taxation or anything else. We can't change anything outside of what we have looked at in history, right?
Yeah.
So,
but the big one, just to go back on the Brisbane land tax situation, so it was announced by the state government in Queensland that they were going to, increase the land tax, and it was going to be substantial. I know for a fact a lot of people started selling their investment properties, and this was going to affect more the interstate people like ourselves. So if you lived in any other state bar Queensland and you held an investment property in Queensland, you were going to, incur a substantial land tax bill. So people started selling off their investment properties. Myself, and I got into some Facebook groups and things like that, and I said, you're going to regret this, because at the end of the day, the potential capital gain, if you hold for the long term, is going to far outweigh even a substantial increase in land tax, because the land tax will end up being a small proportion of the capital gain. And so anyway, what happened? Some people started selling, and then, due to public pressure, primarily, the land tax so-called legislation got repealed, and it's too late if you're already sold.
exactly.
Just crazy.
Exactly right. So when we're making long-term decisions, like property investment is not a short-term decision.
It should never be a
property
short-term
developing decision. Or, property flipping or anything like that is a business. It's not an investment, it's a business. So if you're making an investment in property, you're making an investment for a minimum, I believe, of 10 years. You shouldn't be looking at...
Minimum.
You should be wanting to buy that property and then not have to look at it for the next 10 years.
Yeah, except for revaluing purposes.
That's right, unless you're wanting to buy another property. So naturally, we make the decisions going, would I be happy if the economy shit the bed tomorrow? Would I be happy to hold this property for the next 10 years? And Warren Buffett talks about, the way that they buy companies is, if the world or the stock market turned off tomorrow, would I be still comfortable holding this company that I'm buying? And that's our exact philosophy with property. So to do that, and to make sure that we future-proof ourselves, and to make sure that we've got the strongest chance of long-term sustainable capital growth, we want to look at what a location has done in the past, right? You're not going to get growth every single year, regardless of the location you invest in. It's not going to happen because, again, economic factors out of our control will, some to an extent control
Well,
that.
you can't get growth every year. You know, when I say you can't, you actually don't want there to be, because it's unsustainable. You know, properties in any state in any location can't keep growing at 10% per annum. You know, nobody will be able to afford anything. So a bit of a pullback sometimes, or a bit of a slowing down to growth of only 2 to 3 or 4% is actually quite good, because what you then get is sustainable growth over that time.
Exactly.
Yeah, and then, you know, once or twice every 10 years, you'll get a boom, which is fantastic, but you can't have a boom year every year.
It'd be good. It'd be nice.
Yeah,
We'd enjoy it.
but it'll be unsustainable.
Be very good for business. And so that's number one, is making sure we're looking at a proven track record of performance. We're making sure that there is no land at all, huge scarcity to land, and the houses and the apartments or anything else that is in the location are established. They're not brand new. They're not just being built. They've been there for a very long period of time.
They've transacted a few times.
That's right. It's an established location. We can track long-term data, and we also want to make sure, and this is something we haven't really spoken about as well. Also, in a lot of established locations, most of these locations are the areas where people have minimal to no debt. Because if you're in a location, let's talk about where your parents grew up. Strathfield?
Strathfield, yeah, still there.
I reckon...
Well, they didn't grow up there, but...
You grew up there. How many years ago did they buy their property?
Mate, I'll tell you, it was in 1970.
It was when they still had horse and cart, wasn't it?
No, it was in 1975.
Jesus was still getting around
1975. There. It seems a lot. It was when Jesus was playing halfback for Jerusalem, as they say.
So, and how long ago do you reckon they paid that off?
Oh, I wouldn't know.
Come on, Frank.
I don't know. Sometime in the...
You're the type of bloke who'd have
in the 90s.
On your balance sheet, you'd have your portion of the inheritance sitting there as well.
Probably in the 90s.
In the 90s.
Probably when my grandfather passed away.
How many friends and family, would they have and family members in that location? A lot of old people, right? A lot of people who have lived there for a long period of time.
Oh, yeah, like the next door neighbour has been there same time as them.
That's right, and probably 50% of the suburb is similar age, or they've died and pass it on too.
Yeah.
So what we find in these established locations is people have relatively low levels or no debt because they've lived there for so long, they never sell. They buy, hold the assets forever, pay the debt down to zero, and then just sit there. And then usually people like yourself will inherit it and either sell it down to someone else. So that also means when we have things like interest rate increases, for example, these are the areas that are actually affected the least.
Of course, yeah.
Because what you see in the data or in the numbers, it's always like the most expensive property or the most expensive suburbs are the ones that feel the interest rate increases first. But it's actually bullshit, because it's not that the prices pull back. What they look at with a median house price, it's the fact that no stock transacts.
That's right, yeah.
So no stock transacts, and a few lower dollar value properties may transact in that time, and all of a sudden it's like, oh, the median price has come back 30%.
Yeah. And that's why it's important to look at the volume of transactions.
So it's absolute garbage. So I could tell you right now, any good property in Vaucluse that has sold over the last 24 months during an interest rate increase has not sold for less. It has continued to sell for more. And any time a good property comes up in the suburbs, there's still obviously poor quality properties on main roads with lack of privacy or whatever it is. If good properties come up in those suburbs, they will continue to sell for more regardless of the market conditions, because there is a lot of wealthy people who live there, and the really good quality homes in those areas may only come up once every 50, 60, 70 years. We constantly see that. First time offered to the market in 70 years, first time offered to the market in 30 years, never been sold out of the family, for example. The Fairfax family in the eastern suburbs, they've got properties that have never sold before. They've owned them forever.
Yeah.
So all of these things are why we always advocate for buying established property. And it's not to say that you're not going to do well if you get into a location and all the predictions or the variables move in your favor. But that's a gamble that I don't know if I'd be willing to take. What about yourself, Frank?
Well, why would you need to take that risk when there's so many established suburbs out there? And I know you mentioned Vaucluse and properties in the east, but we're talking in other states. We're talking in Western Sydney as well. There are plenty of established suburbs in Western Sydney.
Yeah, every location.
And in other states in every location.
We just talk about the east because that's where we are.
Not necessarily just the affluent ones.
You talk about Brisbane, for example. You look at all the established suburbs in Brisbane.
Yeah.
The closer you get to the city, the closer you get to the water, there's no more land. They're all built.
And I just think when it comes to buying, new suburbs versus buying into established suburbs, I'm just thinking, well, why do you need to? Why would you want to when there's so many established suburbs with established properties in them that at all levels of affordability that you can go and invest in? it really comes down to a simple thought like that. It's not about trying to overthink it. And
100%.
look, a lot of people like the new and the shiny. Okay, I know they just announced a new school to be built in, I think it's Edmondson Park out there near Badgerys Creek Airport, and that's great. That they are building new amenities and facilities.
But let me tell you something
suburbs.
that Edmondson Park School will not do is it will not be better than Cranbrook or Scots College or Knox.
No, but you're talking compared to the top end. But for people who
but
want to
it's for
go and
everyone.
live there, and that's what I think it is, that these areas are more targeted to owner occupiers, because we need more suburbs to live in regards to our population growth. So those suburbs in and around Badgerys Creek, I think they will be highly dominated by owner occupiers and not investors, and they may not see some growth for the first 5 to 10 years, and even until they start transacting over the decades.
That's right. And that's another thing as well, which hurts with valuations, is that if not a lot of properties have transacted because it's a brand new suburb, it's very hard to go back to the bank every 6 or 12 months and get a reval. In a hot market, it's great because in a hot market, every time they do a land release, the land is more and more and more. But now
the prices up. Yeah,
that's right. But now the marketplace has shifted. Developers are no longer going, okay.
Well, I just read something this morning. I think it was in the AFR that off the plan with their apartments or houses, they're talking about a 25% increase.
I read that in the AFR.
Yeah.
That's absolute garbage.
Yeah, I only read the headline.
That's right, you read the headline. How the fuck can they... 25% increase, and next week it'll be we're having a 30% decrease. It's all garbage, that shit. No one knows what is going to happen
But
tomorrow.
I think it was based on the increased costs of building.
What they say, what they were trying to say is that if you look at the supply that has come to market in the new apartments, so they were showing just Victoria specifically in Melbourne, right now we're at the lowest levels of new inventory coming to market in 20 years or something. So they were saying that apartments, because there's been no supply and there's pent up demand, will see significant growth because of X, Y, and Z reason. And as we know, inside of Melbourne, Docklands, for example, there was a huge amount of oversupply there, but it's bullshit. Like I would say if you generalize off the plan apartment sales, they do terribly. There is definitely blocks that do well. Developers that delivered good stock in good quality locations. Tim Gurner's one of those people, delivered an incredible project.
End, the luxury end,
That's right, the luxury end. He delivered that St. Moritz in St Kilda and broke every record there was to be broken.
He's just bought a site in Kent Street, I also read.
Yeah, so
Kent Street in Sydney.
For $200 million he paid for that site, yeah. So that's garbage for one. Never believe the headlines. And again, it's based on variables that may or may not come true.
I'm not saying I believe them. I'm saying that's what I
So
saw.
I guess what we were trying to get at here, Frank, is we speak to people every single day, and you constantly see it. Oh, go and buy here because that's going to happen. Or go and buy here because I hear that's going to be good. Or have you heard about X, Y, and Z? And the Olympics is a massive one that
Brisbane
we're hearing.
Olympics, and I heard it in the year 2000 when the Sydney Olympics.
And what impact did it have?
Well, I think there was a little bit of an uplift, prior to the Olympics, not so much after post-Olympics.
Prior to the Olympics, because of the hype it gives. That's what I say to people about Brisbane right now. They say, do you think Brisbane's going to have an impact? The Olympics is going to have an impact on Brisbane? And I said, it's going to have zero impact on Brisbane.
It could have some impact, but I wouldn't use it as a reason to buy and invest
I personally think it's going to have... The actual Olympics itself has no impact. What has an impact is that the Olympics creates hype.
And it creates a bit of demand.
That's right. Well, it creates hype because people go, I want to go into
hype,
that.
The demand therefore increases prices. Now, what I say to people is, if it does, if Brisbane booms 20%, in and around, just before or just afterwards, well, that's just the cream on top. That's great. But, it's like I always say, these established suburbs will eventually go back to long-term averages. Like after any boom, they'll go back to whatever their average annual growth rate is, more than likely. But yeah, the Olympics itself. Okay, so, the Gabba Stadium is being upgraded. Big deal. How does that affect the house value?
That's right. We just had a beautiful new stadium built in Moore Park, and I don't think it did absolutely diddly twat to the house price in Paddington, right?
Yeah, so it is quite interesting. And there's other arguments. Okay, well, they're going to extend the light rail, and they wouldn't have probably done that because of the Olympics. Okay, that's great, but we don't know whether they would have done it or not. Now, getting back to the Commonwealth Games, if you believe that the Commonwealth Games were going to boost prices in Victoria, in and around Victoria, whether it be Ballarat or inner city Melbourne, and you have
over the long term as well is what we're talking about.
And you have gone and specifically bought for that reason, well, now they've just pulled the pin on it. What happens now if that was your strategy? Are you now going to sell that property? Probably not, because you're in, and the costs to sell the transactional costs are quite high when it comes to property. So, if that was your strategy, I'm buying in Victoria because of the Olympics, well, it's out the window now, isn't it? And this is why we say, don't base your decisions, your property investing decisions, don't hang your hat on something like that. If it happens, so be it. That's fantastic.
Yeah, mate, 110%. So in other words, folks, make decisions based on the long term. Invest like Warren Buffett. All you have to do is go, who is the wealthiest investor in the world and has done it consistently year on year? And you can't get anyone better than Warren Buffett or Ray Dalio or any of those people.
Well, he bases his investing decisions on fundamentals, and I know we're talking stocks here. And I've seen stuff on him before, and he says, I've got 3 key things that I look for, and I base my decisions based on that. And similarly with property, and we've spoken about, the fundamentals of property before, Jack.
This is a little bit of a Jack Henderson thread from before. What we can learn from Warren Buffett and implement inside of property investing. What we can learn from Warren Buffett and implement in property. Investing for the long term is key. Don't fear market fluctuations. In property, focus on high quality assets in prime locations. Take advantage of market slowdowns to buy at a discount. Invest wisely and hold for long-term success. That sounds too simple.
Yeah. But I saw something of Warren Buffett the other day. He said, don't try and time the market. Just when you've got a bit of money and you do want to invest in the stock market, for example, just buy then. Buy and continue to buy consistently. And he says, if you continue to buy consistently, you'll buy at times that are high, you'll buy at times that are low, and you'll buy at times in the middle. He goes, but in the long term, you'll get a good average of all 3. And if you hold it long term and the market
And that's why he tells the majority of people to just buy the index, meaning just buy the marketplace as a whole and continue to do that. And
yeah, but even in a specific company, if you think that CBA shares are the way to go, don't try and time the market. Oh, last week it was $25, now it's 30. I'll wait till it gets down to 25 again. And by next week it could be 35. Just buy when you can afford to, which is what we always say in regards to property. It's not about timing the market, it's buying when you you have the funds to do so. Anyway,
that's it. What do we know, Frank? Mate, as always, pleasure. Are they new shoes?
Not new, mate, no.
Where'd you get them from?
These are Nikes as well.
Are they? Yeah, but where did you get them from?
Just direct from Nike online.
Were they? They look like the ones that are on the discount shelf.
No, mate.
You go into the shop?
No discount shelves. All right, let's go.
On your tank.
Bye.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Frankie, mate, it's good to see you back here.
Yes, thank you.
Mate.
Back.
Have a go at what you're wearing today.
What are you going to say?
That is fucked.
Mate, it's just some clothes to keep warm on this nice sunny
How old are
day.
those pants?
Mate, these are Oxford, mate.
Oxford.
Chinos.
And are they short longs or are they fucking long shorts? Which ones?
They're longer than your...
It looks like you've got
Showing your
the
Flamingo
white sock that comes up from the Nike.
They look better. All right, come on, let's get on with it.
And then the windbreaker.
It's not about fashion.
You got the windbreaker
It's a
as well.
jacket, mate. It's a jacket.
What is that? What brand is that?
This is Mark's. My wife bought this one for me.
I think you're going to say it's your wife's. It looks like your wife's.
My wife's.
And then you've got underneath it the rod and gun.
Bit of rod and gun.
That's nice too. Mate, I've never doubted you being a fashionable man. You're a very fashionable man. It's good to see. It's
Just
very
doing my
good.
best on a weekday, mate.
Now, mate, today what we're going to talk about, I
Yes.
know there's a word that's popping into your mind at the moment, and it starts with I and ends inflation.
Oh, inflation, mate. Let's not talk about inflation. Is heading in the right direction.
You love it, don't
Philip
you?
Lowe must have been doing something right
And
after all the bagging he's copped. But anyway,
Mate,
I
what
never doubted
are
him.
your thoughts on inflation just before we get into what we're actually going to talk about?
well, it's heading in the right direction, isn't it? The rapid increase of interest rate is doing its job, and we're heading in the right direction. So all signs are pointing to a continuation of the interest rate pause for August.
There we go. And mate, something I did a video on it this morning. Something that's super interesting is prior to the prior to the inflation announcement, all the data experts and the people who get paid a lot of money to predict things that very rarely actually come to fruition. had a 50+% chance of an interest rate increase, and all of a sudden the inflation numbers weren't as predicted. They were better than predicted, and all of a sudden now they've changed their minds, and straight away the media headlines change. Interest rates have stopped. The market's gonna. So it's very, very, very funny.
We're headed for another boom in Sydney.
Yeah, exactly
I see today,
right.
I'm like, oh my god.
So, mate, I think it's time for us to talk about what we're actually going to talk about. And today, Frankie, we're going to talk about value add potential and why we like a property where you can add value to it, as opposed to just buying something which is finished and I guess just hoping for organic growth.
Yeah.
Mate, you've done a few renovations in your time.
No, not many actually. Oh well, no, on a couple.
You just renovated Wavell Heights.
Yeah, the one in Wavell Heights, we just spent about 25 grand on nothing substantial. Fresh coat of paint inside and out, new lighting throughout. Uniformity in regards to ceiling fans and things like that. Little things that you can always I think we got an extra $120 a week.
Well, that's what we wanted to talk about. So you spent about 25 grand on the property, and you got $125 increase.
Yeah,
would you say that was specifically from spending the money on the reno, or was that just because it was slightly under rented?
Well, it's always hard to tell. We are going through a national rental crisis in regards to booming rents, so it is always hard to tell.
It sounds like you just took full advantage of that.
Yeah, well, the tenants had given notice that they were going to leave at the end of their lease, so we took a couple of weeks to just line everything up before they left, and so that as soon as they left on day one, we had painters in and electricians in, etc., and making use of that downtime while the property was getting we didn't even list it because we waited to get new photos and then put it on. Now we've got an extra $125 a week, I think, off the top of my head. Whether I think obviously the cosmetic reno would have had a large part of it, because you wouldn't have got that just from
re-renting it. Yeah. Well, mate, that's interesting, right? So you spent 25 grand on the property. You haven't had the property revalued, so you're unsure about whether it added
I got no
value
interest in
to it or
at
not.
This time. Yeah,
because that's what happens when you have too much cash. You just you don't worry about it.
Like we said, I'm at the other end of the spectrum now in the consolidation stages, they say.
But you look at $125 a week, being what, $7,000-ish a year.
Yeah, whatever it worked out to, it was a pretty good return.
Not
on
a bad
investment.
Yield, right?
Yeah,
like $7,000 a year at a $25,000 spend.
As opposed to keeping that 25 grand in the bank.
Exactly.
Or in a high interest deposit or something like that.
So you're getting about a 30% yield on what you spend.
I think it worked out to it was about 25 to 30% return on that investment of 25 grand for a reno.
Not bad.
And like you said, having had it revalued, but it obviously would have increased the revaluation, the valuation of the property as well.
Absolutely. And then you were going to renovate your Drummoyne property, I think, weren't you? And then you thought, fuck this, I'll just buy another one.
No, I haven't bought anything.
The house, when you had the house in Five Dock, I think, and you were going to renovate it?
Yes. Was going to renovate Five Dock, and instead we found another one, but that was back in 2017. Yeah, but now I'm doing something similar with the other one in Brisbane in Mount Gravatt East. Going to spend a little bit of money tidying that up as well, probably not as much, and we're doing that actually while the tenants are still there. But they come off in December. Now they might choose to stay on, but again, there'll be a little bit of a rent increase there.
That's right. Now, mate, if you were talking about this on TikTok, I reckon everyone in the comments would be going, you're just taking people's money out of their pockets.
This is why I'm not on TikTok, obviously. I'm putting a roof over people's head like every property owner is.
Now, there's a few guys on there that constantly comment saying that how can you dare earn money and make a profit out of people's homes and livelihoods. So, mate,
that's a whole different discussion, isn't it?
You're a coward, Frank. That's what you are. But, mate, I guess what that paints a picture of then is just the return that you can get from a renovation, right? And how much value you can add to a property. And we're doing a lot of this at the moment with our clients' properties. Naturally, it's not a marketplace, regardless of where you are in Australia, that we're seeing a huge amount of organic growth just in this short period of time. As we know, as we hold the properties long term, we will.
Yeah. And it's all part of the cycle. You're going to get months, if not years. I would say years where the organic growth is just not there, as in it's not going to be 5% plus. You're still going to get some growth, 2 to 3% or 4%, but we're not talking huge growth. What we call a quiet period, and like what we're about to discuss, these are times when you can manufacture some equity and manufacture some growth.
That's right. So if we get out there into the marketplace and we buy a property that is brand new, or we buy a property that is newly renovated, for example, sure, you might get some depreciation benefits out of that, which is great. But the reality is, in times like this, you can't really pull any levers to manufacture growth to be able to then get enough equity to buy again in a
Yes.
slow time, which is the best time to buy, right? When
Or
no
just
one else
simply
is.
increase your rent. So it's a two-pronged approach. I suppose you've got the benefit of, if it's an investment property, obviously, being able to increase your rents accordingly, as much as the market will take. There are obviously limits, but also increasing your value, which may give you that little bit more equity to be able to pull out and get a deposit for another investment property.
Exactly. So usually what we're looking for in a property where we can add value to it is that all of the bones of the property are in very good shape. So you're not buying something where there's structural issues, or you're buying something where there's a lot of unknowns, sinking piers, for example, if it's a house that's on bearers and joists, or termites, or all of these things, like roof issues, like all of these things, you can open up a can of worms and it can cost you a lot more than you initially anticipated. So we want the bones of the property to be in very good condition. So literally all that we're doing is cosmetic in nature.
So I was about to say that. So we're talking here about a cosmetic renovation, not so much a structural renovation where you're potentially knocking down the whole back half of the house or opening up load-bearing walls, etc. I mean, you can do that and add a lot of value, but it's a longer-term thing, I believe.
And it's more of a development as opposed to a renovation, right? So, we look at a few properties that we've been buying recently, and bones are really solid. We don't have to change the floor plan. Everything already works, and all we have to do is bring it up to 2023 fashion and style.
Yeah, always good when it's got a floor plan that does flow, or where it's got roomy, quite spacious rooms. That always helps, and that's always a good start. And they are the type of properties, when we're looking for clients who do want a cosmetic renovator, that we do look for, because you can get a lot of older houses that are just rabbit warrens, as we call them, or just boxes on top of boxes in regards to room on top of room, and
the floor plan doesn't work.
The floor plan just doesn't work.
It's dark, or there's a lot of different. It could be a split level home. There's different levels to it. And it just doesn't work. And even if you spent the money on the property, you're probably not going to maximize it to its full potential. So we want to make sure that all we're doing is cosmetic in nature. So we look at a few that we're doing at the moment for different clients, and the things we're doing is new bathrooms, for example. They're not cheap to do bathrooms.
No,
you're looking at probably,
but they do add the most value. The
huge
bathrooms
amount
and
of
the
value.
kitchens, yes.
We're doing new kitchens, and a lot of the time we don't actually have to pull the actual carcass of the kitchen out. We're keeping the carcass there because it might be in good condition, and we're just replacing all the doors on the kitchen, new bench top, new fittings and fixtures and appliances, for example. So as you walk in, if you put your your thinking cap on as a valuer. A valuer walks in and thinks, "Oh wow, this is a new kitchen." 9 times out of 10, they're not going to open the door and go, "This is an old kitchen." They've just added new doors and bench
but like
tops.
you said, if the structure of the kitchen itself is fine, it's and it's still functional inside. It's what it presents, how it presents is really what's important, and how functional it is. Of course.
Exactly. Things like a lot of the older houses were actually built with timber floorboards, and a lot of the time that they've had
got covered up with carpet,
and they look terrible. So a thing that we do a lot of the time with inspection, especially if we're getting things off market or by ourselves, is you can lift up corners of the carpet and see what it's actually underneath it.
Well, what the carpet has done is actually retained or preserved the floorboards in great condition in a lot of the cases.
Very true. And this happens because we're buying obviously established properties in established locations. The houses are usually quite old and built a long time ago, and before they used concrete for the slabs like they do in a new build now. It's usually concrete slab, and then lightweight construction being timber frame and brick veneer. So we're looking for things like that where you can pull the carpet up or pull the lino up or whatever the shit thing they've put over the top of it, and re-sand and re-stain the floorboards to give it that look. Simple things like paint, obviously. White paint makes a dramatic difference.
Paint is a huge one, isn't it?
A lot of these houses at the moment, or not at the moment, but when they were built 60 years ago, use things like wallpaper and that they make a house look very dark and
dated, of course.
Exactly. Wallpaper. But you've got your beautiful, ornate cornicing that looks great. So you all of a sudden rip your wallpaper off, repaint the walls white, and all of a sudden it gives it a new lease on life.
Yeah, I think another one too that can add great value is a skylight, a well-positioned skylight, or even these sky tubes now that can just bring light, direct sunlight into a position of the house that may be in a bit of a darkish room because it might be south facing, for example. But a skylight, great cost benefit, I believe.
Absolutely. No doubt about it. And then things like painting the exterior of the house, like it can literally change what a home looks like. You know, you obviously don't want to paint the wrong houses, because some houses don't need to be painted, especially
True,
if they're a character style build. A lot of the times they look better if
in the original heritage colours.
that's
for
right.
example.
You just tuck point and repoint the bricks, and all of
Yep.
a sudden make the bricks look brand new and all brand new
But
mortar.
street appeal, as we often talk about, is extremely important.
The most important thing,
yeah,
right?
so,
It's
you know,
first impressions,
So having a fresh coat of paint on the outside, and that might be, you know,
which is what you did with Wavell Heights.
yeah, I went with a, you know, quite a modern, darkish grey, so quite a contrast to what it was. It was a light creamish colour before, to a nice darkish grey, so a complete contrast, much more modern. So really lifting that street appeal. Redid a bit of the landscaping out the front as well. I think landscaping is another one.
Massively.
You know, when people drive by, that's the first thing they see. You know, we always say, you know, presentation counts, and it's the first thing that people see when they come up to a house or drive by. That beautiful garden, a nice picket fence, if that's the type of character house it is, and you know, just modern, well presented. Now, it doesn't have to be too modern, the colour. I think the colour has to be, you know, you want it to be there for at least the next 10 to 15 years. You don't want to have to be repainting every 5 years because you went with the latest fad, you know,
Black
or
Lots.
something like that. So something that's going to stand the test of time and is quite neutral, but, you know, could be slightly on the darker side or lighter side, depending on, you know, what
the
fashion
area
is at the time.
demands.
Yeah.
So all of these things, a lot of the time, are not as expensive as people think. You know, like you can spend 50 to 150,000 on a house, depending on the size of the house and how much work it needs, and completely change what the house looks like.
Yeah.
As
Well,
long as
I don't see it as an expense. I see it as an investment. You're reinvesting back into the house that, you know, is going to, you know, like we always talk about, you know, a dollar invested in a renovation should lift the value by $2.
That's right, and there's not too many things where you can put $1 in and get, you know, $2 out in a very short period of time.
No, certainly not a poker machine or something like that.
Yeah, I mean, you know a lot about poker machines, Frankie. That's a past life of yours, isn't it?
It is,
Being
yeah.
the boss. So they're things that we're doing to properties. It's I think if you had the choice of buying something that was finished or not finished, you'd buy the property that's not finished or is in need of a little bit of love, as long as it is rentable from day dot for the majority of people. And
Yeah,
that's okay.
and that's a good point you make about being rentable from day dot. Now, I still hold some investments that still have, and you know, a unit I have comes to mind that still has the original bathroom. But from day one, it was totally rentable and still is to this day. You know, I think the only thing I've changed is, because it's a very small bathroom in a unit, is, you know, the shaving cabinet that sits above the basin, because it serves as a mirror as well, and a bit of storage. You know, the wood rotted away on that. You know, I think it was $110 for my property manager to send someone in.
See how Frank remembers how much it was? He goes, I think it was $110.
Yeah,
He knows
could have
exactly.
been 120.
He knows exactly how much it is.
But, you know, and it's always been rented, this unit, and I've done nothing to it. Now, if I did want to add some value there, I could completely gut the that bathroom. Wouldn't cost much because it's very small. You know, shower, bath, toilet. Like I said, a little basin and a shaving
A
cabinet.
little bit off topic. Do you bath much, Frank?
No, mate. I've got a nice big bath in our house, but I've never used it.
Never use it. You're
Never
not a
used it
bath. I could
once.
see you sitting back there eating some cabanossi, reading,
Cabanossi,
reading a
or
Zoo
smoking
magazine.
a cigar or something. No, mate. Not my style, no.
Not a bather. Okay.
No,
Anyway,
not a
back onto
bather.
the
Yeah.
topic of
So,
property.
you know, so I've got, you know, that one there that has still got the original bathroom. It still has those small mosaic tiles on the floor that, geez, will never come up. You know, I think you've got to get a jackhammer to get those things up.
Straight over the top of them, Frankie. You just go straight
There you
over the
go,
top.
see?
New bed over the top of them, and
Yeah, but getting back to the point, so you don't have to do any renovation to it anytime soon. You can keep renting it out for many years as
yeah,
I
exactly.
have.
And just because something is dated doesn't mean, and we're big believers in owner-occupier appeal and making sure that it ticks all the boxes that an owner-occupier wants. But ticking the boxes that an owner-occupier wants and not having something that is beautiful and contemporary in nature that you would potentially live in yourself from an aesthetic standpoint doesn't mean it's not a good property, because there's a lot of people who would live in something that ticks all the other boxes, great location, great floor plan, but it may not be as aesthetically pleasing.
And I think when it comes to tenants, they are the most important factor for them is location. You know, they're renters. They've got that freedom to go and rent in Bondi or go and rent in Parramatta if that's where their job takes them, or they want to be close to family, wherever. But tenants can go have that freedom as a tenant to go and rent wherever they want. They're not too concerned, I don't believe, in the finer things in regards to that it's not a marble bathroom or things like that. If the bathroom is neat and tidy and functional, but the location is where they want to be, that completely ticks that box for them. So it doesn't have to, so if a bathroom or a kitchen is a little bit dated, so be it. Tenants will, as long as it's neat and tidy and functional and working, tenants are happy. It's more so about the location. So you don't have to buy something that needs a renovation or has the potential to be a renovator, and go and do it straight away. Like, you can just keep that in your back pocket.
And use it during times like now.
Yeah, use it during times 10, 20 years down the track. You can say, you know what, I'm going to add a little bit of value now, or I'm going to sell it, so I'm going to go and do the kitchen and bathroom now just before you sell it, so it looks nice and shiny, and hopefully you get top dollar for when you do sell it.
100%. 100%. And mate, a lot of the time, especially in the current marketplaces, or the current marketplace as a whole, unrenovated properties aren't selling that well. It can tick all the boxes but not be renovated, and people are a little bit scared because of renovation costs.
Well, I think in the market we're in at the moment, in the environment, I should say, where it's hard to get trades, it's hard to get builders, things are expensive. I think
not an Endeavour Build, Frankie.
Well, there you go. I think there's still that little bit of a hangover from COVID in that respect, so that premiums are being paid, and the most sought after properties, as we believe, are those ones that have been fully renovated. But there's some money to be saved by buying one that isn't fully renovated, buy one that's still functional, with the good bones, like we say, and do the renovation down the track when prices come down a little bit and a bit more reasonable.
Absolutely. Frankie, that's a bloody good episode in my mind.
Quick one. That's a quick one today.
Quick
yeah?
in and out, mate, just like that. Right. But that's mate, I think it's gold. I think it's make sure you're not passing up on the things that we need to tick. So the things like location, making sure it's a home that appeals to the owner-occupier demographic, making sure that it's in the best pocket of the suburb you can possibly be in, but then having that extra lever to pull, because the location and the kind of property you buy will give it the growth over the long term, but the renovation is a thing where you can get a little bit of a sugar hit by
and it's value. What we call the ugly duckling property, whether it be a unit or a house that's a red brick or a blonde brick from the 60s or 70s, might not look that appealing, but geez, a quick coat of paint or a render to the external.
Like you, Frankie, hey.
That's we change, and we can turn it into a swan, a beautiful swan, right?
That's right, a beautiful flamingo. Hey,
there you go.
Turn it from a pigeon into a flamingo.
There you go.
On you, Frankie.
Thanks, Jack. Cheers.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Frankie, we're back.
Hello.
Mate, now there's a rumour has it today.
Here we go.
That underneath that sweater you have on there, you've got a Chesty Bonds.
Hey, Calvin Klein this week.
What's underneath the Calvin?
Yeah, I've got a Chesty Bonds on. You got to keep the chest warm, mate.
On
these cold winter days.
And where'd you get the Chesty Bonds from?
From Kmart or Target.
Hey, there he is.
They sell Chesty Bonds, mate, in the 3-pack.
The Chesty. That's when you know you're getting old, when you're wearing a Chesty Bonds. But then you walk into
I was wearing them when I was young.
Mate, big week this week in
the interest rate announcement.
You actually haven't been into the office for 3 weeks, just waiting for the interest rate and the inflation numbers.
I was here last week, people.
Just predicting.
Yes, well, two months in a row now on hold.
On hold
at 4.1%. So what does that tell you, Jack?
What it tells me is poor Governor Phillip just got punted, did all the hard work, and now the new RBA governor has just slotted in there, and now she looks like the Queen.
Yeah, well, she hasn't taken over yet, I don't think. But
no, not yet.
No, I think from next month.
Right, yes, bring the mic up to your mouth.
Sorry, mate. Sorry.
Just like something else you have close to your mouth.
So, so very interesting. 2 months in a row now. Now, the commentary is, though, that it may not be the end of the interest rate hiking cycle, if you like. Inflation is still too high at 6%, and from the commentary they're saying they're not expecting inflation to get down to the target band of 2 to 3% till the end of 2025.
Right.
Because if you think about it as well, it probably makes sense, because as the interest rate keeps coming lower and lower, I suppose it's going to take more of an effort, if you like, of lack of spending.
Because they'll start to stimulate the economy again with bringing rates down over time.
Yeah, and I think it just
slow the rate.
It just takes more of an effort the closer you get, because you're dealing with lower percentages now. That's what I'm trying to say.
That's right. Thank you, Frank. You beat it around the bush there, but you eventually
words out.
you got through the chesty bond and you just got that one out there. So what's your take on it, Frankie? You've been through a few cycles now. You've seen rates come up. You've seen rates come down.
Yeah, well, I think, people shouldn't
you were buying property when Jesus was around, weren't you?
Yeah, I told you, when Jesus was playing halfback for Jerusalem. Look, people shouldn't rest on the laurels, because there can still be, the talk is still maybe another rate rise or two. And I don't think rate reductions are anywhere to be seen in the near future. By all means, we're not economists, we're only hypothesizing here. But, I don't think people should be relying on rate reductions. I think they should be keeping on saving as much as they can and just riding through this period. Eventually, rate reductions will come, or they'll just stabilize, which would be good. But we are by no means at, even at 6%, a standard variable rate of 6%, that is not what you consider high in, if we started getting over 7.5% to 8%, you'd say, okay, they're on the higher side of what a long-term average might look like. But otherwise, we could realistically get up to 7%.
Yeah.
And that would be probably more closer to the long-term average of interest rates.
7%.
Yeah. So time will tell. Apparently more stock coming onto the market in this second half of the year. Again, we'll see if that prevails. But then we just saw, what are we in? We're in early August now. The month of July, Sydney up another 0.9%.
And what's that now for the year from January?
Oh, God, I don't even know. I think it was...
What do you mean you don't know? You're the numbers man. You're meant to know.
It's close to 5%, I think.
5%,
and
not bad.
And a couple of other states, got 1.4% growth. So across the nation, every state is still slowly growing. Now, 0.9% may not seem like a lot for a month. Times that by 12 months, though, if you extrapolate it out. Now, it's not going to be that, but it's still, you're looking at maybe 10%.
Not bad, huh?
That's pretty good.
Mate, it's very, very good. Yeah. So essentially what you're saying is, Frankie, inflation is moving back in the right direction.
Yes.
Not in range of the band of 2 to 3% as of yet, but moving that way. Interest rates are on hold for the second month in a row at 4.1% as the cash rate. Yeah. And mate, that's pretty much summarises the cash rate and the inflation numbers.
I think, like I said, possibility of another rate rise or two, before the year is out, I'd say. But who knows, mate? It's a month-to-month proposition, as they keep saying.
Oh, mate, and you absolutely
a week's
love it
a long
too.
time. A week's a long time in property,
mate. Absolutely. Now, Frankie, what I want to talk about today, which is I feel like more important than the interest rates and inflation.
Let's talk about long-term,
mate. That's right.
Property
I want to talk about rent vesting, Frankie.
Oh, rent vesting.
And the reason I want to talk about it is because I've had a few conversations over the last couple of weeks with prospective clients around their positions and what they want to do. Obviously, we don't just buy for investors, even though this is an investment focused podcast.
Yes.
The core of our business is actually buying people their owner occupier properties in obviously blue chip locations. And the conversation that I've had with multiple people, Frank, is I've got X amount of dollars. My serviceability's been hit with interest rate increases. Sure. Some of these people, or actually the majority of these people, haven't bought before. So they're first home buyers, but they're not first home buyers spending $500,000. They're first home buyers spending $1.5 million, for example. I just got off the phone with another one spending circa $1 million, and there's some people spending much more than that. But the thing that they ask is, well, I can't actually buy what I want for my money. So they might be renting something at the moment. They might be renting an apartment by the beach, paying $1,000 a week to live there. And to buy that same apartment, it cost them $3 million. And $3 million, when you put in a 20% deposit of $600,000, you've got a $2.4 million mortgage. Yep. You run your numbers on what that costs to hold the property, and you're talking probably $3,000 to $4,000 a week to own that property by the time you pay interest, strata, all the stuff that goes with it. And they go, well, why would I go and spend $4,000 a week on a mortgage to buy the property when I'm paying $1,000 a week to own it? And a lot of the people don't actually have the capacity to buy what they are renting because their budget is lower than that. So they go, now I've got to compromise, go into something that I'm not 100% happy with. So the rent vesting method, which is what I personally use, and did you ever use rent vesting, Frankie?
I never did. Well, let's just start for anybody who hasn't heard about what this term of rent vesting is, and of course it's renting where you want to live. So let's just use Bondi Beach as an example. If you like Bondi Beach but you can't afford to buy there, you might say, well, I can afford to rent there. So you rent in Bondi Beach, and then instead of buying in Bondi Beach, you take that money and whatever affordability, serviceability you can afford, and go and invest elsewhere. And that could be anywhere around the country. So you're still living the life of living in the beautiful suburb of Bondi Beach and everything that goes with that, and you're putting your money to work and investing elsewhere. No, I never rent vested, but I did something which I suppose I call it home vesting. I was still living at home whilst I invested into my first and second property. So, which was even better because I wasn't paying rent. I was living at home for free.
That's right. So what you're saying is you're a leech.
Mate, my parents didn't want me to leave home.
Spaghetti bolognese.
I started investing very young. So yeah, I lived at home while I was investing. So yeah, something.
And your mum was still ironing your chesty bonds up until you turned 35, wasn't she?
No ironing of the chesty bonds. Anyway, get back on topic.
So essentially, and I rent vest myself, and the methodology behind it, and it's not just a methodology, like the numbers, if you rent vest, and this is not relative to everyone because it works much better if you're looking at spending more money on a property. If you're looking at spending sub $1 million on a property, the rental yields for those properties are relative to what you would be paying in interest. And you're missing out, obviously, on the growth. So this strategy does work better if you're looking at spending many millions or you're renting higher value properties.
Okay.
So essentially, let's hypothetically say that you've got $3 million to spend on a home.
Yeah.
$3 million. You obviously put down $600 for your deposit plus your $150 for stamp duty, so you've got $750 in the deal, and you've got a $2.4 million mortgage, like I mentioned, at a 6% interest rate. Interest only, you'd be paying around about $140 to $150 a year just in interest repayments on that, which works out to be $3,000 a week. Plus, then you get your principal payments on top. But let's exclude principal payments because the principal comes off the loan. So you're paying $150 a year to own that property, and that's not including any upkeep or maintenance or anything else that you have when you actually own a property.
Costs, yeah.
Now, because at $3 million or a $3 million purchase price, most people who can afford to rent those properties can also afford to buy them, and most people choose to buy.
Yeah.
And because when you get higher in purchase price, rents can't continue to skyrocket up, otherwise you just completely exclude everyone who can afford it.
Yeah.
Your yields become much slimmer. So if we look at one of your properties, the 5-dock home that you don't live in, what's that worth?
Call it 3.3.
3.3 million. And what are they paying to rent?
$14.50
a week.
Yeah.
So that's a prime example. 3.3 million. This is almost the same numbers.
Yeah.
20% deposit. You're in for say $700,000 deposit. You've got a mortgage now of 2.7 at 6%. Again, you're looking at $160, $170 a year in repayments, which is over $3,000 a week, plus upkeep, maintenance, all the rest of it. Now, these people who are renting it off you are paying you $14.50 a week. Now, obviously, you didn't pay 3.3 for the property.
No, yeah.
But they're paying $14.50, which is less than half of what it would cost them to own that same property.
And they've made that conscious decision that they're happy to rent it for much. Now, what they're doing with their other money, if they're investing, whatever, I don't know.
Well, that's the whole thing, right? So let's say they could afford to buy it, and they've got the $3,500, $4,000 a week to own the property. But let's say they want to pay $14.50 there, and they go, okay, well, now I've got $2,500 of surplus cash that I would be spending on my mortgage if I own this property, but I'm not because I'm renting it.
Yeah.
Then what you do is you still want to go and invest the same amount of money. You still want to go and spend the 3.3 million. You don't want to not spend it. You still want to go and invest it. But because you're investing it on lower dollar value properties as opposed to higher dollar value properties, and there is a correlation between high dollar value properties and them performing better over the long term, but it gets to a certain point where it doesn't really change for the average person. So you'd go, okay, well, now I've got $2,500 a week of surplus cash flow that I wouldn't be spending, and I've got the 3.3 million of servicing, and I've got the 700 of cash, or whatever numbers are relative to the individual. So how about you go and buy 3 $1.1 million properties, or 4 $800,000 or $700,000 properties?
Get a better rental yield.
That's right. Now all of a sudden, so on your property at a 3.3 million, $1,500 a week works out to be around about $75,000 a year. Is your rental income on your property? 75.
I'm not sure, mate.
Mate, I'm quick at maths. Don't worry,
You're telling the story.
75,000 a year. What's 75,000, Joel, over 3.3 million as a percentage?
Probably like
Divided by
less than 2%.
3.3 million. Times 100.
2.27.
There we go. So 2.3% rental yield.
It's not bad.
So you could... It's not bad for you. What did you pay for it?
Yeah, 1.75.
There you go. 1.75 and a 14.50 rent's good. So you're getting a 2.2% rental yield if you were to buy that property today and rent it out.
Yeah.
But now you go and spend $1 million on a property, you might get a 4 to 5% rental yield depending on where you buy. So you're getting double the rental yield. Now, all of a sudden, the debt on that property as well is now tax deductible.
Yeah, the big benefit is, as a rent investor, yes, you're renting. You just paid the landlord the rent. That's it. Nothing else you have to pay. You don't have to pay for the upkeep. You're living in, like you said, a $3.3 million home. But you go and invest, and then suddenly all your debt is tax deductible.
That's right.
Or
and
everything.
Let's just clarify what tax deductible means. It essentially means that when you have an owner-occupier property, you get paid from your employer or your business or whatever it is. You pay tax first.
Yes.
So 30 to 50%. Then you pay your mortgage.
Yes.
With what's left over.
Yes.
With an investment, you earn your money, you pay all of your investment debt first, then you get taxed. Because all the interest repayments, all the expenses, everything that is associated with owning that property because it is investment in nature is the tax deduction.
So of course you've got to declare your rental income as well.
Of course, but if you're earning $200,000 a year, and most properties are still taking a loss, even if they are strong yielding, they're taking a small loss. You all of a sudden now have a deduction where if you're earning $200,000 a year and it's costing you $20,000 out of your pocket to own a property, that $20,000 comes off your $200,000 of income. Yeah. And now all of a sudden you're only getting assessed on $180,000.
That's right, on your taxable income. Yeah.
That's right. So you're paying with pre-tax money, which not a lot of people gather or get. Plus, on top of that, your serviceability is much stronger because when they're calculating your servicing, they're calculating your serviceability based on your income plus the rental income from that property and all the other properties that you own. So you can actually service more debt over the long run.
Yes. And
if you're super crazy about investing like you or I, and someone who's in the acquisition phase like me, is when you go to, purchase more property, you need to assess your position. You want to make your expenses as minimal as possible so you can obviously increase your serviceability to the maximum. You can be flexible. If you're renting $1,500 a week now or $1,000 a week and you want to buy a property soon, you get out of the $1,000 a week rental and you go and rent for $400 or $500 for a short period of time.
There's also the flexibility that renting gives you. A lot of people don't want to be, set in a certain suburb for the next 5 to 10 years. Their lives change. If they do, they give their notice or wait till the lease expires and they can take off to across the country to another state or into another suburb. So there's flexibility with renting. Look, the Australian culture is one of home ownership. So it is, rent vesting is something that has been gaining popularity, as you mentioned, but it is one that still people do like to have that emotional attachment to the house that they live in. So for a lot of people, there is still that emotional struggle to get their head around, but I think financially, there are definite benefits there.
Yeah, well, it makes complete financial sense.
Yeah, and I think, with the younger generation, like, your generation, Jack, people have that, they want to live on the beachside suburbs now. They're not so much about, I've got to save.
Right?
I've got to save for the next 20 years before I can go and have the lifestyle I want. Lifestyle is important. Why not? You can have your cake and eat it too, in a way.
100%. And there's probably people listening that'll go, oh yeah, but all your investment gains are subject to capital gains, and this is a calculation that you have to work out. Is like, well, capital gains tax after you hold a property for longer than 12 months, you get a 50% CGT reduction. Yeah. So you're looking at around about 22 to 25% tax if you own it for longer than 12 months because it goes on your taxable income at the end. So you work out, okay, well, if I ever sold this property and I paid 25% tax on it, whereas if I owned the investment, I wouldn't have to pay the tax. But I got all of these tax concessions during the ownership. I was able to live in this property and save X amount of dollars from what it would cost me to rent in comparison to what it would cost me to own. And then look at, okay, but then I've got to pay CGT. You just look at those numbers and look what the net position is.
Yeah, because, especially when interest rates are up at 6% as they are now, to buy that owner occupier property, the debt is not tax deductible because it's your principal place of residence. On the flip side though, any capital growth you do get on your owner occupier property is CGT free, so there is that benefit of owning.
But that's what I'm saying, you need to do the calculations.
Yeah, you
right?
do. Yeah, everyone's personal situation.
And if you're a
is different.
high income earner and you're paying a lot of tax, which is usually the people who get the most benefit out of negative gearing, negative gearing is very good for people who earn the highest tax bracket because they're getting the most money back in their tax returns.
Yes.
If you're on a low tax bracket and you're negatively gearing a property, it's not as lucrative because instead of getting 50 cents back in the dollar, you're only getting 30 cents back in the dollar, for example. So, and just to give context to that, the reason that is because it's calculated, your negative gearing benefits is calculated on your taxable
tax
income.
situation, and your taxable income,
So that's why the position of owning the same property for someone who's on 80 grand a year in comparison to someone who's on 250 a year would actually look different from net numbers.
Oh, for sure.
Hence the reason we always talk about positive or negatively gearing is not a strategy, it's a tax outcome.
Tax outcome, and it's, like I keep saying, it's dependent on your personal situation. You and your partner, or you as a single person.
Or you and your multiple partners, Frank. It's 2023.
Like I said, that's your generation, not mine.
So I think
it's a very interesting concept, and I think it's one that people should get some financial advice around. Should run their personal figures around, look at the tax situation, look at their lifestyle situation, what it is they want, but there are definite benefits there to be had. It's something that wasn't around really when I was starting in my investing journey in my early 20s.
Back in the 1920s,
the thing was to stay at home, and that's what I did to get my deposit together, was stay at home, save money, just work hard, and
beg, borrow, and steal, and make sure your mum irons your bonds,
and invest in property while I was still had that advantage of living at home.
For sure.
Yeah.
So I think the whole concept of home ownership or buying property is great. You should definitely, if I was in your shoes, definitely do that. But the way that you do it, you can be much more strategic. A lot of people are asking, Jack, how do I increase my serviceability? I get that question, I reckon, literally 30 to 50 times a week on comments. People are DMing me. And the reality is these are the kind of ways that you do it. These are the kind of ways you can increase your servicing position, actually increase your net cash flow position because of the tax incentives. Because actually when banks go through and they assess your serviceability, they take into consideration all of these things. They take into consideration your negative gearing, the depreciation you're getting on properties, your rental income,
Well, they're taking into account the big one. Oh, you've got a principal place of residence of which you have a huge debt on, paying interest on that. You're getting no tax.
And that's another thing that I was talking to one of these people about that I mentioned was, you can afford it. You can, you look at your salaries, you're earning 15, 20 grand net a month. Mortgage is only 8 or 9, so you've still got some surplus income there, which is great. But it's going to tie you down. Like once you buy this property, you're not going to be able to go back to the bank and say, hey, can I have some more money to renovate? Or hey, can I have some more money to go and invest? Because you've got this big lump sum of debt of which has no income to service it.
Yeah.
Whereas when you are investing, you can take advantage of structures and trust and company structures. You can take advantage of taxation incentives. You can take advantage of being flexible with what your expenses are. If you really want to buy that third or fourth investment property, you go, fuck, okay, maybe I'd go out of the $1,500 a week rental, go into a $500 a week rental for 6 months, or go overseas and travel for that period of time. Have no rental.
But it is, it's not for everyone. Like I said, there is a big psychological thing to it, only because of the Australian culture that we've been in. And I think people need to, there's this thing, I can't rent, only poor people rent, which is bullshit at the end of the day. And you should worry about, people who are out there listening should worry about their own personal situation and not worried about what their friends or family are going to think. Jack rents, he must be poor. Well, you're probably having the last laugh on that on the financial side of things, because definitely in this day and age, people rent
just as an FYI as well. Jack is poor.
People are choosing to rent by choice for all of those advantages we just spoke of, and are investing elsewhere where they can get, can claim those full tax benefits. Not only tax benefits, that's a side thing, but the capital growth from investing, which is, as like we always say, that long-term capital growth is what makes people wealthy.
That's right. I just put a video out.
Not the tax benefits.
It's not paying down your debt that makes you wealthy.
No,
it's the property growing in value, right? Which is
That's
a concept that not a lot of people understand. If you bought a property for 500 grand today and paid it down to zero over the next 20 years and it was still worth 500 grand, you would have been better off saving. It's true, because you've had no growth and all you've done is pay down debt and pay interest on.
Well, and you've also put things out on social media. You can't save as quick as capital as quickly as property can grow in value.
Yeah.
Because when it takes off, it takes off very quickly, as we've seen just over, from 2020 to 2022, where, I do a lot of reports and a lot of places have gone up, 50% in 2 years. That's 25% per annum. You couldn't have saved, nobody could have saved that money in that amount of time, especially when you
even now, you look at the Sydney,
getting taxed on it.
Sydney property market went up 0.9% in the month of July. And although we don't like looking at macro numbers and all the rest of it because it's specific to that property, but let's look at, $1 million, 0.9 of 1%, $9,000.
Property's gone up $9,000.
Not too many people can save $9,000 a month net as well, right?
That's right, yeah. You'd have to earn 18. You'd have to save 18,000. Yeah. So
all
very
right.
interesting.
Frankie, as always, it's been a pleasure.
Thank you, Jack.
Mate, thanks for wearing your going out shoes and your chesty
You've got
bonds.
the nice brown ones on today.
And I'll see you next week.
All right, mate.
Be
Cheers.
good to your mother. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Frankie, it's good to be back.
Yeah, it's nice and warm today.
You've got your wife's shoes on again this week, which was nice.
Yeah.
And
Just the flats.
You wore a nice conservative black sock,
Yes.
which is good.
Matched with that shoes. I told you got to coordinate.
What have you got on in terms of briefs, underwear? Have you got, you still wearing the crotchless ones? Or?
Oh, mate. Come on, let's keep it above board.
Frankie, some interesting news out this week.
Yes.
Macquarie Bank and a few others followed suit in lowering their 5-year fixed rates.
But I think the 3, 4, and 5-year fixed rates. Yeah, which is quite interesting. I mean, what that tells me, and I'm no expert.
Get your crystal ball out, Frankie. Yeah. Get it out.
Well, what that tells me is the banks are, indirectly telling us that they don't think the variable rate will go higher than whatever that fixed rate is. So I think, let's say for argument's sake that Macquarie's dropped the 5-year fixed rate to 5.58, right? Don't quote me on that. I'm just throwing a figure out there. That tells me that they don't believe their variable rate will go higher than 5.58. Because they rarely lose, the banks. I mean, I think they lost when everyone did fix, when the cash rate was down at 0.1%. That was very rare. So yeah, interesting times.
Seems like CBA just had a nice big fat win with a $10.x billion profit for the year.
Yeah,
good on them.
Look, they're doing well with all the interest rate
Isn't
increases.
it funny how people hate when the banks make money? It's all right for businesses to make money and for individuals to make money, but when a bank makes money...
Well, somebody once told me, if you want to get back at the banks, or if you want to take you want to get some of that profit back, is to buy bank shares. I've owned bank shares. I own some bank shares now. And a lot of people do. And I think they just said that their dividend will shoot up to $4.20 per share. Again, don't quote me, but they pay healthy dividends. You get a good return on bank shares, whether they go up or not. Look, invariably over the long term, bank shares have traditionally sort of gone up. Not comparing them to any other share. You could probably do better in, I don't know, a mining stock or something. But if you want to get a piece of that pie, a piece of that profit, go out and buy some bank shares.
Or just stop being a whinger. One of the two. That's probably an easy alternative.
Any ASX listed company, the mandate is to
make cash,
increase shareholder wealth.
That's right.
I mean, that's the number one goal.
That's exactly right. Now, Frankie, this week, mate, there is a little bit to cover, but I think the topic, which is up front of my mind, obviously speak with many people over a week or a month or however long you want to track, and I just got off a couple of calls just then, and and mate, I want to chat through why we feel property is a growth play as opposed to a cash flow play.
Oh, that old chestnut.
You know, because we constantly hear, you know, people saying to us, oh, you know, I want to buy property and have a positively cash flowed portfolio so we can put money back in my pocket and rah-widdy rah rah rah. And you know, and every time I post a video on social media around no one ever got rich from paying their debt down to zero, people get wealthy from the properties growing in value, they always blow up, and there's always people in there just saying, you know, fuck you, Jack, and this and that. So let's dive into that, because you know, I would say it's probably the majority of people, when they're investing in property, they want the property to you know, shoot off some cash flow.
To grow in value. Well, to shoot off some cash flow.
Most people you speak to, though, are always like, oh, I want a positively cash flow property. It's cash flow, it's cash flow, it's cash flow.
Well, you know, because I think a lot of people are sold this notion or this theory of it will cost you nothing to hold the property, which is all great. Why wouldn't you go out and invest in property if it's not going to cost you anything? And in fact, it's going to put, you know, a little bit of money in your pocket at the end of the year. Why wouldn't you? But the fact is, if it's not going to grow substantially in value over 5, 10, 15, 20 years, what are you going to do? Sell it in 10 years' time for a 3% growth over 10 years? And I'm not talking per annum, I'm talking just 3% over 10 years.
Yeah.
Well, what have you held it for?
That's exactly right. So I think that's the big misconception, right? And I think for the majority of the people out there, like, you know, a small amount of cash flow on a weekly or monthly basis can probably make a significant difference. And if that strategy works for you, then that's great. I'm not saying it doesn't work.
Because affordability does come into play.
But I can
definitely understand that.
But I'm talking about our strategy being the Flamingo investment strategy, and you know, what you see with people who build significant wealth is that they take advantage of compound, and they take advantage of putting a small amount of capital into something and getting a huge return on that capital. And you don't get a huge return on capital from getting, you know, cash flow on a weekly basis. You get a huge return on capital from it multiplying in value.
Well, increasing in value, you've then got some equity that you can then finance against, get your deposit for the next one and go again and replicate that, as we've spoken about many times. If your property is positively cash flowed and not growing in value, you could be waiting for 10 years to grab a little bit of equity. You know, time's not on your side then.
Exactly right. And I think let's stay on the cash flow side a little bit. Usually you are going to pass up one or the other, right? If you're getting a really high growth property and the yield is quite low, the reason for that is because the growth of the asset has well and truly outweighed the growth in rental. That's the reason it is so negatively geared or has such a low rental yield in comparison to the value of the property.
Yes.
It is because the value of the asset grows significantly faster than the value of the rental increases. Whereas we flip that and go, well, you know, you're buying properties with a 5 or 6 or 7% rental yield, like people are doing in Perth at the moment and all these other areas. The reason that the yields are strong is because the property values haven't increased, and the rental yields have slowly increased with inflation and demand for rent. So the thing that you're passing up is growth. And we're not talking about growth you might get in 1 or 2 or 3 years and people go, oh yeah, but I made 100 grand on my property, or I made 150 grand. We're talking about long-term sustained growth, because one spurt of growth does exactly what you said. It doesn't change the paradigm, right? You make 100 grand, your $400,000 property goes to 500,000, or your $600,000 property goes to 750,000. You release a little bit of equity. But then if it's a flat marketplace, you've made that small amount of money. Your property, you know, may still be positively cash flowed, and you're then paying tax on that money, but it's not doing anything else. So all of a sudden you get down the track and you go, okay, well, what have I actually made?
Yeah.
Nothing. You know, by the time you factor into your entry cost to that property, your stamp duty, your fees of conveyancing, if you use a buyer's advocate, for example, all those fees come into your acquisition price. So before you actually make money, you need to pay for all of that back. Then you make capital on top. Like that's your real return. Whereas if you can obviously hold the properties, and we factor this in, so you go, okay, I bought a $800,000 property, and let's hypothetically say it's costing me 70 grand a year to own that property, and it's only returning 40 grand in rent. So there's like that, you know, $30,000 negative delta there, which you've got to cash flow, and not everyone has a capacity to do that, I understand, but you need to cash flow that. So it's $600 a week pre-tax. If you're servicing that sort of debt, you're probably on a high income, so you're getting 50% of that back in your return. So it's costing you $300 a week, 15 grand a year. if that property grows over the long term at say 7% per annum,
Yep.
it's growing at around about $60,000 per year, and it's costing you 15 to own post-tax. So all of a sudden, you've got 60 here, 15 here, you net that off, you're up $45,000 per year.
But I think there's what people say, yes, okay, it's grown 70 grand this year, but it's on paper. It's not an extra 70 grand in my bank account. And like we said before, maybe not everyone can afford to do it, and not everybody can, and that's why there are horses for courses in regards to why people like positively geared properties and others go for the higher growth negatively geared properties.
Yeah, and sure, the money is not in your bank account, but you look at all the people who own the biggest companies in the world, a lot of the time, if we're looking at business, a lot of the time they're not making a lot of profit on the way to selling their company for, mega money. Like the whole idea is you're growing an asset base to one day realize the gains.
Well, it's all part of the long-term plan, isn't it?
That's the thing. So, and the reason we're so focused on growth, because if you look at the two strategies side by side, you go, okay, we've got the same end goal. So the end goal is $100,000 of passive income per year. What's going to get us there the fastest? So we need to work out, well, what do we actually need to have that $100,000 a year? And it works out to be around about $2 million of net asset value at 5% per year. That's gross. Now, what's going to get you there the fastest? Are you going to get there the fastest by going, okay, I need to have a property. Let's say you bought 2 properties for $1 million each. So you got $2 million in assets. You got to have the servicing, obviously, to do that. Are you going to get there faster by those 2 properties going from $1 million to $2 million over, say, a 10-year period? Or are you going to get there faster by having a $300,000 or $400,000 property, and a lot of those properties maybe growing at half that and returning you $50 or $100 per week?
Because there is a correlation, there's no doubt, between high rental yields and growth. The higher the rental yield, the lower the growth. People say, oh, you can get both. Look, you can get a nicely balanced property, but usually the higher the rental yield, the lower the growth.
Of course.
The higher the growth, the lower the rental yield. And that's where we talked about, I think we spoke about it the week or two ago, where we spoke about, the rent vesting thing, and $3-4 million plus properties will have a very low rental yield, but they also grow quite quickly.
Hence the reason they're a $3 or $4 million property.
Exactly, because they went from $500,000 to $3 to $4 million over a few years, or over a decade or two, maybe. So there is that correlation there. And then it's also people should run these numbers and go, what's actually going to get me there the fastest? And the way that you get there the fastest is from growing your capital. There is no denying that. Yeah.
You compare the two strategies side by side and go, if I had $1 million to invest right now, what would be better? If I bought $300,000 properties that are returning me $100 a week each, positive, of which is then taxed. $50 goes out of that $100.
And people love using that analogy. Why would I buy one for $1 million when I can buy 3 for
That's right.
330 each?
And then
because then you can brag, I got 3. Big deal. But if they're not growing in value,
that's exactly right. And then you got the $1 million property that might cost you 10 or 15 grand to own per year, but it goes from $1 million to $2 million in 10 years, and has shown us that over the last 20 or 30 years that it's probably doubled in value again. Then look at the numbers and go, okay, well, what's going to get me the result? And I can almost guarantee that it is the high growth asset.
But I can understand someone, young on a relatively low wage, wants to get involved and started in property, can't afford to get into a property that's too negatively geared, because they, at the end of the day, you've got to be able to afford to hold it as interest rates shoot up or fluctuate as they do. You've got to be able to hold it. That's the key. No use getting impatient and selling it after 2 years going, I didn't make any money. So I can understand where they might go for that regional positively cash flow property.
But that's a starting point.
It's a starting point.
That's
It's
right.
got to be a starting point, and your strategy should then change. Okay, well, I'm now 5 years down the track.
That's
it
right.
didn't grow by much. It grew by 3% per annum. There was still some growth, but it's enough to give me a stepping stone into a deposit.
You can use a little bit of equity,
or
if it's
even
grown.
sell it and then with your savings take it all together and buy then a better property.
Exactly.
Location.
And then another thing that you need to look at as well is growth is one thing from a percentage point of view, right? Like we made 10% or 15%, but percentages don't pay the bills. It's dollars that pay the bills.
I
right?
always say, I had this argument with somebody once. It's still, 15%. It's still 15%. I'm like, yeah, well, 15% on $1 million property in real dollar values is different to 15% on a $300,000 property. And I don't bank percentages. Percentages don't pay my bills. It's the real dollars that do.
Exactly right. So that's another thing you have to consider is like, well, if you're trying to grow a big portfolio, dollars grow portfolios, not percentages.
Yeah.
So, you know, as you're starting to, you know, let's hypothetically say you were earning $100,000 a year and, you know, most people are not aggressive investors, right? They're not out there going, let's buy three.
Most people are conservative.
Yeah,
you know?
so-
Well, most people are very conservative. They don't invest at all in property.
Exactly.
You know, or shares.
But even if they had the capacity to service a mill, most people, if they said, oh, I'll go buy three $300,000 properties, won't actually do that.
No, they'll go and buy one $300,000
They'll go one and then they'll
property
do-
with a long-term goal of buying three $300,000
So let's just say,
properties,
so that's what most people do. They go buy one property and they go, okay, I've got one now, so then I'll just wait and see how it goes.
which is good. I always say one is better than none.
Of course, but if you can choose one at 300,000 or one at $1 million and you got the same capacity, you know, 10% on a mill is a lot better than 10% on 300 grand, right? Because you're making real dollars.
Yeah, and people I've often heard say, well, it's more risky. I'm going to have $1 million, say, of debt, or $800,000 debt on $1 million worth of property. And I actually heard someone then say, it's actually less risky.
Of course,
having more assets and more debt. Like if you've got an asset, a good house or a good unit or any type of property in a good location, it's actually less risky.
Yeah, because people
to own these
don't
things.
understand the concept of debt. They've just, everyone's been taught debt is bad. Don't get into debt.
Yes.
If you do get into debt, get out of it. But and then they'll go and buy a car and it's a depreciating asset, blah, blah, blah. What they don't understand is usually the higher the dollar value of the property, the better the quality is, the more recession proof it is, and over the long term, the better it's performed, hence the reason it's value. So the numbers may scare you because you got $1 million as opposed to 300, but if you've got $1 million in debt and it's tied to the best asset, I would rather have that every day of the week, put it in the safe and go and live my life. And it's all I got to worry about. It's not the $1 million I got to worry about. I've just got to worry about making my mortgage payments every month.
Yeah, and you've got to think, if it was that risky, would the bank lend you 80%? Of, you go to the bank, you say, I want to buy this $1 million property. They go, okay, show me your income. Yep, well, you can afford for me to lend you $800,000. If that was risky, the bank wouldn't lend you $800,000. What makes it risky is you not being able to afford that, which is fine. Then you just say, look, the bank's going to tell you, you can't afford $1 million property.
That's
right.
right.
I won't lend you $800,000.
Hence the reason they have these buffers, right? Imagine if there was no buffers and we just had 12 interest rate increases or whatever it was. There'd be other people up shit creek with a paddle.
Yeah.
But essentially what we're trying to get at here is like the whole cash flow v growth thing. I think at different stages in the journey, different things are important. If you even if you have cash flow right now and it's at a small amount, it's not going to dramatically change your life. And if you're passing up a significant amount of growth,
you'll pay tax on it, which is fine if you're paying tax. I've always said if you're paying tax, you're making money.
That's right.
But it's
never go broke taking profits, huh?
That's right. But are you really going to, is it going to change your life by putting a couple of grand in your bank account every year that you then, even if that was net, you positively cash flow $5,000. Okay, you walked out at the end of the year with $2.5 grand. What's that going to do to your life?
Not a great deal.
It's just going to keep you in the
But
property.
as investors, just the same as businesses and everything else, you go from a stage in your life where capital appreciation in value is the most important to cash flow being the most important. You go through a transitional phase, just like you're going through now.
Yeah, like when I go, fully into retirement,
growth's not as important anymore.
Growth is not important. I've had 30 years of growth.
Exactly.
I then want cash flow coming in because that's what's...
Because now you need the
then
income.
I won't have an income in. My wife and I won't have incomes in, so my income is going to be rental income. So...
And that's really the big thing. It is growth is the most important thing in investing. Hands down, black and blue, I'll argue with everyone on this until you have the net asset value to get cash flow off it.
Yes.
That's the thing.
Real cash flow.
That's right.
Yeah.
Like cash flow, it's going to actually replace your income. Not, okay, I've got
That's the key, replacing your income.
Because if you're, and then you go along and go, okay, well, I'm getting $2,500 net cash flow off the example that you just gave. But if you're using that cash flow, your debt level's still the same anyway. So your cash flow is not going to increase, right? Because if interest rates increase, your cash flow decreases. If they reduce, obviously your cash flow increases slightly.
Yeah.
But with that positive cash flow, if you're not going to use it and you're going to reduce your debt with that, then your actual lifestyle's not changing. So then it means if your numbers are going to be the same, then why not focus on growth?
Yeah.
Right?
Yeah, very true.
So I think that's the thing. It's like growth v cash flow. It's like, well, unless you've got lots of money, cash flow doesn't matter. You need growth. Your focus then should be on how do I make more money in my job.
Unless you're going to go out and buy the property just with pure cash and it'll be debt free.
And if you
then you're concentrating on, well, if you're that wealthy that you've got $1 million in cash that you can just go out and buy $1 million property, then the yield is going to be very important.
And I'm a big believer that when you get to a point of no leverage in property is actually not the best asset class for cash.
You've got other classes, you've got other options.
Way better asset classes, I believe, other than property for cash flow when you get to that point in time. Like I'm a huge believer in that.
Yeah.
Business is a much better thing, or owning shares in a business, like, high paying businesses where they give you the strong dividends. You
have $1 million worth of CBA shares.
Yeah.
You'd be doing all right.
If you're not, because obviously to hold property when you have no leverage is expensive, right? Because you've got maintenance on that property, you've got property management fees, you've got council rates, you've got land tax.
The biggest benefit of property, as we've often
leverage.
spoken about, is leverage.
That is it. The end. So if
leverage,
leverage is the biggest benefit, and the reason leverage is the biggest benefit is because you get growth on that leverage. Cash flow is not the thing. So we need to obviously use cash flow to hold the properties in the short term. But the main thing we are focusing on is where do we need to get that big nest egg to, where's the nest egg need to go to? When we get to that point and we go, okay, well, I'm at that stage in my life now where cash flow is important, you transition it out of a growth focus, just like people should get their advice on superannuation. But the reason in your superannuation, when people get to retirement, it goes from being in a growth phase. Most people are in a growth phase focused super because they're worried about compounding. They're reinvesting everything back into growing it. And then they get into retirement and all of a sudden their superannuation transitions into retirement phase.
Yes.
And then what's important is maintaining your capital while you live off the cash flow from that capital.
Yeah.
And that's what it's all about. Grow your wealth base, grow your capital value. If you've got $100,000 right now to put in as a deposit to a property, your focus is how do I turn that $100,000 into $1 million? Not how do I get that $100,000 to give me $2.50 in cash flow. So turn that $100,000 into $1 million. When you get $1 million, turn that $1 million into a cash flow producing asset.
Yes.
That's the game.
Yes.
The end.
True.
Thank you, Frank.
Drop the mic.
On you, Frankie.
Thanks, Jack. Cheers.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Frankie, we're back, mate. We are back. And you know what? Like the seasons change, mate. It gets colder, it gets warmer, the leaves fall off the trees, but nothing changes about your fashion. It is always
wearing a nice shirt
terrible.
Today. I'm wearing a nice shirt today. Always terrible.
That looks like, mate, we were just talking about sushi mango before we jumped on. It looks like when you go to Nuna's house and they put the tea towel out on the table.
Here we go.
Hey, look at this.
Mate, never goes out.
Mama.
The tea towel is red, by the way. This is a
black and white.
A navy blue.
That was for special occasions. They brought out that tea towel.
All right, what are we talking about today, my friend?
Oh, you want to skip past this is people's favourite part of the whole podcast.
I'm not here for the fashion.
Mate, I know. We can tell. Mate, so today what we're going to talk about is we're going to do a little bit of a zig and a zag, and we're going to run through a case study which I believe is going to be relatable to everyone out there.
Okay, nice.
Now, this case study is a client of ours.
Yeah.
Let's call that client Sam.
Okay.
And Sam come to us after he already made a purchase. That purchase is a property that we would have strongly advised against if he was a client at the time, but he wasn't. And we just want to chat through what Sam's position was when he came to us, what we did to restructure his portfolio, and then where Sam is right now.
Okay.
And the time frame in which he's done that in, and how making a few really good decisions, not a lot, just a few really good decisions can literally completely change the trajectory of your wealth creation journey.
Okay, and he's a young guy in his 20s?
Young guy in his early 30s.
Oh, early 30s. Okay. When did he start his journey? How old was he?
Yeah, so Sam come to us he was 29 when we met Sam.
Okay.
And that was about 3 years ago. He's now 32. And Sam come to us when he was 29 after he'd bought a property in 2016. Which means he would have been around 25, 26 when he made that purchase. Now, the purchase that he made was just off the back of him going out there wanting to buy a property, as most people do.
Yeah.
He'd saved up all of his money. He was working in the aviation industry.
Yep.
just a tradie, and essentially Sam went out there. He spoke to his broker. His broker said, "Hey, you can get $350,000 worth of finance or thereabouts," and he said, "Great. What should I buy?" So lesson number one, and we get this all the time, right? People go out there and they get finance off a broker who's a professional to talk about finance. Excellent. But then what they do is they ask that finance broker, "What should I buy?" Or they ask their accountant, "What should I buy?" Or they ask their friends and family, "What should I buy?" And the reality is you shouldn't be asking people questions who are not qualified to answer those questions.
Sure.
So that was probably mistake number one if you reflect back, and our client will talk about this openly. So he asked the broker, and the broker said, "You know what? I've got the perfect property for you." Now, the perfect property is the opposite of what we think are perfect properties.
Right, so it's off the plan, is it?
You'll love this, Frankie.
Oh, there we
it was the off the plan
Oh, yes.
apartment in a suburb called Sherwood in Brisbane. Now, Sherwood's actually a good suburb. in Brisbane.
I did a suburb of the day on it not long ago.
Well, there we go. So it's close to the city.
Yeah.
It's on the southern side of the
Brizzy.
river. And if you bought a house in Sherwood,
Different story.
you would have done exceptionally well out of it. But our client, before he was our client, took the advice, and the broker said, "I've got the one. It's a 1-bedroom apartment in a high density block off the plan in a suburb called Sherwood."
Wow, not ticking many boxes there.
Almost none of the boxes there. Sam bought it. He paid $345,000 for it. Now, unknowingly to Sam, he didn't know if the broker was going to get a
and
kickback.
for him, he thought, well, I can borrow $350. This is going to cost me $345. Easy transaction.
Perfect.
Non-competitive, off the plan. I just go and pick which one I want.
And
away
at
we
the
go.
time, I don't remember the exact incentive that he got, but he got something back. So he got stamp duty or something.
like
he got an
some
incentive.
some sort of
and that's what he
rebate.
got sold on. If you buy the brand new off the plan, you'll get your thing back. Great. So he bought it $345. That settled, I think, in 2017 or something like that.
Sure.
Now,
Had it been completed?
it hadn't been completed. It was still off the plan. So
Right,
it was brand new, and I think that was the reason they got the incentives at that time.
Yeah, gotcha.
Now let's talk about that specific property. Just like you said, one of the main issues is that it was the right location. Sherwood's a great suburb in Brisbane, close to the city, right on the river, but it was the wrong asset inside of that location. So not only was it an apartment in a location where 80 to 90% of the stock there would be houses. Or maybe 70 to 80%.
One better at that.
That's right. But then you've not only narrowed your marketplace by buying an apartment in the wrong suburb, you've then gone even more niche by getting a 1-bedroom apartment, which then doesn't serve many of the apartment buyers because very few people.
I hope it had parking.
It had parking. It had parking.
There's a tick.
And then it was off the plan.
Yeah.
So we're off the plan. We're paying brand new
Paying a
prices.
premium.
We're paying a premium. We're paying for the broker's kickback that they would have gotten, and we bought the wrong asset in the right location.
Yep.
So the issue which we always talk about is you don't know whether you've bought the wrong or the right asset until you've owned it for 3, 4, 5 years, right?
That's right. Yeah.
So
Did he get a decent yield at least out of it?
Yeah, well, I think the rental income was all but covering the expenses,
Okay, so
and
he would have been sold on that as well.
Yeah, he lived in it for a short period of time for the first home buyer incentive. So that was 2016, 2017. That's all settled. Now, we didn't meet Sam until 2021. What are we in now? Yes, late 2020, early 2021 is when we met Sam and Sam's partner. Now, at that time, he'd owned the property for 4 to 5 years. Naturally, realised that
growth.
this thing's a lemon. Had strata issues, which is very common in those high density blocks, and he was looking on realestateanddomain.com and could see all these apartments around his selling for 250 to 300,000.
Selling for less than what he bought it for.
That's right. Now you think back to 2021 as well, hot market nationwide.
Not for units though.
Yeah, that's right. Some units.
Yeah.
If you owned one in Bondi Beach in that time, it'd be a very good time.
Yeah.
So Sam gets to, and we obviously meet him, and he goes, "Look, I've got this apartment." We say, you got any equity? Can you refinance and pull the equity
Negative
out?
equity.
Yeah, well, he wasn't negative because he'd paid down the mortgage, but he had no equity to be able to withdraw.
Right.
And this is a very crucial moment in every investor's journey if you make the wrong decision up front. Because as you know, Frank, it's a very people want to avoid loss greater than they want to run towards gain.
Sure.
So for Sam, he had to make a decision. Like, you know, you're either going to hold on to this property and fingers crossed that, and
good.
toes crossed that in the next 5-10 years it's going to be worth more, which a lot of people do. My parents fell into that bucket with the
held on
Sunshine
for 10
Coast,
years.
11 years. But as we know, shit property doesn't become less shit over time usually. And that was our advice to Sam. It is, you know, you look at it over the last 5 years, we've had a relatively strong property market and it's worth less today. So let's hypothetically say it was the opposite of that. What would it be worth?
Yeah.
So our advice was sell down the apartment, lick your wounds. That was a, you know, expensive learning curve.
Well, especially as it was his first, you know, it's not a great start to get off, you know, on your first, on your investment property journey when your first one goes south.
Absolutely. Absolutely. And a lot of people have that happen to them, right? And
then they never touch property again. They get
That's
burnt
right.
the first time and they never touch it again, unfortunately.
And this is a great example. And Sam, unfortunately, had the no owner occupier property. But a lot of people, this is how they get into investing, right? They buy an owner occupier. That does well.
Yes.
They've got some growth. They've paid down debt because it's non-deductible debt. As we know, we pay that down. And you get 5 years into owning your owner occupier and you go, oh, wow, I've got some equity. What should I do when I have equity? Either renovate my current home or I go and buy
invest.
another one.
Yeah.
And then they go and invest. And this is exactly my parents' story. They did really well out of their first 2 owner occupier properties. Then they went and invested.
Yeah.
All of that logic went out the window and they did really badly when they first started investing.
Yeah. All right, so back to Sam. What did he do?
Yeah,
next?
so Sam, we sold that down. Sold it for $295,000.
And what did he pay for it again?
$345.
Wow, so he lost a bit.
He lost about 50 grand plus selling fees, plus holding costs and all the rest of it.
The opportunity cost.
And that was the big one. That was the big one that we spoke about. It's, you know, how much opportunity cost have you lost right now? What could you have bought at the same time for $350,000 or $345,000?
And how much?
What's that worth now?
How much would that have grown by now?
And where are you at?
Yeah.
So we sold that down, and at the time, Sam had a partner. They weren't, you know, proper boyfriend and girlfriend for a long period of time, but they had a partner and they probably wanted to, you know, get together for a long period of time. So we actually helped out Sam's partner to begin with.
Okay.
And we bought her an apartment. So we bought an apartment, but we bought an apartment in the right location. So the apartment was next to the beach. It was in a small block of 4, literally 100 meters walk to the beach in late 2020, early 2021. And we paid $550,000 for that.
Okay.
While Sam was going through selling down his apartment so he could do something separately.
Sure.
So we bought the apartment. The great thing about his partner at the time was she's a first home buyer, so she got to take advantage of the first home buyer incentives.
Yep.
So we only put down about 25-30 grand deposit on that $550,000 apartment. Bang, we bought that small block of 4. Sam saw that we did a great job for his partner at the time. And he said, okay, I've sold my apartment. Now it's time for me.
Well, let's just stop there. That's good that he, you know, like we just spoke about, that he wasn't burnt and so upset that he said, no, stuff this, I'm not going to invest. He was still young. Would you say by this stage he's 30, 31?
Yeah,
odd?
he was about 30 then.
You know, he's got plenty of time ahead of him in his life. So it's get back on the horse, go again with some proper advice this time and get it right. And, you know, that's what a lot of people need to do, that get the right advice, speak to the right people, but don't, don't just say, fold your arms and say, I'm not going to invest anymore.
Exactly.
That's
Once
probably,
bitten, twice shy.
That's probably a worse decision than, you know, risking again, so to speak, because there's always that fear that what if I buy another one and the same thing happens.
Absolutely.
But I think you're worse off, by not doing anything. Yeah.
100%. So, and he'd seen, because his father was involved in property and had done well out of property over it. So he knew that it worked. He just made the wrong decision. Yeah. So we bought that one for his partner. This is a crucial one to remember. We paid $550 or just under $550 for that. And then Sam said, all right, I've sold. His income had increased over that time frame because he was at the start of his, trade career, call it. So I'm pretty sure he was still an apprentice when he bought the first one. So lower income.
Yes.
He became a tradesperson. Then he's obviously, 3-4
so
years.
Serviceability is now better.
That's right. So all of a sudden now he's gone back to the bank. He's got cash that he'd saved up during that time. Plus he had a little bit of cash that come out of that transaction because he'd obviously paid down his mortgage. And I think he roughly had $100,000 to $150,000 in cash.
Okay.
So he's no longer a first home buyer. So you can scrap the first home buyer incentives, and he's getting out there into the bad world now with no incentives. So we said, okay, we think that based on your budget, this marketplace is going to be the strongest marketplace for you. That was the Newcastle market.
Okay.
You know, surprise, surprise. Everyone knows I love Newcastle. And it was an apartment, which
Yep.
he was a little bit put off by because he said, I've already had an apartment and that
Ooh,
didn't
yeah.
do that well.
Okay. What suburb was it in Newcastle?
It was in the Hill,
Oh, the Hill. Very good.
on one of the best streets in a street called Church Street.
Yep.
Now, we said, this is what we think is best for you. This is what your budget is. I think you had a budget of roughly $800,000 at the upper end, based on your serviceability and the cash that you had available. And we showed him all the numbers and we said, look, you know, your apartments were not your issue. It's not the apartment market that's cooked and it doesn't do well. It's the fact that you bought the wrong asset in the right location. If you would have bought a house, this is what would have happened. And this is what the apartment's about in this location. And we showed him the same period of time. If you would have bought this, because he could have bought one of these when he bought his.
And I'm assuming the one in Church Street is an established block?
That's right. But he could have bought the same apartment back in when he bought his for
Oh,
the
the
similar
same
money,
price,
300 and something thousand.
Yeah, you don't know what you don't know.
and we showed him. We said, this is what it's done in that same period of time. So, you know, so that's how we conveyed it. He said, yep, great. I trust you guys. Go and find it. So that's what we bought him. We bought him a small block. I think it had six to eight apartments in the block. It was a 70s brick,
Yep.
elevated city and harbour views.
Oh,
It had
wow.
views of the harbour. We paid $740,000 for that apartment. And straight away, put tenants in there. He went in with the 10% deposit and paid a little bit of LMI and obviously the stamp duty because he had that cash. So that was also in 2021.
Okay.
Okay. Him and his partner get a little bit more serious over that time frame. They move in together in late 21, early 22.
Yep.
And they move into the apartment that we bought for her. This was also in the Newcastle marketplace. As everyone knows, during that time frame, we had a nationwide boom. So the property that we paid $550,000 for was now worth $700
Okay.
in
Nice.
that period of time. And they had a decision to make. They're getting serious. They're in an apartment and they're thinking, well, we've been together now, 12 or 18 months. We're in our early 30s. Logical step is let's start a family. So, they got the news, partner was pregnant. And as you do, you go, oh, fuck, where are we going to live? So because they bought this property well,
Yes.
she was a first home buyer. Obviously, it's the owner-occupier property. They thought, well, what could we do if we were to sell this down and combine our incomes together for serviceability purposes? And then what could we step up into? So anyway, they did the numbers. We ended up selling that apartment actually to another owner in the building.
Okay.
We sold it for $700,000 on the knocker and they paid no selling fees.
Yes. And this was also that because they were about to start a family, to buy an owner-occupier house, I'm assuming.
That's
yeah?
exactly right, because they assessed their serviceability together based on the debt that he had on his apartment and
Yes.
the debt that she had on her apartment, and they couldn't get enough servicing to be able to get another house.
So let's just pause it there because this is interesting. They started as two individuals, both buying investment properties. They then come together, and now the next step is, well, no more pure investment property as such. And the reason why I say pure investment property, because they're going to now look for an upgraded property in a house as an owner-occupier property. But as you know, Jack, I also believe that your owner-occupier property is an investment.
Absolutely.
And at the end of the day, it's the best type because it's CGT free, capital gains tax free. So
Exactly.
So in
And-
that regards, there's now stopping the investment property side of things to concentrate on obviously the family. And this is where I talk about, life gets in the way, but at the same time, it's still an investment.
Well, that's right. So the way that we thought about it, and they come to us for advice on this. They said, "What should we do?" And I said, "Well, what's your capacity if you were to keep both properties?" And they hypothetically said it's probably $700,000. And I said, "Where could we buy for $700,000?" We looked around, and I said, "What would the capacity look like if we were to, get rid of some of the debt?"
Yeah.
And they said, "Oh, we could probably spend $1.5 million."
Oh,
And I
okay.
thought, okay.
Big difference.
Huge difference. So I said, okay, well, the way we need to assess this is which one do we buy first? We bought her apartment first. And then we also said which one is a better asset.
Yeah. Okay.
And naturally, Sam's was a better asset because he spent more on the property up front.
Right.
So we thought, okay, well, let's offload the asset that we bought for Sam's partner.
And it had seen some growth, even though
$150,000
we always
worth
talk
of
about
growth.
holding for a minimum 10 years. But like I said, life sometimes gets
That's
in the
right.
way and doesn't allow you to do that.
150 grand is what growth that we had in the
Okay.
apartment. They didn't have to pay selling agent fees. She didn't pay stamp duty up front because she was the first home buyer, and she only put in 25 grand. So
right.
25 into 150 over
Yeah.
that time is about
Can't
a
complain.
7x return in the 18 months that she held it. So we did that. We offloaded it. They cashed out their money. Plus, they also had some savings that they were saving. And then we all of a sudden went, okay, let's combine serviceability now. We're joint incomes.
Yes.
Servicing is increased. We've got the one investment property sitting there in the hill that's also now valued at 860 because we got that revalued at the same time.
Yeah. Rents would have gone up naturally as well.
That's right. So of interest rates.
Yeah, true.
So then we combined the servicing. They had up to 1.5 to spend on a property. And we thought, well, we've got this capacity. They wanted to stay local to the Newcastle marketplace because that's where they live.
Okay.
So now it was, well, what is the best quality asset that we can get for our money? But instead of just purely looking at this as an owner-occupier purchase, how do we combine the two? So it is still an investment. We're still making money, but we're living in something which is going to be comfortable. And that's when we come up with a strategy. Well, let's use the majority of that budget to get into the best location we can get into.
Yep.
As we know, the location does the heavy lifting and
80%
growth.
of the heavy lifting.
And, you know, Sam is a handy person. He's a tradesperson, you know.
Not like me.
That's right. He's the opposite of you, Frank. He does not wear shirts like that.
Not when he's renovating anyway.
That's right. So we thought, well, how open are we to doing some work to a property?
Okay, and manufacture
still
some
livable,
equity.
still livable because we've got Barb on the way, obviously, but add some value. And that was our strategy. It's let's go get the best quality location we can get in. Let's still use the capacity we have to buy, so that 1 to 1.5. But let's also keep in our mind that we want to buy something we can add value to, so we can then roll within the next 24 months, roll all of the gains that we've made into this after renovating into a bigger and better owner-occupier property. And that's what we did. So we ended up getting out there in the market. We found something in a suburb called Hamilton.
Hamilton, very good.
One of the best suburbs in Newcastle. 550 square metre block of
Close
land.
to the CBD and the
Great,
beaches.
awesome. The house was a hoarder's house, so it
okay.
presented disgusting.
Did it come with all the stuff?
It come with a lot of stuff when we settled on it. Sam's partner was not super excited about it.
As you can imagine.
She had a different concept in her mind of
Yes.
what.
But it was livable, you said, like once they cleaned out all the crap,
Yeah,
right?
well, it wasn't livable in the state that they were in, but with a coat of paint,
Yeah.
a deep clean, and some minor landscaping.
Yeah.
It's very, very livable.
Oh, nice.
So we bought that. We paid 1.1 for it.
Which is good buying in Hamilton.
Very, very good buying on a 550 square metre block of land. The neighbour on the right-hand side, if you're looking at the property from the street, sold. They paid 1.8 for theirs, identical, just renovated. On the other side, they paid 1.7, same block of land.
But renovated.
Not renovated, updated, that one was.
But the 1.8 one on the right was.
And that was 18 months prior as well.
Yeah, so it goes to show how much a renovation
So there's
can...
upside there. We knew straight away there's
manufacture
upside.
for you.
Which is what we did. So we've rolled into that now. We paid 1.1 for that property. Sam still has the apartment that's worth 860. So now we've got $2 million worth of gross assets, and we're going to spend about 300,000 on the reno on the house over the next 24 months, and we'll spend 300 on it, and that'll be worth $2 million plus once we do the reno.
Nice.
So that's a pretty
Yeah. Then they've got together, I suppose, some more equity. Hopefully their incomes go up, and they'll probably go out and be ready to buy another investment property
so
in the next 18
roll
months
that
to 24
into
months.
another owner occupier and get into a better suburb in Newcastle,
okay.
maybe Merewether, or they'll just refinance that. The incomes will have increased. They're both progressing in their careers, and maybe keep that as an investment and then move into another owner occupier, which is what you did with.
They've got options, don't they?
That's right.
And that's what property investing gives you. It gives you those options to mix and match with your investment property, your pure investment property journey, and your owner occupier. Like you said, at this stage they're looking at going from Hamilton to an even better suburb like Merewether. Whether that's a bigger house or not, time will tell. But that's their goal at the moment. And like you said, the owner occupier in Hamilton is an owner occupier now, but they may keep it as an investment.
Exactly.
It gives you that option.
And I guess the key things we wanted to cover off with this case study is how quickly your situation can change with making a few really, really good decisions. You think about Sam 3 years ago, owned a property for 5 years, had negative growth, was thinking, this is fucked. I'm in a terrible
he didn't give
situation.
up. Like I said before, he didn't give up, and I think that's the real key. It's a key for a lot of things in life. Don't give up, even if things are going to shit. It's onward and upward, I always say. So that's good that he didn't give up and he continued and he got the right advice. He sought out the right advice, And look how quickly he's turned around for him.
Exactly. You know, and you went from having a $300,000
Good woman by his side.
Exactly. But there's a few
That's that.
few key things we need to talk about. One is he made the decision to cut his ties, but then reinvest to go.
So he didn't procrastinate.
It wasn't property that was the issue. It was my decision making that was the issue. So he fixed that.
Yeah.
That's number one. Then
Didn't
he took action
procrastinate.
again.
Didn't procrastinate.
That's right.
Moved on.
He got into a good suburb, into a good property. That's grown in value. So in the 18 months that he's owned that property, that's grown by, you know, $150,000. You know, in 18 months, where the other one he held, he lost 50,000 in 5 years.
Yeah.
Like you said, he then combined with a partner.
Yes.
Now, for some people, getting a girlfriend, a boyfriend, whatever it is, or husband or a wife, may not be right for you. But joining with partners doesn't necessarily have to be a lover.
No,
it
that's
could
right.
be a joint venture partner. It could be,
Could be a
we've hit
friend,
serviceability limits. What can we do together now? You know, 1 + 1 = 3 that we couldn't do by ourselves.
Yeah.
So he combined with someone else. They looked at their options and went, okay, we've currently got between the two assets, the 850 for the apartment that he had and the 700, we've got $1.5 million worth of assets. What does it look like if we were to sell one of those down, use the capital, and then buy a much better quality asset?
Yeah.
Now they've got, you know, $2 million worth of assets, and along the way they've bought properties that they can add value to. So not only are they continuing to step up into better quality assets, they're growing the asset base, they're getting higher dollar value assets.
Yes.
They're also now they've got 2 properties of which that they can, if they want to, manufacture growth through and not just rely on organic market growth.
Yeah. Yeah. Very good. Very good. That's a good case study, I believe.
And you know, if you project that out, they're early 30s right now. What does it look like in late 30s? What does it look like in early 40s? What does that look like in early 50s?
When you get to my age.
You know, and it's very similar to your story.
Sorry?
You started with one, you got the
Yeah.
second, you
Well-
met a partner, you bought some more, you had a hiccup in the middle there, then you know, again, you found another partner, and you just continued to build
It is,
over
yeah.
a long period of time.
Yeah, and I think it's it is similar. You know, you're on a positive growth trajectory. You have a life setback. You get back on the horse. You go again. You don't give up. And just, you know, as we've spoken about, you know, many times, Jack. It's just one step at a time and one property at a time. And you do it when, you know, there's been some capital growth, your income has grown, so your serviceability has grown, and you're comfortable and ready to do so.
Absolutely. It's a journey, mate.
It is a journey. It's all part of your life. It doesn't have to be the main part of your life, investment property. And, you know, it hasn't been for me. You know, I had a career in the corporate world in finance and accounting. The property on the side was more my passion, really.
That's right. What made you more money?
It certainly became my passion when I saw how much capital growth I was making. So yeah, it's all part of life, but it can certainly be disheartening for some people like Sam, who, you know, his first property investment was wrong and he sought out the wrong advice. Can be very disheartening, and a lot of people do give up, and that can be in the stock market as well. A lot of people buy shares, they get burnt, the company disappears, or, you know, they've just...
You got burned a few times.
Yeah, I got burned. You know, the GFC burnt me with some shares, and that's why I'm not a big fan of it. I just have very little money invested in shares. But, you know, and a lot of people give up on shares once they've been burnt as well, likewise with property. But I think the message is, you know, especially if you're young and you've got time on your side, keep going, because, you know, the upside is phenomenal.
Absolutely, mate. Absolutely.
Oh, yeah,
and
very good.
if you know, if you're someone out there who's listening to this, who's at the start of their journey, and you know, they're disheartened by, oh fuck, I've only got this amount of income and I can only just get into the market, or, you know, you've made a few wrong decisions along the way and you feel like you're a little bit trapped or you have no way out, you know, it's a very, very good story to think that these are two normal people. They haven't got rich parents. They're not earning mega money. They're two normal people. You know, Sam's partner was a nurse, and Sam was in aviation. You know, they're two people who have just gone combined income. We could have 300,000 or 400,000 worth of combined income together. You know, over time, that wasn't like at the start.
And you only you don't need to have $1 million or your first property to be $1 million.
That's right. They stepped up, and that's the most important thing. Is we started with the $550,000 for his partner, that went to 700, bang, sold out of that, stepped up to the next property as the incomes grew and the equity grew. We got 1.1 now as a property. Then we got the 850. 5 years time, that 1.1's 2.5. We sold down the 2.5. Now we've got a $4 million asset.
Yep.
So it's that continued.
It is.
You know,
I've
growth
said it
and-
before. What I love about the property market is when it moves very quickly.
That's right. Doesn't discriminate.
Yeah, it doesn't. And, I always say about Sydney, Sydney does nothing for 7 years and then doubles in 3.
That's right.
It's a very generalized comment, but, when you're in it and it's, and it's doubling, well, that's a good time.
It's a good place to be.
It is.
All right, Frankie.
All right, mate.
Take care.
Very good.
God
Catch you next
bless.
week.
And be good to your mother. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Righto, Frankie!
is it 2000?
We are back.
on.
Sorry about that, Joel. That would have hurt your ears, mate. I screamed very loud. Mate, I had to start the podcast because you were just starting to spit out a lot of information, and most of the stuff that comes out of your mouth, Frank, is usually the opposite of that. It's garbage. So,
So you thought you'd just start the recording. Start. We're on.
so Frankie, tell us what you were saying. It's been how many years?
Mate, this month, September 2023, 30 years ago, I bought my first property.
Wow.
Literally in September.
And that was when Jesus was playing halfback for Jerusalem, wasn't
It
it?
was, yes. It was flicking between halfback and fullback at some stage. Yeah, so 30
Mate.
years ago, mate. There you go.
There we go.
I should show a photo. We should show a photo of what I looked like 30 years ago.
I know.
I looked about 12, but I was
That's when
only
you
19.
just started getting your grey hairs, wasn't it?
Mate, I don't even think I was shaving at age 19.
So, Frankie, before we get into the very, very important topic we're going to talk about today, run us through that. So, go back 30 years from today.
Yeah, I still remember it like it was yesterday. Well, some parts anyway.
And what parts do you remember?
Well, when I
Having
bought the
to
property.
part, probably having to part with your money. That's what you remember.
Well, didn't have much money. I borrowed it, right?
So,
it's not about using
so
your own
run
money.
us through that. So, you go back 30 years. How old were you?
19.
19 years old.
Yeah, so add 30, mate. 49.
49. Okay. And that was the apartment you purchased.
The apartment. And what's funny, actually, I saw a real estate agent only last week posted that they just sold a property in Queensborough Road, Croydon Park. And I was like, wow, that's where I bought my first property 30 years ago.
There we go.
I think they sold,
So, what did you pay for yours?
mate, 83 grand, I think it
83
was.
grand. Okay.
Yeah.
And at the time, was that a decent amount of money?
Oh, well, I suppose it was. I honestly don't even remember, because I'd only just started working full time, how I got the deposit. All I do remember is that my parents put their house up as a guarantor or second mortgage, I'm
Right.
not sure, and that allowed me to
Borrow.
borrow probably 100% or close to it, 90 or 100%. I must have had some money saved.
Yeah.
And
30
away we
years.
go.
So you're 19 years old. You bought an apartment for 83,000 in Croydon.
Croydon Park.
And
yeah.
then what happened after that?
Mate, I held it for 10 years.
What'd you sell it for?
Sold it for 190.
Not bad, huh?
Yeah, so for doing nothing really.
That's right.
And that's when I thought, wow, I've just made...
you bought another property after that.
Yeah, I bought a studio apartment in Ashfield
How'd
a
that
couple
go?
of years later. Yeah, that one, I ended up selling both then to fund an owner-occupier property.
Of which you lost in a divorce.
Yeah, well, that's a different story. That's a different podcast, Jack.
So,
didn't
mate,
lose it, actually. We
what
sold
a
it,
bloody,
but
what a
I
crazy
kept the
thing, eh?
properties in the
30
divorce.
years, and would you have thought 30 years ago you'd be sitting next to me in a beautiful Flamingo one piece,
No, I didn't
talking
think-
property?
I didn't think that. Well, you're not even 30 years old.
I
Think
know.
about that. So
I
no.
know.
But I do remember my dad saying to me, like I said, I was 19. He said, "You'll thank me when you're 40." Right? And yeah, it was true.
There you go. And when you were 19 years old buying your first property, $80,000, how much would you have been earning, you reckon?
Oh, I know. I was earning 17,000.
17,000. So
It was like my first full-time job in accounting. Yeah.
about 5 times your income.
Yeah, whatever it is.
Okay. Well, if you're on $100 grand a year, it's just like buying a $600,000 property now.
There you go.
There you go.
So
Same shit, different day.
yeah, I mean, everyone
And-
says
and-
what's funny is everyone now, and I don't know if it's a negative mindset or whatever, but everyone says it was so much easier back then. I don't recall saying to my dad or anyone else, it was so much easier 30 years before.
Mate, let me
1993.
just on that piece, Frankie. I've got something for you. So I went to a Tony Robbins event last week,
Yes.
and
So my point is, it's all about just taking action, like we always say, and just doing it. I mean, I understand not everybody is in the same situation. In fact, everybody's in a different situation, and for some people, it is just impossible that they cannot go out and invest. But for the vast majority, we live in a great country like
that's right. The
Australia,
majority of people in
Sydney.
Australia, I think, would have the option.
They're employed. Yeah,
That's right,
That's it.
to
I think
do
a lot
it.
of people have the option. It's just about taking the action and doing it.
Now, Frankie, there's just so much stuff I don't even reckon we're going to get to the topic that we wanted to
right.
talk
Let's
about.
just chew the fat, mate.
Chew the fat. Hey, you're very good at that. So Tony Robbins last week, there was a few things that I thought were very profound. Now, Tony Robbins said there's 4 skills you need to learn in life. And I thought you'd like this, Frankie. Pattern recognition. Don't react, anticipate.
Don't react, anticipate. Yes, that's very
Pattern
good.
recognition. Ready? Number 2 is pattern utilization. You've got to use the patterns of which you recognize.
Yes.
Number 3 is pattern creation. And number 4 was energy. So being able to...
Pattern creation, is that about creating your own pattern?
That's right. So what I wanted to touch on those 3 things is pattern recognition. And have you ever read the book, The Changing World Order by Ray Dalio?
I don't read
Bridgewater
much,
or so?
mate. I think the last book I read was in year 12 high school.
Yeah, you mainly,
Circa 1991.
You're an only-
longer than 30 years ago. And then
you're
a
an
few
OnlyFans guy, aren't you?
and then a few sport of that. I don't believe the books. You've thrown me now. It was I've read a few sporting biographies.
Oh, of course, yeah,
autobiographies
Shane
after
Warne,
that.
just straight down the
not
pitch,
Shane
you know.
Warne.
Anyway, so pattern recognition, and the reason I bring up Ray Dalio's book with that is because Ray Dalio has a book called The Changing World Order. If you're into history and you're into money and
Yes.
all things wealth creation, I recommend reading that book, because what it talks about is everyone thinks what is happening right now is new. Everyone thinks, technology, AI,
I'll just say 3 words. History repeats itself.
Well, that's the thing, right? Tony Robbins went on to talk about pattern recognition being everything we are experiencing right now has happened before.
Yeah, that outfit you're wearing happened, 55 years ago.
That's right.
It's come back. Or you're
It's-
trying to bring it back.
it is
I don't know
back.
if it's time yet.
And what Ray Dalio talks about, and he goes through thousands of years of history,
Yeah.
is that everything that has happened right now has happened in another time. There is good times and there is bad times. And what Tony Robbins said is life happens in cycles
I
or
was about to
seasons.
say. So I was about to
Or
say
seasons.
cycles. Yes, for sure.
You've got winter, you've got spring, you've got summer, you've got autumn.
Yep.
And they're the seasons of life. They're the seasons of investing. They're the seasons of everything. There is good times, there is bad times, and there is okay times.
Yeah, ups and downs.
And right now, I would say in property, I wouldn't even call this a winter, to be honest, because it's not that bad.
No.
Prices have come off a little bit. Interest rates have gone up, but it's not like there's blood on the streets everywhere.
No.
And so if pattern recognition is a skill that you need to learn, and then pattern utilization is the next skill you need to learn after you've recognized after you've worked out how to recognize patterns, it's very much what you do. You're just talking about 30 years ago.
Yeah.
You've been through 30 years worth of life, 30 years worth of cycles, 30 years worth of experience. And going back to when you were 19 years old, you bought a property not because you had experienced any of that stuff before.
And I tell you, I don't even remember people ask, where were we in the cycle? Was the property market booming? Was it at the bottom of the cycle? I don't even know. All I know is the instigation was I just started earning a full-time wage, albeit of $17,000, and my dad is like, "What are you doing with all this money?" I laughed. I'm like, "What do you mean all this money? It's $17,000." But it was just it was the right time to invest some money.
But reflecting back now,
interest rates were close to 10%. Let me tell you that. Now, albeit on a lower investment amount.
yeah, but it's relative to your income at the time,
Exactly.
right?
Everything's relevant.
If you go back to, and if you go 10% on $80,000 and you're earning $17,000 a year, that's $8,000 a year just in interest, which is 50% of your income.
Yeah. 50% of your gross income.
There we
Well,
go.
I probably wasn't even paying tax. The tax-free threshold was a lot lower.
18,600 back then as well. But now you've worked out over the last 30 years, you've recognized patterns, right? Because like you said,
Yes.
the market happens in cycles. You've bought in good times, you've bought in bad times. But what we know is that over time, the same thing happens time and time again.
And this is what I've recognized, right? One of the big ones. And this is why, I say people are sheep to a certain extent, because when the market booms and you're going to an open house and there's, 100 people in the open house, people get excited. You can feel the excitement in the air. It's palpable, mate. You're going to an open house and everyone's excited. Yeah, I've got 5 open houses to look at today. Everyone's keen to buy, right? And then in the quiet times when the property market is not on the Channel 9 news, it's not on a current affair, it's not being spoken about by taxi drivers and Uber drivers, and we talk to agents and they hold an open house and literally nobody comes to the open house for half an hour. That's the time to buy, because the market's not booming as it is. Now we know that all that anticipation, all that demand is what creates the prices to surge over a quick 18-month to 2-year period. It's in those quiet periods for those 6 to 7 years prior to the boom that's when real money can be made, and people can buy with, you know, as we say, in isolation as opposed to buying in mass competition. And had you bought in those quiet times, you would have done well when the upswing and
That's
the boom
right.
came around. But people are sheep. Oh, there's nobody here at this open house. Something must be wrong with it.
Yeah, right.
Nobody
It's
wants to go
confirmation bias. We want to
it's
make sure that other
confirmation
people
bias.
are doing it, right?
Yes.
And
So that's
I
what I've
talk about
noticed
it.
many times over the last 30 years.
There you go. And I talk about it all the time. It's like, don't take advice from someone who is not in the position or doesn't have the qualifications to be able to give it. Now, it's pretty hard. There wouldn't be too many people. You know, obviously you're 50. You started investing.
I'm 49. I'm not 50
Come
till
on.
next year, mate.
Don't let the
Come
truth
on,
get
mate.
in the way of a good story. Now, if you've been investing for 30 years, regardless. Now, there wouldn't be too many other people that are alive today, like that have invested for a longer period of time. Because most people don't start when they're 19.
Yeah, that's true.
Most people start when they're 30 or 40.
Yes, yes.
If they're 60 or 70 now.
So they're lucky to get to 30
Most
years.
people have fallen off the perch.
Yeah.
So you've experienced 30 years, you know, and you're going to experience potentially 20 or 30 more.
I hope so.
It's
Let's
going to
not
be
fall off the
interesting.
perch.
Hopefully you don't fall off the perch, Frankie. But it'll be interesting to sit here in 30 years' time. How old will you be then? 100,
I'll
110?
probably be 80. Considering I'm 50 today, as you say it. So I'll be 79, mate.
The 30 years, that is so fascinating to me.
Yeah, yeah.
Because in 30 years' time, it's going to be so interesting to look back on the last 30 years and go,
Well, let's just
how
say for the next 10 years' time. How about we reconvene in 10
Yeah,
years'
but people don't
time?
think 10 years ago, oh, no, but it's been a good 10 years. You talk about anyone, oh, yeah, you've only bought an up market. It's like, well,
Yeah.
fucking how long you need it to be for it's an up or a down market?
It is true, yes.
30 years is like, you know,
It's
most...
a
most
good
people-
sample size,
That's
as
right.
they say.
And then you're going to have 60 years worth of data to analyse,
Assuming
right?
I don't sell, yeah. At some
Well, it's not
stage, I
even
might-
if you sell. It's just that
Yeah.
you've been alive for that period of time.
Yeah.
It'll be so fascinating to look at what has happened from now. And we're going to have this podcast because when it goes out to the ether, it's never deleted.
Yeah.
I'll be a billionaire by that time. And you'll be...
Go. You won't want to talk to me by then,
Mate,
mate.
absolutely,
You'll
you'll be
be two
there.
in the high sky, you know?
And the next thing is obviously the pattern utilization, because we're talking about pattern recognition right now.
Yes.
You've recognized the pattern over the last
Yes.
30 years. I learned from people like you and all the other people who've been around for a lot longer than me and have created a lot more wealth. And people are learning right now, listening to this, about pattern utilization. Nothing has changed. The last 100 years of
Yeah,
Australia.
well, pattern recognition first.
That's
of
right.
all,
You got
and
to
then-
recognize the pattern, and then it's about
utilising it.
utilizing the pattern. Going,
Yes.
well, this has happened before, and it will happen again. It's believing that. But so many people, which takes me to the other part, just before we go on to the next, is our brains do three things. Tony Robbins said, is they distort, they delete, and they generalize. So our brains often distort things. You know, when you talk about someone, how big was the fish you caught fishing? Oh, it was this
mate.
big. So they distort reality.
Have you heard about the one-armed fisherman? He caught a fish this big.
We delete things. And this is fascinating to me, not from a property point of view, but from, I obviously don't drink 11 months of the year, but when I forget how shit it felt and the reason I don't drink, right? So right now I'm edgy. I'm like, oh, I can't wait for December. I want to have a party. I want to enjoy life. As soon as I drink, I'll remind myself why I don't drink.
Yes.
But we delete things out of our mind. We forget about
of
things.
course,
Unless it's
yeah.
really traumatic, we often forget. You know,
Yeah.
if I asked you, what was your worst day last year?
Worst day last year.
Yeah. Could you remember?
No.
That's right. We delete. But I bet you at that point in time, you would have thought, fuck me, this is the worst day I've had in my life.
Yes.
And then we generalize things. So, you know, we're
Definitely.
very good at making everything seem the same and, you know, being fluffy about things. So that plays into when I scroll back up in my notes here.
I think you were saying pattern
Creation.
utilization.
It's pattern
first?
utilization. So we
Yeah.
know this is going to continue. We know this is going to continue. Even if our currency changes and we're not pegged to the US dollar, and it will continue.
But
Because-
if we've recognised the pattern first, then I suppose the second part, the pattern utilization, it's not that easy, because even though we keep saying to people, buy when the market is quiet, not everyone does it. Everyone knows it, but
Well,
it's
that's
that lack
right.
of confidence there. And we're trying to say, we've seen 30 years of patterns.
You've seen 30 years.
Yes.
What about the people who just died today and have been along 80 years?
And I guess, because I've seen it and lived it, I've got confidence in it, right? Others don't. And then others go, well, shall I believe this person or not? And they read all the books, but unless you take the action, it's so funny. I saw this quote once and it said, you can read all the books you like about swimming, but at some stage you have to jump in the pool, right?
It's very true. But the
thought that was a
fascinating
cracker.
thing is, and it was the same as myself, like when you bought a property at 19, you didn't have pattern recognition.
No.
You didn't have pattern utilization.
But what I knew I had on
you
my
had
time,
trust.
but what I had time on my side. So I said, even if this property doesn't grow in value over the next 10, 20 years, I've got time. You
That's
know,
right.
so I don't care. And
you're
it's,
only-
and it's not going to send me
you're only
broke.
60 then.
And it's not going to send me broke, though. Like, even if I hold this for the next 10 years and it hasn't grown $1,000, I've still got the, you know, and assuming it doesn't go down, which
Yeah.
I had good trust that it wouldn't, at least I've still got the asset there that I can always sell and go, okay, well, that one didn't grow as well as I thought it would. It didn't double in 10 years like they said it would. I can sell it and try again with something else.
The best thing about right now and over the last sort of 5 years is everything is documented so much
Oh,
easier.
yes.
You know, back then there wasn't.
There was nothing. There was no books. There was no buyer's agents. There was no internet. You know, internet was only just starting in 1993. But you know, now everything's at your fingertips in the digital world.
And everything's documented, right? So this podcast, literally in 30 years' time, we're gonna be able to go back to it
Yeah.
and listen.
But I didn't read any books. Oh, you know, look, I went on the trust and the advice of my dad, who, you know, had lived 30 years. I don't even know how old he was exactly. He would have been probably in his, well, if I was 19, he was probably in his, you know, late 30s, early 40s. You know, but I went off his trust that for the period of his life, he had recognized some patterns and seen them, that property does well. Property will double, you know, assuming it's a good property in a good location, etc. Property, you know, will grow in value.
That's right. And your dad had 30 years of experience prior
Yeah.
to, you know, you doing that.
Yeah, and my dad, you know, just put it out, he wasn't a big property investor. He did buy a house when he was, I suppose, fairly young, just before him and my mum got married. You know, they had that house. And then, you know, they obviously sold that to get an owner-occupier. And then I think after that, they bought 2 investment properties.
But the owner-occupier they bought was in
Strathfield, where
That's
they still
right.
are today. And
what would that be worth
And
now?
then they only bought 1 property. And then they ended up selling that for some reason.
the Strathfield house. How much do you reckon?
Oh, look, it's worth, you know, it's on nearly 800 square metres. So it's worth a minimum 3, you know, and it's
That's not $3, folks.
3
That's
3 million, sorry. Yeah.
And they would have paid what?
Mate, they
Couple
paid
hundred grand
about,
for that?
I think, $30,000. I think they said that was top dollar back in the day.
Isn't
that
it so
was in
funny?
1975, mate.
Isn't it so funny? And then 30,000. The person before that probably would have paid
Probably 10.
$1,000 for it.
Yeah,
2,000. You
going
know,
way
like
back. Mate, it would have been in pounds.
and there was a big house that just recently sold in Tamarama for 50 million or 47 million. Did you
Yeah.
see that?
Yeah,
and
yeah,
then
yeah.
they bought that house for like £3,000 70 years
Yeah.
ago.
And I was actually saying this to someone yesterday. I said, it's funny. You know, we hear about $10 million properties in Vaucluse, for example, selling 7 year later for 20 million, right? And then, you know, we can compare that. So they made 100% gain. I said, and we can also say that someone can buy a $1 million property and in 7 to 10 years, it sells
Sells
for
for
2
two.
million.
Yeah.
I said, both 100% gains equal. But the difference is one's made $10 million and the other one's made $1 million. So we were sort of just, you know,
The delta is greater.
we were just sort of talking about, you know, how this is why the wealthier keep getting wealthy if they keep on investing, because they're investing into a $10 million asset that goes to 20. There's 10 million straight into the bank account if they were to sell. The other one's, you know, $1 million, you know, or, you know, buying something
yeah,
for
that gap
300.
just keeps getting bigger and bigger and bigger.
Going to 600. And that's why, you know, I've always said the investment property going from one property to 5, 6, 7, 8, 9, it was a snowball effect. It actually got easier.
That's right. And we also talk about not paying our bills with percentages, paying our bills with
Yeah.
dollars.
You
So
can't pay your bills with, or your mortgage with percentages. You've got
that's
to
right. So
pay
it's
them
about,
with
sure,
real
you may
dollars.
have had a $300,000
Yeah.
property that grew by 40%. You may have made, what, 130, 140 grand in growth. What
Yeah.
happens if you had $1 million property that grew by 40%? Same number, or even 30% or 20%, but
Yeah.
you've made more actual money,
That's right, yeah.
which is what we want. The third one was pattern creation.
So this is about creating your own patterns? Tell us
Yeah,
about that.
so you know, obviously, when you recognize patterns and you can utilize those patterns, you can also create your own patterns. I think the first two are probably the most important because, you know, as you start to become more financially educated and more financially literate, you can start to create your own patterns.
That's true, yeah. You can take more action and take a bit more risk on it, if so to speak.
And then the last one was energy, which doesn't really have anything to do with property investing. Another thing I wanted to touch on is he said, which I thought was profound: good times create weak people create bad times create strong people, and strong people create good times.
Mate, that sounds like a tongue twister.
And it's the same thing, right? It's all around seasons, patterns.
Yes.
Because it's true. Right now, we've had really good times. No one's naive to that. The last sort of
And
15 years has been really strong.
Yeah, and everything is cyclical. You know, we had very low interest rates, you know, record low interest rates for the last 10 years or so. Like I said, 30 years ago, I can't remember what the interest rate I was paying was, but it was circa 8 to 10%. We'll now, go into another higher, young people are saying this is a high interest rate environment. I'm saying this is around the average, being 6 or 7%. But over the next 30 years, we'll go higher, we'll go lower. I don't think we'll ever go to record lows of a cash rate of 0.1%, but who knows what can happen in the next 10, 20, 30 years. We may.
Exactly. And we also could go the other way, right?
Yeah.
But again, there's patterns. When interest rates were increasing and when they were 17%, property prices were still rising.
And the other thing, that people should remember is nothing is forever. This, as the saying goes, this too shall pass. These, all these cycles we go through, there's no need to panic sell or anything like that, because this will pass. It's, it's like going on a roller coaster, so to speak, albeit a 10, 20, 30 year one. Hold on. You're not going to be going down that steep slope forever. Eventually, that rapid pace of downward on the roller coaster will slow, right, and you'll start going slowly up again. It's up and down, but neither the going up or the going down will last forever. It will pass, and it's about just holding on for the ride, because it will pass.
My motto is leverage up and hold on. But it's true, right?
Oh, very true.
You get 30 years down the track.
We have a storm in winter that, it's in Sydney, it'll rain for 7 days straight, and people, this is going to go on forever. No, it's not. This heat wave we're having now, this is not going to go on forever. In fact, tomorrow I think it's going to be back down to 20 degrees. But even if this was a 7-day, 14-day heat wave, it will not go on forever. But the best one is the pandemic. It was, that whole thing was not going to go on forever. Yes, action needed to be taken for us to get through it, but eventually we all knew, we knew in the back of our mind we weren't going to be locked up in our houses forever. It would pass, because we'd seen it 100 years ago with the Spanish flu, right? Or the Spanish pandemic, whatever it was back then.
Yeah, it's true. It's very true, mate. It's very true. Now, we got on to a lot of stuff just now. What I wanted to actually cover off, which I need to get up on my phone, give me a couple of seconds here, folks, was the 10 most asked property investment questions. I've lost it, so let me just get it up. 10 most asked property investment.
We might have to defer them to next week, mate. Just questions. Go through a couple today.
We're just going to go through a couple and we'll revert. So the 10 most commonly asked questions about property investment. Number 1, what is property investment? Pretty good question to ask. Yeah. How do I start investing in real estate? Number 3 is what types of properties are good for investment? Number 4 is should I buy residential or commercial properties? Number 5 is how do I finance my property investment? Number 6 is what are the key factors to consider when choosing a location? Number 7, what is the role of a property manager in investment? Number 8 is what are the tax implications of property investment? Number 9 is how do I assess the potential return on investment? And number 10 is what are the common pitfalls to avoid in property investment?
All good questions. All should
very good questions.
Probably know the answers to all of those.
Well, Frank, I actually don't know the answer to any of those. So
before investing in property, I'm sure you do. You speak about them all the time.
Now, mate, do you think we need to, let's cover off the first one. What is property investment? So what is it? This is probably a question which is different to every single person who's answering it, right? Because it obviously has a fundamental
Well, the
meaning.
fundamentals of investing is, investing your money into an asset that is returning you two types of income, if you like. One is, a rental income or a dividend, if you're talking shares, but we're talking property investing, so let's stick to that. So in regards to property investing, a rental income, but the other side is the asset actually growing in value.
Capital appreciation.
Capital growth, capital appreciation, exactly.
That's right. So it's essentially putting some money into an asset, us being property or this one being property, and getting a return, a greater return than you put in on that money in the future.
Yeah, hence, the term having your money work for you, because once you've invested into the asset, it's working for you. You're not going, you're not doing much. You're not going to the property 9 to 5 every day, tending to it. You put property managers in place.
And one of the incredible things about property investment, which is unlike any other asset class, is just simply the amount of leverage you can get on it, which essentially means how much of your actual money you put into the investment versus how much money you can get from an external party, with property being the bank.
And going back to my 30 years experience, Jack, one thing I've really realised in regards to property investing is how resilient the Australian and Sydney property market is. Regardless of things we've been through, pandemics, GFCs, downturns in the cycle, booms, etc. highly resilient, mate. It just keeps on keeping on.
It's like you, Frank,
I like to think so.
like a tank. Number 2, how do I start investing in real estate? Well, mate, let's talk about. We just had a brief overview of you, but how did you start? So you had obviously some family that was.
Yeah, well, my dad planted the seed, I suppose, and
Yep.
I suppose I asked him a few questions back then. What's this going to do for me? Why should I put my money into a property? Like I said, he said you'll thank me when you're 40. Once this property, at that stage, there wasn't even any talk about investing in multiple properties, and I think I went a lot further than my dad ever thought. And
You said, Dad, why don't I go spend all my money down at Jackson's on George?
mate, we were going to Jackson's on George, just reopened. I see, mate. It was very good back in the days. But it would have just been about, well, what's this going to do for me? And, I suppose the answer from my dad is, well, you're going to get some rental income, which is going to help pay the mortgage. And in, all things going well, in 7 to 10 years' time, that $80,000 property is going to be worth $160,000. And I think once I saw that it was literally 10 years later, I sold it for 190, more than double. And I've gone, wow, even though I'd only made $100,000, it was like I've made that $100,000 by effectively doing nothing, not going out to have to work for it.
And work was not your strong suit as well, Frank.
Mate, I was very young and ambitious back in my late teens.
So you got started through, you said you had some cash, and then you also had like a family guarantee, which guaranteed
Must have
the
had some
mortgage.
cash. I don't know how I did, but yeah. I was living at home too, don't forget. So I wasn't paying any bills. I wasn't paying any rent.
Yeah.
So it was a way of forced savings. I suppose that's what my dad was, I suppose, looking at it, that I wasn't just blowing my money, that there was a way of forced savings there
For sure.
by paying the mortgage.
For other people, you start investing by saving cash for a deposit. You get started. You can have a family guarantor. We actually don't really need any money. You just use the collateral of a family member's property to securitize your deposit, and then you can get started. So there's many ways, but essentially the way that you get started is you need some sort of initial capital, whether that's from...
And I think that gives you a good goal, something to aspire to in regards to your savings. So you don't just go out and blow it. I want to invest in a property that's going to grow in value. And I suppose that there needs to be long-term thinking. You need to go, like when my dad said to me, you'll thank me when I'm 40. I'm like, I'm only 19. I'm not thinking about when I'm
You're
40.
like 40.
I'm thinking about when I'm 21,
That's right.
But, you have to have long-term thinking. It's all well and good to live in the day of today and live while you're young and things like that. But a portion of you needs to think about, long term.
Ryan King, who we've had on the podcast, if people go back to a prior episode, you'll listen to him. He said something which I thought was very smart. It's like you need to invest so you're secure tomorrow, but you need to have enough money so you can enjoy today.
Yeah, that's
which is true.
Very wise.
Let's do the number 3, and then we'll stop, I think, and then we'll do the remainder of the 10 next episode. The third most commonly asked question is, what types of properties are good for investment? Now, Frank, we've spoken about this 1,001 times.
Well, for me, I got into residential. There's obviously benefits into getting commercial as well. I never had the appetite or the inclination to get into commercial. Maybe in the future, I don't know. But for me, it was just residential. I think the first thoughts for most people are residential, because you look around, what do you see? 95% of properties are
residential.
Probably residential. We all live in a
And it's the
residential
easiest to
apartment.
get into.
We all live in a residential property
Yeah.
and things like that. And it is the easiest to get into. You need a lesser deposit. You can leverage up more. There's more demand. I think what I like about it is there's more demand. Everybody, whether you're a renter, owner, occupier, etc., everybody
Needs a roof over there.
Needs a roof over there, and is looking to live in a residential property. So there's always that greater demand than commercial property.
100%. You've got commercial, and then inside of the residential or the commercial sector, you've got all your subcategories, right? You've got houses, you've got apartments, you've got boarding houses, you've got all the other things. And our strategy is very much about buying established properties in good locations where there is an imbalance between supply and demand, because they can't build any more properties because they're established locations, where there's a good demographic of person who earns a good income.
Yeah.
And something I've realized only recently about our strategy is that we're in locations where, to live in those locations, there is a level of status, and status is one of the main drivers of human beings. Right? As they earn more money and they get a better job, they get a better car, they want to move into a better home in a better location, and I think that's a big driver for our strategy. Is like, where can we get into a location where, to live in that location, there is a level of status.
Yeah, and in regards to just houses and units, people say, I know there's a lot of people out there who goes, I would never invest in a unit. Well, not everybody has the affordability to go straight into a house. You might in regional Australia. But if you want to, and this is even talking as an owner-occupier, if you don't want to go and live in regional Australia or on the outskirts of Sydney and you want to live in and amongst in the Sydney metro area, then a unit is a very good option. And as long as there are demand, I mean, you look at units in the inner west and the eastern suburbs, the demand there is so strong because not everybody has, 1.5 to 2 million in today's dollars to go out and buy a house in the inner west. Yet they can go out and get a unit that they can afford. And yet the growth rates on that unit might not be as good as houses, but it's still pretty damn well strong.
Absolutely. Absolutely. So it's about understanding the asset class in a more intimate level.
Yeah, for sure.
Mate, I reckon that'll do us. What are we talking, Jolie, in terms of
it's
time?
At least 35 minutes.
Half an hour.
Oh,
That's
there you
bang
go.
on, mate. There we go. We don't muck around. Frankie, congratulations on 30 years, mate.
Thanks, mate.
That's right. Hopefully we can sit here at another 30.
Well, let's hope.
I bloody told them young whippersnappers, Jack.
I might be on a cruise in the cruise we're here.
Mate, potentially. See you, folks. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. All right, Frank, it's that time of the bloody week again, mate, where you
Yes.
come into the office and you annoy everyone. So it's good to have you in, mate.
Thank you, mate. Thanks.
good.
They're thoroughly annoyed now.
Yeah, that's right. I like what you did there. And, mate, you've got your wife's shirt on again this week.
Yeah.
The Lambretta.
Lambretta, it is. It's not my wife's.
The Lambretta shirt. Did you ever ride a Lambretta back in the day when you were in Italy?
No, mate.
No? You grew up in Italy?
No, I was born here. I've been there on holidays.
Must be a
obviously.
different Frank that I'm thinking
Yeah.
of. Now, Frankie, last week we started off by celebrating your 30th anniversary as being a property investor.
Yes.
Out of the 100 years you've been alive, you've been an investor for 30 of them.
That's right.
And we also were meant to cover off the top 10 most frequently asked property investment questions as delivered to us by ChatGPT. And
I think we did 3, didn't we?
What did we get out of the way, Joel? Was it 3?
I think 3.
That's 3. And if it wasn't 3, it's 3 now. So, mate, we're going to go through the other 6 questions.
6 or 7.
And mate, what were 6 or 7?
7 plus 3 is 10, mate.
There we go. That's why that's why I didn't finish school. And mate, we're going to obviously talk about our personal stories with these 6 or 7 questions, because Joel thinks us talking about our personal stories is a great thing.
Okay.
Okay.
Let's do
So
it.
mate, you've got an interesting story. Born in Italy.
I'm not born in Italy.
Come over here
Let's
on
see.
a boat, and mate, you've just been a concreter ever since, which is good. So, Frankie, number 4 is how much can I afford to invest, and what is my budget?
Well, that is different for each and every single person out there, is it not?
Absolutely. But mate, let's talk about your story. So you're getting started in investing, and a question that's probably going to come to most people's mind is how much can I bloody spend? And firstly, how much do I need as a deposit? So how did you work that out when you were, if we go back all those times
Mate,
to,
like I said, that was 30 years ago, mate. I don't honestly remember. I do remember, look, my dad was a bank manager at the time. I had just started a full-time job.
So what you're saying is he was a shifty prick, and you...
Had started working. So, earning all of $17,000, but it's all relevant to today's, in today's dollars, it's probably $70,000 that young people are earning straight out of school or uni these days. So, look, I think it's a matter of saving as hard as you can, saving as much as you can. So then you can then go to a broker or a bank manager and say, hey, I've got this much saved. This is my income. You tell me what is my maximum borrowing capacity. Now, once you ascertain that, you don't need to go out and obviously invest all of that. If you feel like, well, the broker said I can invest 800,000, or they'll lend me, up to 800,000. You don't have to go out and invest all of that if you're not comfortable. But I think it's just a matter of, they're the 2 key things: some savings behind you, some cash behind you, and obviously an income, a steady income. It doesn't have to be a good one. That's different for each and every person, depending on what their job is or what their business is. But with those 2 things, that's what can kick you off. Go to your broker, go to your bank manager, ask what is my maximum borrowing capacity based on these 2 things, and they will let you know.
Yeah.
That therefore is your budget.
So if you don't have a bank manager dad like you did, for a normal punter like Jack, So I remember when I was looking to buy my first property, my parents didn't know what a broker was, and neither did I. So, as you do, you go into Frank's dad being the bank manager. Our bank manager was
back in the early 90s, mate. There wasn't many brokers around.
You were back BC 200, weren't you?
Pre-COVID. well before COVID.
Before Christ. So we just went into the local ANZ branch, I remember, in Windsor. We sat down with a beautiful lady by the name of Jodie. She was the, I think, the lending manager in the ANZ. And we said, here's all the documentation. What can we spend on an investment property? What deposit do we need to buy an investment property? And naturally, they come back with the figures. But I think if you were just getting started in investing, or maybe you own your own property and you want to buy an investment property, or you're just wanting to look at investing in another property, I always like to reverse engineer that now. So even if you're not ready to buy now, work out what can I spend on a property based on what I can spend, how much cash or equity do I need for the deposit for that property, and then what's it actually going to cost me from a cash flow perspective. So you can obviously work out your numbers as well, because you might be able to borrow, like Frank said, 800,000, but the reality is you might not feel comfortable from a cash flow perspective to actually spend that, and you might want to spend less.
Yeah, and I think just to add to that, Jack, about reverse engineering it, even if you haven't saved a substantial amount of money, so you don't have, I don't know, 50 grand, just to pick out a figure, in cash saved, go to the broker and ask and say, well, this is what I'm earning. I've got 20 grand cash saved. What does that look like? Is that going to get me an $800,000 property? They might say, no, that's only going to get you a $600,000 one. So, okay, so how much more cash do I need to save to get to an $800,000 one? And what that will give you is the motivation to go out and save even harder. So it gives you a bit of a goal to aim for.
All right, well, we covered that off. Now, number 5 is, what is the current state of the real estate market?
Wow.
Mate,
depends who you ask.
Everyone wants
Everybody has an opinion on this. They've just gone and catch a cab.
KPMG have just brought out that,
I saw that.
15% increase over the next 18 months, which, as we know, is...
well, if only they'd be right, I'd be happy.
I know, mate. I wish it was...
One thing I know for sure, when KPMG and these big firms and the big banks especially come out with these, especially the bullish and positive forecasts, look, that's all well and good. Let's not forget, just not long ago in COVID, they were talking about a 30% decrease in the market. They got that wrong. Not only did they get it wrong on the negative side, it was a 30% increase, not a decrease. So they got that well and truly wrong. Now everyone's talking about 10 to 12 to 15%, depending who you're talking to, who you're listening to. And one thing's for sure, they will be wrong.
That's right.
Now, KPMG, did you say, saying 15%? Now, when I say they'll be wrong, it might be 18%, it might only be 10%.
That's right.
Very hard to get right on the figure.
They never will.
For them, just getting it positive or negative will be right. So I think the main consensus coming out of all these forecasters from big corps is that it's positive.
That's right.
They're all in agreement that it will be positive.
It's positive
growth.
sentiment. That's the best thing about it. What I take from all these different articles, and this answer the question on what is the state of the real estate market, if everyone's reporting on positive things, that's going to have a positive impact on the marketplace.
And sentiment is a huge thing in the market.
It's everything.
Consumer confidence.
The media controls sentiment.
Yeah,
this is why the more positive they are about things. If the media went out today and said, go buy a house because it's going to go up by 500 grand over the next 12 months, everyone would do it because, most people buy into what the media has to say. But the reality is what the state of the real estate market is at the point in time of someone purchasing actually means zero.
No.
You want to make sure that your real estate market, your personal real estate market, financially is okay before you go out there into the actual real estate market.
Yeah. I mean, people's long-term goals, and we've spoken about this before, is to just be continually investing in property as and when they can. Regardless of where we are in the market and what the sentiment is. It's like, it's like, I suppose, investing in something easier in like shares. If you earn a monthly income and you say, well, every month when I get my pay packet, I'm going to take $500 of that monthly income and go and buy $500 worth of shares with it. Now, if you just did that on a regular basis, every month you went and bought, let's just say some blue chip stocks, $500 every single month for 12 months straight and for 5 years straight, you will do very well. And you will be buying, if you're buying Commonwealth Bank shares, one month they may be $90, the next month they may be $88, the following month they may be $92. But over the time, you're going to be accumulating a lot of those shares.
Dollar cost averaging.
That's right. And you're not worried about you know, did the S&P drop 500 last night, or did it go up 1,000 points, and things like that. You're just buying for the sake of continual buying and investing.
That's right.
And I think that, you know, obviously you can't do that with property on a monthly basis, but you can do it, you know, every few years.
Yeah, exactly right. Exactly right. So it's all about not, I guess, to go back just to answer the actual question, what's the state of the real estate market? It shouldn't even really be a question, because everyone's going to have a different opinion. No one actually knows.
But it is a very popular question.
It's mate, it's everyone. Everyone
come
asks
up
me.
as
So
a frequently asked question.
What are your thoughts on the market?
Everybody has their thoughts on it. And look, it's just a great, you know, it's the barbecue talk for, decades,
every time I go somewhere, it's the first thing people ask me. Like if I'm in a crowd of people that don't really know me, it's, so what's the real estate market doing at the moment? And I think they all think I'm going to have this profound answer. But it's usually like, mate, I actually have no idea what the real estate market's doing right now, to be honest.
Well, like you always say, even though you might not have any idea, obviously you do, it's not about having an idea or not. It's about taking action.
That's right.
And investing. What we do know is on the whole and in the long term, it's a great investment.
That's literally what I say. I say, what I do know is in 5 or 10 years' time, I'd near bet my life it's going to be more expensive than it is right
now. Exactly.
Anyway, on to number 6. What is the potential for property appreciation in the chosen area? Meaning, and I get asked this question, if anyone goes to my Instagram or my TikToks when I'm answering all these people's questions, the most common one is, where should I buy for 800,000? What should I do? You know, everyone wants to know the next area. And again, it's not a profound answer I give a lot of these people, because the reality is, good areas are always good areas. You know, and you can speak to this, Frank. You've been doing this for 30 years now. We're not trying to go, what's the best area to invest in right now? Because the best area to invest in right now is the best area to invest in 20 years ago, and it's going to be the best area to invest in 30 years' time, right?
And I always say to people, what does it matter where the best area is now? Because that does change. Like right now, people are going crazy over Perth. And Perth might get phenomenal growth over the next 12 months. But in 12 months' time, it's not going to be like a Commonwealth Bank share that you can go, well, I'm going to take my 30% profit and sell out. You're not going to sell in 12 months' time. The transactional costs are too high. And the whole aim of buying in property is not to hold for 12 months. You want to be holding for 12 years minimum. So it's a matter of, Perth might be great now and might be great for the next 12 months. But what about for the 12 years after that?
That's
because
exactly
I can tell you for the 12 years prior to this, that hasn't done much. So it's not about a particular area and what that area is doing right now.
That's right. It's what it's done in the previous track record, and we always talk about having an area with a past track record of performance, and then what does it look like into the future. The best way to do that when you're searching areas is obviously we get access to a lot of data, but you don't need to complicate it. It's like, think about, where would I like to live? If someone said to me, here's an unlimited check, where would I live? Look there, because most people want to live in really good quality locations, right?
Yeah.
And you just look at, what did the property sell for 10 years ago? What did it sell for 10 years before that? What did it sell for 10 years? That's all readily available data.
It is. I was about to say, it's readily readily available. You can
readily available.
Well, it's not going to cost you, Jack.
It's freely readily available.
You can
Frankie's got a little tongue twister.
You can get on Real Estate and Domain, put in your budget. Let's just say your budget is 600,000, and see what pops up, and put in your region, New South Wales, Queensland, Victoria, whatever the case may be. See what has recently sold for around 600,000. Then there is all this data there that they can go back 10, 20, 30 years, and you can have a look at the growth rates. Okay, this house, a 322, selling for 600K today. What did a similar house sell for 10 years ago? Oh, it sold for 300,000. 10 years prior to that, it sold for 150,000. This is showing me now a trend that property prices are doubling in this region or suburb every 10 years.
That's right. Consistent demand.
There you go.
Outweighing supply. There you go. There you go, my friend. Number 7. How will I finance the investment, e.g. mortgage or cash? So, Frankie?
Well, like I said.
So how you'd finance it now is you just shake out your back pocket. You probably have enough to fall out of that for a new deposit.
Well, look, if you're talking your first investment property, you obviously need to save that 10 or 20% deposit. Take advantage of some government incentives, which I can tell you were not around back in 1993, Jack. But yeah, take advantage of those government incentives. Save, obviously, for your first one. Try and get that 10 to 20% deposit. And obviously then you've got to borrow the rest. Take advantage of leverage, which is a great thing. Don't be scared of debt. It's good debt. What really amazes me is people will go and borrow money on credit cards or live their lives on credit cards in debt, paying huge amounts of interest. Go and lease a car. Go and lease all of these nice fun things that are only going to depreciate in value, cost them a hell of a lot of money in interest. But then when it comes to investing in something great, like a property that's an appreciating asset, they're worried about, oh, well, this one's offering me 5.5% interest versus this one's offering me 5.25% interest. When it was for a car for 9%, it wasn't an issue. It's
very true.
Come on, get your priorities right, people.
Exactly right. And look, the reality is your returns in property will be much greater too if you're using more of someone else's money of your own. Because obviously you're getting the return on the whole asset. So you buy $1 million property. If you put $1 million of cash into that $1 million property and it grows by 10%, you make 100 grand, you've made 10% on your money. If you put 100 grand into that $1 million asset, the tenants are in there paying them interest on the other debt, and that grows by 10%, and you make the same 100 grand, it's actually 100% return on the money that you've invested into the asset. So the more leverage you have doing it safely, the better the returns are on your actual cash.
Yeah, and you only need to save that deposit in cash for the first one, like we've spoken about many times. Once that first property then starts increasing in value and you start getting some equity there, then your next 20% deposit is going to come from the equity in that property, because subject to servicing, of course, investment property number 2, the bank will lend you 80% of that. The other 20% will come from the equity that has been created in property number 1.
That's right.
Now, away you go.
And you just rinse and repeat.
Rinse and
And if
repeat.
you're like you, Frank, you've still got the first dollar you ever earned, haven't you? You haven't
wish.
spent that.
I wish I did.
Number 8. What are the ongoing costs such as property taxes and maintenance? So, Frankie,
wow.
we've actually done an episode on this, I'm pretty sure.
Look, there are costs involved, obviously, and tax aside, you've got, if it's a unit, you've got strata fees. You've got council rates, you've got water rates. If it's a unit, you've got repairs and maintenance. Now, repairs and maintenance is actually quite interesting. I was just telling the guys, I was just been going through my 2023 tax files on all the properties, all the invoices and everything, because I like to print everything out old school, Jack, and put them into a folder, of course.
Right. You've still got homing pigeons that go and do this.
And I had the floor covered and putting all the documents in the pile, and then for one of the property it was just like repairs and maintenance, because I did a fair bit of work. That had a water leak, had this
in Brisbane.
No, or the one in Brisbane, I did some capital improvements there, but one of the houses in Sydney, there was a water leak, had to get that fixed, and one thing leads to another, and so once you fix this thing, then I need to repaint it and things like that. So anyway, I had this pile of say 6 to 8 invoices for repairs and maintenance for one property. On the other property, a small unit, not one repair and maintenance. So it didn't cost me $1 in repairs and maintenance during this financial year. And that can really fluctuate. Some years you can have absolutely nothing. Other years you might have 10 grand in repairs and maintenance. But repairs and maintenance is obviously one of those important ones. When you have multiple properties in the same state, you start getting into paying a bit of land tax.
Oh, yeah.
What else is there? You've got
your property management fees.
Fees, of course. You've got your
interest, which is the highest.
the
that's
interest.
your biggest cost.
Forgot about the interest.
What we pay the bank.
Yeah.
But look, for the most part, depending on the leverage you're taking on the property or the LVR, most of the expenses should be covered by your rent if you buy a good property. And usually, this is rough numbers, you could usually account for about 2% if you're getting a property that's yielding about 4%. 2% negative per year out of your pocket. So if you've got $1 million property, it's probably going to be costing you about $20,000 a year out of your pocket to hold that property. Yeah. That's likely to be pre-tax as well. So if you're on the highest tax bracket, you get 50%.
But like we said, it can vary. It can vary greatly.
Yeah, I did a video on TikTok last night, which I spoke about a property we bought for a client for $2.7 million. It's an investment property. It's a house, 3-bedroom house at the front, and then a studio at the rear. Combined rent's $2,100 a week. Worked out to be that property was going to be costing them about $30,000 to $40,000 a year out of pocket pre-tax. Post-tax, it was about $25,000-ish, and that's on a $2.7 million asset. Yeah. So you work that out, $2.7 million. Let's say it grows at 10% per annum. It's actually grown at 18% per annum for the last 20 years. But let's say it grows at 10%. You're making $270 a year in capital growth. It's costing you $20 out of your pocket. Your net number's $250 up.
Mate, who said he's not good at maths?
That's right. What are the ongoing costs such as property? No, we just answered that one. Yeah. Should I manage the property myself or hire a property manager, Frankie? What a topical question this is.
Don't even go there. Definitely hire a property management. Seriously, for the, it can range anywhere from 4% to 7 or 8%, depending where you are in the country. But why would you want to manage something yourself, given the liability that, the risk associated with the liability that you could put yourself up for if you don't get something right. You know, in this day and age when there is so much, the law is so much in favor of tenants' rights and and tenants' responsibilities. And look, and so it should be, because historically, some tenants have been hard done by property owners who haven't done the right thing.
People like Frank.
No, not me. Hence the reason why these laws are in place, to look after tenants, because they need to be looked after. My point is, there is so much legislation and rental tenancy law around this that you could not possibly know it all.
Absolutely.
You've got property managers out there who do this for a living. They're doing it 5 to 6 days a week. They've been doing it for many years. So why they are experts in their field. So for like I said, 4 to 5% of your rental income, they deduct it automatically. They send you their statements. They look after the tenants.
It's tax deductible.
It's tax deductible. So, if it's the 5%, if you're on 50% tax rate, go down to 2.5%. You just wouldn't. It's just not worth the risk.
No. And mate, who wants to put up with fucking problems? I put up with enough problems every day. I could not imagine having tenants.
Well, you don't want tenants ringing you as well. And what the property manager does as well is create a buffer between you and the tenants. You don't need to know who the tenants are. They don't need to know who you are. There's a property manager there who does all the checks and balances, making sure they can afford the rent, making sure that they have a good track record of either employment and or being renters before. And let them do their job. That's what they're there for.
Absolutely, Frankie. Absolutely.
Cost benefit analysis, as I say.
Yeah, that's right. Value outweighing the cost.
Yes.
They're very good. And last but not least, Frankie, we've got, what is my exit strategy? How long do I plan to hold the property? Mate, you'd be a great person to answer this one too, because you're at that stage now.
Exit strategy.
What's your exit strategy?
Mate, the exit strategy has always been...
You've got no kids.
Yeah.
Do you reckon I'll make the will?
Well, Sam might leave you a couple of coins, mate.
Thanks, mate.
You'll have more money than me.
Some
Don't worry
of your
about
clothes
that.
would be nice, actually.
Oh, you want some of the clothes? Okay. Mate, the exit strategy has always been, for me, pretty simple in that grow, have several properties, let them keep on growing for as long as possible, sell one or two or however many you need to sell to then pay the debt off on all of them. And let's just say then you've left with 5 or 6 properties that are then debt-free, bringing in rental income, and that's what you can live off in your retirement. And don't forget, while you're still holding them, they're continually growing in value as well. So at any time, you could just then flick one off and say, I want to sell that one for $2 million. It's debt-free, bring in $2 million. The question is then, where do you just park that $2 million? Because you've got to park it somewhere, park it in a term deposit and get 5%, I suppose, and you could theoretically just...
So your strategy's very much been around, don't worry about cash flow along the journey. You've had a strong income, your wife's had a strong income, that serviced the debt along the way. Let's continue to pump all the profits from the properties back into more property, leverage up, get to a point where we've got a strong portfolio. So let's say you got to $10 million in assets and you stopped buying assets, and on that $10 million worth of assets, you carry $8 million worth of debt. You stop acquiring, you don't pay any debt down with your own income. That $10 million goes from 10 to 20 million. The debt remains at 8 still. You sell down $8 million, say, of that $20 million worth of assets, pay off the $8 million worth of debt, and all of a sudden now we've got X amount of dollars left over.
Yeah, unencumbered, and really that's it, yeah. I've been more capital growth focused because that's what, creates the wealth, not worrying about putting $100 or $200 in my pocket every week. I'm like, okay, going into it, I knew that was my strategy, that the properties would be negatively geared. So as long as you know going in and you can afford to service...
Cash flow the difference.
That difference, happy days. But yeah, that is one exit strategy.
Growth gets you there a lot faster.
Yeah.
At the end of the day, it's slightly different for everyone, right? If you're someone who earns a lower income, $100 a week means a lot to you, then this strategy is probably not right for you. And I guess the Flamingo investment strategy that we talk about is probably not right for these people. But for us, it's all about acquiring the largest asset base we can. The faster you can acquire and pile those assets on, the quicker you're going to get to that number, because obviously you only need one market cycle, as we've all learned over the last couple of years. 30 or 40% in the marketplace, the more you were holding, the more you would have made as profit. So acquire as much as you possibly can in the shortest period of time. Get to a place where if you work out, okay, if this doubles over the next 10 years, am I going to be happy with the net equity number I'm going to be left over with? And if you are, you get to that page, you sell down. You may not sell down, and pay off 100% of the debt. You might go, okay, I'll sell down 50% pay down 50% of the debt, then the portfolio will be very positive, and then I'll use the positive income to pay down the remainder of the debt.
Yeah, and it all depends at, come that point in your time when you're looking at retiring or whatever the case may be, what your personal situation is, how much you have saved, and what the properties are worth at the time. I mean, another exit strategy could be that, you might have 3 or 4 properties and you may just choose to sell them all. Just, sell them all, pay off the debt, and then with the remaining capital, with the profits, you may wish to then put that into super, put that into shares or some sort of managed fund or something else. Go see a financial planner and they'll obviously guide you in the right direction in regards to that. So it's really horses for courses.
That's
but
right.
I think the most important thing is you want to be in a position where you've got the option to sell down some assets or sell 1 or 2 assets and pay off the debt in one lump sum. And that's why we also talk about, going interest only on your investment properties and not worrying about paying the debt. People go, oh, but you're never paying any debt. You'll pay the debt off at the end once the properties have all grown in value.
So instead of paying down the debt in the short term, use that surplus cash that you're paying down the debt with to carry more debt.
Yeah.
Because by carrying more debt, you carry more assets. If it follows the long-term trajectory of the marketplace, when the haters who watch this reel are going to say, well, what happens if the marketplace stops going up? Well, I'd rather bet with history than bet against history.
Yeah.
I'd rather carry twice as much property with the same amount of cash flow than carry half as much and pay that debt down. They grow in value, you pay it down.
Yeah. And for others who have children out there, the headlines are forever the same. They've been the same for the last 50 to 70 years. How will our children and their grandchildren ever afford property? Well, grow yourself a nice portfolio and leave your children a legacy and leave them the assets to give them a kickstart in life. There's your solution to that.
Yeah, exactly right. And then when you get to what, your age, Frankie, and all the cash you've got, you can fucking wear whatever you want. Like, most people would be embarrassed to walk out of their house and that, and you just get a...
I'm not embarrassed, mate. When you get to my age, you're not embarrassed by anything. Right. This is quite trendy, mate. Don't worry.
I can tell. Eh? White socks. What are those sneakers again?
These are the...
Nikes.
These are the Nikes, mate. The navy blues. Anyway, I think that's good.
On you, Frankie.
See you next time.
Always a pleasure.
Thank you.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDFs beforehand. This is a Henderson podcast production. Hey, Frankie, we're back. We're back, mate. Let me just get this. What is this? This is just a little charger. We'll move that out of the way, mate.
Mate, what a week!
Did you go to Nuna's over the weekend?
Oh, mate, yeah, got the tablecloth.
I was going to say you just got the tablecloth from Nuna's, and she's just sewn that up over a bit of lunch, and you've started to wear it.
There you go,
mate. It looks good.
It looks good, mate.
It goes with those sneakers.
I make anything look good.
Like the salt and pepper hair you've got going on.
It matches the shirt. Salt and pepper on top and salt and pepper on the tablecloth.
What's it look like with your luscious Via hair from here down to your...
No, none of that, mate. Mate, what a weekend, long weekend, 2 grand finals. Mate,
how was it?
Oh,
were you up Panthers or you up Broncos?
Oh, mate, I was just up for a good game, and it was.
Frankie, what not a lot of people know about you, if they're only new listeners, is you used to be in the NRL.
Well, not as a player.
Frankie was front row for the West Tigers.
Oh, yeah, I wish.
He was their front row of the financial support.
No, head of finance, mate, back in the day when
the
West Tigers were actually making finals.
Mate, yeah, and since you left, they've just gone downhill.
Well,
that's because their financial stability.
Probably not because of me, for many other reasons, but yeah.
So there you go, mate. It was a very, very good long weekend, and I know you would have spent working all weekend. You wouldn't have stopped from.
Mate, I don't work on public holidays or the weekend. Almost work days.
This episode, mate, what we're going to talk about is, and we've spoken about renovations in the past, but what we're going to talk about is potentially people's misconceptions with renovations, how difficult they can be, how expensive they can be.
Too hard, it's all too hard.
Yeah, and how when you're looking or assessing an opportunity, you can completely transform the value of that property simply by repurposing or reconfiguring the floor plan without adding any extra internal space like people think you have to.
Yeah.
Obviously, when people talk renovations, often they talk cosmetic. Let's just do a cosmetic reno, no structural changes. I don't know how many times have you heard that?
Oh, cosmetic, it's easy. It's get rid of the old wallpaper or the gross paint color and paint it neutral colors.
You've still got wallpaper in your place, don't you?
No, it's coming back, but apparently, if you watch the block, it seems to be. So coat of paint, floors, blinds, lights,
And you did one of these renovations
Few new
recently in
appliances.
Wavell Heights or Mount Gravatt?
Actually, Wavell Heights, yeah, and,
Yeah.
and about to do similar in Mount Gravatt East.
So run us through your Wavell Heights renovation, what you spent, and
Okay, so what we did was coat of paint inside and out. So the outside was, geez, what colour would you call it? Probably a mix between a cream and a yellow on the outside.
so similar wallpaper to you.
Yeah. So, we went with sort of a mid-tone modern grey on the outside. It also had some burgundy or dark red features because it's got one of those red iron roofs, one of those Colorbond colours. I forget at the moment what it is.
Yep.
We left the roof, but then went with a modern ironstone and this mid-grey.
Yep.
Inside, again, I think it might have been an off-white, so just a nice, fresh, crisp white on the inside.
Yep.
Ceiling fans throughout, modern lights,
Down lights. Yep.
and things like that, or a more modern fixture and fittings if they had that in regards to the lights. Pretty much it,
And that
really.
was
It
it. So
already
just
had,
cosmetic
already had
changes.
floorboards,
Yep.
bathrooms. So no new bathrooms, no new kitchens. I mean, they were pretty decent anyway.
just giving it a freshen up.
Yeah,
and what'd you spend on
bit of
that?
landscaping as well, clearing some clutter with the trees and things like that.
Yep.
And look, spent about 25K. The biggest impact was, I'd say, the exterior paint color
paint.
and the new front, picket fence and
Because
things
it give
like
it
that.
better street appeal.
Oh, great street appeal,
Yeah. And what about Mount Gravatt? What are you doing to that? These suburbs are in Brisbane, by the way, folks.
Yeah,
as well.
in Mount Gravatt East, what are we doing there? Similar lighting throughout, new fresh lighting throughout, a little bit in the fresh paint, external as well, fresh
Yeah.
paint and internal.
So just to give it a
much
fresh
it.
look.
Yeah.
And that's what most people do when they do a reno.
Yeah.
They'll go in, they'll leave everything in the same spot, and they'll just do usually paint, lighting, flooring,
Yeah.
kitchens, bathrooms.
Now that would have
Done.
added some value. I didn't bother getting it revalved because I'm not looking at doing anything at the moment.
Yeah.
But geez, I was able to put up the rent in Wavell Heights by, I think $120 or something like that.
$120 a week, which works out to be roughly $6,000 a year
Yeah.
on a $25,000 spend. 20%
that's-
uplift in rent due to the renovation.
Yeah,
And
so we
probably
looked
some
at the
market
return on
movements in
that
there as well.
Yeah, because we did it, but if we didn't kick out the tenants were moving out anyway.
Yep.
So it was like took that opportunity between tenancies to freshen it up.
And how long did that take from start to finish, from when tenants were out to when you had new tenants?
Geez, I think it was only three weeks or something.
3 weeks.
Because
Thanks
we
for coming.
planned everything in advance so that the day they moved out, the next day people
The
went in
work
to
started.
do the works. Yeah.
And often that's what people will do to renovations, and they can work an absolute treat. But where an opportunity can lie when you're assessing, an asset, is sometimes they do not have the most functional floor plan. Sometimes the floor plan's a little bit disjointed. You think, oh wow, if this room was actually a bedroom and we transformed that room into a kitchen, how much better would it flow?
And it's funny, what I like looking about with floor plans is, when we buy a lot of property up in Newcastle, but not just in Newcastle, wherever the case may be, the floor plans are just squares upon squares upon squares, or individual rooms. And now, we've gone to this open plan, and it is just, you look at the old floor plans and go, whoever designed this?
That's right.
Why would you live like this?
Every
But you've got to
room
think
was
it was
for
like
a
50
for a
to
certain
60
thing.
years ago.
You had your
right?
dining room, which was for
That's
meals.
right. That was separate to the kitchen. That was separate to the TV room. It's amazing that they didn't worry about.
You slept in still with your mum and dad up until you moved out of home, when you just had a one bedroom.
Not quite. But it was amazing. They didn't worry about, well, if we knock down this wall, we'll get more natural light coming in here and things like that. So
Yeah.
it's quite interesting that over the decades, how floor plans and the way we live has really
completely changed.
Now everything is around the big island kitchen
Yeah.
and stools around that, and open plan onto the lounge room. It's a bit of a pain when you're trying to watch the footy and there's the clutter going on in the kitchen, but it is what it is.
That's right, with all those kids you got running around your house. But mate, that's what for us, it's a really big opportunity, and as people would know from the content I've been putting out recently, we're really focusing on renovations at the moment.
Yep.
Because we don't just want to simply rely on the market for our growth. Obviously, organic market growth will happen long term. Absolutely, we're big believers in that, and our asset selection criteria and process is still about buying the best quality asset we can afford to buy on the best
and that's
street.
based on, as we've always spoken about the location.
That's right.
So now it's like we've secured the location. Let's now concentrate on the asset itself inside,
add value in the
inside
short term.
and outside.
That's right.
But without going into too much expense by not adding that, extra floor space.
Yeah, that's right.
space.
Because if you usually add floor space to a property, you've got to go through council, or you've got to
I
go
was
through a
actually going to
compliant
ask you that
development.
question. So tell me, because I'm not I've never done a huge reno like that. So as long as you stay within the 4 walls, let's call it, you don't need a DA.
No, that's right. So if you're staying within the current configuration of the home, no, you don't need a...
Not the configuration, the 4 walls,
yeah, well,
basically.
the current internal floor space of the home. You don't need
So you're not adding floor space.
That's right. If you start adding windows and stuff like that, then yeah, you usually need to get a DA because you change what the home looks like.
So what about if you do take out a structural wall and have to put in a beam? Do you need...
No, you don't. You just get an engineer to engineer that.
And certify it.
That's right.
Gotcha.
So the engineer comes through and says, yeah, well, based on the span between this wall and this wall being 4 meters, based on the weight that it's going to be holding, this is what beam you need to put in there. And that's really just so future, buyers of that property know that it's been done correctly.
Yeah. And, and I suppose it's good to point out because a lot of people think automatically, renovation means DA, means council, means pain in the ass.
Exactly. And that's not the case.
Yeah.
So, what we have been doing a lot of now is when you walk into a property that's completely unrenovated, you usually cut out 50, 60% of your buyers anyway, because they don't want to do work.
Of course, yeah.
And there's that conception, or perception, I should say, not conception, perception in the marketplace that builders are super busy, everything's very expensive, and I don't want to do it because it's going to be too much of a pain in the ass.
Yeah.
So we're already seeing unrenovated properties sell for less less than it would cost you to renovate and resell that property as a finished product. So there's already margin in that. And we bought a great one on the weekend, 600 square meter block of land, tree lined, quiet street, corner block. If it was renovated, I reckon it's 1,415. Unrenovated 925.
Wow, nice.
So, that's a great example. But there's another one we're just about to start. No, actually, it has started. And great position, corner block on the corner of 2 of the best streets in the suburb. Across the road is actually a race course, which is very rarely gets used other than for training horses. But it's just a really peaceful outlook. You're looking over a big grass race course.
Yeah.
And had everything you needed. It had a good internal floor space, but it was just a bit of a disjointed floor plan. You walked in the front door, on either side, on your left and your right, you had 1 bedroom, and straight ahead you had 1 bedroom.
Yeah.
But then to get out the back, you had to go to that next door, turn left, sort of zigzag through another room, and then out into the kitchen and the dining area.
The classics I've seen is when you walk in and the bathroom is in the middle of the house, or the kitchen is right in the middle of the house, and it's like, wow. Whoever put that there, it's so funny.
They don't work, and a lot of
you
people
can't work around them. You got to bulldoze them. Like
That's right.
you got to get rid of the kitchen or the bathroom in the middle.
But people can't see through that.
No.
So, we thought, okay, there's opportunity here. There's enough internal floor space. How can we reconfigure or repurpose this to make it much more functional for the 2023 family?
Yeah.
And naturally make it much more appealing to a future buyer. So when they walk in, they can't go, oh, that's not really in the right space. Or, I don't like how this, is disjointed. Because that's one of the first things people don't like.
Yeah.
After they get through the street appeal, you can make a property look beautiful from the outside.
Of course, yeah.
But if they get in the front door and it doesn't feel right, or you don't like where that's situated, then straight away you'll eliminate the majority of your buyers. And if you eliminate buyers, naturally that's going to bring the price of that property down. So anyway, what we did is we thought, okay, can we take out a wall which was 5.5 meters in span, so a big wall, and make that now the kitchen open plan living into the dining room, and repurpose where the current lounge is into the 3rd bedroom. Transform the master bathroom, because that was in between the 1st bedroom and the current lounge, which is going to be the 2nd bedroom, into the ensuite.
Yeah.
And then once we turn that into an ensuite,
So you're giving the house an ensuite that wasn't there.
that's right. But the bathroom was there, so it was a master bathroom,
Yes.
and there was a 2nd bathroom for this property, which was at the back of the home.
Oh, gotcha.
So it was a master bath, and then the other bath was sort of like the laundry, and then a little
Off the
separate
patio or
WC.
something.
Yeah, that's right.
Yeah.
And then it was internal, but it was off the patio.
Right.
Yeah.
So now it's going to have still a
So it's still going to be a
family bathroom
3-bedroom,
and
2-bathroom,
and an ensuite. Yeah.
but now we've got an ensuite. So
Yeah.
again, you appeal to more buyers.
Of course.
We're knocking out that big wall. We had that engineered, and all of a sudden, instead of having your separate kitchen, separate dining, separate lounge, we've now got open plan living, dining, lounge.
Nice.
Instead of having 2 little screen doors to get out onto your back patio, which was not usable, we're going to have big wide stacking doors. So all of a sudden now you've got kitchen,
Well,
dining,
you're letting more
living,
light in. Is it
and a
north
big
facing
outdoor.
at the rear, or
It is north facing at the rear, absolutely.
so you're going to let some beautiful natural light come in.
That's right, and we're going to have a deck now that you can entertain on. So
beautiful.
all of these things were ticking the boxes of the quintessential family entertainer.
Yeah.
And we're going to have an ensuite bathroom, which we don't have to move any of the plumbing. We don't have to move anything. We're just literally putting a wall up. So when you walk into the room, you've got a big bedroom, 3.5 meters by 3.5 meters. And we've got the ensuite bath.
Yeah, and you mentioned something there about the plumbing, which is important to note as well. If you can, when you're doing these renos, keep the kitchen where the kitchen is and keep the bathroom where the bathroom is. Now, in this case, you might not have. Well, then you're going to save yourself some money there and expense in the plumbing, right?
That's right. And it's all dependent. So the more you understand this stuff,
because if it's really old, then the electricals and the plumbing might have to be redone anyway.
Yeah, that's right. A lot of the time, it's not necessarily the plumbing, but a lot of the time the sewer, because the sewer is no longer works like it should, or the big thing that we look at if we're going to move plumbing and sewer is, can we get access to the underside of the home? Because if you can get access to underneath the home, moving it is very, very easy.
Gotcha.
You're redirecting pipes and. But if you can't get into the underside of the home, a lot of these new properties, you dig all the plumbing in underneath your slab, then you pour your slab on top of your plumbing. So it's very hard to move, your plumbing in a home where it is a concrete slab. A lot of the properties that we buy in these older established areas, you think inner ring of Brisbane, your Wavell Heights property and your Mount Gravatt, are they both piers and are they weatherboard homes?
No, the one in Wavell Heights is pretty much on a slab. And
is it brick?
Brick, yeah.
And
the one in Wavell Heights is weatherboard.
That's right. So weatherboard
Post-war.
home. That's right. And Newcastle's the same. Yeah. Most of the homes, weatherboard construction.
On piers,
so very easy to get under, very easy to move things. And that's what we look for. So if you can move plumbing, move sewer, repurpose, remove walls, keep everything as the same internal floor space, but just optimize that floor space, you can add significant value to it.
So how do you then avoid overcapitalizing? Because yes, you can do a reno, but if you start filling it with fancy marble in the bathroom and marble islands and things like this, suddenly you're overcapitalizing if you're not careful.
That's right.
Or the fancy, taps and things like that. And
so for an owner-occupier, if you're going to
stuff.
live there, then spend as much as you want, right? Because it's your home.
True.
But when we're doing renovations on behalf of clients, it's less about what brand we install and whether something is a real, stone or whether it's a,
reconstituted or whatever
that's right.
They call it,
we're going for an aesthetic as opposed to making sure that, is it really terrazzo or is it, is it really... do you really need 40 mil stone in the kitchens, or can you just have a thickened edge and have 20 mil stone, for example?
Because that's one of the things I've seen, in the past, where owner occupiers primarily have specced up the house to the max, and they go, we put $1 million into this reno, and then they want to sell it down the track, and they want that money back. But the new buyer comes in and goes, well, you know what? That's great that's a marble bench top, but I actually don't like it. So I'm not going to, why would I pay for it, so to speak?
Yeah, that's right. A lot of people spend more, like if you look out in the marketplace now, you'll see homes that if you try to rebuild that home today, you could buy it established cheaper.
Yeah.
Like a lot of properties are like that.
So I think it's, and people sometimes go unique on colors and things like that and go, okay, well, you want those unique colored floorboards, whether they be very dark or very light. They're not going to appeal to everyone. They're going to be polarizing. Just bear in mind when you go to sell it down the track, that's great that it's some, great timber from, Africa or something, but someone's not going to pay for it.
Exactly right.
Yeah.
So when we
be careful with this.
When we do renos, it's all about an aesthetic. A lot of these older homes have carpet in them for some bizarre reason, but underneath that carpet
was in back in the day, mate, in the 70s and 80s.
They cover up beautiful floorboards with carpet. So we pull
funny.
all the carpet up, we resand, then we restain.
It's to preserve the floorboards,
That's
mate.
That's right. They knew Jack Henderson was coming in 40 years' time. With our finishes in the kitchen, we obviously want to have really nice joinery. Usually we use shaker doors. But we don't go and then do 40 mil stone because kitchen joinery, the difference in poor quality and good quality, there isn't a huge discrepancy. But where the money comes is when you add stone, when you put, Miele appliances.
And it goes through, I've seen the fashions come and go, mate, from the nice thick bench top, kitchen island bench, to then, we go for the more modern thin one. So you've got houses out there with a mix of each. Like at the end of the day, what's really going to date it is probably the colour that you chose.
Yeah.
If you chose a nice crisp white with some sort of, slight vein or pattern through it, it's probably going to stand the test of time.
Exactly.
But it's funny how, 1 year the thick is in for 5 years, the thick bench, and then it goes to the thin one. You know, the waterfall edge and all these stuff.
Same as your top, Frankie. You know,
This has
like
stood the test of time, mate.
that's-
Black and white. You can't go wrong.
that was Nonna's cloth that she used to put on the table where
They used to be the red and white ones, mate.
pasta was on, and now you're wearing it as a t-shirt. So yeah, I think a really important thing is to look at what is the floor plan right now. If it's not functional, that's okay, because you can usually reconfigure a house much cheaper than what you might think. So to give you an understanding, engineering, got an engineer out, it was about $1,000.
Yeah.
They looked at everything. Said,
And this is all before you purchased it?
this after we purchased it. We do this all the time, right?
Yeah,
But if you were a buyer, you get an engineer out, $1,000. He said, here's a report. This is what you need to put in there. Went and bought the beam. Beam was $1,250 or something like that.
Yeah.
$2,500. Knocked the wall out. Put it in there. You probably got another $3,000 or $4,000 in labour.
We've all seen renovation shows when they knock down a wall. The difference is remarkable.
Crazy. So for $5,000, we've just completely transformed this home. And I reckon if we renovated and put it back on the market post reno, so we spent $960 on buying the house. We'll probably spend $200-ish, $250 on the reno, depending on what we do right at the end. So let's say we spend $250 at the upper end. We're all in for 1.2, and I reckon we could resell that property for 1.6 to 1.7.
And then when the upswing in the market happens, which it will inevitably will, in whether it's a year's time or 5 years' time, well, a fully renovated home.
That's right.
In a market upswing, demand
Plus, we
for
get
it in a great location.
the increase in rent, because all of a sudden now you've got an ensuite
That's going to help with the
bathroom.
cash flow.
You've got depreciation on the renovation. A lot of the time you get it refinanced and pull out the equity straight away. So, there's a lot of wins there if
Yes.
you've got the right team around you to be able to do it.
That's the key. You've got to have the team around you, not overcapitalised, as we touched on. And really, it's a license to print money, isn't it?
Apparently so, mate. Apparently so.
So what due diligence do you then do, Jack, like before you actually purchase it? So you've looked at the property, you've got the floor plan in hand. Like, do you take it to an architect, or do you just have a look at it with a builder? And
We look at a lot of property, so we know because a lot of our clients are not just investors, they're owner-occupiers. So we know what people want and what people don't
and
want.
we've seen the end product. We've seen fully renovated properties
right.
that have come onto the market, right?
And then when you have 6,000 people walk through them at the first open for inspection, you go, there's got to be something in this.
Yes.
So, the first thing that we look at is making sure, is it on the right street? Is it in the right location? Okay? That's number one.
Yeah.
You obviously want to make sure that you haven't got major issues with the property that you're not aware of. There's nothing wrong with having major issues with the property, because a lot of the time what it costs to rectify those issues is less than the discount you can potentially get on the property.
Yeah.
But you want to make sure you're aware of that. So we bought one recently where we had to re-roof the whole house.
Oh, wow.
$70,000 to re-roof a house in tile. So again, we bought that property, I believe, $300,000 less than what it would have sold for.
Knowing that was an issue.
That's right.
Yeah.
So any major issues, what are they and what are they going to cost to rectify? So if you need to have a builder look at it, or
Obviously, you get building and pest involved, yeah.
Yeah, that's right. And a lot of the time, when you are looking at a property to do a renovation to, you probably don't want to call a builder. You want to call the specialist who does that certain job.
Okay.
Because all the builder does a lot of the time is the builder goes, yep, no worries. They go call
the
the trade
specialist,
person and they put their 20 or 30% on top. So if you're just an individual investor out there in the marketplace, you've got the time. A roof, for example, I wouldn't call a builder and say, hey, what's it going to cost to do a roof? You go and call a roofer. Hey, what's it going to cost me to fix this roof? Piers are a big one in the areas that we buy, because a lot of the homes are on piers.
Yeah.
Over time, you have settlement. They're there for 80 to 100 years, these houses. So they settle. So a lot of the time, you've got to redo the piers, re-level the piers, potentially re-pier certain piers in the property.
Yeah.
That can have a certain cost. So again, you're not going to go call a builder to do that. You're going to call a bricklayer or someone who specialises in piers.
Yeah.
So they're the big things we look at. Is the drainage for the property? Because obviously with moisture and water can come deterioration of timber and wood rot and all the rest of it. So we've got to make sure the moisture gets away. And if it doesn't, what do we need to do to be able to do that? And then everything else is cosmetic in nature, internal.
Yeah.
There's not really that much that can go wrong inside of a house.
Yeah. And another big one, and let's talk about this, is, we've spoken about the internal of the house and not adding any floor space. The external, the landscaping, the backyard, the front yard, especially with street appeal. I think people underestimate what putting some money into your landscaping can really do for a property.
100% fence. I reckon a fence. And
well, that's one thing I did in Wavell Heights. For some reason in Queensland or in this suburb in Wavell Heights, the fence with the neighbour is like a chain wire fence. So you're just looking straight through the fence. Everyone's just looking straight through the fences at each other. So while we were doing
I've heard there's a lot of swingers up there. That's why.
That's the Gold Coast, I think.
Right. Okay.
So, you know, I said, and the neighbour, we spoke to the neighbour, are you willing to go halves in the fence? Yep, nice, new, high picket fence, because they're like the old schoolyard fences, low, and that chain wire made a heap of difference to the property.
Yeah, we bought one recently in Brisbane as well, Stafford, which is in the north side of Brisbane, about 8 k's from the city. Same thing. The client, first thing they did, it was a corner block, so it has a lot of street frontage.
Exposed,
put up, a beautiful white picket fence, and it literally changed the facade of the property.
This was, for me, was the side fence. So your proper, whatever it is, 5 foot, 6 foot high fence.
Yep.
We've just left it in the timber, but you can paint it if you want, or just let it weather naturally. But a huge difference it made.
Yeah, huge. So that's a big thing. So, we don't want to go overboard on landscaping. We usually...
plants are expensive, right?
100% they are.
But the great thing is get them small and they grow.
That's right.
So you water them.
That's why we don't waste money on established plants. We usually get, your mid-sized plant, I would say. So you can see they're there, but then in 2 years' time, all of a sudden they've grown.
Yeah.
But we usually just do a really nice fence from the front. So you obviously have, nice street appeal. Paint is a huge one. A lot of the homes we buy are character, so they have character features.
Yeah.
On your gables, you've got your timbers, for example. We make sure that they're
and the picket fence is nice, especially if it matches the character of the house.
For sure.
Because again, I've seen ones where beautifully character house, timber, weatherboard features, and then this chain wire fence at the front. It's like, seriously?
Yeah.
And the transformation is amazing. Just
all
by
of these little
ripping that
1%ers make a difference.
Painting it, to the same colour as the house.
And it's not that expensive to do this stuff.
No. It costs you money, but you're adding value to the property.
That's right. So these are all the little things. It's what does the property look like as you walk up to it. So landscaping, we're just doing 900 perimeter gardens around the perimeter of the home.
Yeah.
You put something in there that hedges.
Even just a nice lawn,
Turf,
sometimes
mate.
Nothing can beat a beautifully manicured lawn.
Turfed. 100%. Decks, they're not cheap, but they make a massive difference because they bring the inside and the outside
especially
together.
in Brisbane homes. I know both of my properties in Brisbane that we've spoken about have massive decks out the back. Tenants love it.
Swingers love it.
Off-street parking. I know you're obsessed with swingers today.
In Brizzy. I read an article about it once.
Oh, there you go.
It said Frank Raiti reckons swingers.
Nothing to do with me, my friend.
So, mate, look, they're all the things. They're the little things that make a huge difference. And when someone pulls up to a property, the first impressions, I say, is everything. So what the street appeal of the home is very important. When a valuer turns up to the property, if the property looks nice, that's very important. And then it's all about, how functional is it inside? Can you optimize the current internal space but make it better? Add the ensuite bathroom, for example.
Yeah, the ensuite's a big one, I believe.
Built-in wardrobes, but not do them in cheap, shitty, plastic and glass. You want to do it in, nice joinery.
Quality. It doesn't have to be the best, but
you want it to look nice.
Yeah, just something mid-tier. You don't want it to be the cheap and nasty, but it doesn't have to be the best because, like we said, you don't want to overcapitalize. But yeah, putting wardrobes
downlights,
wardrobes
fans,
in bathrooms.
And with the character style homes, because they do not build them like this anymore, you want to make the character features the pinnacle of the home. You want to really expose all of those things.
Yeah.
So all of your character architraves and skirtings,
the cornices,
like all that stuff, you need to make sure you try and keep that. And if it's wrecked, you want to put the same stuff back there and not try and cheap out, because all that stuff makes a huge difference to the end product and what it's actually worth.
Very good.
That was very good, Frankie.
Mate, so Renos, not something to be scared of, especially like you said, if you're just keeping within the four walls of the home, you're not adding another level.
That's right.
On your house or going out further out the back.
Try and optimize the current floor plan
to
make
floor plan.
Suitable for the 2023 family, and you'll make a lot of money.
And something we didn't touch on there, if you so this was we were using a 3-bedroom house as an example. If you can squeeze a 4th bedroom in there, but when I say squeeze, you don't want to make it too small, otherwise it becomes just a study really. But if there's sometimes there's older houses that have the old formal lounge room, so they've got a nice living area anyway that's going to be part of the over plan, and then might have off to the side a formal lounge room. If that can be converted to a 4th bedroom, then you're adding some real value by turning it from a 3-bedder to a 4-bedder.
Absolutely.
There you go.
Frankie, as always, it's a pleasure.
Thank you, mate.
Can't wait to see what you're wearing next week.
All right.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Ladies and gentlemen, we are back on the Flamingo Property Investing Podcast, and usually I put shit on Frank for the terrible clothes he's wearing, but today I've got a strapping young lad standing next to me, who I actually played a few holes on the course with recently. Very poorly.
My shoulders hurt. Carriage a bit too hard.
Ryan King, you're back for another episode, mate. Thanks for coming.
This
has been a long time coming.
I know, we've been trying to organise it all the time, but I'm a busy man.
Mate, you are a busy man, and you've just had baby.
Had another bub, another little boy, another weapon.
Had two now?
That's two boys, yeah. 2.5 and a 6-week-old. So.
And you were saying they're already investing, and they're...
I am for them.
Mate, awesome stuff. Today we thought what would bring a lot of value to the majority of listeners is the question you probably get, and I know I get it bloody every second day, is how do I get, enough income to step away from work for all those people who love their careers?
Yep.
So we're going to do a bit of a client... which is not a real client, it's a mock-up.
It's a real many client scenario, but the most common one we get, I guess.
100 grand retirement. That's what everyone wants.
So I think it's important to start with, this is not advice. No, it's not advice, right? But this is a common scenario we get all the time.
Yeah.
And this is where we work together well, where a lot of advisors who hate property and property people who hate advisors is they think, this is the one way to do it. And we've said on the last podcast, there's a million ways to skin this cat, and it's about figuring out what fits your strategy to make sure that not only are you going to get there tomorrow, but you can have fun today. Like you've seen it, we talked about this on the course the other day. So many people go down the property route and they're over leveraged and they're stretching and they're in a 30-year jail sentence and they hate their life for 30 years. And
that's
me.
Yeah.
But, and you think, well, what's the point of that, right? And same on the other side where people might be not leveraging and they're investing not enough and you think, what are you doing? Like you're 100% chance of not achieving your goal right now. So we got to look at different strategies. So what we're looking at is there's no context here at the moment. We'll overlay context as we go through the case study. But long story short is we're going to look at a 30-year-old, which is the most common people we get at this stage.
30 years. They've had their 20s. They've been to Europe.
They've partied. They've been to South America.
They've been to the Ivy 4 or 5 times. And they're just getting serious. They've probably just got their first partner. And they're thinking, fuck, I've got to think about my life.
Yeah, I think in today's world, it's probably transitioning closer to 25 because cost of living and inflation and we talk about 6-figure incomes. It's not enough these days. We've seen an average of about 300k household income just to get ahead in Sydney, especially.
What is the median income in Sydney in Australia? Is it like 90 grand or something?
92 per person, roughly, depending on the socioeconomic status of the place. But we see you need about 300k. Like I had a chat the other week with a client, which was pretty upsetting. I had to say they had like 350k household income, and I said that. And they're like, we just feel like we should be doing better. It's a lot of money. It is, but not today. It's not. Like, you should be proud of that. It is, but that's the problem with the inflation and the economy is that what is a lot of money to earn is not a lot of money in the context of getting ahead and living. So,
especially in Sydney, right? You can probably live a much cheaper lifestyle in other states.
100% you can. Yeah, 100% you can.
But you probably can't earn the income.
That's right. And we can, especially post-COVID digitally, but that's, we're talking older heads here. And that's where a lot of advisors come in, like, you cut your costs. You can only put more money in your pocket by spending less or earning more. But there's only such a point you can cut down to these days, you know what I mean? And cutting your coffee and your avocado toast ain't going to do it.
Hey, just on the coffee piece, mate. Here in the background, 36... 28's coffee.
The proper blend, get on it.
Can confirm, we feed this through the coffee machine at work, in the office, and it is a very good blend.
It is.
It is actually proven to add 20% worth of performance to your team.
At least to your day.
That's right.
Yeah, so have a look, jump on there, guys. That's
Instagram. That's a shameless plug.
Yeah, 100%. We're getting that. This is my investing on the side. I love businesses, so why not? But yeah, so I think the common thing is age 30. Want to be retired by 50 or financial. I don't say retiring, I say financially free, which is the choice, right? The choice to do whatever you want. So that's the typical one. So we run this as the scenario we're going to run is age 30, trying to be financially free by age 50 on 100k per annum, and we're going to make sure understanding that by 50. We can do this in tax-free structures, which we can overlay at the end, but you need to pay tax to then get the 100k, so that works out to be about 140k per annum. paying tax to leave you with 100 in the hand. For 2 people, it's slightly less. It's about 125, so 62.5K each per year will get that because of the tax-free threshold. But that's the scenario. Now, we're going to assume this person at 30 has 100K in the bank, and then they've got about 100K in super. Right, so that's the starting point for this scenario. Now, we're not going to start with saying property versus shares or anything like that yet. We're going to say just use all investments. We're just going to do capacity, reverse engineer the process, and go from there.
So how much is the 30-year-old earning?
Well, see, that will overlay that contextually, right? Because this will tell us what they need to be able to invest per annum. And that could, somebody who lives quite a frugal lifestyle could do that on 80, 90, and then someone else could say 2, 3. But I would assume that 250 to 300K household income a year, if you're not on track for this, you're doing something wrong. You can definitely do it with less, but that's reasonable from there. So take these numbers in consideration to what your capacity is, like how much you save or invest already on top of your bills and everything, and that'll give you an idea of where it sits from there.
That's right.
Cool.
All right,
let's get into it.
Let's get into it. He's got his little black book of notes.
So I made
here.
some notes just so I don't mess it up. But
that's James Packer's name. You manage his finances. And who's your trigger boss in there?
No, this black book you don't get a hold of this. No, it's not one of them. So the thing we're looking at here is we know we need 140K pre-tax, right? That means that if we work out the numbers on a fair return rate, so 8%, right? We run it just at 8%, which is a fair return rate over 50 years. It's the same rough return rate for property and shares, non-leveraged, right? So we can run with that. By 50, you're going to need $1 million in assets. Now, we were just saying this before. We're not going to overlay property or shares here, but realistically, you do want liquid assets to be able to, for the lower number, because you can draw down on capital. The only downside to property is being illiquid is you can't sell the lounge room if you want 100 grand, right? So, but there's ways around that. But we need to understand that it's $1 million, saying that by the time you hit 50, if you have $1 million, you could draw down 140K per annum from 50 to 65, and then your superannuation will kick in. Now, I know everyone's got their preconceived notions about super, and it's mostly all wrong. All we're looking at here is super is just another structure. If you're going to be retired at 50, you're still going to want to be retired at 65, and it's the only way you can get a large tax-free income from it, so why wouldn't you utilize it?
Absolutely.
Right? So what we're saying here is this person, they got 100K in the bank, so they've got 100K to invest, right? So they need $1 million by the time they hit 50.
So they need $1 million in net assets?
Yep, net assets from 50 to 65 to be able to hit that 45, if you hit that 140K per annum. By the time they hit 65, assuming they run out of that million, it's just getting 6% return, you're drawing it down just basically.
What would they be drawing down per year? Is it
140?
So they'd be earning, say, 6% originally on their million, so they're making 60 grand, and then they're pulling out another 80, and then over time that slowly starts to dwindle.
So the other variables that is you get a better return. The other variables is that you're in an asset that you stay higher risk for longer. We're assuming that most people, when they come finance you free, risk-adjusted return to your need, you're going to reduce your risk just to not get greedy and do that. But the reality is when we get there and markets are doing well, people, you've got more money than you need, and you go, let's keep investing a bit. And we'd break it up into buckets. So we'd say, well, we always want to have 3 years of cash so that we're financially free for 3 years. What market doesn't recover after 3 years, really, right? So in historically, it doesn't really happen. So you got 3 years of cash, then you probably have 4 to 7 years worth in yielding assets, so that it's topping up the income bucket, and then anything left over past that, you'd go pretty hard risk wise, so that it's getting 10-12%, and it's topping up the bucket. So you would theoretically last longer than that, but this is just saying if you went completely the lowest risk possible, right? So to get to that, then from 65, that superannuation would need to be at 1.6 million for that person to generate the 100K tax free, right? Because you're not going to.
Because when you get into superannuation, you go into a tax free environment.
Yeah. So while it's growing, it's 15%. But then when you roll over to pension phase at what we call preservation age, which is 65, you can then everything gains are tax free, income's tax free. So we only need 100.
Just on that, what happens when you go into, say, part pension phase? Let's say you're 55 or 60 years old.
So you can't do it from 55 anymore. You can only, it's what we call a transition retirement or a TRIS, and you can only do that from 60 now. And laws of taxes have changed the rules around it, so it's not as beneficial as it used to be. You could roll it, you had to meet a condition of release, which was you could basically go to your employer and say I retire, and then go back there the next week, and it was fine, or start a side hustle, retire from that, and you met it.
That's why you started the coffee business, right?
That's right.
Yeah.
And then then what you can do is you would draw as much of your income as possible from the pension at tax free, and then contribute as much of your income as possible, so then you got the tax benefit, and that was a nice fast way to improve your retirement savings before you retire. You can still do it from 65 now, but
Yeah.
it's a bit later, and you can do it from 60. It's just not as beneficial.
Right.
But there's not really the part pension phase other than 65, which most people want to be done by then anyway. So, but it's lost that benefit heavily from what it used to be. Because it used to be from 55, you could roll it over and go from there, right? So we need 1.6 million to last us to 100. I just assumed, right? So 35 years. Then what we say is, okay, well, if we're starting with 100K in cash, so we're investing 100K, that's our capital. What do we need to contribute at a fair rate of return between now and age 50 to get the 1 million? And the number works out to be about 25K a year.
Per year.
Right? Per year. So
Net.
So you invest 25K, so 2,000 a month roughly, at that fair rate of return over every year for 20 years. By 50, you should have 1 million if you start with 100K. It's more if you don't start with 100K, obviously. Then that would set you up for that. So
you're essentially investing 20 grand a year for 20 years.
correct, right?
Yep.
Then we say, okay, but at the same time, we've got to be topping up investing in super. Now it's a lower rate because the further, more compounded effect longer term. And that gives us 10 to 15K depending on the return per annum, right? So if you invest 25K per annum into your non-super asset, 10 to 15K per annum into your super asset, let's call it 15 worst case scenario, that gives us a total capacity need of 40K per annum investable into those two assets split across the two to be retired by 50 at the lowest risk strategy possible.
Net.
Which is not bad. Someone who's 30, put aside 40K a year, right? So 3.5K a month.
So you need to be, it's $800 a week, thereabouts, net. So
Correct.
what do you think you need to be clearing realistically to be able to do?
So it's going to cost you, on average, not taking into account mortgage if we're rent investors, etc. like that, you need about 80K a year net to live a good life. Yeah, so probably 120.
Yeah.
120.
Net.
So
probably
net,
earning 180.
Yeah, 140, 150 kind of thing. But keep in mind that 10 to 15K per annum into super, you get a big tax rebate for that because it's 15% tax deduction, 15% tax rate, right?
So you'd probably in reality try and maximize your concessional contributions.
If you wanted, but you wouldn't need to. But so that 10 to 15 really comes down to 7 or 10, right? So it's a lot less. So, but those numbers sort of doable. Now, then we say, so you do that, right? That gets you that 2.6 million assets is your total asset need of your life to achieve that.
Yeah.
Right.
That's not with property.
Not with property, right? And this is where we say that's the lowest risk strategy, right? Like that's the easiest way for someone who doesn't have serviceability or scared of leverage or anything like that. It's liquid, it's easy, it's not sexy, but it gets it there.
And what would you invest into? What are you putting that $800 a week into, would you say?
So if this was me, this is a common case we get, I would use an investment bond for the $1 million outside of asset because that's tax free after 10 years. So we've got 20 years. So really we wouldn't even need $1 million because the 140 doesn't need to be 140 anymore. It needs to be 100. So I'd go like an investment bond, just passive portfolio, just in the market, let it ride for 20 years. That would be that one. And then in super, I just have my normal super portfolio, either in the market or a core satellite approach or whatever you want in there, and just have that invested that way for that long, right? Very passive, very hands off, very doable. So then we overlay with the property side, right? And this is the risk versus reward relationship. And we say, okay, well, same scenario. We need 140K by 50, right? Which we've discussed after yield and cost of holding property. You're probably going to get a 2.5% net yield.
And that's
right?
based on, say, a 4%-ish rental yield.
Yeah, correct.
Yeah.
Right, which is where, with values going up and yields coming down, that's sort of where we're looking.
Yeah.
That gives us a net asset-based need by the age of 50 of 5.6 mil. Now, the problem with that, the reason that's so much higher than the total need of $1 million or 2.6 mil on the other side is because it's not liquid. So you need that extra yield simply because you can't sell a lounge room or a brick,
That's
so
right.
We've got 5.6. Now that could be 5.6 million in property portfolio, debt paid off, or it could be 10.6 million portfolio with 5 million debt on it, right? Whatever it is. Net assets of 5.6 by the time you're 50. So that means to get there with the 100K that we've invested, we would need to invest 120,000 per annum between now and 50 into that strategy to get the same result, right? Whether that's 120 of paying down debt, and this is where it sounds really bad because it's 3 times the amount of the other strategy, but that's when the leverage comes in a factor and you say, well, actually, if we're positively geared, right, where before we might have only had 40, maybe we've got 80 grand extra in positive geared portfolio across that $10 million portfolio. So that's income you don't get that income from the other investment side of things, right? So that's the benefit of the property side. Now, if we then said, okay, but I've only got 40K per annum, so why would I do that? Well, then that tells us the return on that same strategy has to be 15% per annum. So when we're looking at this, right, when we're looking at these strategies and adding the context of the person, first and foremost, do we need liquidity? Secondly, do we have serviceability to get 5.6 million or to pay off? Because you've got to pay that. If you're not going to grow past that, you've got to pay that debt off, and it's a lot of debt to pay off in 20 years. Then we look at, but maybe the leverage gives us that 15% return. So we know on the right-hand side, like of the page, on the first strategy, we're looking at 8% per annum and 40K per annum investment, right? On the other side, we're looking at either a 3-time capacity or contribution amount, or we're looking at a double risk rate, extra return. So then what we do is we look at that and we say, and people go, well, obviously I'd get, a lot of people from that conversation, obviously that, well, no, you wouldn't, because now we overlay your risk appetite, we overlay you as a person. You know, it's all well and good to invest in super and shares, but what if you are shit with your money and you need a forced saving strategy? So then we look at property, right? Because it's the only way you're going to get it. What about leverageability? Do you have good serviceability? Do you have a big tax bill? Maybe we need to negative gear to get there a bit faster, right? So we overlay all that stuff on top, and then that'll tell us we'll probably end up doing a bit of both.
That's right, yeah. And it also means that, you know, by looking at those two things, you're carrying the $5.6 million of net assets in property in retirement at a 2.5% net rental yield, or you could carry 1/5 of that and get a much stronger yield. And this is why I always say to a lot of our clients is property is incredible for building the wealth because you can take advantage of leverage. Let's say that 100 grand that you start with at 30 goes in as a 10% deposit on $1 million asset, and you only need $1 million of net assets at 8% in 20 years time. So if you had $1 million of gross assets, or you'd have $900,000 of debt and $100,000 you put in for the $1 million property, that property needs to double from $1 million to $2 million, or 2.3-ish, because then you need to pay your capital gains tax and all the rest of it, to get the $1 million of net assets.
You've nailed it. And that's the part, like when I do that strategy, people go, oh, like that's where a lot of advisors, they see the numbers and they go, well, why would you get property? You know, go that. Well, no, because property's benefit is leverage, right? And so if, yes, I could do it that way. And if I'm someone who is just no risk and you've got 40K a year and you want to do that and not hold debt, sure, no worries. And then you want to use the rest of your money and have no stress about property or anything like that, that's fine. There's no problem with that strategy. But that's what we do with you, with a lot of our clients, is go, we could probably get there a lot faster utilizing leverage. So and I say this to people all the time, property is a terrible retirement asset. Right? I know you hate it.
No, it's true. I agree totally.
Simply because in retirement, not because, and people get so iffy about that, because you want liquidity. If you're retired, you want to go on a 100K holiday, you can't sell the lounge room. And if you do, then you have to sell a whole property. Then
and it's an asset class that comes with a lot of cost.
It does.
In retirement, land tax doesn't go away.
Yeah.
Property management fees don't go away.
Diversification, if you have like tenancy risk, which it's not really big in good areas these days, but if you did, like you get 30K rental yield, that's a third of your income, you know, of the income you want. So there's risk there. But what we usually say is, if you want to go down the property route and hold property until retirement and keep it there, you're going to need at least 10 mil in property, right? And at 10 mil, you pretty much want to start structuring into a business. And that changes the game completely. You can do so many other things, right? But below 10 mil, you've still got that risk, right? So you go hard, but you're now not a property investor. Now you're a business. Now we're factoring in company structures, trusts, and all that stuff, right? So if you're below that, what we do with you, a lot of our clients, is we start with property early because we can leverage, and it's the power of leverage. It's a great forced savings tool. It's a great wealth building asset, a great accumulation or growth asset. But then we have the strategy to start structuring some of that property later on into like selling it down and using that asset base to then go into the other side.
100%. And I'm a big advocate for that. You know, like I always say to people, I'm not your person when you get to retirement. You need to go take advantage of people like Ryan, get an understanding of where your money's going to be better used for yield, because you're not necessarily focused on growth when you get to 50 or 60 years old.
But and that's where like the context has to sort of change with people. Is it's also not focused on growth. Like the biggest problem we have with, especially like Greeks and you know, European clients over here, they love property, and I've had heaps. They get to 55, 60 and they've got 12 million asset and they're living pay to pay, and they're like, and they can't let go of it because it's that, but I'm worth 12 million. Like, yeah, but don't we want money now? And but what we also say, it doesn't mean we sell down everything, man. You could strategize the sales of those properties over years to make it tax efficient and just top up your stuff as you need it, right? Like you can use it smart, but you also got to remember when we're 50, 55, 60, people think I'm retired or I don't need to can't take risk anymore. Bro, if we live into 100 or 90, it's another 30 years, right? You've got to have some growth at that exposure there to keep going. So it's about structuring your portfolio in buckets to make sure that you can invest. So you might keep the growth bucket in property, right? You might, and then sell down some of that structure to be able to afford the yield bucket and the cash bucket, right? Like, and structure that over time. But the biggest problem people make when they do that, and this is why people fall into the property or the shares category, is they leave it too late. Like, they build property all the way up until 60 and then go, what do I do now? And now you've got to trigger all these CGT and you're trying to sell everything. It should be part of your strategy. Okay, when do we offload? Like, when do we start offloading?
It's all about planning. It's debt reduction and then consolidation, as opposed to, accumulation and growth.
Correct. Because we have a lot of clients come in with big property and it's like, and even like utilizing your super for the property, transferring assets into super or whatever it is, but they get there and they want, now they've heard about super and the tax free and like, oh, now I want to do that. You've got contribution caps, we can only do so much to get there, but we can structure that over time to start from, like, say 50 or whatever, to start dribbling that in. And then all you're doing is transition your income. And then what happens? You might still have debt, because a lot of people will get to, they have X amount in super, but their mortgage might be the same rate. And they're like, well, do I pay off my mortgage? I'm going to take my super out and pay your mortgage. Well, hang on. We can generate 8% out of your super from drawdown. Your mortgage is still only 5 or 6%. Why wouldn't we structure it accordingly that we could keep investing into the super, keep them, as like, people think I have to be debt free, and it's ideally you would be debt free on your mortgage especially, but at the end of the day, all your dollars are one bucket of money, and you just need the best return. So why would you pay off that 5 or 6% if you can get 8 or like
8 with it? Yeah.
It doesn't, and it's not always the case, because you're taking a tax. The mortgage is a tax free return and everything like that. But sometimes that's the idea. It's not just one or the other, and that's where you overlay the context. But that structure that we just went through is the blueprint to understanding, okay, what does it look like for me? You can change the numbers for you, and then figuring out how do we overlay on top of that to get the right outcome.
And if you didn't want to draw down on the capital, so you say, by 50, you need $1 million in net asset value, and then you draw down over that, plus you'd make some returns, which would get you to 65, and you'd essentially have almost none of that mil left, and then you'd roll into your super of 1.6 million, and that'd get you through to 100.
Yeah.
So if you didn't want to draw down on any of your capital, and you wanted to, maintain your capital, but just live off the dividends that you get from that capital, how much would you need?
About 20 times. So the rule of thumb is 20 times the number. So if you want 100, you need 2 mil.
Right.
If you want 140, you need 2.8. Right, that's the rule of thumb. Adds a buffer in there as well, but takes into account tax, takes into account a 5% yield, which is dividend stocks. Realistically, you can get you can get them in bonds now. You can get a term deposit of 5% at the moment. So 5% in a given market is we usually use a 20 times number on anything, if that's what you want to do.
Right.
Which obviously adds a large amount to the.
So you go from being 2 mil, you go from being $1 million to 2 mil essentially.
Yeah,
so you're doubling what you need.
Yeah, correct. But like I said, and then that's where, once you hit that target, once you get everyone tries to go for the cream. You said this on a podcast the other day, everyone's looking at the second, third property, right? It's like, why don't you figure that out first? Like, how can you get to that mil and 1.6, get there, set the foundation and go, well, that's better than 99% of people. I'm happy with that. And then build on that. Well, now I've got more capacity. I can do more. I can leverage. Okay, I've got serviceability. Well, that's ready. Now let's see how big we can go. Because even if it fails, you still got that there.
That's right. You can sleep easy at night.
100%. And you can also, one of the biggest problems with the risk versus reward ratio is people think risk is bad. But if you take no risk, you're 100% chance of not achieving your goals. That's the biggest risk. So the thing with risk is you do need a level of risk to achieve your goals. But most people take the bad stories, they take more risk than they can afford. As you build that foundation that you can sleep well at night, that actually gives you a better risk budget. You can now afford more risk because you've got a backup plan.
You got a buffer.
So now you can affordably go into the next level of risk and have more chance of it succeeding.
100%. And on the super piece, so a lot of people come to us now, especially when they're hitting serviceability limits, and like, oh, I want to buy a property inside of my super, because as you'd know, your serviceability inside of super is very different to your serviceability outside of super. What's your take on, let's say you're at that 35, 40 years old, and you're wanting to grow your super balance? Are you focused on growth up until when you get into retirement, or are you focused on cash flow?
No. The super is a growth asset. Like from basically till you hit 50, 55, you wouldn't even adjust risk profile. So you'd be taking, for most people, within comfortability, you'd want to take the highest level of risk, like that you're comfortable with and can service, up until that 50, 55. Then you can adjust from there. But that's a different conversation to leverage. So when people talk property and super, because that adds a whole new level of risk, but that risk only comes down, growth wise it's the same, but the risk only comes down to serviceability. People, if you got employment risk, if you're going to lose a job, we don't have secure income, and you lose that contribution factor, you've still got to contribute, or that's going to blow up. You know? So that's a different thing altogether when we talk about risk. You know, investment risk, growth style compared to, you keep that risk, but then we overlay that serviceability risk if you go down that strategy as well.
Right. Yeah, but if you're, let's say you've calculated your risk, are you going for a cash flow positive property inside of your super fund, or are you trying to grow your 400
So
grand
you're
you've
asking
got
the
in
wrong person for resi. So I guess keeping transparent, I hate residential for SMSF. I think you lose a lot of the tax benefits. Like one of the best things with resi is your tax benefits, and you're going to lose that in the super fund because it's a low tax environment. We really only do self-managed super funds with property for business owners who want to buy commercial and then rent off themselves. It's just cleaner strategy out there. Get that going and then build from there. Secondly, for people with huge amounts of money, like large amounts, and because then your ratio of cost for the SMSF is far greater than a retail fund, or people who want to do estate planning, so transition, have 6 members in the fund, use their kids and stuff like that. Other than that, we wouldn't. The only other strategy we look at with resi is often with older people who are running out of time to buy a home, maybe buying their future home inside inside the super fund, so they can either at preservation pull it out and live in it, or they can then sell it inside there, do what we call like a self-funded loan. So then they take the money comes to them as a loan, they then buy the property back, etc., and own the home from there. So I'm mostly because it's been done so poorly, so many off the plan regional Queensland
shitholes,
just rubbish. But I would still focus on growth. I would focus on just like you would outside of super, any asset. If you're growing, there's no point focusing on the cash, on the yield of it, because you want the growth asset, right? Like even though and I still wouldn't hold property in that super, even if it was a great yield, I still would want to sell it at retirement and have liquid funds for
sure.
in
Yeah,
that super
you
fund.
want to use because you can still get 60-70% leverage inside a super if you
70,
buy the
80.
right property, right? And then it just comes down to your servicing.
That's right.
But if you've got 300,000 of liquid in there, for example, and you put that into $1 million asset, a good asset, whether it's commercial, whether it's resi, and that mil turns to 2 and 3 and 4 over that next 30-year journey, you've essentially turned your
that's right.
200-300.
But I just wouldn't go like you can. Some people. My thing with cash flow, and I'm talking dividend stocks, everything is, unless you need that money from serviceability or from living lifestyle costs now, you're giving the taxman a piece of your return for no point. Why would you get a dividend, give the taxman some just to reinvest that dividend and lose part of your return? Like, it doesn't make a lot of sense. But in different environments it does, and in retirement we do have a bucket of dividend yields to top up the income bucket. But in any asset, if you're growing, if your plan is wealth accumulation, grow, stick to that. Stop trying to make cash that you can give the taxman for no reason.
Very true. With super, what is the cap that you can have in there now? Is there still no cap?
So 2 million per person at the moment to roll. There's no cap on how much you can have in there, other than the 3 million cap they're going to tax higher. But 2 million per person can roll over into pension phase, and that increases every couple of years. It was 1.8 a couple of years ago, but with inflation it goes up. So 2 million per person. So theoretically, 2 people could have 4 million in there, tax free, fully capital gains tax free, and they could generate easy 200 a year out of that tax free. Pretty good scenario.
And what do you pay in tax over that? So
over that.
Let's say you have.
So just roll back. You keep it in superannuation at
Yeah.
15%, and then depending on if they bring finalise the 3 million rule, then that would add another 15%. But
So you're in 30% tax.
so a lot of this way, SMSFs are great for people with lots of money. They can take the amount they need into pension phase, so 4 mil, for example, and then they can keep the rest in. So they could be with their kids, for example, and have another 10, 20 mil in there invested in joint assets, and let that at 15%, still a lower tax rate environment than anywhere else, and let that help their kids grow and top it up if they need to, or take it out because they're at preservation age, so they can pull it out.
And what happens if you go below that 4 million mark? If you keep drawing down on the money below 4, can you then bring some more in?
No. So it's a lifetime rollover cap. So whatever you roll in there tallies up, and over the whole life, it's that cap.
We need to do an episode on that's our next episode. I've just worked it out.
Yeah.
Superannuation. How to take advantage of your superannuation when you're 30 years old. You see? Mate, any closing words?
No,
Just get the coffee. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Frankie!
Hello.
We're back in the podcast studio.
Yes.
And, mate, as always, we'll start off with just saying how well dressed you are today.
Very well dressed today, yeah.
You are. You look like a
professional.
Yeah, well-respected young man.
Young man.
You do.
Jeez,
It's
very
nice,
good.
man. I like what
Must
you're
have had-
wearing.
The haircut must make me look a bit younger.
Did you get a haircut?
I did, yeah.
You look sharp. You've been to the dentist as well. Your teeth look
No,
straight.
I haven't been to the dentist.
Mate, now today,
What are we going to
I
talk about?
thought the topic of consideration, or the topic of
Discussion.
I should say, not consideration. We've already considered it, haven't we?
Yes.
Is very timely because, mate, where are you off to tomorrow?
Hawaii, mate.
Hawaii.
Yeah.
Aloha.
Yes, aloha. Just, a
And
bit of a
how
getaway.
How many holidays is that for the year now?
I think this is only my second.
Where else have you been?
The Maldives there for my
the
anniversary back in
Maldives.
March.
And then are you going somewhere else?
No, not really.
Where'd you go last year? You did a
Last year
holiday.
we did Cook Islands last year.
No, you also went
But
somewhere
that was
else.
a hangover from COVID.
And where else did you go? You went to Noosa? When was that?
I knew, so that was just a quick getaway.
Just a quick getaway. And Frank, the good thing about when you go on holidays as well is you still stay in hostels, right?
No, mate, no. I
Trying
keep working and trying to buy properties, mate, for our
Trying to
clients.
save
It always
dollars.
happens as I go away.
Yeah, Frankie actually has a reputation for he does absolutely fuck all when he's in the office, but when he goes on holidays, he always gets a deal or two away for a client.
Yeah,
so
we'll see what happens.
we
this
try
time.
and send him away as much as possible. But, mate, what we're going to talk about is when enough is enough, because obviously most people want to invest in property not because they love bricks and mortar and because they just want to invest for the sake of it. They're investing for a financial outcome,
Yes.
whatever that
Well,
may
you'd
be.
hope they've thought about it.
And we've spoken about this on past episodes, and we won't dive into the nuts and bolts of, reverse engineering your goals and all the rest of it. Yeah, so most people invest for an outcome, Frankie. And the interesting thing is, eventually, when you get, into your journey and building your portfolio, you need to come to a point where you say, enough is enough.
Yeah,
I
true.
bought enough.
Well, for most people, I'm pretty realistic. I never set out to invest in property. Well, when I first started when I was 19, it was just about getting the first property, like we've mentioned before. I never had a set goal of I want to have X $1 million worth of property or X number of properties or anything like that. It just sort of evolved as I went through life. Like I said, property investing was a side hustle, if you like, or a side investment for me. I had my career in accounting and finance that I was pursuing, and every time I was able to, and the bank
And by
would let me move
pursuing,
it.
you just meant showing up to the office every day, right?
You could say that. But every time I was able to borrow a bit more and was ready to invest again, I did.
But the interesting thing is now, and we're going to cover off this, and then also what you do when you've got enough, is you eventually got to a point where you thought, I don't need any more,
Well,
because up
yeah.
until recently, and when I say recently, when was the last purchase for you? 3 or 4 years ago?
I can't even remember. Maybe with last purchase.
2017, 2018? was
Yeah,
it?
something like that. Yeah.
Yeah.
So say 5 years.
5 or 6 years ago.
Yeah.
You bought that last property and then obviously felt like, I've got enough now, because you've still got capacity, you've still got serviceability.
Yeah, I've still got capacity.
You've got
for
more than enough equity to go and buy lots and lots of properties. You've got a lot, money sitting in offset. So you
servicing
can,
would be the issue now.
you can, obviously with interest rates, it'd be more challenging, but it'd still be a possible thing,
Oh,
a
yeah,
possible
yeah.
scenario. But you've come to the realization that I probably don't need any more. And if I went and bought more property and invested more, it'd just be for the sake of doing so.
Yeah, yeah.
And in reality, even though I do say you look like an 80-year-old dad, you're quite young. You're still in your 40s.
49,
believe
yeah.
it or not.
49, yeah. 50 next
Which is
year.
young, right? Most
Yeah,
people are
of course,
looking at, you ask them also, when do you want to retire? Oh, I'd love to be able to retire by 55 or 60.
Yeah, yeah.
And in their heads, when they're saying that to us, we know that they don't even believe they could do that themselves. There's that limiting belief of, can I actually retire early? And you've achieved that. You're at that point now where you don't need any more. So I'm curious to understand, when did you sort of think, or when did you come to the realization that, hey, I've got enough assets now. If I look at my net asset value in comparison, to my debt levels, if I sold down some properties, this is how much I'd have, which you've
Yeah.
obviously done those internal calcs yourself.
Yes, yes.
When did that happen? And when do you remember a dollar figure? And did you work out an income?
No real dollar figure. It was just about okay, got several properties now. They've been doing well. Net asset position is quite strong. Obviously, you take into account your age. So, both my wife and I have the same age. So we're both in our late 40s.
Yeah.
She's still working full time in corporate. Now I've transitioned out of corporate during COVID to, working with you, Jack, and doing the buyer's agent thing on let's call it a semi-retired / part-time.
When he says the buyer's agent thing, he means showing up to one meeting a week, doing a podcast.
Doing this, but that, and for me, that change was definitely a passion play for me.
Yeah.
It was not about.
But you had the confidence to do that, right?
Yeah.
Because for most people, I couldn't do that now. I couldn't just go, got the properties, I'm going to go to a passion play.
You're very young. You're still, in your
You've got to
mid to
service
late
the debt,
20s.
right? And I reckon if you, obviously with COVID and that the role that you were doing that was redundant and you said now it's time to go and do something else, but if that would have happened 5 years prior, would have you made the same decision?
Probably not. I suppose it was where I was in my career
that's right.
and things like that. Obviously the support of my wife as well, who, we knew we would take a hit on income, but we knew that from savings we had and rental income coming in and her income that we were able to do it.
Yeah.
So she was very supportive in me following my passion in, trying to help others. I've been investing for 30 years now and I've, made some mistakes, learned a lot of things as you would over a 30-year journey in property investing. So for me, it was about trying to help others, and to teach them, not to make the same mistakes I may have made during my property investing career. So,
And you made your first stint looking very sharp, I must say, on an oversized suit on the front cover of the Smarter Property Investment. What was it? No, Property Investor magazine or something?
Was it Your Property Investment magazine? Yeah,
that's right. That was your grandfather's suit, I think, wasn't it?
No, it was they were doing a special on how property investing has changed your life, and so me and a few other
on the
people
front cover.
on the cover, so that was pretty good, and an article inside. That was a few years ago now. Getting back to the point of,
but you got to that point and you had the confidence to do it, because if you didn't have the assets behind you, you wouldn't have had the confidence.
Yeah, of course. If you
just had the family home, for example, you would have went, probably have to go and get another real job.
Yeah, but I do still have to service the debt. Now I'm still in a fixed rate period, about to come off that mortgage cliff, as they call it, in May next year. But I'm comfortable in the financial buffer, as we say you should always have, that even when I come off that and we go to a variable rate of, even call it 6%, depending on what they do next week with interest rates, and between now and May next year, that will be able to still service that debt. And my wife is obviously still working. It was never about, and I'm pretty, my wife and I live a pretty, basic life, if you call it, in that we're not big spenders. We're not out there, spending $200,000 or $100,000 on cars and holidays and the like. So we've got no kids. So it's not about leaving a legacy where we have to leave these properties to anyone. At some stage, we're going to start, selling them down and spending the money and enjoying it.
What would you spend the money on? I'm interested to know.
I don't know, maybe I might fly premium economy or something.
Mate, have you ever, that'd be good to see up the front of the pointy end of the plane.
No. Well, my goal would be like to travel for 3 months, come home for 3 months, travel for 3 months, come home for 3 months.
Right.
And I say that in theory, but maybe, I've been on a 3-month holiday before. It's a damn long time.
Yeah.
And you're glad to be home. So even if it's not 3 months, if it's 3 weeks here, come home, 3 weeks there, come home, and things like that. It's just to have, like we've spoken about before,
options.
The freedom and the choice and the options to do what you want in those retirement years.
Yeah.
And not have to rely on the pension.
And what about a cash flow position? You're obviously, you're not silly with your numbers. I've seen the spreadsheets that you carry, and your spreadsheets for your portfolio is probably more than I track for my own business.
Probably.
You've obviously worked out the numbers. You know your net asset value. If you sold down, we just spoke about it, 2 properties, you pay the debt off the rest, you then have X amount of income.
Yeah.
Did you work out those numbers to think that?
I haven't worked them out.
You know what your missus earns now. You know what you used to earn. You know what your lifestyle expenses are down to the bloody cent.
Yeah, I haven't worked it out in any great detail because they're still changing. Like I said, when I come off fixed rates in May next year, obviously the interest expense on those properties, which are probably, positively geared at the moment, might fall back into a negatively geared position. So I've really got no hunger, I suppose, to buy more property. We could buy, my wife and I could put our super together and set up a self-managed super fund and easily fund a property or two in that. I sort of, because I'm so heavily invested in property at the moment, I sort of, like the thought of superannuation being a way of diversifying out of super and with shares.
Yeah, because you're quite heavy into property, right? So
very heavy.
Having some money in...
So having some money in super there, that's, the share market doing that.
But the funny thing is you can't even access that money for another 15 years.
Well, that's right, yeah. So that's sort of, there's that money coming down the track. By another 15 years, I would hope that my current portfolio has doubled
Again.
again.
Yeah, yeah.
And then I'm like, I'm not going to be able to spend that money, mate. You know, I don't have any high hopes of living till I'm freaking, if I
You
get
never
to,
know how much an
if I
F45
get to 80, I'll be lucky. You
if
know
an
what I mean?
F45 membership goes from $40 a week to 400,000, mate, you never know.
Oh,
You
mate,
could spend
F45's
it.
in trouble, mate. I don't know about that. So yeah, it's not about, you know, wanting $100 million worth of property, because it's like, well, what am I going to do with it? It's just my
When do you
wife and I.
think, have you discussed with your wife when you'll retire? Fully retire? She stops working?
Look, she's still happy doing what she's happy doing, although some nights she comes back and is a bit stressed, and I'm like, well, you don't have to be doing that. But I think, you know, I've heard her say, you know, she might go till she's 55, you know, but it's a year-to-year proposition. You know, I'm always sort of saying to her, well, you know, one thing you can't get back is time. So it's a matter of don't leave it too late. You know, you just
Never
don't know, mate,
Yeah,
when your number's up. So, you know, without sounding morbid, you know, you want to enjoy the latter years of your life, so to speak.
Well, mate.
So she's got that option to retire when she wants.
Yeah.
You know, I'm happy doing what I'm doing.
And when do you think you'll sell down?
I don't know. It's just assessing.
So you have
it
no
as
desire
time.
to sell down
while the
right now?
properties are still paying for themselves, so to speak. And this is why my next step is to really wait and see in May next year, when I go back to a variable rate, what each property looks like and how much negatively geared they are, and how much we're having to put in our pocket to fund that. You know, but at the moment, I looked at, when I did my tax last year, I looked at, you know, all the properties together, and literally each property cost me like $8 a week averaged out across them. And I was like, wow. And that's, you know, taking into account depreciation expense that you can claim and all of those. So I'm like, they are really costing me nothing to hold them. So why would I sell them? As soon as you sell a property, right, one, you lose the rental income. Second, you're going to lose the future capital growth. So if you can keep holding them for, and like, you know, you said, next year I'm 50. If I can hold them all for another 10 years till my wife and I are then 60, you know, what I'm forecasting out is, what does that portfolio look like then? Even if it doesn't double, even if it only goes up 50 to 60%, it's still going to be a pretty
significant
strong
amount of
position, right? You know, and then it's about, okay, maybe sell the house we're living in now and we can downsize to a unit, which I don't have to go out and buy, because I already got a couple of units in locations that we would,
Live.
you know, go and live in Sydney.
Funnily enough, you just bought another one for a client directly next door.
Yeah, so that's how good it is that we recommended for a client. You know, a nice waterfront unit in a good suburb. So, you know, I suppose it's just taking it year by year. No, you know, still, yes, keeping an eye on what that future looks like, but you know, the finances change, the interest rates are going to change.
You know, people who are listening, the number's going to be slightly different for everyone, right? Because it comes from income, lifestyle, aspirations, age, all the rest of it. But for you, you know, you were on good corporate incomes, you know, multiple six figures combined. There comes a point where you feel that sense of security.
Of course,
you go from being acquisition aggressive, we need to grow wealth because we haven't got it, to I feel comfortable.
And having the backing behind you, because of, you know, I started investing when I was very young, that I had the option there to go, you know what, stress levels are up here, time away from home and not being able to go on holidays because you're in a high paying, high stressful corporate job.
Yeah.
So you know what? Give up some of that money to get some of your lifestyle back. And, you know, we talk about work-life balance. I mean, that's it. And that's what property investing has given me, that option to, you know, to go, you know what, I'm in my late 40s. I've been, you know, working since I was 19 years old. So I've been doing the corporate thing for 30 years, climbing up that corporate ladder. That, you know what, now it's about,
Took the West Tigers to their first grand final.
no, I came after that. But, you know, giving back a bit of the money, going, you know what,
You're trading then the money for the time. You want the
money
time back,
for the
not
time and the less stress. That's got to be better for your health. You know, health. I've had my health issues. I've had an open heart surgery. You know, hence the reason why I've had a lot of X-rays, a lot of CT scans, a lot of things. Right. Hence, you know, if I get to 80, mate, I'm doing well. So, you know, I've got that in my back of the mind. You go through open heart surgery and then get a bone infection in your chest afterwards, as I did. I was meant to be in and out of hospital in 6 days. I spent 2 months in hospital, right? And, you know, I know a lot of people are in a lot worse health position than me. I'm very lucky. But
it brings things into perspective.
Very much into perspective. That, you know, your health is your number one priority. And, that's where you can't get back time. So
but if you now, let's hypothetically say wife stops working, zero income outside of the rental income of the property, which is about neutral anyway. So you've got zero income.
Yeah.
You've worked out the numbers. You know that if you sold down and got to zero.
Well, I'd have to sell down, I could easily forecast it with my spreadsheets, sell down, the 5-dock house. That'll knock off half the debt straight away.
Yeah.
Although hopefully there's a metro coming in 5-dock, so in close to 10 years time, so I don't want to really sell that once I look at how we can see how well that metro suburbs like Bella Vista and the like have gone. So I want to hold on to that 5-dock property, but let's forget about that. I could sell the 5-dock property, one house, and that would pay off half my debt straight away. So that's going to free up a lot of interest expense and free up a lot of cash. Just in that.
Doing that, and you probably have to sell on another property to get debt free.
Yeah, probably another. I could sell principal place of residence to get debt free. Wife doesn't want to do that at the moment because obviously it's a lifestyle thing. She likes living in the house and in the suburb we're living in. She's not ready to downsize yet. Obviously, selling down the principal place of residence. I say to her, it's CGT free, so that's good. If not, you sell down a couple of the other ones, pay the CGT, and stay in the house.
And you net, and have you worked out roughly what income you'd net? And we don't need.
No, I haven't. To be honest with you,
I'll work it out. It'd be roughly 300 grand a year.
No, I don't know if it would be.
It would be 6 million net assets at 5% to give you 300 a year.
Yeah, well, that's enough.
So
it's enough to buy those exit row seats, mate. I don't need to go to premium economy.
and with that amount of income, that because obviously people get to a point, and a lot of the time when we talk to people about passive income, they project more than what they're earning right now. You look at let's hypothetically say we speak to someone in their 30s, they go, they're earning 150 grand a year. How much passive income do you want? I'd love 500.
Yes.
So
when realistically they probably don't need that.
Well,
much,
the reality is it flips the other way. When you go to passive income, you're often earning less than what you were when you were working. But the idea is when you're working, you've got all these expenses, interest, you've got lifestyle expenses, etc. When you go to passive income, you should have no debt and very minimal expenses because you're now enjoying life more.
Yeah, and look, once you've paid off all that debt, and you don't have to worry about the first Tuesday of the month and interest rate decisions.
That's right. And then that pendulum for you switches as well, right? Because obviously income, as you and your wife were going through life, was going to acquiring assets. You're using cash as deposits plus equity to fund things. And then you'll flip. So you'll all of a sudden go from no debt, and then 100% of that income, let's say it is 300 grand a year, is lifestyle money.
Yeah. And if, let's say, we were to do that at 55 in another 5.5 years time, then like you said, we've got then super kicking in at what?
In 10 years time.
60, 65.
Yeah, early 60s.
So you've got the super sort of as a backup behind that.
Yeah. And we've had Ryan King sitting in your chair before, and that's a very big part of the strategies that he builds out for his clients is if we do retire early, let's say you do retire at 50.
Yeah.
From 50 to 60, it's all about using your money outside of super to get you to that stage. And then when you get to 60, it's about using the money inside of super because we're in that tax-free environment.
Yeah.
And you often need a much lower net asset value in there because
it's tax-free. Yeah.
That's right. 300 grand right now, you're going to be paying your normal individual tax rates.
Yeah.
So you're still going to be paying 120 of that in tax. You'll net 180 a year, which is about 3 grand, 3.5 grand a week. Whereas in super, to earn the same 180, you get half the amount of assets because you could get paid. To earn 180, you can have half the amount of assets because you can get paid 180 and net 180. There's no tax to pay.
Yeah.
So it's an interesting, I guess, paradigm. And you're holidaying a lot now. You enjoy your holidays. And security. I bet you weren't doing that when you were working in corporate.
No, well, when you're working in corporate, it's never a good time to go away. I have, my wife and I have travelled a fair bit.
You went to Vegas quite a few times, didn't you, Frank?
Usually,
you still banned from the Palazzo there?
I'm hoping to go to Vegas for my 50th. Well, the plan is, for my 50th next year.
The Henderson team will be there.
Oh, will they?
We'll hire
you guys will be too busy, mate.
The Henderson private jet, and we'll fly over there.
You might have to go over and source some a development site, mate, so you can build the Henderson.
Potentially the Henderson Casino. You reckon?
Mate, there's a suburb just out of Vegas called Henderson. Actually,
is there really?
Yeah, I'll go take a picture of the sign for you.
Please, mate. Please put it in your carry-on luggage on the way home if you can. But that's interesting. Now you've got the time back and you've got the financial security to know that if the worst case scenario ever happened, your missus lost a job, interest rates went up.
Just sell a property.
Yeah, that's right. You've got that in the back of the head, right? Where a lot of people don't have that. A lot of people is like, we're earning, we're spending, we're earning, we're spending. If shit hits the fan, what the fuck do we do? Mm-hmm. And now you've gotten to that stage. Because if you only had $1 million in equity, you wouldn't have that security. Because you go, oh, fuck, what do I do?
Yeah. And so, you know, the message out there to any, you know, young people listening is to, you know, like we've always said, the earlier you can invest in property, you're going to have more time on your side. And it's the age-old adage of time in the market, not trying to time the market. Get in as soon as you can. Try and get 20 to 30 years of runway ahead of you. And, you know, then when you get to your late 40s, early 50s, you'll have these options.
That's right. And you'll have that sense, peace of mind to know if I want to keep pushing hard, I'm doing it because I want to, not because I have to.
And believe me, it goes quick. Like, you know, I laugh because it literally, I'm 49 now and I literally still remember, can still picture walking in that first unit with my parents when I was 19 and buying that first investment property. And that was 30 years ago. And lucky enough, my mind is still there that I can remember that. But, you know, if I think back, 30 years is a long time. You know, you're not even 30 years old. A lot of people listening to this are not even 30 years old. So to them, I probably do seem old. But believe me, your life will go on. The properties will just be there doing what they do on the side. You have property managers managing them. It's not at all stressful at all in that regard.
On that piece, I'm just going to pull something up on my phone that I posted this morning on LinkedIn. And this is, I got a gift for my birthday this year off Perry, and it's a poster.
Oh, the poster, yes, that you got here in the office.
And it's a 90-year human life in weeks.
Yeah, that's a bit, I don't know if I'd want to do that.
Well, I think it's interesting. And the reason why I said it was interesting, just on this time piece, is that often we forget about time, especially when you're young. Shit just goes. You know, I remember I literally, just like you, I remember turning 18, having my first night at the brewery, you know, getting pissed with my brother.
I'm sure you were in there before you were 18, Jack.
I wasn't. I didn't drink until I was 18.
Oh, very good.
Yeah, I hated drinking. Anyway.
So explain to people
and then it's
what this chart is.
9 years on, and I bought my first property at 18, and next year it's 10 years I've been investing for. So anyway, the chart is a 90-year human life in weeks. And for every week that you're alive, you dot one of the boxes.
So it's a grid formation.
That's right. Yeah. It's just box. And there's 52 boxes per line, which is a year. Bang, bang. Yeah. So anyway, I got this for my 27th birthday, which was July 17.
Yeah.
Now, I've been dotting my little dots, and I actually forgot to do 2 or 3 weeks. So I went back yesterday and dotted 3 more dots. And then I looked at, as a percentage, how many weeks it now is of the year. And my birthday feels like yesterday. Yeah. It was only July. It's been 15 weeks since my birthday, which is 28%, let's say 30%, a third of the year.
Yes.
Gone. Like that.
Yeah.
And the realization that you have when you see those things is, have I actually done any fucking thing? Because it's so easy to do nothing.
Yeah.
You know, it's so easy to go,
well, time gets away from you. Life gets away from you because especially you're so entrenched in your business and growing your business and, you know, wanting that to be as successful as possible. I mean, what's scary about that chart is you can actually see, you know, the 90-year date. And I suppose
and the other thing I thought about yesterday is good chance I won't make it to 90. And
yeah, true.
And there will be a dot on here where I won't dot anymore because that'll be the end. And the interesting thing would be is, imagine if we knew whereabouts on the grid the dot stopped.
Oh, look, that would be terrible if you knew where it was, because
I don't think it'd be terrible. I think it'd be extremely motivating because would
it, or, you know,
well, right now this feels
would it be not motivating? Depends how close you were to the dot.
Well, it feels infinite at the moment.
Yeah.
Because we live life thinking that we will never die. Most people think that. Unless something dramatically changes, like you have a health scare.
I think the older you get, the more you realise it.
But I just think, imagine if I was going to die at 45, for example, and the dot stopped at 45. What the fuck would you do between 27 and 45?
Well, you'd probably be enjoying your life and not worrying about your business.
Well, you'd be doing everything you love. You'd be going, I haven't done that yet. I need to go do that.
I need to go to Disneyland, you know?
So it's
I don't know if it'll be a good thing. Anyway, luckily we don't know that, you know. When our number's up, and we hope it is at 90, you know.
I just find that so fascinating.
Yeah, it's quite interesting.
Anyway, Frankie, you're off to Hawaii.
I'm off to Hawaii, mate.
You're sitting in economy?
Sorry?
You're sitting in economy?
Yes, but I bought the extra exit row seats, mate.
And I feel sorry for you.
Pay the extra for the exit row seats. You have that option when you have some passive income.
Even when you've got plenty of money, you still sit at the back of the plane. And what about hotels?
Yeah, nice hotel.
Oceanfront. What are we talking? 5-star?
Yeah, 5-star.
5-star? Is this the first time?
No, mate.
Mate, it's good to see you.
5-star, but not extravagant, you know.
No. Mate, as always, pleasure.
Thank you,
How
mate.
long are you away for?
And 9-10 days.
9-10 days. If you're any clients watching this, Frank's always on board. He'll be here.
Jack will be looking after my clients while I'm gone, but I still will be. Hopefully buy property.
Thank you, Frankie.
Thanks, mate.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Frankie, it's good to be back.
Aloha.
Aloha. How was Hawaii?
Very good, mate.
Was
nice
it?
And sunny.
Well, sunny over there, is it?
Yeah, it's sunny, constant 30 degrees, mate, all year round.
Mate, how good. And
Okay,
did you
right.
get laid?
The flowers, you mean?
That's right, did lay.
No flowers.
You put the lay on you?
No.
Aloha?
I think that used to be in the old days when you used to actually fly into Waikiki and then have to get off the plane and walk across the tarmac.
Oh.
You know, you're probably too young for the Brady Bunch when the Brady Bunch went
Yeah,
there.
no, I wasn't around then. I wasn't around. What was your biggest highlight of the trip?
Mate, look, it was just nice and relaxing. Did a bit of...
I don't want a generalised answer. I want a specific...
highlight.
What was the highlight? If you think about... Ready?
Okay.
Just answer this question in 1 second. 3, 2, 1. What's the biggest memory from Hawaii? Just answer it.
Hiking up to Diamond Head Crater.
There we go.
Because I've been several times to Hawaii and always wanted to do it. And everybody said you should do it.
Yeah.
Never did it because
'cause
everyone used to say, well, this is the reason why you're like this, because everyone said because it gets so hot in Hawaii, by 10 a.m. it's like 30 degrees, right? And you don't want to be doing a hike in that temperature.
And you don't wake up until 10 usually.
High humidity. So everyone used to say you should go and do it at 6 and get it out of the way. I'm saying I'm not doing that, right? So this time my wife and I, we went at 4 p.m, right?
Because
So we
you're
did
not
it in the
early
afternoon.
riser.
Yeah, so we did it in the afternoon and just happened to be while we were there, nice afternoon breeze. So it was quite nice. Yeah. It was,
How long's the walk? A couple of 100 metres.
No, it's like the highest point in Waikiki there. It was probably got 30, 40 minutes, but it wasn't. For me, it was okay. I said to my wife, an F45 session was tougher than this.
Was it?
It's pretty...
And what, were you wearing those same sneakers you got on there?
No, not these ones, some other...
You had some hiking ones on.
No, just those white ones I have. It wasn't the best. Because there is a bit of a paved path, but then it just goes rocky, and then there's some straight stairs straight up.
Are you wearing that polo?
No. I bought this.
Is
over
that
there.
new?
It's a new one, mate.
Wow. What brand's that?
Mate, little Tommy Hilfiger.
You spent, how much was that?
No, not much. We went to
Discount.
the outlets, mate. Anyway.
And what about those shorts?
No,
They're hand-me-downs from your grandfather, aren't they?
You should talk, mate.
Mate, it's good to be here. It's good to welcome you back,
yes,
Frankie.
it
How
was a
much
good
money
break.
did you just spend on your trip?
Oh, too much, mate, too much.
How much are we talking?
I don't know. The dollar's not strong, mate. It's
the
only
people,
64
the people
cents.
want to hear the real facts. They want to know, when you're a property mogul like Frank Raiti, how much can you spend on a holiday?
Mate, well, as they say, you can't get the time back, but I can always come back and make more money.
That's right.
You can always make more money. So people have that holiday. I mean, don't put it on a credit card and then not have the capacity to pay off the credit card. But, you got to take time out.
Mate, you've got to take time out.
Well, how many holidays have you been on this year?
Says the man who works 3 days a week.
3 hours a day. Not 3 days, but every day. How many holidays have you been on this year?
I've been to Necker Island.
Oh, yeah. But that was, you're always working.
I'm going on the Bull Rush Rally next week.
Oh, okay.
That's work, though.
But I mean a holiday with your wife or with your girlfriend.
None.
Oh, mate, you got to look after her, mate.
Mate, what the fuck? How can I go on a holiday when you work 3 hours a day? I'd go back. I'd come
I'll
back.
cover for you, mate. I'll cover for you.
And I'll be bankrupt, and then no one will have a job.
Harry and I will cover for you. Don't worry.
Oh, that'd be good. I could imagine. He'd just be saying, "Let's have a coffee."
There'll be plenty of coffees had.
Now we got to get into some real shit, Frankie.
All
We're
right.
going to talk some serious
Talk
stuff
some
today.
property, mate.
Mate, absolutely. Now, Frankie, we had an interesting conversation. We've had a few conversations like this recently. Interest rates have increased.
Again, yes. The good old Melbourne
But it's
Cup.
not just, we're not just going to talk about the 0.25%. We're going to talk about, clients we purchased for last year, the year before, they're on 2%. Everyone talks to us, Frankie, and they say they're long-term thinkers, don't they? I can hold for 10 years.
Well, one of the questions, we were just talking about this, one of the questions we always ask investors, are you willing to hold this property for a minimum 10 years?
That's right.
And they say yes.
That's
Until
right.
then,
Until
they don't. So they get a bit nervous.
That's right. And I just finished a podcast with Chris Gray, who you and I both know.
Yes.
And mate, it was interesting because I was, similar to you. He's not far off 90.
He's a little bit older than me, so he...
And I said to him, you've been investing now since he was 22. He's 52 now, 30 years. And I said you would have gone through lots of these times. And he's also an investor who has the tendency to stretch himself, not do things within the parameters.
He's probably
of
never
normal.
even sold a property.
He sold a few here and there, but none of his like core holdings.
Yeah.
And I said, interest rates have risen and fallen. You've had credit crunches. You've had times when business has been good or not so good. And I said, how did you get through those times? And we discussed that everyone, and Mike Tyson says, everyone has a plan until they get punched in the mouth, It's
Punch
just,
in the face, yes, love that.
but it's the
Love
same
that
in
quote.
property, Everyone says, yeah, absolutely, I can do that, until times become a little bit tougher than what they were used to. And all of a sudden it's reactive decisions. And as we know, reactive decisions usually don't end in good decisions.
Yes,
Because
well, Chris's mindset is that he's a contrarian, so he's conditioned his mind to do the opposite to everyone. So he probably told you probably know this, but he bought, circa half his current portfolio, in the GFC, while everyone was saying do not touch property. Everyone thought the arse was going to fall out of the market. People were talking it was going to fall 30, 40, 50%, and he just went, no competition to buy, I'll just start snapping all these up and hold them for the long term. Because like everything, it will all pass eventually.
That's right. But it's interesting because now, we've got clients, we've got friends and family, we've got lots of people who have, wants to build this large portfolio. No one actually thinks long term. They think, 10 years, 12 months down the track, times become a little bit tougher, cash flow becomes a little bit tighter, you're paying more out to cash flow your properties. I don't care if you bought in the middle of, the outback or you're buying in blue chip. No property right now is positively cash flowed if you're buying recently, because you're paying 6.5%. You'd have to have a gross yield of 8 or 9% to be able to make it net neutral. And now there's that thing where it's like, it's costing me this amount of money. Do I really want to give up my lifestyle in the short term to be able to hold these properties long term? Maybe I should sell down. And Frankie, you would have been through this, right? You've been through 30 years of investing. So it's interesting. Let's unpack how you continue to push through these uncertain times, because most people don't have that grit, that determination, and that belief that this is just a part of the cycle, and in 5 years' time I'm going to be laughing at what I'm worrying at right now.
Well, I just had that mindset of it's a long-term hold, minimum 10 years before I even start looking at how it's performed. I mean, that's not completely true, because maybe after 3 to 5 years you want to look at what equity you've created to go again, especially when you're in that building phase. But I just, I knew that, the stats were there that people do well and create wealth out of long-term holding. And, by long-term, we're talking a minimum 10 years, if not 15, 20 to 25 plus, or, never selling at all. So as long as I could afford to make the repayments every month, and that's really all it comes down to. Can you afford to make the repayments every month? Hence the reason we advocate on interest only, because the repayments themselves are lower than what a P&I repayment is. Now, the interest rate might be a little bit higher, but it's all about that direct debit every month, what comes out. So as long as I could afford that, and look, if things got a bit tight, I just made sure I didn't go out as much, or, I saved.
Used to hit the clubs a little bit, Frankie?
Saved money. It's
You
one of
and
those
Joel
things
together.
you manage.
Drum and bass.
Because I saw it as a forced saving as well. I knew that I had to have money in my bank account for those direct debit loans to come out. That was first and foremost. I lived at home for a long time. I didn't buy a car for a long time.
You still live at home now, don't you?
No, I don't still live at home. I've got some mates who still do. But yeah, didn't go out and splurge on fancy cars as soon as I could. Stayed at home till I got married, basically, which was at, my first marriage at 28.
45.
Now people are staying, that's the norm. My kids will stay at home, or young people like yourself will say, I'm staying at home till I'm 30.
Hey, mate, come on.
Well, you're out and about.
That's a bit of ageism, isn't it? Us young folk.
Young folk. Well, you call me old, so you must be young. But yeah, it was just, the money had to be there.
Yeah.
If I had to work overtime or whatever, so be it.
And that's the thing, right? This is the prime example why most people don't achieve their financial goals. Because as soon as there is a little shake, there's some bad media, now it's hitting the back pocket, it's like, oh shit, what's happened for the last 100 years is about to stop, and we're about to go into a spiral, and I can't, but I just wish people could, transport themselves 20 years into the future and see what property prices are going to be.
Yeah.
And it's also very interesting, not just about investing, because again, we start off with the right intentions, things become a little bit harder, we stop. Same as fitness, right? People go, I want to lose weight. New Year's resolutions are coming up, 31st of December. Let me tell you, people are losing weight. People are getting out of the relationship. People are starting a new job. come March, everyone will go, fuck that, that's too hard. But the interesting thing is everyone goes into these things with good intentions. And as soon as it becomes a little bit harder than what they anticipated, all of a sudden it goes out the window.
Yeah.
And Charlie Munger, I spoke about this in the podcast today also. Charlie Munger, one of the founders of Berkshire Hathaway with Warren Buffett, greatest investors of all time. I don't know them personally, so I can't speak from personal experience, but if you listen to what they say...
They are old.
And watch what they do, they say they have a knack for understanding business,
Yes.
but the reality is their philosophy is find really good businesses that have a moat around them, meaning that they're going to be very hard to disrupt, and make sure that you're buying them at a good price and you hold them for a fucking long time.
And they keep reinvesting in those same companies. They don't spread them to
That's right. They take bigger stakes in the company.
They don't go out and buy 50 to 60, shares in 50 to 60 companies. They've got a handful of core businesses that 100%. They believe in. Like I think, Warren Buffett's held Coca-Cola for donkey's years.
And his philosophy around Coca-Cola is great, right? Even though we're going a little bit off track, it's like, well, do I think that Pepsi or do I think any other cola brand will take over Coca-Cola? Or do I believe that if Coca-Cola put their prices up 10% per bottle, and let's say they sell 20 million bottles a day globally, what is the profit? They're very calculated.
He believes that Coca-Cola will and always be number one.
That's right. Like we believe blue chip property
industry
will always be the best.
Yeah. So
I find it very hard to believe that Mike Cannon-Brookes will go and live in Perth one day. Probably won't happen. But Charlie Munger, what I fucking was meant to say on that before we went off that, is he says that you don't make money in the buy, you don't make money in the sell, you make money in the wait.
Of course.
But the wait is where most people, that's what they can't do, right?
Well, it's, it's like anything. Waiting, it gets boring, right? And people want everything today. And what makes it worse now than when, over my past 30 years of investing is, I didn't have social media to be telling me every day on my algorithm. I look on a property story now, there's another 2 that will pop up in the next 5 minutes. I didn't have that. And, as well as I do, that when the media gets negative, that can be very negative. And so, people are now just getting fed negative news.
That feedback loop.
Yeah.
You get negative news and you get young busty women as well, don't you?
Let's keep it on track. So that negative news is just making, your mindset even worse and worse, that it's telling you sell, get out, the world's going to come to an end, property's going to crash. So I didn't have that. So, I was going along my business, living life, in my career in accounting and finance. The property was on the side just doing its thing. I really didn't give it too much.
You weren't getting that active negative loop.
Yeah, occasionally, you'd go through, a taxi driver will talk about it, or you go to the family barbecue and people talk about it, once every few years when the boom came. Happy days, but it's just people just need to be patient,
and that's the really big learning, because we're seeing it now in real time. Clients that hold really, really good quality assets, and now they're becoming a little bit more expensive to hold. Maybe they do have to sacrifice a little bit of their lifestyle, but it's like they're not willing to do that because we're not guaranteed this outcome. So what happens if it keeps going and going and interest rates keep going to 15%?
And one of the things I have read, right, is that with every cycle, the cycles do repeat themselves, and property long term continues to increase. But every time there's a cycle, there's someone out there who says, "Oh yes, but this time it's going to be different." And you know what? It's not different. And so when people start saying, "Oh, it's going to be different," it's not going to grow by as much, or it's going to crash. People fall with that, they panic, they sell, or they don't even buy at all, which is even worse. Now, if you've been only holding for 3 to 4 years or even less, and now you're going to sell because you feel like you've got a market valuation on the property and it's gone down a little bit, that's fine. It's only on paper. It's like buying a share at $20 and then, in a month's time that share's down to 18. You sell, you're going to crystallize the loss.
That's right.
If you don't, it'll come back. And
that's right.
Actually, Warren
with
Buffett,
the right property, it'll come back.
Yeah. Now, Warren Buffett says a funny thing. He goes, people panic too much when they buy shares. He says they buy a share at $20. It drops down to $16. And then they do hold it. And they go, oh, you know what? If it ever gets back up to $20, I'll sell. So they buy at 20. If they don't sell it at 16, they'll wait till it gets back to 20 and go, I've recovered my money. And then they sell when they've just held it and made nothing. So the opportunity cost is just gone.
It's huge. And just on that piece, let's get out your phone, Frankie, and let's run through the Bondi. This is a perfect example.
Bondi, yes. So, Bondi Beach units.
Here we go. Let's do Bondi Apartments.
Okay,
now,
so this
if
is capital growth.
Capital growth.
Over the last year, the units in Bondi Beach are down 4.1%, right? So you'd be losing, right? 5 years, if you've bought one 5 years ago, you would have made 18%, all right? So not that much either. But if you'd bought one 10 years ago, you're up 101%. So you've doubled your money, 10% per annum. But look at that difference. Only 5 years ago, you know, you haven't made much, 18%. But if you bought 10 years ago, you've made 101%. If you bought 20 years ago, you've made 176%, nearly double again. So,
That's right.
You know, the longer you hold, the more capital growth you're making.
That's right. And it's a long-term average, right? And then if we look at the 20-year combined trajectory of that, you're up 176 divided by 20 years. What's that roughly work out to be? We're about 8 or 9% per year.
Yeah.
Not bad.
Yeah, that's right. Now, you know, if you've been holding for
I like that
for only 5 years.
That is a nice little finger piece there, Frankie.
If you've only been holding for 5 years and go, geez, you know, my property's only gone up 20%, I'll sell out because that's not a great average annual growth rate, right? What this is showing, it's the next 5 years. It's from holding from years 5 to 10 that, you know, historically, over the last 10 years anyway, has gone from 18% up to 100%. So you would have foregone 80% capital growth.
That's right. And that the thing with any growth in any asset class is it's lumpy, right?
Yeah.
It's not like we can time it perfectly and get in and get out. Like,
You know, and I jokingly always say about Sydney. Sydney does nothing for 3 to 4 years,
Yeah.
and by nothing I mean 2 to 3%. Does nothing for 6 to 7 years, I should say, and then doubles in 3 to 4 years. And that's how lumpy sort of Sydney is. So it just ticks along for those 6 to 7 years, and then boom, in 3 to 4 years it will double. Now, if you've sold out at year 5 or 6 or 7 because you're going, it's only been doing 3 or 4%. Boom, you sell out, the boom then hits, and 3 to 4 years, another 3 to 4 years, you would have doubled your money. And
Yeah.
this is why we always say about holding at least 10 years, because historically, you know, in good blue chip locations, holding for 10 years, you will get a boom period somewhere in that 10-year period.
of course. And you probably make the majority of your money in that little boom
Yeah,
period.
in that 3 to 4 year period, yeah.
And another thing that we spoke about, Chris and I, on the podcast was around, you know, people who try and time the market, right? So we look at COVID, coming into COVID, which is the most recent boom that we've had in the marketplace. And, you know, we spoke about not a lot of people wanted to do anything because they thought, the market's too frothy. We don't want to get in now because we're you know, reaching the peak. But what they also didn't do without getting into the market is they also then didn't go refinance and pull out the equity when money was cheap and banks were very easy to deal with because they wanted to lend out credit because they were stimulating the economy. Now all of a sudden, better time to buy, much harder time to lend. So now they can't get their money.
Yeah.
So another thing about, you know, being long term, and Chris said a great thing around, when you become an investor that has, you know, a larger portfolio, it's more of a business than a passion.
Yeah.
You know, because that it's really what it is. You're always thinking about, okay, can I get money from the banks now or not? If I can, even if I don't want to buy, it's best to have that equity sitting in my offset account than sitting on a bank's balance sheet.
Yes.
So you want to pull that out, you want to put it there, then, you know, times might get a bit tougher, like right now. And this, you know, we've got clients that have got millions of dollars worth of equity in properties that's just sitting there. 2 years ago, they could have released 500 grand of that, just sat it in offset. You've now got cash for a rainy day.
Yeah.
But they didn't because they weren't thinking like that. Now they need the money, for example, that'd help them cash flow. Like imagine if they could just cash flow the deficit, the negative gearing, with equity from the portfolio. So it's not having an impact on their personal position whatsoever. You wouldn't even think about it.
Yeah.
Because you don't notice it.
I remember, it's probably over 5 years ago now, when banks were holding too much of the book in regards to investor property loans, and ASIC put up that buffer that they put on the banks. APRA, not ASIC. Geez, what did they put it? An extra 3, 4, 5%?
Yeah,
was it?
it was like 2 to 3% on top of
and investor lending just literally ceased overnight.
Yeah.
Right, until they could rebalance their books and have a greater proportion in owner occupiers. So when people like APRA and the RBA gets involved with messing with interest rates and buffer rates, it does make it more difficult to borrow. So
it's the biggest thing.
And I said at the time, I remember talking to people at the time, this 3% buffer they'll scrap it. They'll end up scrapping it because, like always, they go too hard, right? Everything will the brakes will come on screeching. Investors will stop borrowing and then buying. That has a flow-on effect to the market, and then they go, oh, okay, well, we've achieved that with a sledgehammer, like they're doing with interest rates at the moment. We'll drop that 3% buffer, bring it back down to 2%, 1.5%, and then investors jump back in.
It's very true. It's cyclical. Like what they're doing right now is a planned approach. It's not like, hey, let's just keep increasing rates. They're increasing rates to pull liquidity out of the marketplace, to make the world a little bit harder. And eventually they'll go, oh, fuck, we've gone a bit far here. Let's stimulate the economy. Let's lower rates. Let's make credit easier to come by. But this is the perfect time to learn. You know, this is Ray Dalio. I've spoken about this book a million times. He wrote a book called Principles, where he studies hundreds and hundreds of years of history. Yeah. Before we were even pegged to $1, we were pegged to gold. Before we were done to go, all the different global, heads of financial markets, where you look back a very, very long period of time in Amsterdam now, where everyone goes to get stoned. That used to be the financial capital of the world, Amsterdam. But I don't remember that. I wasn't around. Lots of people wouldn't remember it. But that's a really good book to understand history. And even when we aren't pegged to the dollar and we're pegged to something else, it's the same shit. It's just repeating itself time and time and time again. He talks about long-term and short-term debt cycles. For anyone who's interested in this stuff, you should read it. But right now is a good time to learn. Yeah. If you went through COVID, you made a lot of money, and now you're kicking yourself because you didn't do something right, if you let that happen again, that is called you being an idiot because you didn't learn, right? Like if you learn something and then you don't implement it, and it happens again, what do they say? Doing the same thing over and over again and hoping for a different outcome is... the
definition of insanity.
That's right. I said an idiot, insanity, same thing. So for us now, Frank, if you look back, if you're in this position now, you're going, fuck, cash flow is a bit tight or tighter than it was. It's not going to be like that forever. No. We're almost at the end of the interest rate cycle.
Like I said, if you can afford to keep making your repayments every month, that's all. That should be your 100%. Main aim at the moment.
And I've said it, most people have a car loan. They've got a nice car. They go on a nice holiday. If you've got to scrap that shit for 2 years, you've got to scrap that shit for 2 years.
You'll be rewarded in the long term, I can tell you that.
Exactly. But you think about it now, that when you get through this period and times become easy, don't then go out there and go, oh, it's back, I'm a millionaire again.
Capitalize. You need to then capitalize on those easier times. And they will get easier again. Lending will become easier in due course. And
that's when you want to cash up. You want to have liquidity sitting there so you don't stress in tough times. You don't want to dry your liquid up. And I'm a prime example of that. I had millions and millions of dollars worth of equity sitting in an offset account, and I thought, fucking let's go. And I leveraged up. Fortunately for myself, I'm in a position where I can control my own income, not on a fixed income. If I need every time I get 0.25%, I need to work a little bit harder to pay those bills. So I'm fortunate. But if you're on a fixed income, this is a good period now to learn. When you come out of it, make sure you've got cash sitting there, 2, 3, 4 years worth of cash flow for your mortgages and other expenses. And when the next time we go into a winter, as Tony Robbins calls it, you're going to be happy as Larry, right?
Yeah. And the other thing too with the banks, and I'm harping on, making those repayments every month. If you are having trouble, the best thing to do is to tell the bank, right? Because they will look after you in the respect that the bank doesn't want to sell you up. So if you need to put your repayments on hold for 3 or 4 or 5 months, and people did this during COVID, they will do it. They will capitalize the interest. So it'll cost you a little bit more in the long term. But you say, look, I'm changing jobs, or I've just lost my job. I'm going to need 3 months to get back on my feet. Tell the bank, they'll put your repayments on hold for 3 months, and you can take that pressure off
yourself. Like a hardship program.
Yeah, it's just, it's like a repayment plan sort of thing. They will do that for you. The other thing to do is simply ask them for a rate reduction. The best way to get a rate reduction is to ask them, and, not to threaten, but to say, hey, I'm on 6.5%. I rang ANZ, they can do 6.35. What can you do? And it's easier for banks to retain business than try and generate new business. So more than often than not, and I've done this myself, where I've been with, say NAB for several years. And then I said, you know what? I think my rate's a bit high compared to what I see out there in the market. And they said, don't worry, Frank, we'll look after you.
Don't worry, Frank.
And they've reduced my rate just like that by a phone call.
There we go. That's a really good one. If it's a takeaway for everyone, I'm going to do that.
I'm
going to get on the phone, Frankie, tomorrow, and I'm going to call all the banks and say, listen here, folks.
And you can do a TikTok on it.
Jack Henderson is my name, and you motherfuckers are taking too much cash out of my pocket. Can we bring those down a bit?
But then everyone who talks about, my interest rates have just gone up 0.25% on Melbourne car. Well, they might give you 0.3% off.
It's true.
And there
Very
goes
true.
that, you've just had an interest rate decrease.
Very true. If you're listening to this right
You
now,
don't ask, you don't get.
that's right. And I bet you most people won't implement that.
No,
I'm
it's-
going to do it.
Again, it's about taking action, because most people, I'm with that bank, I don't want to swap. Well, you don't have to swap. Just tell them, look, I'm seeing better rates out there in the market. It's like for like.
Hey Siri, please remind me tomorrow
Pause.
at 8 a.m. to call banks and reduce my interest rates.
Well, you got a broker. They should do that for you.
There you go, Frankie. I'm going to actually implement that. That's my
Yeah.
takeaway from this. Everyone
I
should
mean,
do
whatever,
it.
even if they knock off, 0.1% or 0.15.
Well, let me tell you,
help.
point-
Better money in your pocket than theirs.
0.1 of about 25 mils.
Yeah, it's going to be a lot for you.
25 grand, not bad.
I'm still on fixed rates, so
Oh, it's tough out there. That's why you can afford to buy Tommy Hilfiger.
yeah. Tom Panos was going off last week about inflation and saying it's all the rich who are at restaurants and overseas at the moment causing inflation.
Says-
and all the battlers are getting stuck with it. Anyway, I sent him a message. I said, regards from Hawaii, Tom. But I said it's not just the so-called older generation, the so-called rich, as he calls them. I said there's plenty of young people living at home who have never purchased, so they're debt-free, not being impacted by interest rates, living at home, still going out to restaurants, still buying the Gucci bloody shoes and tops and handbags and the like. So
You wear a lot of that stuff.
they're impacting inflation as well. But, I think inflation affects everyone, whether it's directly or indirectly. But,
What it's called is fucking the world.
it's called the economy, which
That's
is,
right.
the world
I'd
economy.
much rather be dealing with inflation than dealing with what's happening in most parts of the world right now with wars.
Oh,
And
of course, yes.
first world problems, eh? Oh, shit, my fuel has gone up where I can get in my car and drive to work and then go
Oh,
home
catch the
and
bus. I mean,
sit in
people
my
say-
air-conditioned home and then...
People talk about petrol as well. Well, if you catch public transport, there is always an option.
It's true.
Victim
Victim mentality is easier, Frank.
Less Uber Eats, less eating out, going to the supermarkets.
I reckon, Frankie, I've got a
cooking at
proposal
home.
for you. I reckon we do... It's a new Henderson service offering,
Yeah.
and it's called Be Like Frank. So what we
Mate,
do is...
give me your money and I'll go to grocery
is
stores.
clients, I was going to say, clients come on board
Come back with the
and
bargains,
we
mate.
do a money management for them.
And Sultana brand's on special, mate. I'm loading up.
We're talking about live like Frank, and then if you wanted to go really tight, we talk like live like Nick Feltrin.
Oh, God.
I've never met two men in my life who live on so little. What do you reckon? I reckon it's a good
Oh,
initiative.
mate, if people want some
And
help, I'm
the
happy
way
to
that
talk to
the
them.
way that we'll charge our fee is whatever we save you, we take 20% of the upside. That's a good model. Whatever we save you,
Yeah, so it costs them
20%.
nothing, yeah.
That's right.
All right.
And then we'll invest that.
Ring in.
04502. All right, Frankie, mate. I've got to go and actually make some money so I can
All
keep
right.
the lights on because
Good to-
inflation's hectic.
Good to be back from Hawaii.
Mate, aloha, and I'm glad you got laid.
Thanks,
Thank
mate.
you.
Bye.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Frankie, we're
Hello.
back, mate. Have a go of this.
Back for 2024.
Back for 2024,
Right.
mate. I've had a lot of calls and texts asking if you're still alive.
Yeah, mate. I'm
I
still
said, is
alive.
Frankie still alive? It's his 80th birthday, isn't it? I said, Frankie's still around.
I'm like,
Mate, it's
mate, big year. I'm turning 50 this year.
50.
Oh, in your eyes, that's 80.
How good's that? Turning 50, looks 80.
Yeah.
Hey, mate,
Yeah,
Lang
big year.
Walker.
Well, Lang Walker passed away. It's quite
Sad,
sad.
isn't it?
Yeah, 78 years old.
78.
There you
Did
go.
a lot for the Australian property market, that's for sure.
He did. He did a lot for property, a lot for, was very philanthropic, as they
That's
say.
right.
Gave away a lot of money to charities, which is good. But yeah.
50 years. Tick it off. And, mate, I like your shirt. Is that a new one?
No, it's not a new one. I've worn it before.
You got the Vespa and you've got the
Vespa.
Italian flag just running
it.
through the centre of it.
That's it, mate. Well, the Italian won the Australian Open, mate, so I thought I'd fly the flag,
He lives in Monaco, that bloke, doesn't
Yeah,
he?
he lives in Monaco, tax-free haven, mate.
Yeah, of course. I'm surprised you haven't got a joint there, do you?
I'm surprised you don't.
Frankie, it's 2024. 2023's been and gone. What was the first thing we spoke about back in 2023? Here we go.
Probably interest rates.
Flamingo. Oh, yeah. Frankie loved his interest rates.
I was also thinking, they think back to 2020, 2022, 2021. can you even remember what the big issues that were? Probably typical housing affordability, interest rates. But, like we always say, those things are gone into the past now. They're soon forgotten.
Mate.
And especially when you're investing long term, those micro things just don't really matter in the long term.
Essentially, our first episode was in May, and it was about you don't become a flamingo by following everyone else, which is very, very true. But mate, obviously there was a lot of doom and gloom chat last year. Market, the RSN's going to fall out, interest rates are going to increase, the mortgage cliff. Remember the mortgage cliff,
yes.
the impeding mortgage cliff?
I read something about that mortgage cliff yesterday. Somebody posted something online, said, what happened to it? I said, just another typical scare hypotheses never eventuated.
Everyone's going broke, the cliff's coming, wait, make sure you wait for the mortgage cliff and you'll be able to get a bargain.
And what did the Australian property end up doing
8%.
last year? 8%, exactly.
8% on a mill's 80 grand. I'll take it.
I'll take 8% every year.
I'll take it off the ground. Well, mate, it's interesting, and this the topic of discussion today are going to be the 2024 predictions again, right? Because every year there's more predictions. There's more experts out there thinking they know what's going to happen. And if I've learned anything from the most successful investors in the world, both property and I guess other sectors, is that the people who are predicting things usually are the ones that know very, very little, because no one can actually predict what's going to happen in the future.
No.
And they usually have a vested interest in doing so. So they make predictions because their business is based off making predictions.
Well, I was going to say, for a lot of them, that's their job. Journalists need to, when they start making predictions, they need to put something in the paper. They talk to economists. Economists' job in general is forecasting and reforecasting and reforecasting.
That's right.
They've got the freedom to do that, I suppose, as economists. But basically that is their job. But yeah, it's going to be an interesting year. Now we're talking about interest rate reductions.
That's right.
Decreases. When is that going to happen, and what's that going to do to consumer sentiment and in particular property investors and property buyers in general? What will they then do? Will they pull the trigger?
Well, Frank, you were already starting to see it. I mean, the inflation numbers again are down, the lowest level in 2 years.
2 years, just announced today.
Which is great. Awesome news. Obviously, that means that people are spending less. They're probably a little bit more strapped for cash because interest rates have come up, which means the interest rate increases are doing what they're meant to. And the thing that I find is very funny is all the people that slandered, the RBA. Philip Lowe and all the, what are you doing? You don't understand, blah, 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 blah. All these experts that, wouldn't know left from right. When the reality is, and I really, really believe this, they have to put on a front for the Australian public, the national public, the international public, to make it as simple as they possibly can. So when they come out and talk to people on their, RBA meeting minutes and all that, they make it seem as simple as they possibly can. Of course,
because they can't start speaking, economic talk and talking about the price elasticity of supply and demand and things like that, not everybody knows about it unless you've studied economics.
Exactly. I honestly believe that these people know what they are doing. They have more data, they have more access to things, they have more control over everything than everyone seems to believe.
Yeah, for sure. And
they knew what they were doing. They obviously knew that the faster we can get rates up, the more that we can shock people, the more that we can scare people, the faster we're going to be able to get this thing under control. And the quicker we can go back to business as normal.
And look, they might have got the timing, the RBA I'm talking about, might have got the timing wrong, but that's easy to say in hindsight.
Well, I don't think they did. Because the market grew by 8%. No one, I mean, I don't know anyone who's gone bankrupt. I don't know if you do.
No, but some people said, they started cutting rates too late. They could have done it earlier. Well, would have, could have, should have. It is what it is. Well, they did it based on the best of knowledge that they knew at the time. And here we are. We were coming out of, again, a very, very uncertain economic time being COVID, which everyone was very focused on health, making sure the world was going to go back to normal. And then they focused, okay, well, now we've got to get this manufactured inflation under control, which they've done. Big four banks now, your Westpac, ANZ, CBA and NAB have all come out and said, we're predicting rates to drop. They've all got different months. I think they range from August to October. And they're all predicting them to drop to different levels as well. That's right. They're all in the fours. Yeah. So, but the consensus is, at least amongst the big four, that rates will start to decrease. And what that's now doing, which you can already start to see, we're recording this on the 31st of January, so it's the end of month one. We've had 3 or 4 weeks out there in the marketplace. We're doing opens, we're buying property, we're missing out on property. We're obviously seeing the inquiry come through our business. And I know in comparison to January last year, there's a very different feel in the marketplace. There's more optimism, there's more activity, there's more buyers out there.
And people now, because the outlook for the next 12 months is more optimistic than it was last year,
Yeah,
as
well-
opposed to last year being very pessimistic.
Of course, last year they were talking about, how many interest rate increases are we going to have? Now there's talk about how many interest rate decreases are we going to have and when will they start? Now, only yesterday I read, read a lot of people, follow their stuff, and there's talk, one economist has come out and said he's predicting first interest rate cut in March. At the RBA meeting in March, which they now don't meet on the first Tuesday of every month. I think it's now every 6 weeks, something like that. So he's predicting, based on retail figures that came out yesterday that were quite low, and obviously now backed up by the inflation figures today, low again at 2-year low, like you mentioned, that he's calling for a rate cut in March. Others, I think the head of ANZ has said June. Others are not talking till the September quarter. So it'll be very interesting as to when that first one happens.
But no one's talking rises. That's the positive.
Definitely, that's the thing, that the cash rate has now hit its peak. And, now I'm not convinced that we're going to see, a knee-jerk reaction and a cut straight away. A lot of people are saying, well, it's just the first cut will just get rid of that November cut, which some people are saying we shouldn't have had in the first place. But I can't see them going with a flurry of cuts. Maybe one cut, sit for 3, 4, 5, even possibly 6 months to just see what the impact of that is. But I certainly don't see the rates dropping very quickly. Not in this next 6 months anyway. That's just my opinion, to be honest.
And to be honest, mate, I actually don't personally care what rates do. The really good thing now is the optimism which is in the marketplace.
Yes, exactly.
And optimism in the media headlines are the things that drive consumer sentiment and drive consumer behaviour. And the more confident people are, the more they're doing things, the better the marketplace is going to be. But I think one thing people can't forget, and it's maybe a time of self-reflection on this, is, last year everyone was making decisions again based on very short-term metrics. What is happening over the next 1 month, 2 months, 3 months, 6, 9, 12 months? Right now, same thing. We're going to see a lot of people get back into the marketplace now due to confidence, due to things happening, due to people. I can't wait until the first FOMO headline comes out. Property market predicted to grow by 15% over the next, and as soon as we start to see things like that, all of the people, that the herd, that the masses are going to jump back into the marketplace. But the thing people cannot forget is when we are investing in property, we are investing not for 1 year, not for 2 years, not for 5 years. We're investing for 10, 15, 20. You've been investing for 30 years.
Yeah.
And we're going to get market fluctuations during that time. We're going to have positive. We're going to have negative. We're going to have positive. We're going to have negative. We're going to have normal. And if you're holding property during a 10, 20, 30 year time, you're going to have lots of different marketplaces, lots of different headlines.
Lots of different interest rates.
That's right. And the reason you're holding it is because you believe that over the long term, property will be more expensive than it is right now. And it's going to make you more money than it's going to cost you. That's the belief. Otherwise, you wouldn't do it, right?
Exactly right. Like I always say, you're not buying, if you're basing your decision whether to start investing in property based on the current interest rate environment or what that is, it's irrelevant. Your interest rates are going to change over the next 10, 15, 20, 30 years. Look, it probably could help that in your borrowing capacity. So, if interest rates do come down, if there's even a 0.25% cut, which you would imagine the banks would pass on in full, otherwise they'd be caned by the public after what we've just been through with all the increases, that could increase
it's about $25,000 for every $1 million.
Well, there you go. So, an extra $25,000 could be the difference between, affording, a good unit or a good house in a decent suburb or not. So I can understand people going, well, all the talk is about an interest rate cut. I need to wait, or I want to wait for that first cut to happen before I go and see my broker and get official borrowing capacity. Other than that, in regards to long-term property investing fundamentals, it's irrelevant.
Exactly right. And something we'll notice is people who are getting into the marketplace, as the things like that start to happen, like you said, interest rates do start to decrease and prices start to move. What we know from history is that when prices move, they move very quickly.
Yes.
Prices can literally move 5, 10, 15% within 2, 3, 4 months.
For sure.
Now, this is not reported in the media. You're not seeing 15% increases in the media.
No.
And you're not seeing it reported in CoreLogic data. But we see it on the ground. We see a property that you could have bought for $1 million last year selling for 1.1, 1.2 just simply due to the competition.
Yeah.
And the median doesn't move that much, but it's the individual property values that literally overnight change. I mean, we've missed out, I think, on 8 or 9 properties so far this month. And the reason we've missed out on it is because we've come into the new year using the same negotiation tactics as we did at the end of last year, which was we have more control than the vendor. We know there's not as many buyers in the marketplace as there was, so we can take a little bit longer. We can start lower in our negotiation, and we can make it a longer negotiation. And we've been beaten on properties. And the first time it happened, we thought, just a little bit of a, maybe buy the right buyer for the right property. We weren't going to pay it. Second time, third time, fourth time. And all of a sudden we got to the end of the month and we looked and we've missed out on all these properties.
Yeah, so the market's moving. That's a sign the market's moving, right?
There's so much competition on properties. And I showed a client, we bought a property for a client last year, 4 doors up from a house that just sold, identical, same land size, unrenovated, 3 better. We paid $720 for this client's property off market. One just sold for $830.
Wow.
It's a 15% change.
In how long did you say?
But it wouldn't have sold for that last year.
No.
But it's just like automatically bang. And we went up to high 7s on it and another buyer bought it. But that's the thing you need to remember is when you're in the market, you feel those gains straight away.
Yeah.
And when you're in the market, if you are an investor in the market right now and you're starting to see the market move, this is a really good time then to start getting your properties revalued. You want to take advantage of that equity uplift as soon as properties sell and they settle, get a reval done, and feel the effects of that. And we'll start to see, I think, more and more lenders become more competitive now. The marketplace will get more competitive with lending, and you'll start to see your cash backs. You'll start to see
your offers.
The borrowing. Yeah, that's right.
Yeah.
Your borrowing capacity will loosen up a little bit. They'll start to open up the credit lines because they'll want to get the economy moving again.
Yeah.
But just remember that, the longer you wait to get into the marketplace, the more you're going to be chasing it. And we saw it in 21, 2021.
2021.
The market started moving. The sentiment was strong. Every Saturday and Sunday paper and then, the 9 News was reporting on, this property sold for 600,000 over 400, you know what I mean? And all of a sudden you're chasing yourself.
So the interesting thing about that, Jack, is, you're saying that, buyers are already out there. It's January, renewed motivation, if you like. So what happens when we do have this first interest rate cut, which, it's coming this year, in what month it happens, we don't know. But then you're going to see that herd mentality, right? And you'll see the newspapers and the media really change the tune in regards to, interest rates have dropped, your borrowing capacity has increased, get out there and now's the time to buy. Because, as much as everyone says they don't do it, everyone likes to or wants to try and time, their entry into the market and things like that. So if there's already buyers out there now, and competition is quite fierce at the moment, what's going to happen as soon as that first interest rate cut and the herd mentality hits and everybody jumps in? I think it's going to be too late then. I think you need to be getting in now. And, everyone's going to say, you're just saying that because you're buyer's agents, it's always a good time to buy. But no, look, we know an interest rate cut is coming, right?
Yeah,
that's a given. It's going to be, nothing's 100% certain, but it's as close to 99% as you can probably get. People will start jumping in then, and then the confidence will really lift and, people will be reading the media like they shouldn't, but they will. So, it's about, yes, competition may be fierce now, but it's still less than what it's going to be once that first interest rate cut. God help us if there's followed up by a second one, then we could be off to the races, as they say.
It's very, very, very true. Mate, let's do a bit of reflecting on your portfolio last year. You were fortunate to lock in rates. You didn't even feel any of these increases.
Well, I haven't yet. I locked in rates for 3 years, fixed. I wish I'd done 5 years now because I did have the option at a slightly higher rate, but I thought, 3 years is a long time, and it has been. They don't expire till, I think it's late May, to be honest, so I've got a couple more months to go, but obviously in that time, and this is why the financial cliff, let's get back to that mortgage cliff, hasn't happened, because during that time, I've been saving tens of thousands of dollars of interest that I've just been parking away and saving. When things change like that, whenever I got a pay increase in, when I was working in my career as an accountant, my lifestyle didn't change. I didn't go and upgrade my car. I didn't start, going out more and eating at fancier restaurants because of that. And I think that's, on a side note there, if as your salary and your income increases, every time, the rents went up, my lifestyle didn't change. So lifestyle spending stayed here, income kept on going like this, then I'm creating a financial buffer for myself. So over the past, 2.5 to 3 years, I've been creating a massive financial buffer. Even to the fact that not only have I saved in interest because the variable shot up, but I've been, now that rates have gotten to a decent amount, I'm now parking that cash and earning interest, in a high interest yielding deposit account, because obviously with fixed rates, I lost the offset account. Now when I come out, I'll go to 6%, whatever it is. That money I've saved will go not only towards making those repayments, but sitting back in various offset accounts against the loans that I have. So you
haven't really felt a great deal of change.
No.
Did you think about selling anything last year? Did you think about buying anything last year?
I'm always thinking about buying something, as you know. But like I've said before, I'm sort of at a stage in my life, my wife and I, we really don't need to. We've got no kids, we've got no one to leave it to. So, buying's not really...
What about the Henderson Foundation?
The agenda, the Henderson
You know
Foundation.
what I mean? Look at Joel. Joel's over there. He's thinking, like, what about me? Just a young kid trying to get by.
That's it.
Young immigrant from New Zealand.
I think it's, look, and I track my properties, quite regularly. I saw where they peaked in, I think it was May, not last year, the year before. And
22.
And I saw the dip. I think they dropped about 8%. I'm talking my portfolio in general. So not the 20 to 30% as people were talking about. And now, my portfolio value has now surpassed what it was at that peak of.
And what's it sitting at now?
May, somewhere between 14.5 to 15.
Not bad, eh? Not $14.5 to $15 or
Yeah.
million,
not billion. So look, it's come back, and that's the thing. Nobody likes to see their portfolio value sliding, but I've been through this before. Like I said, 30 years. I know it can't keep on going up forever, and in reality, you don't want to, because if something is booming and booming and booming and booming, then a crash is imminent. You have your couple of years of boom in a good 10-year period, comes back a little bit, and then off we go again. Ride the next wave up and the next cycle.
So it sounds like you haven't really felt it in your portfolio at all, and the marketplace is in a better position now than when you peaked back in May 22 by the sounds of it.
Yeah, I think it was May 22.
And sitting over that value now.
Yeah, it's come back.
You've had growth.
In basically May 22, probably just over 12 months, it bottomed and come back.
And I know from my own portfolio, I've been getting all my properties revalued in the last couple of months to then go out, do a refinance and see what else we can get into. Every single val I've had done has had really strong growth. So there's 2 apartments that I've got in a block in Bar Beach. I paid $660 for the first one back in 2018, 2019, and then I paid $710 for the other one 2 years ago. So back in 22, I had both of those. So they're on top of one another. I just had those revalued by Bank West about 2 weeks ago, and they both come back at 1.2 million.
Wow.
So the last valuations that I had were $1 million each on them. So I've refinanced up to 80%. So 800 grand. That was back in 22, 23. 12 months on, I've just had them revalued again, and there's another 400 grand there, which I'm going to pull out. Same thing with another property. So I'm seeing it in my own portfolio, and then all of the properties we're getting valued for clients too, because every 6 months we get our clients' properties revalued, and I think everyone should do that. Little hack: desktop valuations now with most of the lenders for properties under $2 million are very, very generous. So if you have properties, I would urge you first, instead of going the full val option, get a desktop valuation. Even if your property is renovated, still get the desktop valuation, because desktop vals are being very generous.
Yeah.
And
because historically they are very conservative.
But they're not.
Yeah.
What I'm saying
but
at the
are the
moment,
borrowers, are the lenders, the lenders, I should say, are the lenders lending against desktop vals?
absolutely they are.
Yeah. Okay.
Yeah. Desktop, it's a full desktop val.
Yeah, yeah.
And they're lending.
But some of them, they used to say, well, if we're going to lend you up to 80%, we want to go through
Well, usually if you go above 80%, you can come into issues. But if you're going to 80%, which is what most people will lend at, the desktop vals are doing well. And I'm seeing full valuations. We test both. We get full valuations through properties, and we get desktop vals done.
Yeah.
The full valuations are extremely conservative, like extremely conservative. And that's because you've got the human element, right?
I was about to say, you've got the human element in there.
You've got the human element. You know, the valuers are obviously out there in the marketplace. They feel like the marketplace is, a little bit uneasy, so they don't want to put their neck on the line to, give it a strong valuation. Yeah. But, I'm seeing a little hack for people: go desktop vals instead of full vals.
Yeah.
And you'll probably get a really strong valuation. And I do that every 6 months. Just keep going, bang, bang, bang. It doesn't cost anything. Go to your broker, get a val done, see if there's equity there. And then if rates start to come down, what you're also then going to see is obviously values will increase, but then your serviceability will start to increase. So all those people who, watch this video and go, oh, well, or listen to the podcast and go, oh, what about my servicing? Equity's good, but how do I service it? You're now going to start to see your serviceability increase. Every 0.5% you get down on $1 million is 50 grand of servicing.
Well, and let's not forget, we've now got tax cuts. Everybody's getting a tax cut from 1 July.
Not everyone, Frankie. Not everyone else. Bloody high income earners, mate, getting slogged.
Well, I took it off the high income earners and give a bit more to everyone else. But those who are PAYG employees, a little bit of tax cut there. That's got to help with serviceability as well. And so look, getting back to my fixed rates expiring, I'm obviously going to go to variable. I obviously want to go for another 5 years of interest only. So I'll have to go through the serviceability test too. But yeah, I'm going to get all my portfolio revalued and, take everything up to 80% and just pull out that cash, that equity, whatever I can, and just sit that in my offset accounts. And, when an opportunity arises, if I do want to purchase...
Well, you're going to Vegas for your 50th, aren't you?
Yeah, I'm not going to pull out the equity.
I reckon pull it out, Frankie. Straight down to the roulette table and then just go...
Black. Are you a red or a black man, mate?
Mate, I am... Depends how many schooners I've had.
50% chance.
That's right. Well, if you put...
You're doing it in US dollars, though, in Vegas. The US dollars...
Mate, you never know, Frankie. We could have an episode. When is your 50th?
In April, mate.
Mate, we could have an episode come May. Frankie's lost it all, or now he's a...
Oh, well, he's just live stream me in from Vegas. That'll be a good one.
So I think, Frankie, that the nuts and bolts of it are, don't listen to the predictions. We know they don't work. Very rarely do they come to fruition exactly what someone says.
Yeah. So
just invest based on market fundamentals, not predictions. You can look at as much history as you want, and they're all going to prove to you that predictions very rarely come to fruition, both as good and as bad as people predict. You want to, if you are thinking about buying, don't wait for things to happen. You want to get into the marketplace. So in the first growth cycle that you're going to get from a property, you feel the full, 100% of that growth cycle, as opposed to, the marketplace moving 10 or 15%, then you're getting in.
Usually once you've heard it in the media or seen it in the data,
too late. When you hear Frankie and I talking about it on the Flamingo Investing podcast,
they're already good. They're already jumped, and you missed the first 20% of growth. So yeah,
Frankie, you've been doing this for 30 years now. Like you said, your portfolio peaked May 22, it come down in 23, and then you're looking at the numbers now, and you're above your peak of 22. So again, not short term. Make sure you think long term. And another thing I wanted to cover off is just on where we're seeing opportunities coming into the end of last year, even in this year. Like the opportunity in buying unrenovated properties and adding value to them, I believe, is just still so good, because people still have this mentality that it's hard to build, it's very expensive, supply chain issues, blah, 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 blah. So a lot of these properties are not selling for as well as they could sell.
Right.
If they were renovated, and we're seeing the renovated properties selling extremely good.
And you don't have to do the renovation straight away as well.
You come to Henderson and Endeavour Build, mate. We sort it out for you.
But, mate, as long as it's rentable, get a tenant in there, get some cash flow coming in. Do the reno in 2 to 3 years if that's what you want to do. Well, I just want to run
people through. So what we did, we bought a property for a client last year in April, settled in June, July, had tenants in there until August-ish. Tenants moved out. We paid $725 for this property. Bang, did a reno, 200 grand we spent on the reno, fully renovated with this 3-bedroom house, deck off the rear, looks beautiful now. Pre-reno, it was renting for $450 to $500 a week. Post-reno, just rented last week as well. This is real numbers, rented for $710.
Yeah.
So we took a reno. Let's hypothetically say it was, not hypothetically, let's say a midpoint of, I think it was $450 to $500 was a number, but let's say it's $475. We took it to $710. So we essentially added $250 a week to the rental income on a $200,000 renovation, which is what's $250 a week times 52 is about $12,500. So we increased the yield by 20-30%.
Yeah. And
the valuation come back at a mil 40. So we added the 200,000 that we spent plus then another $150,000 worth of value to the property. And then the client can fully depreciate the renovation as well, because they did it themselves. So they've got the value uplift, they've got the rental increase, they've got the depreciation and the tax benefits.
And the rental increase helps with obviously their serviceability then when they go see their broker when they're ready to again.
Absolutely.
Yeah, I just, my house, one of the houses in Brisbane, just did a coat of paint inside and out, a little bit of electrical work in regards to, modernising light fittings, etc. An extra $35 a week rent.
Not bad,
there you go. And would have improved the value as well.
Crazy. So there's still a lot of opportunity in that. We're really going heavy into that niche, both in Newcastle, in Brisbane, Geelong, In Sydney's inner west, there's a lot of opportunity, I believe, for properties to renovate. So that's us, mate. I've got to jump into 1 o'clock.
All right. See you next week.
As always, make sure your socks are on before your shoes. And Franco, this is the best outfit you've worn in a while.
The shorts, mate. You like the shorts?
I like the shorts.
All
Thanks,
right.
Frankie.
Cheers.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Ladies and gentlemen, we are back. Flamingo Property Investing. Sitting next to me for the first time in 2024 is the Three King himself. And he's got it on his leg, actually, if you want to look. What's on the third leg? That just says Little King.
Chastity belt.
That just says Little King. Mate, welcome back to the potty.
Thanks, bud. It's been a while.
Mate, it's been a little while. Let's dive straight in. So today we're talking all things superannuation, not just property related, but superannuation in general.
Yeah.
The must knows, maybe some things that are common misconceptions. I know there is a lot of common misconceptions out there. I also know that a lot of people don't start thinking about superannuation until they start going, fuck, it's not very long until I get to 60. So we're going to talk around maybe why it's something you should consider a little bit earlier in your life. The tax advantages of making contributions into your superannuation.
Yeah.
And everything in between.
Yeah, 100%. I think this is a really good topic. We've touched on it in a few of our other ones. We said we always will. And it is the most misconceived thing ever. And I read it, the Facebook pages where they're like, people give advice, properties pages and that. I stay off them, but someone shared the other day. And someone was like, superannuation's a scam, just buy a property. And it's like, this is one of the biggest misconceptions. Like, superannuation isn't an investment. It's a tax vehicle. That's all it is. You don't sit there and say, trusts are a scam. Like, it's about where you purchase them for purpose. And that's what most people don't get. And it frustrates the fuck out of me because, like, you're missing everyone. If you're going to be retired at 40, you still want to be retired at 60. So why wouldn't you have the money from them be more tax effective than not? And that's really what we'll get into today. But I think the important part is that you need to understand it first. And the first thing that exactly what I just said, it's not an investment. It's a tax vehicle that you can hold investments in. If you want to sit your money in super inside a bank account, you can. The superannuation isn't risky. There's a level of risk in your investment.
Let's talk through that actually, because that is something. And even when you're saying it right now, everyone looks at superannuation as an investment. They're like, you're investing into super, but no one knows behind the word super where that money goes. So what you're saying is superannuation is really just a holding vehicle, just like a trust would be, or a company would be, or your personal name would be.
Superannuation is a trust. That's all it is. It's a trust that has a trustee that manages it with the government's implication that we will give you a better tax rate for holding it in here for longer, so that we are less likely to have to pay a pension at 67 and a half. That's all it is, right? And people think, but this one gets me too. Rest did better than this. No, Rest isn't the investment. Rest is the trustee of the super fund, which is a trust, and they're choosing investments inside. Usually they just mandate someone else's investment. But to say Rest performed better than that, no, they didn't. Their investment did. Before you look at switching a super fund because of which one's performing better, look at the investments inside that super fund first. And you need to take control of that, of the investment. Like I said, you can open a super fund and sit it in cash. That's not the thing behind it. It's simply a trust structure that has a tax benefit, that has a trustee behind it, that manages it. That's it.
Let's talk about the tax.
You wearing a tux?
Advantages and disadvantages of superannuation. So let's use a person or a avatar. There we go, an avatar.
A blue guy, tall blue one.
Let's use an avatar so we can make it more realistic. Let's talk about someone who's 40 years old and they're in a job, they're earning 120 grand a year, and they're just paying their minimum contributions of which their employer pays. Run us through what that structure would look like as normal, and then whether you make more contributions, less contributions, what's concessional, what's non-concessional.
Yeah, I think we'll take a step back from that first.
All right, let's go one step back.
Ease up, bro. Ease up. Whoa, boy. No, ease up. We'll go back and let's. identify some characteristics of superannuation first and then put the case study in, right?
All right.
Because
we'll put the avatar in there, the blue guy.
you just we'll slot him in. But just like property, not all super is the same, right? And you can't just target at one. So the first thing to understand is what's the rules around it. Well, the rules are that you get a good tax rate, which we'll talk about in a minute, because you're holding it in there until you're 60. Right, there was 55. Some defined benefits out there are still 55, but till 60. At 60, and this is the part people don't get, what do you do with it? You can take it out. It's tax free, that's fine. Or you keep it invested. People forget that you're only 60. You still got a long time of life, theoretically. You keep it invested, you get it, you create income out of it, you let it grow, and you live on it as your income, and now replaces your salary tax free. The benefit of super is where else legally can you get tax-free income in today's dollars up to $300,000 a year. You can if you max out the caps today, you could get about $300,000 a year in income between two people, tax-free, and keep it growing.
Which would be like having $550,000 of income taxed.
Correct, right? And so when people say, "Oh, I don't like super," tell me where you can do that. Show me another strategy you can do that, and we'll do it. You can't, right? Like you just simply can't. So that's the benefit of it. But what are the rules behind it? Well, you can't touch it other than, the conditions of release, right? Which is you're dead, you can never work again, or you reach preservation age, which is age 60, right? So people confuse preservation age with retirement age. Retirement age is what the government will give you, 67 and a half. If you're watching this podcast, you shouldn't even be thinking about that age.
Mate, I've got some old punters who just get on here and love the boys.
Let's go. Yeah, the boys. So that, if we're trying to invest, the age pension, the threshold to get the age pension is so low, unless you're going to be selling drugs, do cashies, or you've started late, it's not really something you should even be considering. Right?
And what is roughly the age pension at the moment?
We're talking, what is it? It's a really good question. I don't deal in this space, but I think it's roughly 35,000 for a couple and 25,000 or something like that for a single.
Unreal. 22. So you go out for dinner probably once a week.
Yeah.
Live in Bondi.
And this is the thing. People hit retirement and they think, yeah, I'll just pay my mortgage off. It'll be sweet. Yeah, you'll be eats, bro. What are you going to do? You got food to pay. You still got to pay your rates. You still got to pay your insurances. You still got to put petrol in the car. And guess what? You got more time to spend your money. You think it's cheaper? No way. And you get the ABS come out and they're like, here's the comfortable income you need to retire. And it's like 52,000. Statistics show that the average retiree, just to survive with bills and everything, because like you might pay off your mortgage, but that's really the only expense that goes, right? Your kids are mortgage out. That's all we do. So the average retiree needs $1,000 a week to pay their bills. So when they're saying comfortable, they're like, the ABS is saying comfortable as in you can survive. Fucking mad. We look at all of our clients really, for a couple, like a household, you need 80 to 120 tax, like after tax, 80 to 120 grand. And the thing is, you can do that in super with, 1.3 to 2 mil. It's not a big ask, considering investing over that whole time. So we've got to understand that's the benefits behind it. And then we talk about the tax thing, right? So with the tax, it's when you're working, we call that accumulation phase. When you're working, it's taxed at 15%. So all contributions pre-tax and all earnings. Now, with assets, slightly different to the personal name. After you hold them for 12 months in super, you get a 2/3 discount, or a 1/3 discount. So you only pay 2/3, where you get 50% CGT discount in your own name. You only get 2/3. So it works out you pay about 10% on capital gains throughout while you're working. Again, find me another structure that you can grow your money at 15%. Right? If somebody's sitting there and they're taking 200 grand a year, they're paying 45%, right? Paying 45%. So you get 30 cents in the dollar better off
by putting the money into superannuation.
Putting in there. And then factoring capital gains and growth, fuck me dead. Like, yeah, it's not there till 60, but again, we say to our clients, you should be using superannuation as your backup strategy, as in from 60, it's what takes care of you. That way you only need to gap from the age you want to retire before that to then. And then it kicks in. And the other part is bankruptcy protected. So good estate planning benefits as well. So the only risk to super on that front is legislation risk. But what don't we face legislation risk with?
That's right. I mean, you look at property and it's always negative gearing and we're going to change this. There's going to be planning laws. And
well, let's look at this year. We were talking about this before. Proposed tax changes. The proposed tax changes have been looking mad for 3 years. Last minute, boom, now they're not so mad. Still good, sort of, but like that's legislative risk, right? And that happens in super. But why would the government want to affect their ability to not have to pay Centrelink anymore, like to pay the age pension. So there's two sides to it. They do make a lot of money on super. Like there's a lot, especially industry funds, there's a lot of dodge going around there. It is a money maker for big corporations, but it still has a benefit to the government to make sure it's working well, you know?
And just on the tax, so you said that you're only paying 15 cents on the dollar. Can you put as much as you want inside a super, or are there limits to what you can put in super?
That's the downside. So we've got two types of ways to get money into super. We got pre-tax and post-tax. Pre-tax called concessional contributions because you get a concession, right? Now their limits are $27,500 a year per person.
And what's your minimum contribution your employer has to make? It's 11%?
There's no minimum, but the minimum the employer has to make is 11.5, goes up to 12 next year, I'm pretty sure. But then you have your after-tax contributions, which is another great way. People say, why would I do that if I don't get tax deduction? Because once it's in there, it's still tax effective, right? And down the track, when we go through estate planning, there is benefits to putting that money in there like that. But it means you pay the tax on the money, you put it in there. So you don't get the tax deduction on the way in, but once it's in there, it's still getting that tax treatment.
And just on that, let's hypothetically say you didn't use earned income, but you know you sell a property, for example, you cash out an owner-occupier property, you've got a big lump sum there, of which has been taxed for anyway. Can you put that sort of money into your non-concessional contribution?
You can put any money into there, but the caps rule. So the non-concessionals are 4 times the amount that the concessional is. So each year you can put 20. At the moment, it's supposed to be indexed at $2,500 rates with CPI. 27,500 in there, get the tax deduction, and then you can put 110,000 in there after tax. You can also, if you've got a balance under 500,000, you can also use the what's it called, the non-concessional catch-up rule, which means you can put in 3 years worth. So you can put 330,000 in 1 year, but then you can't use that cap for 3 more years. So this is a really good strategy as people get closer towards the end, or you might say you've just done what you've said. You might put in 110 in June, and then in July you put 330 in there. You got 440 grand in there, like that. The growth on that's phenomenal over the next 3 years anyway. But then we've got things like this is where the game really changes. We've got things like your downsizer contributions, right? So, you know, people who've been in their house for longer than 10 years, they're over a certain age, they can sell it. And we usually do this way at the back end. They sell it. You can do this a couple of times. If you had 2 houses that you wanted to sell and over that period, but you can put up to $600,000 in. No, it doesn't hit your caps or anything. So that's a big one. You get someone who's downsizing a $2 million property and they're going into an apartment or retired living or something, and they got couple's got 1.2. Boom, we'll chuck it in there, top that straight up. There's an income, right? And then there's also the strategy around that, which we consider with some people who might be on the edge. If you can do that, get that money in super and generate an income while growing, there's also the consideration of whether you keep your mortgage on the next place. Because at the end of the day, as long as you can pay that mortgage and still be comfortable, it's whatever the dollar stretches to the best stretch of that dollar. But the big one for people in the accumulation phase that is phenomenal that we use all the time is the carry forward rule. So since 2018, they brought in any unused concessional cap. So let's say your employer put in $10,000. So you've got 17,500 unused. Prior to 2018, they don't want too bad, so sad, it's gone. From 2018, they had the 5-year carry forward rule, which meant that for the 5 years tracing back 2018, you could use any of that unused cap in that financial year. And now we can do that still, but it's 5 years, so we're at 2024, 2019 is the last year, right? So if somebody's got that and you got $80,000 or $60,000 in catch-ups, what happens is that comes off your taxable income that year. So if you're earning, let's just use a random, I'm just saying you're earning 100K and you've got a lump sum, you sold a property or whatever, and you've got capital gains tax, all that stuff. You can dump, if you've got whatever let's say your cap is 80 grand or even 60 grand, you can dump that in. Your taxable income is now only 20 or 40 grand. That's good for capital gains, isn't it? It's fantastic, right? Now in that year, you might not pay any tax. So you dump in the 60 to 80, you get 20 or 30 back. So you just put in your 80 grand or 60 grand and you only spent 40.
Because you get a tax refund.
Get a tax refund, right?
Yeah.
So stuff like that's really, really good coming in. And so all these strategies, and people say, yeah, but it's so far away. I get that. And the way we sort of strategize around super is very simply, it should be your priority. Get it on track so that no matter what else happens, from 60 you're good. Then you can take a little bit more risk in everything outside of that because you know you're good. Rather than wait till later and oh, we're close now, we'll do it. Time's your enemy against superannuation, or it's your friend, depending on how you use it, right? So we get it on track, and then what that means is we go, cool, that's the number we need, And at the end of every financial year, we reassess the situation in May and say, oh, we've got a little bit of money left over. Is there anything else we can do with it that makes sense? No? Well, let's chuck it in super. Why not? If it's not doing anything, let's get a bit of money back from the tax man, top that up. Right? And then as you know, super, you pay down the debt, you're investing. When all your money's allocated in a stretch, if there's money left over, the priority should be back. Then we recircle the chart. All right, well, let's go back to the priority one. Super, let's top that up. Right? And then if we've maxed that out and there's money left over, oh, now we might put that more on the debt or whatever, like have that prioritization. It's not super or this, but you should use it as part of that strategy. And for business owners especially, like, fuck me dead.
Let's run through that. For business owners, what's the positives?
Man, this is really spiraling. We're getting like...
Let's get deep.
But let's, again, wool up. Wool boy. Let's take a step back.
Get in here, you bastard.
I'll whip you. All right? When we're ready, we'll whip.
Now run us through business owners. So,
all right, well, first we've got to understand the types of super, right? We've got your industry funds.
Industry funds. That's like Australian super.
From little things, they'll scare me out of your money. I'll get sued for this. And then the other one is your retail, which is essentially what most advisors provide. Okay. And then you have, we got, there's another one called small APRA funds, which is sort of separate. You don't really use those.
Yeah.
And then we've got self-managed super fund. And you hear, like, come on, people, you're smarter than this, right? People come out there all the time and be like, use a self-managed super fund, do it yourself. How the fuck do you know what you're doing? Like, you think you're going to do better than someone who gets paid $100,000 a year to manage that? Like, it's a real common misconception. We love self-managed super funds. They're great, but they do have issues. Like, what you're paying for in an industry fund or a retail fund, the fees you get charged is because the trustee is that super fund. So when we use Australian Super or Australian Retirement Trust, Australian Retirement Trust, my favourite industry fund, by the way, for anyone out there. But when we are using those guys, what we're paying for is two types of fees. Fee number one is for the investments, because your fund has to pay, like you would directly pay for an investment, so you pay for your investments. And two, you're paying a fee, an admin fee, for the trustee to make sure your fund is compliant and regulatory, right? So there's no mistakes, because people don't realize that in super, it's such a regulated, and we're going to keep it simple today, but like it's a complex beast. You get into the tax and untaxed elements, and then all the compliance around it. It's wild. And if your super fund's not compliant, there's jail time, there's big fees, and the worst too is they can take a penalty, which can be a large amount of your fund. But the worst one is that if your fund's not compliant, it will automatically get taxed at the highest marginal tax rate. So you just lose all the benefits of super and your money's still locked up. So when you're a self-managed super fund, you're the trustee. And you can have the best accountant, the best financial advisor, but you're liable, not them. You're the trustee. They don't get the penalties, you do. And so when you end up doing the numbers on how much you need in super to then pay the right people and have it looked after, there's a certain number that makes sense. And that's usually about $250,000, $300,000. So when you've got 100 grand in your super fund, unless there's a specific reason, which we do sometimes, ATO, no, I don't, but sometimes we do it for clients who are like, we got one right now. They got like 200 grand in their fund. It's probably lower than the balance, so the fee's a little bit higher than what it would be in a super fund or whatever, a normal like a retail or an industry. But we've got this property that a business loves. We're going to rent it off their business and everything like that. It made sense, right? But usually it doesn't, especially if you go on all the super fund is, like we said before, it's just a trust structure. So if you open a self-managed super fund, once you do the trust deed and stuff, it's just a bank account. That's all it is, right? And people, like, you can access that bank account. Like, if you can't access your super, right, because someone's managing it. But if you got access, like, and you're in a pickle, people will start touching their super, and that's bad. It might sound like a Band-Aid solution, but it's not. Like, it'll undo you. So,
and you're not allowed to touch it, right?
Not allowed. Like, yeah, not allowed. Not allowed to touch it. There's things that people can do that are like things that people do around the rules to stay compliant, but you shouldn't. And no, you're not technically allowed to. But what we then do with the super fund is you set up a bank account. Now, most people will do this thing where they'll go from an industry fund, set up a self-managed super fund because they wear tinfoil hats and they hate the government, and then they'll set up a bank account. Then they'll set up a wrap platform and just hold managed funds in there. You still got to pay the platform fee.
Yeah.
It's pretty much the same price that you could have just had, instead of paying your $5-6 grand in audit fees or whatever a year to do it properly. I know people will be saying, oh, I can do it cheaper. Yeah, so can I. But to do it properly, you could be paying $1,500 a year over on the industry fund for the same thing you're doing now. But you're managing it. Are you an investment expert? Probably not, right?
So you're taking on more risk, you're taking on more cost, and you're getting probably a similar or a worse outcome.
And if you're off the ball for 1 second, you could lose half the fund to tax.
Yeah.
That makes sense, right? So they're the types of funds. So then we go into business owners, right? We go into business owners and we go, well, what opportunity opens up here? Well, there's some cool things with superannuation. You can technically buy anything you want in super within reason. Investments, pretty wide range. In a self-managed super fund, you go down that route. People say, why can't I do that in a retail industry? Because the trustee doesn't find it compliant. The trustee is not going to manage everyone holding artwork and shit like that, because you want to pay for that. That's what the cost is going to be involved, right? So it's not scalable for those businesses. So you have a self-managed super fund, you can buy essentially whatever you want. There's percentages for like hobbies, there's percentages for all kinds of things, right? You can buy cars, you can buy like this sort of stuff, but it's all based around what its purpose is. Because at the end of the day, your super has to meet the sole purpose test. And the one thing is that whatever you're doing in there is of the benefit of your retired self, not for now, right? So this comes into the business owner stuff, but also property. There's this, like, there was, you might know that phase a few years ago where people just linking up with developers and selling properties off the plan in bumfuck nowhere.
Oh, mate, that happens every day.
Yeah, you can buy it in your super fund, and people go, I can buy a house in my super fund. No, you can't. You can buy an investment in your super fund. You can't step on the lot. You can't touch it. You can't live in it. You can't do that. You can. There is a strategy we've done before a few times where if someone's in a pickle, everyone needs to have a roof over their head and money to live on by retirement. You can buy your home in super fund as an investment, and when you hit 60, you can take it out like a benefit and live in it. But you have to, it's like withdrawing money, you're withdrawing the house from the super fund. You can do that, but you can't do that till you're 60. You can't just go and buy this place and then be like, oh, I'm going to rent it, I'm going to get my mate to rent it. You've got to do everything at arm's length now. So there has to be a way between. So when people say to me all the time, and I think we'll get some questions on this today, should I buy property in super? That's not the question. The question is, should you leverage in your super? And if you should leverage, we've only really got 3 options: small leverage into shares or managed funds, or commercial and residential property, right? So the question isn't property, it's should you leverage? Do you
like a classic Porsche? You shouldn't leverage into that.
All of them. I saw one last night, the Moby Dick 959 build. Oh,
We could leverage that in super.
easy. I'll tell you what, some of the classic cars at the moment, you can make an argument for it, but you can.
And just on that, like how would they know if you were jumping around in the Moby Dick? Should have number plates that says super.
You just span your beard. We'll cut that out.
It's a nice beard.
You have to actually really, even though it's funny, it's a good point, because the risk in super, you can do fucking anything with a self-managed super fund. If you get caught, it's bad. Right?
It's like everything, right? You can do anything you want that's not right, but if you get caught, that's when it's bad.
Yeah, and it's just not worth the risk, like with most of it. But it is a bit more like, because you do have to audit it pretty heavily, and the HO's like on it, like they'll come after you and they'll go back and check shit. So it's just not worth it. But with the question, it is, do I want to leverage, right? And if you want to leverage, or if you need to leverage and you can afford the risk, if you can afford to leverage, of course, leverage makes sense, right? Even in your super fund. So therefore, an industry fund or a retail fund is not going to be for you because you can't leverage. You can buy leveraged funds, but then you have less control, which the GFC, they were right before the GFC. AMP has that many seized funds at the moment that people's money is still stuck in because of it, because they don't have control, right? Leveraged property funds, leveraged geared funds, wholesale geared funds, like you can do that, but you don't have control. So if you want to leverage, or you need to leverage, or if capacity leverage, then you need to consider the self-managed super fund. But people then say to me, well, should I buy commercial or resi? Now, I hate residential property inside super. It only makes sense if you had enough of it that when you're retired, you get tax-free income, or you sold them all, capital gains tax-free, and then did whatever, right? But the process between now and then isn't that effective, right? It's a 15% tax environment. What's the biggest benefit of our leveraging properties? The tax deductions, running a negative gearing. So why would you then do super when you can get a bigger benefit outside? Like, you're getting less of that benefit. It's the trade-off, right? So that's a big one you're going to consider. But the one for me is the flexibility, right? Why do I like resi outside of super instead of inside super? Because outside of super, you've got some fallback options, right? If something was to go belly up, or something went, as a worst case scenario, you might be able to move into that property and pay the rent for a short period and survive. Inside super, you can't. The only way you can pay that loan is with contributions personally, And there's a cap on that, right? So as your portfolio leverage debt gets higher, there's a limit to how much you can service without having to put your own money in non-tax effectively. Then it's like, well, what am I doing that for? To pay debt. So if you get resi, and buying good assets should never have this risk, but let's say you have tenancy risk or something's wrong with the property and there's not a tenant in it, where the tenant was paying the majority of the loan and your contributions were topping it up and then paying extra off, which made sense for you to then go again. Now your contributions have to pay that loan. And there's no fallback option for you to do that. Whereas why we like commercial, especially for business owners, we like it purely for business owners, not for non-business owners, is I can buy that place. I can run my business from this. If I'm a business owner with an existing expensive rent, why the fuck would I pay myself the rent? And then top it up with contributions, pay it down and go again. Secondly, maybe you don't. Maybe you want someone else in there to pay which is the same outcome, but the risk there's tenancy risk. But if that person moves out, guess what? Where's your new business address? Now you're paying the debt with rent and your contributions on top. So there's flexibility to de-risk the situation. And that's the thing. That's what it is. It's not about the asset. It's about the risk level and the mitigation strategies around it. You know what I mean? So that's what we look at with the super and understanding that side of things, because it's like you can leverage hard into it. And if you've got good contributions, good balance, that kind of stuff, you can do pretty good. But if you didn't, like we always look at things of what if the worst case scenario happens? And that's the risk there, right? Like
Well, what about working out? Let's hypothetically say we're working towards a 60 retirement age, and we want to live on the number that you said, 100. Let's say 150 grand a year, tax free combined. What would you need in there as a net asset value to generate 150 a year and not eat into your capital base?
3 mil.
3 mil.
3 mil to be safe. 5% yield. You'd be confident that you get 5% dividend and then keep it growing on top of that.
And that would mean that you would remain having 3 mil or more, because that would be slowly growing. Plus you'd be living off the dividend income tax free.
Correct. But you could do it with 2.4 if you drew on capital. 2.2, 2.4. In today's dollars, not including inflation, right? But that's where we then talk about how do you structure superannuation in retirement. Most people think I just take my money and go. You can, sure, do whatever you want, but that's not what we do. We do what we call the bucket strategy system, right? So you're in retirement, let's say you're 60. So let's say that person's 60. And likely you're probably another 30 years. Now, if you're 30 years old and I'm telling you to invest for 30 years till 60, what are you going to do? You're going to sit in cash? No, you're not, right? Like, so why are you doing it at 60? So we've got to then purpose out the phases in buckets. All right, well, what's the biggest thing we need in retirement? We need income. We need money. We need access. So we're not going to tie up some, but how long do we need to be safe? When we're working, our clients run 6-month cash buffers. It's enough, right? Because you're working. Like, if you can't get back into the workforce in 6 months, something's wrong. Like, let's fix it up. When you're retired, you're not going back to the workforce. So what's a general market downturn that might put us at risk? 3 years? No, 3 years. Some advisors run a year, which I think is crazy, but 3 years is what we run. Some do 5. So you have 3 years in immediate cash. We're not trying to make money on that. That's your salary for the next 3 years, right? Tell me a period where the market hasn't rebounded in 3 years.
In recent times,
exactly. In recent times, tell me a period, right, where from the time it crashes to the time it's sort of back making money, give me a period, right? Like 3 years is a decent amount. So what we do is we go, right, well, we're going to have 3 years in cash, bucket number 1, 3 years in cash, and that'll be split up in 3 months in cash. And then the rest of the 3 years will be split over term deposits, maybe some bonds, like some income generating assets, not equities, but some bonds. And what happens is the back end of that 3 years, as you use 3 months, that next term deposit matures. That becomes your salary for 3 months. And then at the back end, those things will top up the coffers for the next thing, right? So that's bucket 1. So that's how that's structured, so that you've always got cash. So for 3 years, the market could shit itself, I'm good. Then you've got the period from 3 years to maybe 7 years or 10 years. That's the market where that's still close. We don't want that too risky. So we might run it at like a 30-70 or a 50-50 maximum sort of thing, but we want them in income generating assets, maybe generating some frank dividends in there, whatever, right? And what that does is that asset pool will yield enough cash that it'll top up bucket number 1. So ideally, if you've got enough money in there, and this is where people fuck up, is they can't do these buckets because they don't have enough money by super, so they can live for 10 years really good, but they're drawing on capital. Whereas if you get enough in there from the start, that bucket should have enough income to top up bucket number 1. So you're never drawing or you're never having to sell that, right? But then you have the third bucket, which is the growth bucket. That's 10 years plus, right? So you were segregating the money for purpose so that each has its own risk level. right? Because if you just target all in one, what are you going to sit in, 10% growth, 90% defensive because you're worried? So we break them up into buckets. That one now might be 50 to 70% growth. It's still, we're looking at 30 years there, right? It's got cycles in it. So let's let it grow. The growth from that, and this is how we make sure we don't draw down on capital, the growth from that tops up bucket number 2, right? So as that, either if you are drawing on that to top up bucket number, well, then that tops that back up. Then bucket number 2 tops up number 1, and that's your cash. Now, if you don't have enough, what happens is you still run the same bucket, but bucket number 3, as let's say we need to top up 100 grand for the year. Oh, that's a big number, but like 50 grand. And you'd only generated 30 grand's growth. Well, we're going to draw down 20 grand from that. So now the next year's growth either has to be more, or it's going to be, if it's the same, we're going to draw down more. Eventually, that bucket's going to be empty. But it's going to take a while. And then we start living on the dividends from bucket number 2, but we will eventually draw on that too, until you've got 3 years left of life and we've just got the cash buffer there, right? So the people need to understand that's how superannuation should be worked in retirement. That's what we're working towards. It's a strategy. It's not just on money and then I run. And people get that confused all the time. They think it's just just a number.
And then what about like max? Like, what is the maximum amount you're allowed to have in superannuation?
So
before the taxation, changes inside of there.
3 mil, and then you get 30% tax. But
So
no, it's not. That was they pull in the new tax thing. So, no. So the transfer balance here, we've got to remember you got 2 phases of superannuation. We've got accumulation, we're working. We've got pension phase. What happens is when you hit 60, you purchase an account-based pension. That's the term. And all your assets get transferred over. It's the exact same thing as super. It's just so that they can classify, now you're in tax-free mode, right? So you can have, at any given time, in your lifetime, and it's going up every year, but at the moment it's 1.9 million per person. A few years ago it was 1.6, so it's going with inflation or CPI. So you can have 1.9 per person. I think it'll go up again probably next year to over that 2
So 3.8 million total.
3.8 million for a couple, right? And what that means is a lifetime transfer. So that means in the entirety of your life, you can transfer from accumulation to pension 1.9. So if you transfer $1 million at one point, but you take 500 out, that doesn't give you another 500. You're still at $1 million cap. Right. So, but that's in pension phase, right? That means you can only have 1.9 million each tax free. Show me someone who needs more than that, generally speaking, right? That's that. You can have fucking unlimited amount in superannuation still at 15% while you're retired on top of that.
Right.
Yeah. Well, other than the new rule, which is if you're over 3 mil, which hopefully that gets indexed, then that'll draw extra tax. But even if it's 30%, it's still less than having that in marginal tax rate. So you would want to structure, first and foremost, you want to structure as much of those assets in super to top out that cap. Then you'd want to look at maximizing investments outside of super to take you up to maybe SAPTO. So whatever would generate, assuming we're never going to sell them, whatever would generate up to 25,000 each, that would keep you under the tax-free threshold. So you could have, what's that? You could almost have $1 million, so 500K each in investments outside, plus your own home, to generate that. And then anything more than that, you would consider a bond strategy or have it in accumulation phase in super still. So it's still at 15%.
Yeah.
Right? So you structure it like that from a tax perspective.
And can you draw down on it, 15% in accumulation or no?
Yes, but you can. You can withdraw because it meets the condition of release.
Yeah.
Yeah.
Mate, lot to unpack there.
Lot to unpack. Should we look at questions or you got more?
Mate, I got some questions here. Josh goes, what's the minimum you'd need in your current superannuation to purchase a property? And let's assume Josh means residential property.
Yeah. Well, I do literally no resi, so you might know this better, but is it still 80% LVR minimum? 70
to 80%.
Yeah, so
inside of super.
So I would say, because you can't do it in a retail, so you would want, if I'm running that super fund myself and just forget what property is, just say from the lending perspective, you would want to have the 20% deposit, or let's call it 30% deposit plus costs. And I would want, all my clients will run 50 grand buffer in their super fund on top of that for fees and just in case.
Yeah. So you'd want to make sure you retain 50 grand minimum inside of the fund as cash or sitting in something which is liquid.
Yeah.
And then you deposit plus costs on the property.
Yeah.
And then another thing I think people forget with that is you still have to meet serviceability requirements, not with your personal income, but then with your contributions and the rental income. So the first step that I personally would take is that I would go and get an understanding, one, of what does it look like with myself and my partner inside a super with our contributions plus the rental income or projected rental income, and how much can we borrow, and then based on how much we can borrow, that can dictate how much you can spend, and then that's how much you'll need for you to
Correct.
deposit.
And just like you'd see in that, so people often have two mentalities. They think of serviceability or deposit and not both, and they go, well, I've got the deposit, cool, like doesn't mean, like, you've got 200 grand doesn't mean you can buy $1 million property if you can't. And same in your super, just because you got it, if you're not, your contributions aren't enough on top of that. And a lot of funds will really downplay will downplay the rental income. They want to see a lot of contribution history to make sure it can happen. And you want to make sure too, just in case your tenants move out, because realistically, the big benefit of getting that in there is either you're paying down the debt so that your LVR is better so you can leverage harder, because if they're paying the mortgage and your contributions are mostly paying down debt, given the low tax rate environment, it's not as good to hold interest only like we do outside all the time. But if you're paying down the debt, it means you can get LVR to go again, or you leave it at a high LVR and you use that money to then diversify, and you buy shares on the side, so you have both, and it's best case of both, right? Whatever it is, but you don't want to be running by the skinnier teeth on the SSF.
But often, I mean, you'd only probably get rental income to cover to cover the mortgage inside a super if you're running less than a 50% LVR.
Yeah.
Because if you only got two people in there, you got the 55,000 say of concessional contributions, and you might have rental income of $700 a week. $700 a week is not going to cover that large of a mortgage.
No, 100%.
Yeah. So usually you're going to have to top up with your contributions.
Yeah, but most of our clients, like on the commercial side, they will top up the debt repayments. We'll put a little bit of a buffer on there, just for inflation and stuff like that. We'll put a little bit of a buffer on there, but then we'll start investing in shares on the side. So we'll have 50K cash, whatever the mortgage is with the debt and the asset, and then we'll have shares on the side with the extra contributions, because if we need to, we're selling them if there's a capital gain on them, it's 10%, and we can go and pay off the mortgage if we need to. But people got to remember as well, what's the benefit? Like the benefit is that when you leverage in super, again, offset by the risk, but the benefit of leveraging in super is if you got 250 grand in there now and you can go and buy an 800 grand asset, you are now getting control of $800,000.
That's
if
right.
it just does 8%, like your shares do, if it just does 8% and it's safe and you can manage that affordability, you get 8% of 800 grand now.
That's right. Your returns are much greater. Yeah. The next one, how easy is it to start a self-managed super fund and invest into crypto?
Let's break it into two things.
How easy is it to start a self-managed super fund first?
Very easy if you don't do it properly.
Right.
I've had and I'm saying there's a lot of people out there, and they're switched on people who will say, I can do it on this fund for $150 a year and all that stuff. Yeah, if you want to, cool. I'm yet to meet a person who has done that effectively. It might be cheap, but they're missing so much.
Right. And then, as you've said, if you are not having it set up and audited correctly, you could, for saving a couple of bucks here, you could cost yourself your whole return in your super fund or a large portion of it.
A self-managed super fund's like, the setup's a little bit expensive. Like if you go through me, it's not. No, but it is a little bit expensive. And accountants, what they do, there's a lot of companies out there, like the company I use. I'm not allowed to say their name, but a company that I use, they're accountants, and that's what they do, but they don't deal direct to the public. So they'll set it up, they'll invoice me, and then I'll invoice the client, and we pass on the exact fee. We don't charge extras. Most accounting firms out there, because it's a big revenue maker, they'll use someone like that and then just uptick, just chuck a profit on top for the same thing, which is what makes it expensive, because it is an arduous process. But you're looking at $2,000 to $6,000 a year to manage that super fund properly. Like, so if you average that out into the fees, which most super funds you can run at 1% fee, to the numbers, right? You want 200 to 600,000 in there before it makes a cost-effective strategy. Benefit of it though is you can have up to 6 people. One of the benefits we love about self-managed super funds is when your kids start, as a parent, when your kids start work, for the first 5 years they're just paying fees and insurance. Nothing's growing. So if you have a self-managed super fund and when your kids start work, they can join that, and they don't have to invest in the property or anything like that. They can just invest in liquid funds and that
just
kind of
on
stuff.
that. Yeah. Hypothetically speaking, mum and dad are in the super fund. They've just hit 6-year retirement. 4 kids are still in there. So it's a family of 6. How does the fund work then?
So it's all split.
Right.
So the fund is allocated proportionately.
So they still have their own little bucket inside
Correct.
of the fund.
Now, I'm not going to get into the complexities of how that works, but when you are in a self-managed super fund, they can pool assets. That's the benefit. It's like being in a trust with someone. You can pool assets, but it is still proportioned accordingly.
Right.
When you go into a transition phase of that, so when you do, it's still proportioned, but there are things you can do that this is where it becomes really sexy, especially from a estate planning point, where the fund can do things, you can do things with your investment that makes it really effective. Like there's loans and stuff where you can transfer assets to the accumulation people and have other things go in for the pet. Like there's things you can do to make it where instead of just selling the property and segregating funds, that they're already segregating there notionally, there are things you can do which makes it really cool, because the fund can hold, the kids can hold the growth asset, do other things to fund the retirement of the parents, and they might only, like let's say you have 10 million in there across 6 people or something like that, they can say, well, we only need 100 grand a year, so we're only going to roll over our transfer balance cap of X amount to hit that. And then that leaves that whole cap open. So then as it gets older, and you can strategically tax effectively roll over different amounts at different times to make it really effective for the whole journey. And if you want to pass on wealth, most inheritances come when people are 90, your kids are already 70. What are they going to do with it, right? Like,
and just on that, this is again not part of the other question. So the parents pass, all of a sudden the whole superannuation, all their inheritance goes back into the superannuation fund.
No, so
comes out of the fund.
You gotta have the estate planning and stuff in there to talk about. Like it can, but it will still go. It's their money, so it'll go into beneficiaries, and the way of your estates plan will depend on how it flows.
Sure.
But you can, like that's definitely a way you can do it. If not, some other ways, you can have it come out of the fund, and then that person can contribute it back into what we call a recontribution strategy, where maybe it was because when there's an inheritance tax on certain, the way the taxed element, the untaxed element, there's inheritance tax essentially if it's not structured properly.
Sure.
So there's strategies there where we can take the money out from the pension side, and then we might recontribute it back in as non-concessionals, and then now it's tax free. So little things like that, but we're getting a bit complex there.
Now we've set up the fund. Crypto, investing in crypto inside of the fund. You said you can invest in nearly anything.
You can. Saying you're investing in crypto though is a bit of a stretch. Speculating, sure. 100%.
But you can put money inside of crypto?
You can.
Okay.
There's a lawyer on TikTok. I forgot his name. He's your best guy to talk about that stuff. I do, none of my clients hold crypto in their super fund. A lot of our clients will hold 10% of their portfolio in some crypto, but I will not talk about crypto in super because I haven't done it. But you can. The answer is you can.
Sounds like it's all a fugazi. You got any questions from your little box or no?
Are SMSFs really that hard to manage? Yes, if done properly. They're not. If they're not, then they're just a bank account and a trust. You do an audit. They're not that hard to manage if you just do it. But doing it properly, they are. They are complex, and you won't know how well you've done it until you get audited, and then you'll find out. Right? I've had, and I will say that I get a lot of people who do probably manage it effectively, low cost, wouldn't come and see me, so I won't know. But everyone I've seen try, rubbish. To the point where we've had many cases where we've had to wind up a fund. Just wind it up. It's just a mess. Just wind it up. What are you doing? Like, it doesn't make sense. Wind it up, go back to an industry or a retail fund. You know what I mean? Should you buy property with SMSF? It's not should you buy property, right? When people ask me these questions, it's contextual to what you want to achieve, right? If you need to leverage inside super, or you want to, or you have the risk capacity to, then yes, it should be a consideration. Whether you should or not, I don't know.
Yeah, I think it's... I think if you're young and you are looking for growth, it'd be pretty hard to match the growth that you can get through a good quality resi asset.
Yeah. Just the cost, right? Just the cost of the leverage. Like that's the biggest, like I say to people all the time, yeah, property doubles every 10 to 15 years or whatever that is. But if you can't make it to the 10 to 15 years, it's not gonna.
Yeah.
So same thing in super, property is a fantastic growth asset, but not because property is the growth asset, because of the leverageability on the property, right? That's like if you said to me, I want 200 grand to go buy a resi property cash in my super,
you wouldn't do it.
You're more.
Yeah.
Don't do that.
And that's also another thing which I'm not qualified to talk on, but you are. As you get to retirement age, pension phase, whatever it is, and let's say you have held some good resi assets inside of super or even outside of super, usually holding those assets debt free is probably not the best place for the money, because even when you have a property that is debt free, there is still so many other costs. You've got land tax, you've got council fees, you've got property management fees, you've got maintenance.
If you got an offset, it doesn't make sense. But tell me this. Say I just went through the pension strategy, the bucket strategy for pension phase. How do you do that with property?
Well, the only thing is your property will be in growth, but you can't do the top ups then.
That's right.
Yeah.
Right. So that's same
Well,
thing.
you'd have your rental income doing the top ups.
But how do you carve that out? You can't sell the lounge room and top it back up.
No, but if you're not carrying any debt, you'd have the rental income, which would be surplusing all the other
Correct.
costs.
But I mean, say the first 3 years.
We'd have to sell down. If let's say you held 3 properties
Correct.
in there or 2 properties, you'd have to sell down some of the property. And let's say let's use 3 properties because we've got 3 buckets. You'd sell down 2 of those properties because you'd use the cash for everyday living, the other cash for your bucket 2, and then the growth phase would be your 3rd property,
100%.
which would sit in growth, and then the income would come.
So you'd hold Darwin and Townsville in the middle bucket. you'd hold Vaucluse on the last one.
Yeah. You'd
But no, you can.
You'd go Toowoomba, Darwin, and then just for the growth asset, you just
WA.
put it straight in Perth.
Certainly. No, but that 100%, right? And this is what I explore people. I'm like, and the other part, I talked to this. I caught up with Atlas yesterday.
Oh yeah,
Brett Evans and James.
The boys,
yeah, because I was doing.
Shout out to the lads up there in the Gold.
Well, actually, they wanted a podcast. James wants to do a session on tax structures.
Mate, well, I'm keen to do a session
Because I got a lot of clients about Forex and crypto, asking me about Dubai and all that stuff. So we're doing a lot of stuff there. But
Dubai.
yeah, goodbye Dubai.
Isn't that good? Isn't it? Like we're in a beautiful country where you can make really, really good money with low risk. And then people are always looking for the shiny pastures.
Yeah, but this is what I said to you. This is what
Let's
I say
go
to
to
clients.
Dubai.
What I say to, because they look at the tax free, which is not. There's tax free, but there's fees. So anyway,
Tax free on money that you make.
Yeah. So
You got to make the money first. You know?
So, but what I say to everyone and clients who say this is, in any strategy that you want to make more money, you're trading simplicity for complexity, right? So same thing, like with one of the reasons we don't really hold property in pension phase is it's complex. There's issues. Whereas if we just hold liquid funds, there's no issues. And most people in retirement are done. They're like, I don't want to deal with it. But if you do, exactly what you said, right? It's not property versus shares, it's purpose. And if that makes sense, 100%, keeping holding your assets in growth phase, selling, and maybe you might have a mix of rental income and maybe some dividend shares in the middle bucket, and then you just have the sell down enough to have cash there, 100% that works. But people got to stop thinking property versus shares. Like, hang on, what's the purpose? What fits that?
And I say it all the time for outside of super. It's like property is not the right asset to hold inside of retirement. Because even when you have debt-free assets, that's still so expensive. You still got 2 to 3% of the property's value just in cost.
But forget that. Forget the expense. It's just a headache. Like for most people in retirement, like.
Well, if you've got good assets, if you've got good tenants,
but the good tenants, but say like still like even you got good tenants and you got like a real estate
good property management,
say you got them
like Henderson Asset Management.
Correct, but even to the point like but even to the point like I had clients, Greek clients actually not far away, and they had assets, and the reason we got rid of them was they were just sick of having to do check-ins and do that. Like they didn't want to do that anymore. They're just like, I just want my money coming in.
I want to put concreta.
No grass. But yeah, so do you have any? I'll go one more. The other one was at what age do you prioritize investing in super over outside? Super should be your priority. The first lot of money you have to get you to the goal you want, because you have the most amount of time, the most tax, you should be allocating that first, whether it's salary sacrifice or whatever, the amount you need to get that to the position you want it to be, carve that out, put that into super, and then anything past that, look outside.
Let's talk. That's the last one we'll talk on. Salary sacrificing. This word is a commonly, or phrase is a commonly used phrase, but not many people know what it is. So can we talk through what salary sacrificing is and why someone would potentially explore it, and when it makes sense and potentially when it doesn't make sense?
So you got two things people confuse: salary sacrifice, salary packaging. Salary packaging is novated leases. When you're working for a charity, you get FPT benefits, all that stuff, right? That's using pre-tax income to pay for shit. Salary sacrifice is only super. It's you're sacrificing an amount of your salary to go into your super before it reaches you. Now we need to understand it's not special. It's not. There's no benefit to it other than simplicity. You've got 2 ways to put money into super: non-concessional, and that is you pay tax on it, you put it in BPay, direct deposit, whatever it is, or concessional. The ways you can pay concessional, which includes the money your employer puts in, that makes part of that cap, or you can BPay it. You can drop it in there, direct deposit, transfer it in, and then you fill in what we call a notice of intent to claim, which you submit to the ATO at tax time, and they say, okay, we're going to give you the tax deduction for that contribution. All salary sacrifice is your employer doing that on your behalf more frequently. Okay?
But it would usually only make sense from a tax saving point of view to fill the gap between what your employer is paying and the $27,500.
Potentially. So when we said before, when they say, when should we invest in super? From day one, you should project out, and I'll show you 2 apps before we finish, project out towards the finish of how much do I need? What's it going to take to get me there? That amount, whatever the difference is between what your employer is doing and that amount, or the amount that you want to do that's above that, you should salary sacrifice that because it's simpler. On top of that, your employer is going to do it in either weekly, monthly, or quarterly at a minimum, and it's going to dollar cost average that portfolio over time. That's the biggest benefit of super is regardless of what the market's doing, we're always buying assets because your money's going in frequently and we're buying assets. We're not trying to wait. Anything above that amount with our clients, unless they're at the cap, with our clients, we'd most likely sit in the offset or sit in the bank account. And then in May, we'd go, hey, what do we got going on? And we'd make a lump sum contribution if it made sense. Yeah. But the number between what your employer is putting in and the number you either want to or you need to achieve your goal should be salary sacrifice. Makes it simple, doesn't give you...
And you save on tax, right? So let's hypothetically say that you're paying the highest tax rate of 45 cents on the dollar or plus or minus that number. And for you to get paid $1 of that, you're going to give 45 cents of it to the beautiful ATO. If you put that $1 then into your superannuation up to the 27,500 cap, instead of paying 45 cents on the dollar, you're only going to pay 15 cents. So you're essentially putting 30% or 30 cents net more into your superannuation.
You are, but we've got to remember it's no different to if you did it yourself. So salary sacrifice and you putting money in your direct debit yourself and then doing the tax deduction form is the same outcome. Yeah. Just you have to do more.
That's right. So it's either your employer doing it for you or you
correct.
doing
And when your employer does it, they'll adjust your tax rate so that over the year you'll get less of a tax return, but you would have paid less tax throughout that
But
time.
the outcome of both of those things is to, instead of just giving the money to the ATO so you can get a little bit more back in your pocket, you're gonna save 30 cents in the dollar save, you're on the 45 cents, and that's 30 cents is going to go into your super.
Correct.
There we go.
Correct. Oh, last thing. There's 2 apps, right? If you want to learn about super, even just finance in general. And
app number 1 is called the TAB, and the second app, Sportsbet.
Binance. There's crypto. No. So 2 things that are in every financial advisor's back pocket. If you're not going to use a financial advisor, then you should have these in there so that you can reference. It doesn't make you a financial advisor, it just gives you help. One is called Macquarie's Little Black Book or Macquarie's Technical Team. It looks like this. That little black one. So if you click into it, it's this thing. Right, and it gives you all the information on super and everything like that. And then the other one is just a financial calculator, which I like to use the TVM one. Just that blue one up in the top. Download it from your app store. Get those 2 things and you'll be able to project out your numbers and be able to read about super in a very summarized way. You look at it, you got questions on there you can go through. You're not going to be a financial advisor, you're not going to know the complexities, but you'll at least be better off than where you are.
That is it. We've decided debt recycling coming up next month, March. All right, folks. See you next week. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDFs beforehand. This is a Henderson podcast production. Righto, Frankie!
We're back for another week.
Fuck, I feel sorry for someone's eardrum going up next to that. Imagine starting a podcast like that.
Put the volume down.
You're looking good. Almost 50.
Yeah.
Incredible, mate.
I've been, still going to the gym, mate, at 45.
You go to the gym, you don't train.
Yeah.
I've actually had a few young girls call me from the gym saying, this bloke wears a Henderson shirt sometimes. We don't know who it is. Is this your dad?
I go to the 9:30 class. Not many young girls come to that class.
I never said, mate, come on.
Girls.
No, I just said girls. I've had a few girls call me.
Anyway.
Now, Frankie, mate, this is one of the most fashionable outfits. This is not a piss take either. This is a serious compliment.
Good, yeah.
You're looking sharp.
Cruise wear. Getting ready.
Cruise wear. Mate, tell us about your 50th birthday.
That's not till April, mate. Well, I'll talk about it when I come back.
It's February almost. Next week's March.
Coming around quick.
What are you doing for your 50th?
Flying to Vegas, bit of New York, bit of Virgin Voyages cruise out of Miami. Yeah. Part with the boys, just the boys first, then my wife will fly over.
So you're going just with the boys first?
First, and then my wife will fly over for my actual birthday.
Why didn't you bring your wife the whole time?
No, mate, it's a big celebration. She doesn't want to be there for the drinking and celebrating.
Yeah.
She just wants to come for the fancy dinner at the Bellagio.
She saw you at the Henderson Christmas party and said, that'll be the last time I ever see Frank drunk again.
Nah.
Now, Frankie, you actually made a comment about my shoes just before we jumped on. What are these called?
I don't know, Yeezys or something. You said.
Yeezys.
Yeezys, is that what they are?
Yeah. You should buy a set. You'd look good in those.
Too much
Mate,
money.
these actually aren't
Too
even
much money for me.
This is from the main strip of Bali. These
Oh,
ones.
okay.
Yeah.
Very good.
I bartered this bloke down.
You have to when
He
you
wasn't able to feed his
expect it.
family that week, but that's all right. I got a cheap pair of Yeezys. Anyway, mate, let's get into it. We're talking today. There was a lot of topics we were talking about. I'm just scrolling before thinking, what are we going to talk about? But, mate, I think it's worthwhile talking all things asset management because we have just launched Henderson Asset Management.
You have? Yes, very good.
There was a reason for that, and the reason is because usually with property management, they do one thing, and that is collect rent, deal with tenant disputes, give you your rent, and then take a clip, which is totally fine. But
Of course.
as you and I know, we're having, what's your portfolio worth? 14-ish?
I don't know, whatever it is.
14, 30, but $50 million worth of property between us.
Okay, yeah.
That's not bad. We know that property managers can sometimes do their job a little bit better, and as an investor, you have to worry about a lot more things outside of just collecting rent and paying bills.
And we spoke about last year about why we highly recommend having a property manager or a company doing it as opposed to self-managing it yourself. It's just simply not worth it, in my opinion. The risk you would need to take on and the knowledge you'd need to know to manage it yourself. If that's not your area of expertise.
But imagine this, Frankie. Imagine this. You and I have both learnt from people how to do things, right? We've learnt from other property investors. But imagine if your property manager was yourself or myself. We were actually managing the properties for clients. And we were able to share with them all of the stuff that we'd learn along our way for them to become better investors.
Yeah, which we do. We tell them, get a depreciation report.
But we do that through Henderson Advocacy, through the buyer's agency.
Yes.
But there's a lot of people who can't use Henderson Advocacy because they can't buy a property. They don't have a serviceability to buy a property. Maybe they don't have the budget to be able to work with us, or maybe they just simply don't want to use a buyer's agent.
Yeah.
But everyone, bar a small percentage of people, uses a property manager. So what I wanted to do is I wanted to create a division of our business where you don't
those
have to,
who already have investment properties.
that's right, or don't need to buy, but they still want to be a part of our ecosystem and be able to access all of the stuff that our full service clients can access outside of the location selection or in asset section, all the rest of it. Because the way that I was thinking about it was, I obviously sought out Chris Gray and other mentors, but if I had a property manager who had a huge portfolio, knew everything, not just about managing the asset, but knew about finance, how often you should get your properties revalued, how often you should refinance your loans, what releasing equity was. And then I had someone who could, that same person, advise me on, hey, Jack, you should renovate this property because you can add X amount of dollars to it. We just leased one down the road that had a renovated bathroom and an ensuite, which you can add to yours, and they're getting $150 a week more.
Yeah.
And then that same person can say, hey, have you considered getting a PAY tax variation because I know you can save money from a cash flow point of view, and a depreciation schedule. I guarantee there is more than 50% who listen to this podcast who don't have depreciation schedules on properties because they think, oh, my property's old. So
I didn't on my first one.
There you go. And then on top of that, you have someone who can help you plan out your portfolio and give you the advisory that you need to be able to continue to grow, because your asset manager or your property manager is the person you talk to the most out of everyone along your investing journey, because they're the person who will, every month you're getting your rent. You're getting probably feedback. You're getting market updates.
They're ringing you up saying the plumber, the tap's leaking.
Exactly.
Can
so
we send out a plumber? Yes, send out a plumber. Yeah.
When the reality is, you don't really talk to your mortgage broker all that much unless you're doing a loan. You don't really talk to your buyer's agent all that much unless they're buying your property.
Your accountant probably at tax time, once a year.
Exactly. So what I wanted to do with Henderson Asset Management was create a asset management company that can advise and guide on all aspects of that.
Yeah.
And that's how Henderson Asset Management was formed.
Very nice, very nice.
What do you reckon, Frankie?
I like it.
You like it? What about, well, if you think about your own journey, how many properties have you bought over about 13 or something?
15 or something, yeah.
Yeah. So 15 or something over the period of time.
Yeah.
You think about, imagine if you had that person in your corner to be able to advise on certain things.
Well, I just learned along the way from speaking to individual property managers, to speaking to my accountant, to speaking with mortgage brokers of late. Back in the early days, it was simply the bank manager.
But often these people don't actually have portfolios, you find.
No, like your accountant, or even your mortgage broker, they don't necessarily have a portfolio of investments and investment properties. They might not even have one.
That's right.
But they just know how to do the the cog in the
niche.
wheel, if you like, the portion
And
of
it's a
it.
funny thing because people go to accountants for wealth creation advice when the reality is that accountants trade, and you are an accountant, so you can,
Yeah.
talk to this. Your trade is to help with structuring and save on tax.
Yeah.
Like it's tax optimization essentially
yeah.
is what accountants are for. But, my parents got stung with this where they go to their accountant because they're their financial guide in their life, because they're dealing with money, even though they're dealing with money in a way to save tax as opposed to create wealth.
Yeah.
And they ask their accountant, hey, what should I do with X amount of dollars, or how do I build wealth? And their accountant says, this is what you should do. And the reality is they haven't got a track record to be able to do it.
No, they're just going off a textbook answer, possibly, or I've seen other people do this, so to speak.
Yeah, exactly. Or because they have a vested interest in a certain thing. There are plenty of accountants, and I've heard it from clients and obviously my own parents' experience, that they just advise, you should go buy this because they then get a kickback when we're developing.
Yeah, well, I've never personally used a financial advisor. I have used an accountant to basically, get the best tax benefit for me in regards to primarily properties. So more for tax advice. Like you said, I'm an accountant anyway, so I, and through experience of buying and selling a lot of properties, I know, a pretty high level of what I can and can't claim and how I should structure things, etc. But I have never personally gone to a financial advisor. Now, what I hear, right, is that a lot of financial advisors are anti-property in the fact that they will take your money and say, you're going to get a better return from putting it into a share portfolio, stocks, etc., trading, etc. Now, like I said, I've never used one, so it's not from personal experience. Whether they have a vested interest because they get better rebates,
Well,
or
of course, because they
referral
get a
fees,
percentage of assets under management
and things like that, more than likely. But
then
from
a lot
what
of
I've heard, and like I said, it's simply hearsay, that some of them will steer you away from investing in property and steer you more to the share side of the equation.
And then let's talk. That's the accountant. So
and that's not a bad thing. There's plenty of money in wealth
course.
creation has been made
how
on
much
shares.
money have you made in shares?
Not much. I've lost probably lost more than I've made. No,
There you go. There's plenty of money to be made in shares. Mate, I think shares, you need to be a slightly more sophisticated person to be able to make money. It's pretty hard to fuck up in property, right? Like, as long as you buy something half decent, you hold it for a long period of time, you'll go okay. But you think about that. So we've spoken about, you've got if you're a property investor, your team looks like your accountant. So that's one person. Your accountant usually has a certain theory or thesis or vested interest in one piece of advice.
Yeah.
And then you'll come away from that person and then you'll go to your mortgage broker. So
Yeah.
if you think about your mortgage broker over the time, or the bank manager, how experienced were they in property and investing?
I don't know. I probably didn't ask them.
Not very,
the
I
question.
can tell you. The bank manager probably didn't
not
know.
in regards to the personal, because I suppose it's a personal thing. But they knew how to get a loan, how to get me a loan, and things like that.
So they're in their expertise, but then
Yeah.
often people will ask their mortgage broker or they will ask their bank manager or they will ask whoever it is, hey, what do you think about this?
Oh, yeah. Well, I've spoken to my mortgage broker a lot of times, and I said, do you get a lot of questions about, I'm looking at this property. Do you think it's a good property? He goes, all the time. So they do become, the mortgage broker especially becomes that sounding board where really the mortgage broker just wants to get you a loan. You go away and buy it, and then come back when you told them it's bought and
That's
you need
right.
the money.
Their expertise is in finance. And I would argue that obviously not everyone is created equal, but even mortgage brokers, there is mortgage brokers that are very sophisticated, have large portfolios. The brokers that we work with have big portfolios themselves and have built substantial wealth through property. So they're people who can speak from their own experience when they're giving advice. But a lot of people, they go and ask brokers about things and they actually don't know the answer to it.
Yeah.
So that's another stakeholder. So you've already asked your accountant their piece of advice, and you come away from your accountant, and then you go and ask the broker their piece of advice. You come away going, fuck, they've said something different to the
Then
accountant.
you've got your solicitor, legal
And then
rep.
you go and ask your conveyancer or your solicitor what you should do. And how many times have you heard, don't do that, or make sure this is like this, or you wouldn't want to get caught out with this?
Or you only speak to the solicitor. You talk about speaking to your accountant once a year. You're just speaking to the solicitor every time you purchase, and they're just simply doing the conveyancing. You're not even, because you might have just gone, I've just bought it in my personal name, and they will say, well, that's your choice. They might not give you the options. I suppose you've got to ask them the questions to get the real knowledge out of all of these people, but they might say, you're buying in your personal name, nice and easy. What do you have? 50-50, 80-20,
Tenants in common.
0, tenants in
And
common, joint tenants.
People don't even know that stuff. They're like, oh, what is that?
Well, they'll if you say what's the difference, they will give you the description. But you're just using them for the conveyancing.
That's
or
right.
you might say, I want to set up a trust, or
So that's another stakeholder.
Yeah.
So we've spoken about that. They've got a different opinion. Another different opinion. And then where do you go? You usually go to your property manager once you've purchased. Then you're
Once you've
asking your
purchased.
property manager for their advice. Oh,
Yeah.
what do you reckon about this? Do you reckon I should spend this on a reno? How much value would it add?
Yeah.
What do you reckon? And the reality is, a lot of them don't even know. So you've got all these different stakeholders inside of a property, investors or someone who's trying to build wealth through property, and they've got to go to 5 different places to get 5 different opinions, and they decipher the information. We haven't even mentioned a buyer's agent. You go to your buyer's agent, they're going to have... So everyone's got a different, a different opinion, and then you've got to try and decipher it all and make the decision yourself. Whereas if you go, for like, you've got to, let's talk about business. You have a business coach or you have a business mentor. That business coach or business mentor is that one, ideally, the one point of truth for everything. Like they'll tell you about the marketing that worked well for them in their business. If it's similar to yours, they'll tell you about how they structured their payroll. They'll tell you about, how much they spent on OPEX and how, what their budget was for X, Y, and Z and how they grew from 10 to 50 staff. Like you go to a business coach or a business advisor or whatever it is to tell you on all of these things because they are telling you or advising you based on their experience.
Yeah.
And that's essentially what, we want to create with Henderson Asset Management is you should be able to come to one place, especially if you're going down our strategy and you believe in what we believe in and you want to create wealth like we
Buy
have.
your property and then progress from there.
And we can advise in all the different areas.
Yes.
So you can come to one person and go, okay, what should I do? Or you shouldn't even have to come to that person. You should get your every 6 months automated valuation that comes through. Hey, Frank, want to let you know, mate, 6 months ago, property was $1 million. Now it's $1.80 million. There's an $80,000 equity uplift.
Someone
there.
who's proactive as opposed to you having to ask the question, hey, can I get a valuation done?
That's it. Every 6 months, bang, you get a review on your finance to say, hey, you're
giving you your equity position and your available equity that you might be able to pull out.
That's right.
Hey,
And then
just
your,
letting you
your
know.
rates, just want to let you know, rates have come down 0.5% since our last review.
Yeah.
You're probably paying slightly too much. Let's put in a phone call to CBA and bring those rates down.
Yeah.
Because why would you pay more than you have to? Then another thing, bang, you go off. Hey, just want to let you know at the routine inspection the other day, you could probably renovate the bathroom, renovate the kitchen. Remember that $80,000 worth of equity that we got? We can pull that out and do the renovation with the equity and add X amount of dollars worth of value to the property. Plus 64 Smith Street down the road, just rented, renovated with the same 3-bed, 2-bath configuration. And we got $150 a week more. So having that one advisor to do everything, I think is...
And I think what the takeout out of that is a team behind you in this asset management that is proactive. Like you said, every 6 months it's automated. The client gets their valuation, gets their equity position. Has it increased, decreased? Has it stayed the same? Getting that knowledge from similar properties in the area and things like that, as opposed to you having to ask the questions. And the problem with you having to ask the questions is if you're not experienced because you've just started your journey and you don't know what questions to ask, well, how can you get the answers to questions you don't even know I need to ask?
That's right. But and also you're usually asking the questions even if you do know, and you're asking the questions where you're going to get 10 different answers from people who haven't actually been there and done it themselves. Because when people are investing in property, they're investing in property for a reason, which is to create wealth through a property. You wouldn't invest in it if you didn't want to do that.
Yeah, everyone has slightly different reasons, but in essence, that's what it is.
Well, you're not doing it because you want to go look out the front and go, fuck, that's a nice property. You're investing in property because it's a wealth creation tool or it's a store of wealth.
Yeah, or it's a holiday house, and that fact that it is different.
Potentially, yeah, not our clients. Yeah. So I think having that one point of truth, and I think this will become more and more of a thing, instead of having your 10 points of truth, having one point of truth where you just go to that one person and they're in contact with all the different stakeholders.
Yeah, that's the point too, that they're in contact. That one person doesn't have to have all the knowledge or be financially licensed and all of these things and all that. They just need to go and be that person, the conduit, to go and get the right information for you, so you don't have to go
and then put it into an easy to understand or get the information and then process it and then deliver it to you as to what to do with the information. Because having the information is one thing, but then executing is another thing.
Exactly. Understanding it and executing is another,
Because,
and I think that being proactive thing is fantastic.
So for yours property recently, we were talking about it on another podcast where the tenants moved out in Stafford, I think this was, or
my one
Waiver Lights?
No, it was Mount Gravatt East, yes.
Yes, on the south side.
South side, yeah.
Who was the person who contacted you and said we should do the renovation?
Well, this is interesting because I obviously bought my 2 houses in Brisbane through a buyer's agent back in 2015, 16, whenever it was. Now, they actually, funnily enough, have a property management to their business as well. So they manage my properties as well. And it was them who said, well, you've got tenants moving out in 3 months' time. Let's start planning about some things that, you know, we've not necessarily been putting off, but things that are starting to get a bit tired now. You know, the bathroom, the external look of the property, the painting of it outside and in, and how we can not only make it look better and maintain the property, making sure the property is always kept maintained, but it will allow us to get extra rent. So, you know, I spent whatever it was, 10, 15, 20 grand. I think in the end we ended up getting an extra $70 per week. It would have, you know, if I was to get it valued, it would have lifted the value of the place, because, you know, I'm going from, it's simple things like, you know, it was going from a cream coloured house to now a nice modern darkish grey blue, or whatever the modern colour is that the painter suggested. And it really lifted the street appeal of the house. It's now got fresh coat of paint on it, which is going to last another 10 to 15 years before it needs to get repainted again. It's more attractive to tenants. It's more attractive to potential buyers if I were to sell it. So of course the value of it has gone up. The rent's gone up, so that's helping if I ever want to go and refinance again, because now I've got a higher rental of recurring income.
That's right.
As opposed to just having the money sitting there in an offset account and not using it. So yeah, it was the property manager, and then, you know, they, being in Brisbane there, they also then managed the trades,
renovation and all the rest of it.
Yeah.
And if they're proactive, most people wouldn't even think about that, because you're so busy in your day-to-day life. The tenants move out, you get a notification, hey, tenants moving out, we're going to re-advertise it.
Yeah, and a lot of property managers, you know, and in my other properties, they haven't ever suggested things like that to me with, you know, other houses or units. They're all about tenants moving out, we're going to advertise it, get the next tenant straight in.
That's it.
You know, and of course, you know, when tenants complain about something, oh, there's a leak out of this window, and
but it's reactive.
Something's fallen off. It's reactive.
It's reactive instead of proactive.
That's just a quick repair. Yeah, get someone in there to repair it.
Exactly. So it's reactive instead of proactive. And I think, you know, one of the big things is, and we're coming up to the end of financial year now. So if you're an investor and you're listening to this, take note, right? There's definitely things right now in everyone's property that need to be done.
Yes, and we've spoken about this before too.
And everyone is going to have a tax bill at the end of the financial year.
Yeah.
So if you've got a tax bill coming at the end of the financial year, or not a tax bill, but you've got a situation where you can either get back some tax or pay out some tax, most property managers are not going to call you and say, hey, Frank, just want to let you know, we've spoken about the floors are wrecked here, or we can put a new oven in the property, or, we've spoken about maybe putting some fans in the bedrooms, blah, blah, blah. Tax time's coming up. Obviously, if you do that stuff now, you'll be able to claim it straight away.
What, coming up to the end of February, and believe me, the next 3 months will go really quickly. March, April, May, June, you've got all that time before 30th of June to get those repairs and maintenance.
But just take note, if you're listening to this, you won't get that call. 90% of people won't get that. No. Because I've done it before,
where I've called my property managers and said, hey, we're in the end of March now, heading into end of financial year. Can you actually call the tenants? I've been the proactive one and said, can you call the tenants and find out, are there any, little things that they've, maybe hasn't disrupted them, but they couldn't be bothered ringing you to say, hey, that light hasn't been working, or every now and then it gets a bit flicky or something like that, because I want to get it done now, because if I get that expense just before 30th of June, when I do my tax, I can get that money back, or portion of it back, straight away. You get the expenses done. So many times I've had the property manager call me in July and August and said, oh, the tenant just rang me up. This thing hasn't been, the oven's been on the blink for the last, 2 months. Right. And I go, it's for 2 months and they're calling you now. I said, had we done it in last financial year, I could have been claiming it now. I said, now I've got to wait another 10, 12 months before I can claim it. So
that's right.
The point is, get it done before 30 June. So you can claim it straight away. It's a good cash flow thing.
And there's a disconnect usually, because the managers, we're not saying they're not doing their job properly, because they are, but they're not thinking like an investor thinks.
Yeah.
They're just thinking like, oh, it needs to be fixed, let's get it fixed. But they're not thinking about, tax time, property investors, negative gearing, can claim things, decrease their position. And I think if you have a team of people that all know your situation and your goals, meaning they know roughly what you earn, they know how many properties you have, they know what your goals are, they know the nuts and bolts or the fundamentals that they need to know to be able to give you the right advice, you're going to get that personalized advice.
Yeah, well, it comes from the top down. The company, goal or the company message has to be that we are going to be proactive. You have to know what's going on with your clients' portfolios and properties that we're managing, so that we can provide that proactive service. A lot of property, real estate agents, they're concentrating on selling properties, that's where they make the big bickies. Obviously, they try and then secure the management as well, and that just provides a nice recurring income that's just flowing in month on month. But they're more worried about concentrating on, the selling of properties, listing properties and selling them. So that's the mandate, if you like. But if the mandate, like you said, is a whole of
asset management, portfolio management.
That's right. It's a very different message to the staff that's going out, and the staff then the service they're providing to the clients.
And I think another big one is like the manufacturing of not only equity through renovations, but then yield. Like how many clients, or how many investors right now are sitting on properties, their investment properties, with a significant amount of equity because they've owned them for a period of time, and a block of land that you can add a granny flat to, for example. That's a no-brainer. You're just literally leaving 30, 40 grand a year in rental income on the table, of which you could fund through equity that the property generated. So it wouldn't cost you $1 out of your pocket, but it would add a significant amount of income, which would also then increase your ability to pay down the debt or,
and
cash
the value
flow
of the property. Yeah.
So like those little things, and if you're an asset manager, you would know that. I can assure you, companies like Goodman, for example, in the commercial sector, or Fraser's Property, these people inside of their portfolios have asset managers who advise on all the things that they need to advise on. The energy ratings for the buildings. We need to do this. We need to do that. We need to make sure that blah, blah, blah. That's the kind of thing you need, I believe, in your team.
Yeah, for sure.
Frankie, when do you go away?
Not till April, mate.
Well, he's come in the office today and he goes, "Oh, boys, I'm flat out. I've got to go. I'm like, where are you going?
Where are you deal this week? That's it. I have a week off now.
Righto, Frankie. See you next week.
Jack.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. How are you, Mr. King?
I'm good, my friend. How are you?
Mate, it's good to see you. You're looking sharp.
Always. Got the.
I was going to say, you're wearing some brands there. Cairo.
They're my brands.
Henderson Advocacy.
Yeah. Oh. Henderson Asset Management. We'll put it on that sleeve.
That's right.
3 Kings on that sleeve.
3Ks Wellness.
Just missing the 3628, so we've got it there.
Mate, got the tats on the legs. It's all happening, huh?
All
3
happening.
Kings.
Just
mate,
walking advertising.
What are we talking today?
Mate, today we're going to talk about debt recycling, which is I think a much overused topic that people don't really understand. They throw it around a lot.
Oh yeah, and we like to go in deep on
deep.
Yeah. I don't even understand it, so it's good. This is a learning thing for me.
We just get rich people to pay off the mortgage.
That's right. That's pretty much it. Debt recycling is be young and good looking, find someone old and not that good looking, get them to pay off your mortgage.
It used to be called sugar daddy or mama.
Well, it's just been rebranded. It actually is finding a sugar mama or a sugar daddy. But the financial term is called debt recycling. No, in all seriousness, mate, it's a term that I see on TikTok quite a lot. I've spoken a little bit about debt recycling and how it works, but let's unpack the what, the how, and the why you would do it, and then we'll run through a few examples as to how it can be advantageous to the average punter out there.
I'd be keen to hear from your view, right? From your view on what you see, because what I see with debt recycling is mostly in the advice spectrum, and a lot of advisors use the term because it's sexy. They use it and they reel people in, and it never really happens. What do you see about it? Like, what do you see when you think of it?
Essentially, debt recycling is a way to minimize your non-deductible debt and turn it into deductible debt, which has a tax deductibility to it, and also being creative on how to use. For example, you've got your non-deductible debt, which is, let's say $500,000 is your owner-occupier property, and you've got a $1 million mortgage. Essentially then, let's hypothetically say you pull out $300,000 worth of equity, whatever it is, you then invest that into something, that then becomes an investment of which now the $300,000 is deductible, and if you take on any other debt, that's also deductible. And let's hypothetically say over time that then starts generating an income that is greater than the cost of that debt. You can also then start recycling the income that comes off that asset to then start also pay down your non-deductible debt.
The first thing we want to go back to, and this is important for people to understand, is the bottom line of what good debt versus bad debt is, right? And when we say to people, what's good debt, what do they usually say? My mortgage, my home. Because people think good debt is a growing asset. It's not.
Debt that's attached to an asset that's increasing in
Correct.
value as opposed to decreasing.
Now that's better than a liable asset.
That's
like a
better
car.
debt.
It's better debt, but it's not good debt. So it's usually good, best, better. But we have good debt is debt that is deductible, right? So we can pay the interest cost with pre-tax money. Bad debt is lifestyle debt or debt that we have to pay with post-tax money. And we covered this off last time a little bit in the super conversation. But when we're talking about home debt, you got $1 million mortgage at 6%, $60,000 a year. People don't realize it's not 60,000 by 30 years. You got to earn 90,000 to pay the 60. So it's 90,000 by 30 years. That's a big number, right? And this is where the rent vesting model always comes in. And essentially, I did a story yesterday where I showed 5 scenarios of someone buying a home and retiring. And at the end of the day, when you retire, you need money to live on and a roof over your head in one way, shape or form, right?
Yep.
Unfortunately, in Australia, we prioritise the roof over our head, and that's what people do. The old model, pay down the mortgage, sit there. But if it's just a roof over your head, it doesn't matter what's it worth on paper. If you can't put food on the table, you have to sell it to then put food on the table. And a rent vestor who rents their whole life and eventually has enough money to keep renting and put food on the table is a better scenario than someone who has debt-free mortgage.
Well, it's a better scenario to the individual, right? A lot of people, and I think my parents would fall into this boat. You know, they want to have something they can leave to the kids and the grandkids.
Yeah.
But they don't. That's not going to give them a lifestyle, right? You see all these elderly people who sit in these houses that are worth $1, $2, $3, $5, $10 million, haven't been renovated for 40 years. They sit in the same chair every single day.
And then Hendo comes in and says, "Hey, let's do it."
And then I say, "Hey, do you know that's a great property for an accelerator strategy?"
But they we see this, and most people won't see this because people won't put this up on TikTok. Or
Lots of people will see this podcast, man. We are
heaps,
very
lots of-
popular.
No, but
faces.
I'm saying people don't see this in the society where people do have to sell their homes to survive. And you hear the stories, they sell and they move somewhere else and they go, "Oh, well, that was great. I downsized." You could have done that 30 years ago and been debt free 30 years earlier. Like it's all contextual, right? So we've got to make sure we're running those two things, but we can't sit on the fence and say, "Oh, but investing is better," because the one thing you don't get with a rent vesting strategy, especially when you have a family, is the security of your own home. Right?
Unless you're good at negotiating lease terms.
Very good, which I'm not. So they miss that part, and that's an important piece to the pie, right? Having that security, especially with a family. I didn't think it was until I had a family, and it is an important piece to the pie. So when we're looking at that strategy, we've got to look at, okay, there's financial and emotional decisions, and how do we balance it? And this is where debt recycling comes in, because most people want to buy their own home. And a lot of people will buy their own home, be stuck in the jail term of this non-deductible mortgage, which will cost them so much money pre-tax over time. And we like to think that, that's not real, because especially salaried, your tax comes out before you get paid. And you don't think about it. It's next to housing, tax is everyone's biggest cost, right? 100%. So what we're looking at with debt recycling is how do we factor this in of achieving those two goals, right? How do we achieve these goals? You're not going to debt recycle if you're rent vesting, because all your debt, if you've got debt, is going to be deductible, right? When we're talking about investing...
And one thing just on that, I've tried to debt recycle a McLaren, and apparently the ATO, this thing, it's not not allowed.
No, well, it gets in the business, right? So it's fully recycled. It's all pre-tax. It's perfect. You could debt recycle a car if you have it outside your name, you open ABN and you get it put in there, boom, done, debt recycled. But what we're looking at here, like when you're investing and you don't have a non-deductible debt attached to a home, then you're essentially just leveraging, right? And you can do, if you're doing shares, it's a margin loan. So we can talk about that another time. There's another topic. So you do a margin loan or you're investing, but that's just leveraging. Debt recycling is simply the strategy of taking non-deductible debt, i.e. bad debt, and turning it into good debt, which is deductible. Where people go wrong with the strategy is they try and analyze numbers and growth rates and all this stuff and try to focus on the growth outcome. You got to cut that away. That's a what do you call it? That's a symptom or an outcome of it, a side note of it. But the real strategy is if all you do is take your non-deductible debt, turn it into deductible, regardless of growth rates, you're in a better position.
That's right, because you're paying for it with pre-tax dollars. So instead of
Correct.
having to earn the 90 to pay the 60, you can have, a mortgage repayment of 60, and you can pay that 60 with your pre-tax income. Essentially, where people get confused with this strategy is they don't understand what portion or how they can claim it or pay for it with pre-tax income. So if you've got a property that's generating you, say, $50,000 of income through rent, $1,000 a week or thereabouts, but it's costing you $70,000 a year in holding costs and interest and all the rest of it, there's a $20,000 discrepancy there between what it's making you and what it's costing you, which is a negative discrepancy. And that's the $20,000 then that gets offset against your taxable income. So if you're earning the 90, like we spoke about, the 20 comes off that 90, you're now only paying tax on the 70 as opposed to paying tax on the 90. And that's where the pre-tax comes from.
Correct. And I think even to simplify that further is interest and costs related to an investment are deductible, right? So people like, especially in business, when you want to claim a deductible, they think they get all that back. It's just the tax component, right?
That's
so
right.
When we're looking at it, we've got to understand that principle.
So let's just explain that a little bit more, because this is let's go fundamentals and basics. It's just the tax component of it. So if we use that same example, that you've got a $20,000 deduction off a $90,000 income.
Yeah.
What portion of that $20,000 do you actually get back?
Whatever your marginal tax rate
And
is,
let's
right?
hypothetically, what would the rough...
34%,
Okay.
40%.
So $20,000 comes off that $90,000,
Yeah.
and of that, you're probably going to get 30 to 35% or 30 to 35 cents in the dollar back.
And the best way to think about it, because then you go into tax rate strategies where it's not, don't look at things as, oh, I've got $20,000 deductible, I'll get 4, 5, 6 grand of that back. You want to go, what happens is you've got assessable and taxable income, right? Assessable income is all the income you earn across the board that the HO is going to assess. Taxable income is then the component that is taxed upon, right? So when we don't have negative gearing or deductibles, our assessable and our taxable are going to be relatively similar because there's nothing to bring it down. So all of that income is going to be put into the marginal tax rate, and that's what's going to get taxed.
Yeah.
The idea of tax strategies is to go, well, the assessable doesn't change, but when we start putting deductibles in, let's say we have $100,000 income as our assessable, and we can claim 30,000 of that on deductibles. Well, now our taxable income is 70,000. So now we pay the tax rate on that. Now, if you're an employee or you're salaried or you pay yourself a wage, you're still going to put the tax aside, or your company's going to put the tax aside for the 100,000. So why you get it back is when you do the tax time, the AHE goes, oh, actually, we're taxable on 70. Here's the refund based on the more tax you paid, right?
And that's also like if we take it away from employees to companies, and the news and the papers and all the rest of it love hammering big corporations, you know, generated X amount of $1 billion in revenue, only paid $2.50 in tax, you know, and it's a very similar thing, right? Like they generate X amount of dollars in revenue or profit, but then by the time that they distribute and then obviously write down their profit from your gross profit from what it could be to what it actually ends up being as a net number, there's much less tax payable.
And we tend to forget that, like most companies, like at that sort of, they're gonna push dividends out, which is profit to their shareholders, who then pay tax on that, right? They're gonna push out bigger salaries, which that employee then pays tax on that.
Payroll tax and all the rest of it.
Payroll tax, GST, all the good stuff, right? We love that. So what we want to understand is that debt recycling is transitioning bad debt to good debt, right? To be able to stretch your assessable or your total income before tax further than it would otherwise. We get a lot of people in their investing journey who will pay down their mortgage, because everyone thinks that's the thing you'll do. You pay down your mortgage, and then they'll pay down the mortgage with post-tax dollars, and then they'll take further post-tax dollars in surplus and then invest it. And so what you have, and this is the summary behind the debt recycling, what you have, let's say you've got a $500,000 mortgage, and you pay $100,000 down to that, right? And then you also pay $20,000 into your investment, right? That's all done. That's $120,000. You've probably had to earn 160, 170 to do that, right? Versus if you have put all of that into your mortgage and then take that back out and invest it, your asset position is the same, your debt position is the same, you just have deductible
as opposed to non-deductible.
So exactly. Rather than that 100 grand costing you $6,000 in interest a year, which is then 9,000 of earning, now it's only costing you 6,000 plus it's growing, right? So,
and then also another thing on that as well, we hear it a lot. People will say to us, "Hey Jack, I've got $500,000 worth of equity in my property, and I've got a $500,000 mortgage, and I've got $200,000 in cash. Should I just go use the cash as a deposit for the property?"
Yeah.
And again, you're using earned income a lot of the time, of which you've then paid tax on, to have it sitting there in a savings account to then go put into a property, which is going to be an investment property, to minimize your non-deductible or your deductible debt. And what you should be doing is using that cash to go pay off your non-deductible debt, which is your mortgage or owner-occupier property. So then you decrease your non-deductible debt from 500,000 to 300,000 if you put the whole 200 on. Then you redraw that 200,000 again. So again, you've got the 200,000 in cash, but now you've got a $300,000 non-deductible mortgage and a $200,000 deductible mortgage, of which now you have out as cash because it's an equity release. Then you use that as a deposit and costs on the property. So then you've got 100% debt on the investment that's deductible, and you've minimized your non-deductible debt on your owner-occupier.
100%. And this is part of the planning when buying homes, and like a lot of our clients will come in and they'll buy their first home, which is not their ideal home, it's their first home. And this is why we use offsets a lot, is we want the flexibility, and we don't want to be paying down the debt on something that eventually you want the debt out of. Because one strategy, like I've had friends come to me for years, and don't get me wrong, if you're buying properties and you're doing it non-tax effective, you're probably still going to end up okay. This is just about a strategy to try and enhance that, right? And you get a lot of clients who move into their first home, and what they do is they pay that down rapidly because they don't at that point, they probably don't think they're going to be any more well off and get another one. Then they're ready to upgrade, and they go, oh, wow, we've got this, we're going to rent it out, we're going to get the cash, the income from it, and then we're going to go get this huge debt on the next place, and that's going to help us pay it. Well, when you've done that on the investment, you've still got the same debt ratio you otherwise would, but you're paying more pre-tax on the home, and then you're paying tax on the positive geared income from the rental property. You're backwards by 30%, right? And what's hard is when people have these emotional sense, you're like, realistically, realistically, the priority is we should be holding as many properties as we can long term, right? So priority one, if we've got enough capacities, we draw the equity out, right? We do a cash out equity strategy, knowing that we can only go to 80% though, right? So we draw out the cash out equity status, we use that to get as much minimal debt on the new home and hold the debt on the investment property. Sometimes that's not possible, so then and that's the best way to hold the asset and get the new one, but a lot of time that's not possible. So the next strategy, even with transaction costs, is probably to sell that property. That way you get 100% of the equity that's in it, put it on the new home, and this is where the emotion comes in. Oh, but my house, are we playing emotions or are we playing finance here? Because data-wise, makes sense to sell that place, put all of that equity on the new home, and then draw out the equity and invest off the next home. Exactly
right. And that is also a debt recycling strategy, right? That's probably one of the most common ways people go buy an investment. They go first owner-occupier property or an owner-occupier property, they decrease the debt on that dramatically. Then they go, how good's this? Let's keep our current property as an investment, and now let's go buy a new owner-occupier property. So now what they've done is they bought the property for 500, it's worth $1 million, they got 300,000 worth of debt left on it, and they got 700,000 worth of equity. They pull out the equity from this property for the deposit on their new owner-occupier property, and now they've bought a $2 million owner-occupier property, of which they've put, say, 400,000 of deposit down, and they got a $1.6 million mortgage on the owner-occupier, plus a $400,000 equity release, so they've got 100% debt on the owner-occupier. That is now non-deductible, fully non-deductible, and they've got $300,000 of deductible debt only. So what they should do is sell down their first property, so it's worth $1 million. You've got 300,000 worth of debt, you sell it down, you pay your tax and selling fees and all the rest of it, you net with 600,000 after you pay your mortgage back. You use all of that 600,000 to go buy the $2 million home. Now you've got $1.4 million of debt or thereabouts on your new home and the 600,000 worth of cash in it. Then you can redraw up to 80% of the $2 million, which will give you $200,000 of equity release. Then you use that 200,000 to go buy another investment property.
Yeah,
that's the right strategy, even though you're going to have to pay some selling costs and some extra stamp duty. Again, stamp duty goes into your cost base anyway, so you get a deduction on that when you sell the property in your capital gains tax and your selling costs.
How does the debt recycling work logistically? So we have, let's say someone with no other assets, no other income, no other investment. So we got the non-deductible debt on the home. Instead of paying that down and then investing, we're going to pay all of our surplus into the mortgage. That mortgage comes down X amount. We then we would usually do this quarterly, biannually, or annually, depending on how big the amount is. We would then use a master credit limit, is usually the way. Because just to preface, we would usually do this strategy with shares. You can only do this strategy with property infrequently, because once you get it out, it sort of sits there, right? So if you generally with our clients with the debt recycling strategy, we might go into one property, but that's going to cap out serviceability, etc. That would sit interest only, high debt for as long as possible. We'd continue to pay down the mortgage, and now if the serviceability is not there, which for most of our clients it wouldn't be after 1 or 2 properties, then we'd go into shares. And this is I guess, fundamentally the debt recycling strategies into shares. Reason being, from a risk perspective, as we leverage, we increase risk. With property, like we've said before, we can't sell the lounge room to decrease risk. Whereas shares, we could sell down some to cover interest costs, whatever, if need be, in a bad market or whatever. So fundamentally, we'd pay that down. We'd draw that amount of the loan out, just the exact same amount you paid down.
So you're paying down $1,000 a month off your mortgage on top of your standard repayments, and then you can refinance that back out.
Correct. And I think it's important to note that we would look at this strategy from 70% LVR down. Ideally, we'd start highlighting this strategy at 70% LVR because you can only draw back out to 80, and that's still increasing the risk a little bit with market movement. So we'd ideally go, right, from 70%, we start watching it, and then from 60%, we want to go. And we'd only draw usually 100K or 10% LVR max sort of out, depending on where they're sitting.
Yeah.
And then the surplus goes into paying down the loan. You draw that back out as an investment loan through a credit facility, such as a master credit limit. Used to be like a line of credit, essentially. Chuck that over in the investment. And then what happens is you have the exact same amount of debt, right? We keep the investment only. Otherwise, because you've got to remember that principal repayments on any debt is not tax deductible, just the interest cost. What then happens is just in say, $100,000 scenario, right? You get earnings, and there's a few ways to do this. You get earnings. Now, if you can afford it, it would be better to retain the earnings, right? If you wanted, some people do this with a dividend strategy, so they'll use dividend stocks, which will pay down, go into but then again, you're paying tax on the dividends. So we would, like, I know there's the cost of the loan, which offset it, but it's still, and goes on to your taxable, right? Mm-hmm. So, or into your assessable. So we'd ideally have a growth strategy, if you can afford it, that would continue to grow, and we wouldn't sell the asset down unless needed. And what it would start with is you would then get a tax rebate. Right, and in that instance, on 100K, it might be 3K that year. So now you have $3,000 more to pay on your mortgage. You repeat that process year on year, that 3K becomes 6K, becomes 9K, becomes 12K. It continues, right? And as that gets up, so what happens is you are effectively paying down your mortgage a lot faster. But your debt's still the same, but it's sitting on a deductible asset that's going to help you pay off your debt faster, plus grow your portfolio at the same time. Now, assuming average growth rates over a 10 to 15 year period, by doing this, I guess numbers specific, but over a 10 to 15 year period, we should be able to reduce a 30-year mortgage to zero, have that same level of debt over on the asset with potentially 50% more equity in that investment than we had from the debt position, right? Plus all the equity on the home, but we'd have that 50% equity position. So then you got the choice. You're now debt free on your home. You can either sell down the asset to pay off the investment debt if you want, or you can let it keep riding and do the same thing, keep growing it, and have a passive or have a secondary income stream on top of that and continue to grow from there, right? So people got to remember, it's not about the investment. It's simply the strategy is transitioning bad debt to good debt. Everything else is a positive on top.
And getting the taxation benefits off the back of it.
Yeah, so effectively stretching your gross income further.
So it's very, very similar, like whether we're talking about extra super contributions, for example, to make up your concessional cap, or we're talking about debt recycling or whatever it is, a lot of the time, the main reason we're looking at these strategies is to simply increase our net income position. Like with superannuation, if you're on a high marginal tax rate, let's say circa 40 cents in the dollar, and you just want that dollar in your own pay packet, you got to give the ATO 40 cents of it, see you to get 60.
Yeah.
Where if you put that dollar into superannuation, instead of giving the ATO 40 cents, you're only giving them 15 cents, which you're essentially making 30 cents in the dollar, of which goes into your investment and then compounds. And it's the same with this debt recycling, right? Like if you're then being able to claim back a certain portion of it because it's pre-tax paid as opposed to post-tax paid, you're increasing your net position. And as we know, if you increase your income, whether it's from earning more or just paying less tax, you're going to get further in life.
Yeah, correct. And that like I said, the next to housing, tax is everyone's second biggest expense. And stretching that.
Well, it depends on who you are. It could be drugs, alcohol, women. Like there's a lot of things that it could.
Tax would still be up there. Like, that's a habit and a half. But most people will pay 40 to 40 grand tax minimum a year and moving upwards on that. Like that's a huge expense, and being able to stretch that into being it's literally not even changing the scenario. It's just structuring the flow of money better.
And this isn't I just got excited because I'm very excited. And again, if we think about I talk a lot about trust borrowing and having the right structuring. the same thing, right? Like the main reason outside of asset protection that people use things like family trusts is because when you disperse into a family trust or income goes into a family trust, you have the option to choose where you disperse the income to, which in essence decreases your tax position, right? Because if you have 3 people that you can disperse it to and you've got $100,000 of income and you can put 33,000 or thereabouts of income into each, you're going to pay less tax than $100,000 than if you just want to disperse the whole 100,000 to one person.
100%.
So it's all about a tax minimization and increasing your net income position.
And this is what I say, we talk about leverage and this is a risk. We talk about risk, and leverage increases risk. But it decreases risk in a way too, because the biggest risk is that we all 100% have to pay that tax bill, right? We have to. And so where we go to like a safe leverage position is when we leverage safely. I guess that's a bit of an oxymoron, but when we leverage safely by using a known amount from the tax man, we're actually decreasing some risk anyway, because that's a known number going, right? And if we're still within our serviceability, still within our capacity to afford the repayment on the debt, it's actually decreasing the risk because we're holding an asset while using money that we otherwise would just throw to the wind to help us gain that. So leverage can be a decrease in risk strategy overall when done properly, by you simply using that tax. And then the other part on the debt recycling, you can get, like with companies, you can get really crazy with this stuff and start funneling money up into companies and trusts, and like you can actually flow the debt recycling through that way. Gets a lot more complex, but there's extra ways. The simple debt recycling strategy is just the way that everyone can do it to have the exact same flow of money structured a better way to have more money in their pocket and grow faster.
And everyone wants more cash in their pocket. It's probably the question I'm asked most, which is like, oh, Jack, how do I increase my income? Well, without doing anything, it's just decrease the amount of tax you pay, which will increase your net amount of income.
Yeah, and I think it's important though, like any strategy, this requires serviceability and capacity.
Of course.
So people can't be like, I've got 99% LVR and no money. They
can't be like Jack Henderson and just be like, leverage up, boys, grab it by the horse and just hang on.
Yeah, that's right. But you've got to, so if you're not in the position, you still need to build capacity towards it. But the bottom line is a lot of people will have a mortgage and have investments such as shares or whatever. For those who are paying down the mortgage, putting cash into shares or investments, that makes no sense.
That's right.
Nonsense, right?
Put all the cash down into non-deductible debt, redraw it back out to invest, and then claim the deduction on the 100%.
It's the same outcome, as in it looks the
same.
Same
Super fund, different outcome.
From little things, big things die. So it's the same. It looks the same on paper, just moved around, and is more effective in your bottom line. And why wouldn't we do that,
mate? I'm thinking the same thing. Let's recycle everything, not just paper and cardboard.
We are green. Go green and recycle your debt. But I think then we talk about the assets behind it, like would we do property, would we do shares? Doesn't really matter. The strategy theoretically is made for shares because of the flexibility in being able to sell down, but it's simply taking that equity and putting it into an investment asset and going again. Now with property, once you do it once, you're going to be tied up and capacity and serviceability are going to be affected. So it's going to be a lot less flexible, but there's no problem with doing that 1 or 2 times, maxing out your serviceability capacity, sitting on those, continuing to build that equity and then diversifying into shares off the back of that. We would just most likely do it in shares simply for the flexibility.
Absolutely. And then like we were talking about earlier in the podcast before we wrap up, if that's then generating you an income off the back of it, you can then use that income to decrease your non-deductible debt to keep that flow going.
Correct,
so it's
100%.
like non-deductible debt, you decrease it with your earned income, you then invest your redraw or your equity then into something which is generating an income. That then generates a positive income on top of whatever it's costing you. That then goes down to decrease your non-deductible debt. You then pull that back out and go into, and then it's just this big flow of just
rob Peter,
it's
pay
just
Paul,
cash,
keep it going.
really. Like it's
it's making money. But in summary, for people watching this, if you've got a position where you've got your own home and investments, you need to relook at that situation. If you've got space in your investments or equity in your investments, any investment, cash shares, cash in general, or you've got equity in investment properties, debt recycling fundamentally is trying to take that equity, putting it onto your home loan, which is your non-deductible, and maximizing the deductions on that place.
And just for context as well, we especially property, we talk a lot about offset accounts, $500,000 mortgage, $200,000 in offset account, and you're only paying interest on $300,000 of debt. If you pull out the $200,000 of cash out of the offset account and then increase your in essence, debt level, that's now not deductible because you've pulled out cash. So what you could do, you should get advice on this, is use the cash to pay down, if you need to increase your servicing, to pay down the debt. So then the 500 actually goes to 300, then redraw it back out, or just redraw on the mortgage already if you don't need to use the cash.
100%. That's a really good point, because people will just they'll take 30 grand from the offset and invest it in shares or whatever. You'd be better paying it down, drawing it down, and using the debt to invest. Same position, better tax outcome.
That's it, mate. As always, it's a pleasure, not a chore. All right, folks. Next episode is case studies, and the next one after that is exit strategies. See you then. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDFs beforehand. This is a Henderson podcast production. All right, we're back. Flamingo Property Investing. Jeremy Harper sitting with me today, mate. You look very flash.
Thank you. Thanks.
Is that the same shirt from last week?
No,
borrow Frank's?
I did wash it.
Mate, you're one of the best brokers there is in the game, and a very good dancer as well. We saw you recently at our Henderson party doing the ones and twos.
Yes.
Which was good to see. Mate, what I thought would be an interesting topic to chat through today is you obviously see a lot of different financial situations. You probably see the good, the bad, the ugly, and everything in between. We work on a lot of clients together, and we see what works and what doesn't work, right? And I think the interesting thing about being a mortgage broker or a banker or someone in the finance world is no one can lie about anything because it's all there on their statements, you know?
Yep.
You know, at a face value, you can do a podcast and say you've got, certain things, but when you provide information to someone like yourself, it's there in black and white.
Yep.
So you obviously see how people make a lot of wealth and have built wealth. If you've been working with clients for 5, 10, 15 years or whatever it is, you see that whole journey from, them starting out. I know we've got a lot of younger clients who are just starting, so it's going to be interesting to see where they are in 15 years' time. And you see what works and what doesn't work. So I think that's what we're going to unpack today. We're going to unpack the best things to do when you're starting out, whether you're 20, 30, 40, 50, everyone starts at different times. What you see works best from a building wealth point of view. And then obviously once you've built the wealth, you want to be able to actually maintain and keep the money.
Yes.
And continue to grow. So let's start with the starting out piece. Let's run through that as to, you see young people come to you. What are the things that work and the things that allow people to get into the market? We're speaking about a mutual client who doesn't earn mega money, but he also doesn't have overly large living expenses. He doesn't have a car loan. He doesn't have a HEX debt, and all these things add to him now being in a position to buy his second property at the age of 21 or something like that.
Yep. So I think for me, when I first started my career, learning the concept around sort of active income and passive income, and if you can get your head around that really early on and understand that, okay, when you start your career, first job, first business, your active income is going to be quite low. So your goal is, how do you replace over time that active income with the passive income? So that is getting into property, getting into other assets early as possible, so that when you get to the other end of your career and you want to wind down that active income, you want to sell your business, you want to take a step back from work, not do such large hours, you've got that passive piece to replace that. And that all comes back to compounding, getting as early as possible, starting that journey. So if you think about it, early 20s, you just finished high school, you don't know what you want to do with your career, so you've really got to take a deep breath. I think one of the challenges with some of the younger people they face is everything's thrown at them, right? So it's got to get into uni, got to go overseas, got to get that new car, and so you've got to take a deep breath and say, okay, do I need to go ahead and actually purchase that? Do I need to sign up for that? Do I need to go down that pathway just yet? Or wait a little bit of time to figure these things out?
It's so true, because there's like the pressures of the environments we're in, right? It's like if everyone else, if I talk about my own experience at the moment, it's like, my partner and I, we need to talk about getting married now. We need to talk about having kids because that's what everyone else is doing, you know, and that's how you feel when you come out of high school, right? It's like, well, everyone's going overseas and everyone's going to university. And it's like, just because everyone else is doing it doesn't necessarily mean it's the right thing to do.
Correct. So if you think about university, I mean, I went to university, I took 6 months off, I end up finishing the degree. I think university is great, and people should look at doing that. But quite a lot of people won't even finish that degree. So they'll come out with a HECS debt at the end, or they'll go and do a second degree, or they'll go and do a master's without even actually working that career. So that may all make sense when you're 22, but if you fast forward to, say, in your early 30s, and you're no longer working that career, you've now got a 30, 40, 50, 60, $70,000 HECS debt still to your name, which is going to impact your ability to borrow, ability to save, because you're paying more from your withholding every month on your paychecks going towards that HECS.
Just on that, how much is it? Like, if you have a HECS debt, is it they calculate a certain percentage of your income to pay it down?
Correct. So it is a percentage of your taxable income.
Right.
So it scales up. So, you know, if you start to earn a bit more money, you may be starting to pay sort of 8, 9, 10% of your taxable income that goes towards that.
Pre-tax or after tax?
Pre-tax. But what you're finding now is, with what's happened with the inflation rate, so the indexation on HECS, 7.1% last year, and that's a rolling average of what's happening in inflation.
So it's essentially your interest rate on that.
Correct.
So it's like having a variable rate that rises and decreases with inflation.
And they'll accrue that, or they'll add that onto the HECS balance in June every year. So it's annualized once a year.
I didn't know that.
So you've got to be really...
What a fucked model.
Yeah, you've got to be really mindful that, you know, if you take some time off after your HECS degree, that starts to accumulate in the background.
And is there a this is off topic, but is there a time frame on the HECS debts, or it's just like you pay it off when you pay it off?
Pay it off.
So hypothetically speaking, you're a young woman or a young man. It's 2024. I shouldn't assume. And you have a child, and you have 10 years or 5 years off work, whatever it is. That HECS debt's still there, and then you get
Correct.
back to work. But during that time, you've incurred interest, and that interest is also compounded as well. So you're like not paying anything off it.
Yep.
And your interest now is growing. So your HECS debt, you might have had 5 years of paying it off, but then you have 5 years off work.
Yep.
And all of a sudden your HECS debt's actually larger now than what it was when you started.
Correct. So if you think...
That is interesting.
Yeah, so you think about big picture, and I'm seeing this with, you know, some late 20, early 30 clients where they've all come through uni. They're now earning good income, but the HECS is still there, and they can't get on top of it, or they get on top of it very slowly. So, you know, if you're going to go to university, fantastic. Make sure you finish the degree. Make sure you actually utilize that degree. Think about if you want to do a master's, maybe take some time off between getting into your career to make sure that, hey, I actually want to go and do my master's. I actually want to continue on this career, because that's going to have a huge impact.
For sure. And then just on serviceability piece. So like, you know, like we said, we come out of university or come out of school. The good thing about school is if you went to a private school, often your parents are paying for that and you don't have to think about it, right? But all of a sudden then you go into university and mum and dad say, time for you to be a big boy or big girl or be whatever.
Yep.
What impact does it have on serviceability? And obviously we have a lot of younger clients, right? So when we are working on clients together, often this is a thing that comes up. Hey, there's often 3 scenarios. It's like in your current situation, if you get rid of your credit cards and do X, Y, and Z, and if you delete your HECS debt, get rid of your credit cards and do something else, like there's the 3 different servicing numbers.
Correct.
So what impact usually does like HECS have on servicing, roughly?
Yeah, so again, it works out to be, you know, if someone's on sort of 90, 100,000, that could be $500-$600 deemed repayment per month on the calculator. So that can have quite a significant, so it works, the higher your income, the greater the reduction
impact
on your borrowing capacity.
Fascinating.
So for some people, if they've got a small balance outstanding, it may be better to pay that out.
That's right. And I was just going to say that.
And then particularly if it's an investment loan, increase your deductible borrowings that you can claim on your tax, because the HECS is obviously non-deductible.
That's a TikTok video getting made just after this. First home buyers.
Yep.
Earning less than 125, is it in New South Wales?
Yep.
First home buyer incentives. Those people have got 60, 70 grand saved. They only need to use 30 or 40 of that. Often it's probably best to use the remainder of that cash to decrease your HECS to 0, which will then increase your serviceability.
Yeah, but also then they go and update payroll, less is withheld off their pay slip every fortnight or month. So they're getting more money in their back pocket.
You're getting a higher net pay.
Correct.
Plus,
Correct.
Okay. That's fascinating. So this is the things that are probably a few pitfalls that people maybe don't think about. Like, oh yeah, I'll just go to university. If I don't like it,
I'll go do another degree.
Yeah, and because they're not feeling like they're paying for it up front, it doesn't actually matter because out of mind, out of sight, right?
Yeah.
Or out of sight, out of mind, whatever the fuck it is. It's one of the two. Okay, so that's the first one. Really think about whether this education you are about to go down is going to be advantageous or whether it's not going to be advantageous to your long-term career growth.
Correct. And then the other things are things like, you know, be really mindful around, okay, I'm 21, I can go get a credit card. Do you need that? No, you don't. Car loans. avoid, you know, buying cars in cash, because again, these sort of things will start to follow you into your late 20s, and that's going to start to impact your ability to start getting to that property.
And let's talk about the credit card thing as well, because again, misconception, I heard it so much when I was coming out of, you know, school. I was quite young, obviously, into the workforce. Get a credit card, Jack, because that'll be good for your credit rating. You heard that once or twice in your life?
Yeah.
Was that a slogan designed by the banks?
Yep. So that's very much an American system. We are starting to become more around the American system around how we report our credit
Like comprehensive
history.
credit reporting.
Correct.
Right? Yeah.
But at the end of the day is you just need to have, you know, maybe a phone bill that will go onto your credit file.
Yeah.
Start to
So thinking that you need to get a credit card because it's going to be good for your credit rating or credit history or whatever you want to call it, which will then be positive for when you buy a home, is absolute BS.
correct. I mean, a bank is going to look at someone who's 23, 24 and say, you're young, this may be your first bit of credit that you're applying for.
And they
they
get that,
understand that. It's
Yeah,
not,
see, I was
it's not the
18
end of
years
the world.
old rolling around with an Amex in my wallet like I was a big dog. Didn't need it. All right, so that's something else to think about, is like make sure you're not getting yourself in unneeded personal debt early in life.
Yep.
Again, because of the society pressures or society norms, right?
Correct. And then as you go through your 20s, everyone wants to go to Europe. Okay, maybe that could be a once off, maybe bootstrap it,
I did the Europe trip.
set yourself a bit of a budget, but you know, don't make that something that you want to do once or twice a year, because you don't have the finances or the funding to actually support that. You know, I've seen people go and take a personal loan to then fund that European trip.
I would say that is the vast majority of people.
Right. So that's horrible
Like,
financial
if
kind of decisions.
you're early to mid 20s, I don't know how much people earn, you know, but I would say most are earning between 80 and 120, give or take, you know, some less, some a little bit more. You're usually paying rent because you're living at a home with your friends, which I think is good for life experience, not so good for the financial side.
Yep.
You're not saving. And to go to Europe, basic Europe trip, flights, maybe a Kentucky or something like that, you're living like a bit of a pleb over there, like with food and drinking. It's 15, 20 grand. Like, there's no change out of that. And most people aren't having that sort of cash sitting in their bank, right? Because everyone's like, oh, it's so hard to save.
Yeah.
So I reckon most people are the personal loan or paying for it on the credit card.
Yeah. So once you take, so if someone comes to me and they're 28 and they've got a little bit of a HEX, that's fine because they're working their career, so they're getting a return on that. Maybe they've got a car loan. Again, that might be okay because if they use the car for work and that is an asset.
But often you don't need...
But you don't need that fancy
Yeah.
car. But if they've got a car loan, personal loan, a credit card, there's not much at that point. There's not much a broker.
And let's talk about it. So they're three things that you don't need, right? And I'm thinking about two clients we're working with together. One a young couple. I actually went to school with one of them. And another young single guy. Neither of those two have either of those things.
Correct.
And they're both onto their second properties.
Correct.
They've both been career focused.
Yep.
I don't believe either of them have HEX debt.
No, I don't think so. No.
So there we go. Great example. Both of those, you know, guys, girls crushing it in the
Yep.
start of their life, both onto their second assets, and neither of them have those, three things.
Yep.
Which is keep that top of mind, listeners, because when we get to the other end, you're going to see the impact it has when you don't do these things. When we start talking about building wealth and then keeping your wealth.
Correct. And I mean, I look back when I was young. I was driving a Corolla with half the door would fall out when I get down the highway. But you know, that was just that's the stage of life that you're going through.
Exactly. I can't talk on cars though, because I am a little bit of an overspender when it comes to vehicles.
And then on that, so as you're going through your 20s, I call it and this is probably more for sort of the male audience, but you know, the three-headed hydra, right? So it's
The three-headed hydra.
so Greek mythology.
That's
So
very stoic.
alcohol, number one,
Oh yeah.
gambling, number two, and
Haven't been a gambler, but
and recreational drugs.
can appreciate it. And yes, I can appreciate that as well.
I've seen that. Well, I've seen a combination or individually those three wipe out someone's finances completely. You know, destroys their relationships
Oh,
to
mate.
the extreme. But for the everyday person that goes down to the pub on a Friday night, pulls out a couple of hundred to play on the
Slaps
pokies.
the pokes. Yeah.
You know, alcohol and then gets on something later in the night. That's just going to destroy their savings plan.
Yeah, and it's gonna push them back further and further and further because you feel like you're in a hole, right? Like I can't get out of this hole, and often the reason is because of actions. It's so true. Alcohol, you know, those three things usually don't happen with the first one being alcohol. If you can limit
Yep.
your consumption of alcohol, that will then limit your want or need to go out, because when you go out, you drink. When you drink, you usually gamble or do substance, and that leads to all the other bad stuff.
Yep.
Very, very true. Because even that, like, you think about it, going out, I mean, I don't go out that often, but I remember when I was younger, you would spend easily $150 to $200 on drinks.
Yep.
Easily. And that's not even that much, right? Like, what are you paying now? $8 to $12 for a vodka soda or something?
Oh, I think
15 to 20 for like a vodka Red Bull, maybe more.
Yep.
So what's that? 10 drinks, 15 drinks. Most people are drinking that on a night out from like a 6 p.m. to a 4 a.m. That then goes into, so you spent $200 or $300 on drinks, $200 or $300 on whatever goes in your body. Gambling. No one's putting 10 in a pokey.
No.
It's usually either yellow or a green note.
Yeah.
See, before you know it, you're $800-900 in the hole.
Yep.
And that, for most people, could be 80 to 90% of their weekly wage, plus rent, plus your car payment. And all of a sudden now, that's when you're slapping your credit card at the end of the week, because you've overspent dramatically in the want or the maybe, well, what's the word I'm looking for? Maybe the privilege of being young, you know, in quotation marks.
Yeah, yeah. And that goes back to that sort of that lifestyle arbitrage, and going back to the example of the client before, where as your income starts to increase and your career, you start to work really hard, you try and maintain that lifestyle. So just try and be a bit more frugal. You don't have to be, you know, completely count your pennies, but and maybe have your hobbies that you're going to spend a bit of money on. Maybe you love your gym, so you're going to go to this great gym, personal training, that's all fantastic. But then just be a bit more frugal and thoughtful about where your money's going and other items throughout the week. And if you can maintain that over a long period of time, that's how you start to save that first deposit, and then you start to get yourself on that journey.
Agreed. And like we talk about Nick, you know, who works in our office, I always talk about he's the number one saver in the world. I've never seen someone who saves more money than him. Yeah. And he's a prime example of that, right? Like, he doesn't have a fancy car, but he owns it. Doesn't live a fancy lifestyle, but he lives within his means. And his savings ability, from my understanding, is like 70% of his income. Yeah. You know, but he doesn't pretend to be someone he's not.
Correct.
All right. So that is the things that we want to avoid. They're the pitfalls, right? Because you start off in life, like you said, you've got the society norms. University is something that you think you have to do, even if you're not 100% certain on the career path. So probably take a breath and maybe don't get into that $40,000, $50,000, $60,000 worth of HECS debt, because that can have a dramatic impact. Like, on average, this may not be like an Australia-wide, but from your clients or the people that you see, how long does it take to pay off a HECS if you're
that's the thing,
an average person?
Because the cost of doing a course has skyrocketed over the last sort of 10 years.
Right.
So people used to finish maybe with a $30,000, $40,000 HECS. That's now $60,000, $70,000. So I was seeing a lot of people would sort of finish paying off their HECS late 20s, early 30s. That's now been pushed out to sort of mid 30s, late 30s, probably even the 40s for some people.
People who do those like multiple degrees, right? Especially if they're not working until very late. Like, we get a lot of clients who are in the medical field. Yeah. And like, I've got, one client I'm thinking of who be like mid to late 30s now, 2 children, and like just finishing the studies to to be like in the top of their field, and their income will come off the back of that. But I can imagine they ain't paying cash for that education, right?
Yeah, correct. So yeah, that's and the longer that carries on, the more impact that's going to have on their individual budget and obviously their ability to borrow as well.
Let's talk about the renting versus buying thing, because I know I never moved out of home until I owned a property, and I obviously started working when I was young, being 15 years old. Yeah. But when I moved out of home, I rented in a share house. I think my rent was $150 to $200 a week, give or take. But my thinking around it was, this is actually not dead money, because I own an asset right now. I owned multiple assets at that time, but it was already growing in value. So even though I was paying rent, the growth of those assets was well and truly outweighing what I was paying in rent. So I didn't feel bad about it. But I think a lot of people move out of home earlier than they need to. They use the excuse of, I don't want to live at home with mum and dad anymore. It's not cool, blah, blah, blah. Yeah. And then they get into that rent cycle, and all of a sudden, and then they live by themselves, or they just live with one friend, and all of a sudden it costs them an arm and a leg. What do you see with that, like the renting versus buying thing, and how many people get out of home, rent, and then often go, fuck, it's been 8 years now and I'm still renting. I need them. A lot of people move back home to save the deposit.
Correct.
Like my brother was one of those people. He moved out with his partner. They were together for ages, and then like eventually the reality sets in. Like, we want to start a family. We don't want to be renters when we start the family. But all of our income's going. So the only way we're going to be able to do that is minimize those expenses, and that they move back home 1 year, save the deposit, and then bought the home.
Yeah, definitely. And this is going back to that, if you've got the ability to live at home and potentially get into that first property, or maybe move into that property as a first time buyer, and then down the line rent that out, definitely I'd be taking advantage of that. I mean, we're in Sydney, so it's such a transient city. There's a lot of people that come from the UK, Ireland, wherever, that don't have the ability to live with mum and dad. So they come here, they start to rent, and then I do see with those type of clients, they need, they're starting their own family, they can't be in a share house, they need their own space.
Yeah.
So then it does become a question of, oh, I can pay this rent, or I can go and buy something. Yes, it's going to cost us more, but to get off that rent train, because they don't have any other assets.
Exactly. Yeah. So essentially, in short, if you get on, you become a renter, there's nothing wrong with being a renter at all. I'm a renter myself now. But you always want to be thinking like your surplus cash needs to be going somewhere. You can't just be a renter and not build an asset base, because as we now start getting into the building wealth topic of this or the building wealth section of this podcast, you're then going to see that it takes a very, very long time to build wealth if you've done all of these things, which are the pitfalls, and then try and start late in your life, which you see constantly, right?
Yeah, correct. And, I think getting to that next phase, people then wake up one day and say, well, hang on, I'm earning really good money now. And right now we're in this sort of, this pressure point as a Australian household economy, not necessarily the overall economy, but for households, right? It's a pressure point where there are people earning really good income. They're going, hang on, like, where's that money going?
That's Jack Henderson.
But we're paying historically high taxes on an individual level. And then also you've got inflation on top of that. And then you've got high, housing costs, either rent or mortgage. So it is very hard right now for people to sort of hold on to some of that income that they're actually earning.
Yeah, of course. And then they've got the need to wear Gucci and, go out and all the rest of it.
Yeah.
Like that's, if you're frugal, you can still save money. But,
Definitely.
It's not just the cost of living, it's the cost of optional living.
Correct.
Because you choose to do a lot of the things that you do, right?
Correct.
So let's talk about that. So as you're going through your late teens, mid to late 20s, people in their early 30s, they're the major pitfalls that will catch up with you, even though they may not be, somewhat, I guess, noticeable at the time. HEC step, for example, you get that and it feels like nothing changes in your life.
Yep.
Renting, for example, doesn't really feel like it's a big deal. Getting the car loan, oh yeah, it's only $100 a week or $150 a week. All those bits and bobs that at the point in time don't feel like much. Then you start to get into a point in your life where you then start thinking about, all right, well, like you said, earning good money, maybe you want to start a family or really give this thing called life a go.
Yep.
Then we get into the building wealth side, and you're so far behind the people who just made a few, not even big decisions, but a few decisions that were somewhat calculated. Like look at these young clients that we've just been mentioning. They're in their 20s. You fast forward 10 years, they're in a significantly better position than someone who's done all of those things that we've just mentioned and wants to get started.
Yeah.
Because they've got no capital behind them.
Correct.
Yeah.
And you start to really, you go on this accelerated pathway, and I guess people right now, we're sort of being taught to think in the moment. So what's my rent today versus what's the mortgage? So we put together an example, like you look at, say, Waterloo,
let's get the example up.
Waterloo, $3K from the CBD.
Yep.
The median rent, I think, was about $3,400 a month.
2-bedroom apartment, 3 kilometres from Sydney. Median rent's $880 a week, which is $3,800 a month or thereabouts.
Now, to take out a mortgage, I think we said for about $980 was the median.
So median value is $955, and 80% loan on that, which takes into account you've saved some cash and you're putting down cash as a deposit of 20%. You got a loan of $764 at a 6.15% rate. You're paying $4,655 in repayments. That's P&I.
Yep.
Plus you got $500 a month in holding costs. For example, your strata and all the rest of it.
Yep. So there's about a 35% difference between.
That's right. So you've got $5,200 per month for P&I plus your holding costs, in comparison to the $3,800. So you're like you said, 35% cash flow difference.
Correct. And I think the key, what I'm trying to get to there is, we're all taught, if you listen to the media, what's rent, what's the mortgage, oh, I'm better off renting. Okay, well, if you're thinking in the moment, but this is where people's mindset starts to separate a little bit. If someone says, okay, well, maybe I'll live in this, pay the P&I, and then I'll rent out in the future, or hold on to it. Yes, there's going to be a cash flow difference that you have to come up with between the two scenarios. And that means more money out of your back pocket, less spending on dinners, etc. But what does that look like in a couple of years' time? You've now got equity into a property.
That's right.
assuming the property
I
holds
mean,
its
if you bought an
value.
apartment in Waterloo, you probably would be behind the eight ball. But if we use a good location, a Henderson Advocacy approved location.
Yeah. So assume it's held its value, or it's grown a little bit.
Yeah.
You're building equity into that. So in 3-4 years time, we can go back and draw that out. That renter, if they haven't made the equivalent investment over that time, they're now behind the eight ball, and that's
Yeah,
where
that's
you
right.
start to see that sort of different.
And then often
pathway.
that surplus cash flow, which is cheaper to rent than own,
Yeah.
is wasted anyway.
Correct.
It's lifestyle.
And that's where you start to go like this. It's a completely different scenario and outcome between the two sort of households.
For sure. And let's go into that now. So you're seeing those two households now, right? You're seeing the people who started in their 20s and are now in their 30s and come to you.
Yep.
And you're also seeing the people who didn't do that in their 20s and are now in their 30s and are just starting.
Yep.
So what does that look like? Like, obviously, the difference is the guys who started in their 20s or their late teens, whatever it was, they understand leverage, they understand finance, they've been through it before, they understand owning a property potentially or investing in other asset classes in comparison to someone who hasn't
Yep.
and is then just learning everything.
Correct. And I think, it's having that long-term mindset around, okay, what's your 5-year goal here and your 10-year goal, and seeing how we can use over that time the leverage of the existing properties to get into the next one to help build that portfolio. And this is where you start to the clients start to build on their knowledge. So I think having really good accountant in their toolbox to call up, educate them to say, okay, this is what we want to do. Great, how do we get there?
Potentially someone from Atlas Wealth.
Correct. So, someone who we want to use. Okay, what entity do we want to buy the property in? How do we want to add value as doing a renovation, getting that uplift? Can we get a dual source of rental income on that property to help with your cash flow? And that's where you start to think a bit more long term, and maybe even sitting down and say, okay, well, that's our goal. We need to now go and save an extra 30,000 of ourselves, plus we'll tap in the equity from a refi, get some equity out, combine that for the next property, and it gives someone that sort of that plan in the short and long term.
And I also think another thing on top of that, it's like, even if you only just make the one good decision, right, which is just buy a property early or invest early. The difference between just buying a property early and investing into, say, another asset class like shares, for example, just buying a property only needs the one cash injection, which is like if you're a first home buyer in 2024, your 5% deposit, you go in, bang, you've got something. You've got a full savings account, you've got to meet a mortgage every month.
Yep.
But you don't necessarily need to then save more money to inject, right? Where if you're investing in equities or investing in a share portfolio, it's consistent contributions, which is what people really struggle with, is consistency and making sure they're strict.
Yep.
So the good thing about property is if you only buy one property, let's say you do it when you're 20, and then you go do all this other shit, you get a HEX debt, you go traveling to Europe, you get the car loan and all the rest of it, you could have $1,000 in the bank when you turn 35 years old, but just because you've been forced every week to have the $200 or $300 a week coming out of your pay packet to go into the mortgage, and if you bought a good property, you've held it for 10 or 15 years, you all of a sudden now are in just like the incredible financial position because you've made mostly negative financial decisions, but you made one decent decision and that property now has gone from 500 to 900 or 1.2 or 1.3 or whatever it is. You've paid down some of the debt, so the $500,000 debt now might only be $350, and all of a sudden you're sitting on $800,000 or $900,000 worth of equity, which is like your nest egg to start your family, to go and have the options, right? And like you say, like to leverage off of to go and do the good stuff.
Correct.
And have you seen that a lot? Like people who, you work with a lot of expats, right? So maybe someone who at the start of their life, started their career when they bought the property and then they got the travel bug, they split up with the partner and then wanted to go live in another country and all of a sudden they do full circle, come back to Australia, they've wasted all their money overseas because they've been on really good tax-free income. But now they come home and they've just got this asset that's been sitting there for
Correct.
X
And they
amount
can
of
leverage
years.
that again
Yeah.
to either, buy another place to live in or move back in and then leverage that to buy further property, or even if they want to, take out some funds to invest back into the share market or
into
other
a
assets
business,
or in their business.
That was the
Correct.
thing that helped me when I started the business was this wasn't like I needed to plan, okay, I got to save for 3 years, make sure I'm really tight. It was like I had a property or 2 or 3 properties. The market had moved. All I had to do was show income from the mines that I went back to the bank with and said, hey, can I get some equity out? That equity then become my cash buffer, still held the properties, jumped out of the mines, didn't need to worry about an income. All of a sudden I had a safety net. My worst case scenario was I ran out of buffer, I went back into the mines, I got a job, continued servicing the mortgages. Best case scenario was where we are right now.
Correct.
Which is the option property gave you.
Yes,
right?
correct. And so a good point about cash flow. I think, in this segment, cash is king. So you've got to have a cash buffer. Have some funds in the offset account, because during this stage of your life, things will get a bit tight in terms of your monthly cash flow. There may be months where you've got negative cash flow. That's okay. But if you've got nothing in the bank, things can get a bit squirrely right there. But if you've got a bit of a cash buffer for those months or that 6-month period, if you think about it, you've got, maybe someone goes on paternity leave, right? So you go down to one income. Maybe there's an illness. Maybe there's a job loss. Maybe there's a change in career. Maybe you go back to study, start your business slows down. There's all sorts of variations there where you may be earning really good money. That comes down for a period.
And then I think also, sorry to butt in, but also other things that like are more negative, right? Like how many people go through a breakup late in their 20s, early in their 30s, and they go, fuck it, I'm going overseas for 6 months. Like that is a common thing, right?
Yep.
Or life doesn't turn out the way they thought it was. Or in the tech sector, for example, over the last X amount of years, or recruitment in the tech sector, you're on big money all of a sudden, gone. Like you lose your job.
Yep.
And they're hard to replace, so I think it's right. Like having cash buffers is incredibly important.
And so that's another fork in the road. Some people may just throw their hands up there and say, too hard, I'm going to sell a property, and that's where potentially they could cut their teeth on some potential profits. Or they say, actually, no, I've got some cash here. I'm comfortable. I've done my budget. Even with this decrease in income, I'm okay for the next 6 months. And then I can find another way to pick up some additional income during that period. And I think that can hold people steadfast into long term. And again, that's where you might go from someone that's maybe got 1 or 2 properties, they sell one, they're back to 1 or 0, to someone that in 12 months time goes from 2 properties to 3 to 4. And that's a big difference right there.
Mega difference. You obviously know Frankie from our team. He was one of the people who was frugal with the money, didn't live above his means, all the rest of it. Had two or three properties with his first partner, wife, whatever you want to call her. Went through the divorce, split up. If you didn't have anything, most people get sunk by that, right? Because even if you've got no assets, you split whatever you have, which is usually superannuation, cash, all the rest of it. Generalizing, but usually there's one party that gets more than the other. But with Frankie's scenario, he had 3 properties or 2 properties, split up, sweet. Frankie had a decent income, was able to get some equity out to pay out the partner. So, the partner went off and did what they did. Frankie still held all the properties, was a little bit tight from a cash flow point of view.
Yep.
But all of a sudden, you get some really good growth in the marketplace. Yeah. He lived a single life for a few years. And that then, again, was you look at a stock market, right? Or any graph, and it's like up and down, and you have your little dips. There was a difference between going like that and having a massive dip down to 0, as opposed to just a little bump in the road and then shooting up again.
And that's such a good point, right? If you can never replace those potential equity growth on a couple of properties with your wage. So as you said, if you sold them and you've missed that opportunity, you've missed that huge wealth generation right there.
That's right, because you have the option, when the worst happens, to hold, like to retain, as long as you've got serviceability and all these other little variables. But you have the option to go, okay, sweet, we had a relationship breakup, or I lost my job, or I could do all these other things. Like, what are the little things that I can leverage off now? To maybe take me back 1 or 2 years, but not 5 to 10 years.
And that goes back to the cash flow and having that long-term understanding what's happening in the market, broadly speaking. So if you're sitting here and you go, things are feeling a bit tight, I'm a household, I've got a couple of young kids, I've got a mortgage, it's feeling a bit tight, you just got to think long-term. July, tax cuts are coming through, so everyone's going to get a bit of relief there. Doesn't matter what your income is, there'll be something there. So you have a bit more money coming in every month from that. Rates may look to even out, which they have. Maybe this is the top, I can't speculate, but perhaps there might be a rate cut late in the year.
In the not too different,
so then you think, right? Okay, what does that look like on a monthly point of view between a potential rate cut, potential tax cut coming through? That gives you a bit more relief in the next sort of 12 months.
Yeah, exactly. It's not getting caught up and being reactive in the short term.
Yeah.
And that's when we get into this building wealth phase, again, you could have done everything right in your 20s. And when we say right, like right from a wealth creation point of view, doesn't necessarily mean right. There'll be people commenting on these little clips going, oh yeah, but you didn't experience anything and you could be dead tomorrow and fucking blah, 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 blah. Like, I get that shit all the time.
Yep.
Which is true, you could be, but you also may not be too. Like, you have a much higher probability of living to 90 than you do of dying at 22.
Yep.
So, you do everything right, but then you get to the building wealth stage, you're just starting to get some momentum, but then you don't have the right cash buffers in place, or you make reactive decisions because you've overextended yourself, or you've done things that you maybe shouldn't have done, and all of a sudden all that hard work that you've put in now starts to unravel, right? And we've seen it with not only clients, but a lot of people out there in the marketplace where it's like rates are going up, oh, we're going to sell now, being reactive, not forward thinking and going, rates were at 2% only 24 months ago? We had $300,000 or $400,000 worth of equity in our property. We didn't access the equity. Now servicing's completely decreased. Rates are now 6.5%. Bank won't give us the equity. So you now can't go and get that buffer out to put in an offset account to give you 12, 24, 36 months worth of cash flow buffer, and you don't have to worry.
Correct.
Learning from the experience of others, but I bet you right now, because that would happen to a lot of people. We've got the investment property, we've got the owner-occupier, I've got heaps of equity, and I see it on my comments all the time, but rates are too high now, we can't service. 24 months ago, rates weren't high though. Everyone knew rates were going up, like it was constantly in the media, even though Philip Lowe said it was meant to be further down the track. It was still coming, and people didn't forward plan. They didn't go, let's go refinance out some of that equity. Let's go and make sure we've got some cash buffers there. And now they're being reactive, and you have to sell down a property in a down marketplace, pay the capital gains tax, and all the other shit that comes with it. You might actually net out nothing. It doesn't help your situation. Whereas if you can ride through these, times, you look 6-12 months down the track, rates do start to come down a little bit. Optimism comes back into the marketplace. The market rallies by 10%. Credit opens up with the lenders all of a sudden. No longer a 3% buffer rate, might be a 1% buffer rate or whatever it is. And all of a sudden you're back in the game. Bang, bang. And you can all of a sudden make these huge leaps. But if you had to sell during that time, or you had to take 2 steps back, you can't just all of a sudden then take those massive leaps when the marketplace recovers, right?
Correct. And coming down to the lending piece, there's, looking at working with a broker, there's multiple banks outside the big banks that are more solution focused. Yes, there's going to be a higher rate. There's going to be fees involved, but is that going to get you what you need in the short term? And then, as you said, you could look to refi out or exit that product into the future once it's served its purpose.
And this is all the learning thing, right? Like you do this in your 20s, you learn all these little bits and bobs, and then you get to your 30s and shit happens, and all of a sudden you're like, oh yeah, I can do this, or I can plan for that.
Yep, correct.
Another one as well, which is just another, a good example from a friend I spoke to recently. Same thing. We worked in construction together. He had a partner at the time. Went and bought their first home out in northwest Sydney in one of the house and land estates. Anyway, built it, did really well, split up with the partner, bought it out. He started a business. Business was going great guns. Few things changed, and that business didn't do as well, and he's now having to liquidate the business. Now, if he still has the property, and he's able now to not go to a major lender because his servicing's cooked, but he's been able to go to a second tier lender or non-bank like a Resimac, for example, cash out some equity from that property to now pay out some of his debts to liquidate that company. And instead of him now having to go bankrupt, he's been able to leverage off a property, get rid of some debts, liquidate a company, made a mistake, off to the races again. But he's now still got the property with that foundational piece to go. And then again, market rallies 10%, starts a new business, does a really strong year, first 12 months, and all of a sudden you're back in the game.
Yeah.
So that's just another great example of like how just that was only one good decision he made. Save for 1 year and buy a house as opposed to go to Europe or do whatever.
Go Europe, get the new car.
Yeah, it's like that sort of shit. Okay, moving forward. We've spoken about delayed gratification. Obviously, this is all these things like delay their Europe trip, not forever, just for 1 or 2 years. Just like get your foundational piece set and then do all of those things, which is what I did. I did the 18 years old, bought a property, 20 or 21, bought the second one, then did the Dubai and Europe trip, had the 2 properties, spent too much money on the trips, hired the Lambos, did all the business class flights and all the rest of it. But I wasn't spending my whole net worth because the properties were growing faster than the money that I was spending. Even though I was spending my cash, and I was probably cash poor at the time, the equity from those properties was growing at 5, 7, 10% per annum. So delaying it, get the foundation, then do those things.
Yes.
Love it. One thing we've got on our little list here is like the analytical thinker, and like someone who, looks at a scenario, maybe takes a little bit longer to make the decision, but weighs up pros and cons of each thing. And then once they've made the decision, they're all in.
Such a good point. It's so common with just successful people. It doesn't have to be in property. It can be in their career, just in life. They will you'll present the information, they'll understand it, they'll have their list of questions to come back to you, they'll digest all that, and they'll go away, as you said, it may be for a period of time, but once that may be a no, but if it's a yes, they're in, they execute. So they go, yes, we're going to go and get this property, this is the brief, and off they go. They don't get clouded by what they read in the media, log on to news.com.au, this is what it's saying, rates are doing this, property's doing this. Whereas the people that get sort of caught up in what's going on externally, they get that analysis paralysis. They can't make a decision. They sit on their hands. It's too hard. And then that just gets put to the back burner and they move on.
5 years down the track, they're still sitting there. So I think it's two pieces to that. It's like being analytical and assessing the scenario for what it is, but then also being an action taker and execution, right? And that's what you listen to all the greatest entrepreneurs in the world, and it's like ideas are everything, right? How many people said they had the idea for Facebook? How many people said they had the idea for Uber? How many people said they had the idea for all these mega companies?
Yeah.
One person had the idea and executed on it. And obviously they're the people who reap the rewards. And something with this as well is like, often when we're going along this journey, and I'm thinking about a client that we helped, there's things that'll get in the way, there's roadblocks, and there's things that are very easy to knock you off track. And then for you just to go, oh no, let's put this on the back burner and worry about it later. But often later never comes because you put it on the back burner, life gets in the way and you keep going. So I remember we had this client, like we were on a property, found it, all the DD was done, ready to purchase. And his partner, they were buying it together, his partner got made redundant, like given the notice. And all of a sudden, like that, he was, it was a very nervous time. And they're like, no, let's stop this. Let's get into a new role. Like, let's get my partner into a new role, and then we'll revisit it. And I had to be like, no, let's not do that. How long is it? Like, what's the worst case scenario it's going to take your partner to get into a new role? Even if she had to choose a job she didn't want to do, 3 months.
Yep.
Like we're in Australia here. If you're half decent, you have a resume, you walk into someone, you're going to get a job straight away. So I said, you got 3 months to get a new job. Let's go a longer settlement so you don't have to worry about holding costs for 3 months. So you got 3 months to not worry about holding costs and get a new job. But let's hypothetically say we don't do that. We cancel this property, push that to the back burner. Christmas comes around, you get a new job, you get into the new year, and all of a sudden it's like, oh yeah, but look, rates are a bit uneasy. 12, 24, 36 months go by, you never do it. You do end up then, because and this often happens, when you don't do something, you're disappointed in yourself. Often then you will go and try and buy yourself a bit of happiness. You go, oh, we didn't buy the property, so let's do the trip this year. Or let's buy the car. All these things that are not good. Because you don't do something, you go and do that. Often you see it with relationship breakups. They save the deposit or something, and then all of a sudden they don't do it, and then all of a sudden all that money they saved goes onto something to fill that hole for a little period of time. But anyway, we did it. I said, if I was in your shoes, this is what I would do, because I see this time and time again where you put it on the back burner and you never do it. I said, yeah, we agree, let's do it. I said, worst case scenario, I'll buy the property off you, everything will be okay. So they did it, bang, straight away, got the new gig and settled on the property, and we're off to the races. And now, because they did that 12 months ago, the market moved 10% or something. So that one decision made them 90 grand or something in equity growth.
Correct.
So that's the analytical and the action taker. And, you then do the compounding effects of that decision, and it's significantly greater.
And I think it goes back to the accountant, having just good people around you hold you accountable, right? Other
That's the biggest thing. It's accountability. I think the thing with all professions is like they have the role to play, but if someone actually wants you to win, like I know for myself, when I'm getting up in the morning to go training, if it's just me getting myself up, it's very easy to go, fuck, it's raining, I'll train this afternoon, or I can't be bothered, or I'm a little bit tired this morning. You give yourself excuses. But if I know I'm going with someone, or someone's going to be at my front door at 5:15 in the morning to go running, you don't think those things, because there's that person there that keeps you accountable, right?
Correct.
And it's the same in wealth and telling people your goals who will then keep you accountable. Their service is great, but it's the knowing that someone's going to be like, hey man, how you going with your goals? Hey, you said you were going to do this and you're not doing it. So that's the important parts of your team. So that's the building wealth piece as well, which is delayed gratification, building a foundation early, which gives you the options down the track. Obviously understanding leverage and the power that can have, and the options it can give you in life, whether your business goes bad, like I just mentioned with that guy, and you can leverage off the property, or whether it's you want to get into a business, you need some working capital, or whether it's, You got the wedding coming up, you know, you could potentially use a bit of equity for the wedding or whatever it is. You've got options, but if you don't do those things early, you don't have the options. Making sure your living expenses don't increase with your income increase, because when you go from like your 20s to your 30s and your 30s to your 40s, your 30s to your 40s is your biggest income growth, generally speaking, right? Because you build 10 years of your career, you get into that management or the middle management or the CEO role, and then your income skyrockets.
Yeah,
And you would see that, right?
definitely. I mean, and it's interesting when clients have kids, you know, the mum normally goes into what you call the nesting phase, so they'll get the house ready for the children. But then I think the dad kind of goes into this delayed gratification phase of really going back to their bare bones in terms of their lifestyle, because it's all about the kids. Kids can be expensive, you know, you got childcare, you got all those expenses. But what I do see is that the dads that are still working hard, they're very, as you said, they're starting to get that J curve in terms of their income, fantastic, but they're starting to really just strip back on their expenses, so they're weak. And I see this in Sydney all the time. You go to the park on a Sunday and a dad that's incredibly successful, got a couple of kids, and that's their Sunday. So, you know, you got someone who's 35 earning really, really good money, and that's what they're doing on a Sunday, versus someone in their 20s, they're trying to, you know, tour around Europe on borrowed money. So it's very interesting, that mindset change.
The shift.
Yeah.
That's right. Yeah. And then let's then push the time frame out again. We've gone from our mid 30s to 40s, and then you're maybe looking at clients now that are in late 40s, mid 50s, early 60s, whatever it is. And it's about the keeping the wealth piece. They've built it, and now it's about enjoying it, doing whatever you want to do. So what do you see with those particular clients, and what have they done to keep the wealth, and what are they then doing to get to a stage where they don't necessarily need to trade their time for money or be pushing hard in their career?
Yeah, so I think a key is they've got a really good tax structure in place for the whole family, and they understand, you know, there's obviously you can do things, set up your tax affairs legally in a way that's going to minimize the tax that you need to pay in a legal fashion, and they're utilizing what's available to them. So that goes back to, you know, accountant, good structure, good education, so they know, because what a lot of people start to learn is once you make a decision or put something in place, it's very hard to unwind that. So it's about having that knowledge before you know, making sure you buy that in the right entity, maybe it's in the right person's name.
And this was the piece I was talking about when I said remember this later in the podcast. The same decisions that take a long time to undo if you make the wrong decisions is the same as like a HEX debt.
Correct.
Getting a $30,000, $50,000, $70,000 HEX debt can take a long time to undo if it's the wrong decision.
Correct.
And you're talking now about people who have really built significant wealth and are at the stage where they can enjoy it. It's because they've made the right decisions that over the long term have compounded positively.
Correct. And then it's just being smart. So you may get into that position. Again, it comes down to lifestyle and what they want to achieve, but you may have a property portfolio and some other assets that are yielding income, and it's how are you going to reinvest that income? Is it to pay down the non-deductible debt in sort of like a debt recycling fashion and really accelerate your income plus the other streams to get that down, and then all of a sudden the debt in your portfolio is all deductible? Great. But then also thinking, okay, if you're starting to wind down your own income, does it make sense around the structure, and do you have a property that's negatively geared? Is that giving you the best benefit? Do you need to start to unwind some of those properties, perhaps put them in a different structure, to make sure that, again, it goes back to that tax effective piece?
Because, and we just did a full episode on this with Ryan King, but a lot of people ask the question around how do I earn more money? Everyone eventually will hit an income cap, right? Whether you're the CEO of Australia's biggest company, like the Woolworths CEO who just exited, that was probably his max income he'll ever earn, right? So everyone hits an income cap eventually, but regardless of what you earn, the one of the easiest ways to increase your net income position is to be effective with your tax.
Yep.
Because it takes minimum 30% away from you, maximum 45.
Yeah,
50% of it away from you.
correct.
So if we can be more effective with instead of increasing our top line, or if we're struggling to increase our top line, let's increase our bottom line, which is, okay, we're paying $70,000 a year, $60,000 a year, $30,000 a year in tax. How do we minimize that to only pay $20,000 a year or $10,000 a year? And with the money we're saving, we're investing. It's helping us grow our wealth.
Correct.
That's the positive stuff. And the way that the ATO structures, or the taxation system is structured in most economies, is you will be incentivized if you invest. You will be incentivized if you're trying to grow your own wealth, whether it be through property or other asset classes. You will get tax breaks, you will get deductions, you will get incentives,
Yep.
Which is a good thing.
Correct. And so, in terms of long-term holding on to wealth, and I'm having these conversations more regularly than I was a few years ago, and I think because of the housing crisis, it's top of everyone's mind in Australia. So I'm having sort of more what you might call like an everyday mum and dad with a couple of kids, thinking more front of mind around how do we set our kids up. So what you've got to be mindful of is there's a lot of families at the dinner table right now having that conversation around how do we set up Jane and Joe, who are 10 years old, for when they get to 20. And so that goes back to that sort of family trust, having something set up to help them on their property journey. And just to think about, that's more, people are starting to think more long term, which I don't think that was in the Australian psyche maybe 5-10 years ago.
Agreed. And just on that, I think one of the really big hacks for wealth creation for children, where the parents will get a huge benefit out of it, and I recommend, if you're watching this video, explore what an investment bond is, an education bond. Do you understand what they are?
Correct. Yep.
Incredible.
Yep.
Contributions of which are taxed when they're going in. When you get to a certain point, they then become tax-free. So it's like a mini superannuation of which you can access much earlier in your life.
Yep.
There are rules and regulations around it, but for people who are thinking about how do we make sure our kids don't necessarily have to worry about money or go through what we went through, whether you think that's a positive or a negative, I actually think that people going through hardship and hard things is a positive for them, not a negative. But if you're one of those people who wants to give your kids a better start in life, then exploring what an investment bond is and going hard into an investment bond with any surplus income or anything you can, getting advice around it is a very, very powerful tool, because it is like what I would describe as a mini superannuation of which you can invest into. It is obviously taxed, like I said, but if you invest to a certain point, when you get to that point, it becomes tax-free.
Yep.
Which is incredible. And the reason it is like that is because the government incentivizes people to plan for their future, make sure they are less of a burden on the taxation system and the Australian government. So they are incentivizing things like that.
Correct. And I do see there is a different, so there's some subcultures in Australia where the families very much focus on helping the kids out. And, like if you look at, say, my wife, Chinese, so the Chinese culture is very much about how do we help maybe even the grandkids, so the generation down. But that's not the case for all families in Australia. Some cultures, well, I've made my money, I'm now retired, I'm going to go spend all that on, cruises, $50,000 cruises every year, and not help out the kids.
I think the interesting thing, which is a completely off topic to wealth creation, do you know Alex Hormozy? Have you heard of him before?
Yep.
So he's like, I consume some of his content. And Alex Hormozy talks about, if we wanted to create the most resilient, the hardest working, the best family man or woman, someone who's dedicated, someone who wants the best for their life, and we needed to put them in an environment and shape them into that person, how would you do it? Would you do it by showering them in gifts and love and money so they didn't have to ever work or go through any hardship? Or would you turn them into that person by challenging them, putting them through hardship, making them learn the hard way, and eventually they get to a point, right? So often you see with culture, and you look at it right now, it's like, even with my own parents, the reason they are so successful in their own right is because they went through so much hardship and so much shit in their early life, which formed them into resilient people, which formed them into people who have a certain worldview, who are very interdependent as opposed to dependent.
Yeah.
Whereas I think now most people are trying to give the kids the things that they didn't have in their life. But what they don't realize is the things they didn't have in their early years of their life are the things that actually made them into who they are right now. Where if it's the opposite, if you give the kids and give them everything, then they're going to go through life with this learned helplessness, which is, well, what do you mean I can't just have a handout? Or what do you mean I have to actually go through hardship? Like, I've never had to experience this before. So it's such an interesting dynamic, right? Because parents don't want their kids to go through what they went through.
Yep.
But what they don't realize a lot of the time is the reason they are who they are is because they went through those things.
Correct.
So,
I don't know if my little brother...
Fuck, they're good clips. There's going to be 2 very good clips in that. Thank you.
I was going to say, I don't know if my little brother will be watching, but he, 25, still lives at home.
Yeah.
He may fall into that second bucket, and he had his first full-time job, and I spoke to him first week, how's it going? He goes, I can't believe people get up every day at 6 a.m. and go to work. Like, this is not for me. So
That right there, folks, is called learned helplessness.
that's right.
And again, that can do two things. If your brother goes, I can't believe people have to get up every morning and go to work at 6 a.m. I'm going to make sure I never have to do this. And
Correct.
that gives them drive. That is great. But I would say for the most part, they fall into the
They want to sit at home and play the PlayStation.
Fuck this. When's mum and dad going to die so I can get the inheritance, you know? It's interesting. It's interesting. But I think all of those things that we've covered off, like, and none of that stuff's revolutionary. Everyone's heard it before. It's like, start early in your life, have a slight amount of delayed gratification. And it's not even like an excessive amount of delayed gratification. You know, the thing that I talk about all the time is in New South Wales right now, a 5% deposit, no lender's mortgage insurance, no stamp duty. It's like you can get into a $500,000 property for 25 grand. You will go and spend 20, you will beg, borrow and steal to get 25 grand to go to Europe.
Yep.
Because everyone's there every second year, third year. People are traveling Turkey, wherever it is. But you won't do it to buy a house. But you do it to buy a house. And the reality is you don't have to make one good financial decision for the next 10 years. And that property or investment will just tick over and make sure that once you get to the 30s, which is the building wealth phase, you've already got a foundation to build off and you can have a much stronger head start.
Yep.
And then you get to that later year in the life that we're talking about and it's happy and dandy.
Correct. Yep. I agree.
Very interesting stuff, Mr. Harper. Anything? Closing words?
No, that's it.
That was a very, very good podcast. What do you reckon, Joel?
Yeah.
You got notes?
What juice, mate? I've got a fucking ton, though.
There we go. Look at that. There's a few clips in that. All right, folks. See you next week. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production. Frankie, it's good to be back.
Welcome, hello.
Mate, it's good to see you've gone back to your old-fashioned ways.
Why? It's
Oh, you
the
just
same
look-
shoes as last time.
Yeah, but mate, what's going on with those shorts?
Mate, royal blue, I like them.
Royal blue and that shirt.
It's a polo shirt, mate.
No, it's not just a polo, mate. You spent big on that one. What is that? What
Tommy
brand's that?
Hilfiger.
Hilfiger. Now, Frankie,
Yes.
mate, you come to the office, not very often, and when you do come, you just distract everyone.
They all want to talk to me, mate.
I know. And also, what they want to do is they want to see you open your net bank up. You have never done that for anyone yet because there's too
What?
many. There's too many zeros in
Net
there.
bank.
Your net bank, yeah. How much cash you got, Frank? That's what people want to know.
Not enough.
Now, mate,
Yes.
we're chatting today. We didn't really have a topic other than your topic where you talk through, interest rates and inflation and blah, 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 blah. No one cares about that shit. Just give us a quick update on it, Frankie. We got
Well, as we know, January, not much happens in January,
no,
right?
not as we know. The reason people listen to this podcast, Frankie, is because people don't know. So they coming to us for advice.
Yeah, okay. Well, not much happens in January, right? After Australia Day, the real estate market officially opens or unofficially opens.
Yeah.
So February figures, now we're into March, mate. We're already into March. What are we, 17% of the year gone or something like that?
Isn't that wild? 17% of 2024 is gone. And you just
mate,
look at your
gone.
life and go, what the fuck have I actually done? What have you done this year, Frank?
Not much, not much. Oh, we bought a few properties for clients, yeah.
What else?
Anyway, let's get back to the February figures. Across the board nationally, up 0.6%. So,
Yep.
again, every state and territory was up with the exception of Tassie.
0.6%.
Yeah,
There's
so,
enough growth in that to buy yourself a car.
Well,
if you're gonna take a cigarette.
Sydney did 0.5%. I mean, you extrapolate that out for the year and there's 6% per annum. Not saying it's going to do that. They're predicting it might slow down a bit, but still ticking along nicely. And then today I just saw national vacancy rates have hit an all-time low, 0.7% across the nation.
So why aren't
that
people
is
living in those 0.7%
very low.
of properties that's available, mate?
Well, they just must not be present. I'd hate to see what they look like. But yeah, 0.7% is a very low.
Are you still
very low.
renting out one of those properties that you own, Frankie? You've got 10 people living in the garage. No. Oh, sorry, we're not allowed to say that on the podcast, are we?
Definitely not.
Now,
so
Frank, okay, well, there you go. There's the micro numbers. So in the grand scheme of things, fuck all's changed. Now, Frankie, we're going to go through the Q&As today.
Oh, okay.
All
Some
right.
questions from viewers.
Questions from you. I've got thousands of the bastards, but let's get back to it. All right. We got a question here from Eric. Do you recommend investing in another state that you don't live in? Go on, Frankie. You've done that.
Yes, well, I have. I live in New South Wales. I first started my investing journey in New South Wales and pretty close to home in the Sydney suburbs, as most people do because they're comfortable with that. As my journey progressed and my portfolio started to build and get larger, I then stretched out into Brisbane, bought 2 houses in Brisbane, and then have bought a house in Victoria as well. So yes, I have 3. So my portfolio is now across three states, New South Wales.
And what was the thing that motivated you to go into states? So you had how many did you have in New South Wales before you?
I don't know how many at the time, maybe 4 or 5. A bit of diversification. What I liked about it is that if New South Wales was in, a downturn or just ticking along, then, it's more than likely that one of the other states, because every state runs in different cycles traditionally. So if New South Wales was down, Brisbane would be up. If Brisbane was down or, going mediocre, Victoria might be up. So my whole portfolio is ticking along and growing at all points of time, so to speak.
Oh, there you go. Okay.
So yes, I do like it. It's a good way for a bit of diversification. And like I said, getting a bit of access to all markets in different states.
Yeah. Okay.
I don't like WA though.
Neither do I, Frankie. All right. Next question comes from Nick. How do I go about getting a bank valuation of my house to see the true loan to value / equity available? I'll answer this question.
Yeah.
So essentially the way that you would do that is a few different ways. You can get a desktop valuation where you just call your broker, call the bank and say, hey, can you run a desktop valuation, which is just where they use their online automated valuation system and they spit out a number. Naturally, then you'd say, okay, well, if it was valued at $1.5 million, my debt's 800,000. You then work out what your loan to value ratio is. Or you can get a full valuation, which is when a valuer comes out to your property, or you can get multiple valuers to come out to your property. They'll walk through, they'll do their valuation, and naturally, again, valuation, whatever your debt is, that's your loan to value ratio. To be honest, none of those are true valuations because the reality is the marketplace determines what your property is actually worth. They're the most accurate you can get based on...
but you never know what your property is actually worth until you sell it.
Yeah, but those kind of valuations will give you everything you need to know to get your accurate equity position because you can't cash out equity based on a real estate agent's appraisal, for example.
No. You need to get an official valuation to release.
But again, valuations done by valuers are subjective to the individual, right? Like you get 3 valuers to come out to a property, they're all going to be different.
You'll get 3 different values.
And that again, that's the thing that I don't like about valuations is that it has human biases to it, right? Like that human bias. So, for example, if it was the real property market, property went for sale, 99 people could come through a property and not like it. One person can come through and love it and pay huge money for it.
Yeah.
So who's wrong, the 99 or the 1?
No, that's just the market.
That's right.
That's just supply and demand.
And valuers
which is made up of human beings, but
valuers are the same. They would have their personal biases, personal preferences, just like you and I do, Frank.
Yeah.
And they will value something based on those. Of course, they've got their things that they've learned through their courses in university and studies and all the rest of it. And there's ways.
They're using comparable sales, in the same street, in the same suburb.
Yeah.
Similar sized blocks, all of those things. Just as we do, to substantiate what we feel is fair value for clients.
Very true. Very true. All right, Frankie. First home buyer here was going to build, smash down the loan and pull the equity out to buy an IP. What do you reckon? That's from Mike. So the first home buyer was going to build a property, then smash down the loan, meaning pay down the loan, then pull out the equity and then buy some investment properties. What are your thoughts on that?
So has he already purchased?
Doesn't matter, Frank. Don't get into the technicalities.
Okay. So he's paid it down.
No, he's saying he's a first home buyer.
Yes.
And he's going to, so he's thinking about building his first property.
Gotcha.
Paying down the debt.
Yes.
Then releasing the equity to go and invest.
Yeah, well...
What are your thoughts on that?
Yeah, well, I think it's good if he's only got that one investment property
He's got none at the moment, 0.
But if he gets one, to pay down the debt, or just put the money in an offset account. I like the idea of getting an offset account, keeping the money in your bank account, so to speak, and offsetting the interest, as opposed to giving it to the bank and maybe relying on a redraw facility that they could take away at any time. Yes, get your savings. The more you're saving and the more you're knocking down that debt by way of building up your offset account, you're going to then create some some equity there, and then you can leverage up against that.
Exactly right. I would have a slightly different take on that. I think buying.
I wouldn't wait to pay it down to zero.
No,
You could
that's
be
right.
waiting
But
20,
I
30
probably
years.
wouldn't go buy and build for my first property. If you're buying land and building a house, you're usually buying in a new house at land estate. I
Yes.
probably wouldn't do that.
Yeah, no, I agree with
I'd
that.
go buy something that's established. I'd add value to that property. Take advantage of your first home buyer incentives which you can inside of your state. Use the surplus cash that you have to add some value to the property. That will then, in essence, decrease your loan to value ratio because you're adding value to the property, which then makes the gap wider between your loan and the value of the asset. And then, probably put the money in the offset account.
Yeah.
And
Yeah, no,
and go
I
again.
agree with that. Buying an established property as opposed to building.
Alrighty, Frankie. Here we go. 600,000 worth of equity. Looking to buy an investment property. Bank said I can borrow $800,000. Advice, please.
Well, go out and get your maximum borrowing capacity and
Yeah.
go
So
out and see
what's your take on that? So this gentleman, his name is Nat and Travis is their names.
Yeah.
600,000 in equity, and they're looking to buy an investment property. The bank said we can borrow 800,000. So essentially, what they can do is they can use a portion of that equity, say 20% they need for the deposit and cost on an 800,000 property. So they're probably going to use 200,000 of that 600,000 worth of equity. So they're still going to have 400 worth of equity left. Then they'll put down a 20% deposit on a $800,000 purchase. They'll borrow the rest of the money, so 640 from the bank, and they've got 800,000 worth of debt or thereabouts on that property. Would you go and spend all that money, Frank, on an investment, or would you spend less? So let's talk about your own situation in the past. When you bought Wavell Heights, when you bought that other thing in Brizzy, what suburbs it in? Down south?
Wavell Heights and Mount Gravatt East.
Mount Gravatt. Did you use all your borrowing capacity for those?
Pretty
first?
much. I don't see the purpose in... I mean, you always want to keep a little bit of a cash buffer for a rainy day, or, for interest rate increases and things like that, or, a big repair and maintenance bill or a special levy or stuff like that. So it's always good to have a cash buffer. But the way I look at it is you're borrowing money from the bank and you're then going to purchase, an investment property with it. So it's not actually your money. You're getting it from the bank and you're investing it. So why not invest as much as you can? $1 million property is going to go to 2 million. 800,000 is only going to go to 1.6. So I'd rather invest an extra 200 to make another 200.
That's
You know
right.
what I mean? So
The more you spend, generally, the
the
better
more
the
you
quality
invest,
of the
yeah.
asset
Yeah.
gets, and the better the quality of the asset, the better it should perform.
better location, so to speak, but leave yourself a little bit of a buffer.
Bit of a buffer.
Yeah.
How much buffer you like to have, Frank?
It's all relative, I suppose.
What's it cost you to live per week?
I don't know.
Come on, be truthful. You know. You know.
I don't know.
Come on.
I don't calculate
Frank,
it per
you
week.
know your numbers. I reckon you've still got the first dollar you've ever earned. So how much is it? All right. Oh, this is a good one for you, Frankie. By how much percentage or dollars would you want your employee or employer, I'm assuming that's meant to say, to increase your income by every year once you're at 150 grand?
Well, what's the question? How much would you want your employer to increase your
Yeah, so
income
Frank, you've
by?
been a CEO.
Well,
you've
you'd
been a CFO.
want them to you want them to increase it by as much as possible, but
Let's talk about your own experience. How did you because you ended up getting to a multiple six-figure salary.
yeah.
How did you go from being a cadet accountant, a very average one at that, to a CEO? We're just talking about this, to the CEO of
Look,
a
you
very
just
well-renowned
it just comes down to you're doing your best in your job. You're showing initiative. You have a good attitude, and you work hard. Your bosses see that. They give you more responsibility. You handle that. You get promoted. So when you get promoted, you obviously get a pay increase. Usually comes with that. Another way that people like to do it is they will change jobs for whatever reason, personal reasons or whatnot. Some people do it purely to get more money. I was just reading an article the other day that you're probably going to get more money by changing employers and changing jobs in that initial stage.
Not Henderson, mate.
Not many people are going to change jobs from A to B for less money, right? Unless it's for personal lifestyle reasons, etc., or passion reasons. So you
actually have to pay us to work for us.
That's right. You can change jobs, you get promoted, and over your 10, 20, 30-year career, you keep on going.
So so virtually, Frankie, what you're saying is there's no fixed increase or fixed amount you should be getting.
No, what I've always said is if you're not getting, when it comes to your annual performance review or annual salary review, sometimes they're two separate things. If you're not at least getting CPI, then you're going backwards. Right? Or if you're not getting a 12-month or an annual salary increase at all, then CPI is eating away at your salaries, so you're going backwards. So a lot of companies will have in place, you will get a minimum of CPI or a certain percentage, whatever the lesser is, so to speak, or whatever the higher is. It's all dependent on each and every company. But yeah, you'd want to be at least getting CPI. To me, just
adding more value, to the company, which is showing, like you said.
Yeah, I don't agree that somebody should get more money just because they've been there another 12 months. If you're doing the exact same job, the only thing you should get is maybe that CPI increase to keep your salary the same, so to speak. Yeah.
Sweet. What about when CPI decreases?
No, when it decreases, you get nothing. You should get nothing.
Should get nothing.
Very rarely.
Right.
When have you seen CPI decreasing?
Mate, no idea. Just thought I'd ask a question. What's the minimum you would spend on a commercial asset, and why do you prefer commercial? From Victoria. Now, I'll answer this one, Frankie.
Because I've got no commercial.
How much would you recommend spending on a commercial asset? So generally speaking, again, the more you spend on an asset, the better it gets. So with commercial, it's no different. The more you spend on a commercial asset, the better the location it's going to be, and the better the style of asset it's going to be in the commercial sector. The more resilient it's likely to be, the better the yield will likely be. The issue with commercial, and I wouldn't say I prefer it over resi, commercial is going to need more capital to get into.
Yes, because
you need a bigger deposit, minimum, right? Plus costs.
Yeah.
And the other thing is, if you're using equity, most people get into commercial for cash flow.
Cash flow reasons, yeah.
Want to get in for cash flow, which is great. So if you've got chunks of cash, put it into the commercial assets, and you actually are only carrying 30% debt, then that's 70% debt. Sorry, then that's great. But if you're using equity as the deposit, you're still using debt because you've realized some equity, brought it out as cash out, then you use it as a deposit. So you're still carrying 100% debt on that property.
Yeah.
And it's not going to be cash flow producing. So all of a sudden you're investing for cash flow where it's not producing. And you can't just go and refinance a commercial asset every 6 or 12 months like you can with a resi asset. You can get a resi asset revalued every 6 months because there's constant volume in the marketplace selling.
Yeah.
And that means there's constant comparables.
And you may have longer vacancy periods. I know that's something that has sort of always concerned me, but I've always concentrated on resi. I like the fact that there is obviously more demand for resi from investors. And therefore, I've never gone, more than 3 to 4 weeks of having any of my properties vacant, where you could literally go 6 to 12 months, if not longer, with a commercial. Now, if you're going that long as in a vacancy period on commercial, you'd have to be asking yourself and your property manager, why? Are we asking too much? Is it not presentable? What's wrong with the property to be vacant for that period of time? There's always a reason why something's vacant. Yeah,
agreed. Good shit, Frankie. Another one here. Is it the general strategy to pull equity out of your investment property and put that in the PPR offset? This is from Nicole, I believe. So you can't just release equity from an investment property and put that in your offset against your owner occupier, because it's all about the purpose of those funds.
It is.
So just by releasing it from an investment property does not make that debt now tax deductible. You have to use it for an investment purpose, and then the interest becomes tax deductible.
And technically, if you were to ask someone from the ATO, if you are going to release equity from your investment property, they will say that the purpose of that funds has to be for your investment property, either renovating it or purchasing another investment property, not putting it against your principal place of residence. Now, I'm certain people do it, right? But if the tax office was to come and audit you, you could be in a bit of trouble when they say, "Oh, you've released this equity here. Where have you put that money?" Yeah. You've told the bank or your broker you were going to renovate your investment property. where's the renovation?
Yeah.
So you got to be very careful with that.
Yeah.
I whenever I took out equity from certain investment properties, I kept it in the offset for that investment property. I never actually put it on my principal place of residence because I didn't want to ever get into having been questioned by the ATO.
What do you mean, Frankie? You love that shit, don't you? Yeah. So essentially, it's the purpose of the fund. So you can't release it from a tax deductible asset and then put it against a non-deductible.
Yes, people think this is a big mistake people make is they think, well, I'm releasing the equity from my investment property, therefore because it's an investment property, it's tax deductible. And they might release it to go and buy a car or a boat, which you can do. But it just means that 50 grand you've released is not tax deductible,
That's right.
even though the security is your investment property. Big mistake. That's a big mistake. People get caught out a lot with that from the ATO.
There you go. There you go, Mr. Frankie. All right. Priya, do you need a minimum balance in your super to set up a self-managed super fund? Heard it's about 100,000, but not sure. So there is no actual minimum balance. You can set up a self-managed super fund with 50 grand in it. You can. Doesn't mean you should.
No,
and you should
that's
definitely
right.
go and speak to an accountant, financial planner, blah, blah, blah.
I've heard that 200 to 250 is the minimum you probably should have there. Now I haven't set up a self-managed super fund. I'm so heavily invested in property that I like the fact that my super and my wife's super is a way of diversifying a little bit away from property. And the thing is, there is with the self-managed super fund, from talking to my own accountant, there are compliance costs there. So you don't want the compliance costs being a huge proportion or a large proportion of,
Your returns.
of the 50 grand or the 100 grand you got there. So a lot of the time, your accountant will say, look, wait till you get to 200, 250 grand, then we can start talking about a SMSF.
Exactly. Yeah. And if you're going to buy property, you need enough for deposit and costs and all the rest of it. And it usually doesn't make sense until you've got that sort of money in there as well.
Because your self-managed super fund income, your contributions, your employer contributions, and rental income, if you're going to buy property, they have to cover all the costs of holding that investment property.
Exactly.
So you want a bit of a buffer in there as well, like we spoke about before. So, maybe 200, 250, you're skating a bit on thin ice there.
Very, very true. All right, here we go. Minimum cash position to get into the real estate market, disregarding capacity and income. So the minimum you'd need if we're disregarding capacity and income, if you're not a first home buyer, buying the kind of properties that we buy, you need 150 grand, I would say. You need a 10% deposit for the property, thereabouts. So you'd want, say, if you bought for 800 grand, you want 80 grand plus stamp duty, say 30, 35, so that's 125, plus lender's mortgage insurance and a few other bits.
Well, the question is a very broad one because the person is saying to get into the property market. Well, there's hundreds of property markets. So are we talking, Perth? Are we talking North Queensland, Darwin?
Yeah, well, I would spend,
Sydney,
if I was saying get into the market, spend circa 600 to 800 grand. You'd want a 10% deposit plus costs, which would lend you up somewhere between 1 to 150 in cash. If you're a first home buyer, the first home loan deposit scheme, 5% deposit, no lender's mortgage insurance, etc. That'd be the way that I would do it. All right, we got one from Jack Burrell. Where would you buy with circa $650,000 purchasing capacity, house, apartment, and townhouse? Frankie, where would you buy?
I would buy a unit in the Newcastle region for about 650. Yeah, nice little two-bedder, as close to the CBD and the beaches as possible.
Yeah.
Didn't Perry buy one just around there, I think?
That's a year. He just bought one in the hill.
Yeah, for around 650, wasn't it? Or just under?
Yeah, 640.
So, yeah, I think you can
Big
get
outdoor
something.
terrace, nice views of the city.
Small block. I think you do well. They're good historical growth rates.
Mate, very good. And for me, it would be in a similar region. I'd have two options. 650, I would buy an apartment in a small block, of which I did when I was younger. I bought one for 665 in Bar Beach. That's worth now 1.2.
Yeah.
And
or a bit further out.
Yeah, potentially. Or I would buy a house in a region or suburb called Beresfield, which is, I believe, a very undervalued pocket of Newcastle.
Yeah, heading towards more Maitland region,
it's like in between Maitland and Newcastle, right at the end of the freeway, intersection of Newcastle and on the way
which
to
we
Brisbane.
have bought for
quite a few properties there. And you can buy something there like mid fives to early sixes and a house that has dual occupancy potential. That's what I do.
Yeah, nice.
One of the two. All right, Frankie. What's next? Here we go. Nathan says, I have $100,000 of equity to use. Should I buy an investment property or should I add a granny flat to an existing property?
Oh.
Frankie, what would you do?
Well, it depends when he says, shall I buy an investment property, to what value would he be able to buy? And that would then, limit $100,000 worth of equity is not a huge amount, so that's going to limit his borrowing capacity and where then, what region, suburb is he going to buy in. Whereas by putting a granny flat at the back of his PPOR, well, it's going to give him some good income,
which should increase your serviceability.
Increase his serviceability, increase his savings. Like he might just say, well, I'm going to, build the granny flat and then just save all that income for the next 3 years, which will give him more money to go and invest in investment property down the track. So I'd probably go that way, depending on how old he is too. If he's only a young guy, he's got time on his side.
Yeah. So essentially, use the 100 grand, go into a granny flat, use that granny flat to increase your income, decrease the debt with that.
It's going to increase the value of that property as well. Maybe only buy the value of the granny flat, maybe a little bit more. But it's going to help him definitely with, we always talk about growing your income. That's definitely going to help, having a rental income from a granny flat.
Alrighty, Frankie, that was very good. Thank you. Now, looking at purchasing my third investment property, freestanding house, $1.25 million budget, Brisbane or Newey?
Oh, this is nice. Third investment properties are very good from this person. Well on their way.
This person's name is Mikey.
1.25 in Newey, in Newcastle, is going to get you.
Brizzy.
Yeah, or Brisbane. Okay, so in Newcastle is going to get you something very nice. Within 4 or 5 k's of the CBD.
Mayfield East.
Or you can go right in. You can go right into like Islington and places like that.
Get something a little bit smaller.
But a little bit smaller. In Brizzy, 1.25, you probably get something on the north side or south side, but north side, within that 8 to 10 to 12 k's, you'll get something in the Chermside region, Wavell Heights, where I have mine. It's probably worth about 1.2 now on 600 to 700 square meters. Nice 4-bedroom house. I don't think you could. Probably looking at the historical growth rates, I would say Newcastle. And I like the fact that Newcastle is only 2 hours from Sydney. Obviously, Brisbane's a lot further. So I'd probably go, I do all the reports, as you know, and when I look at the historical growth rates of those good suburbs on the north side and south side of Brisbane versus Newcastle, and Newcastle wins hands down every time. So,
exactly. It's interesting. It's going to be interesting to see what happens over the next 10 years with Brisbane obviously having the Olympics. Olympics not going to dramatically change the property market, but it will create hype around the area, which will have an impact on the property market.
But I think long term, Brisbane does have, and I'm talking the next 10 to 20 years, I think those growth rates in Brisbane are going to start to increase. I think they are only going to get better. More migration, more people getting, afforded out of Sydney. I think both Newcastle and Brisbane are going to do very well. So for 1.25, you'll do very well in both. If I had to, put a gun to my head and pick one at this point in time, I would pick Newcastle.
There we go. You've heard it from fucking Frankie. You've heard it from the Frankie. Get the gun out. All right. Last but not least, there's so many questions here.
It's good. There's a lot of interest.
What's the best way to go from property 1 to property 2? Frankie, let's talk about your own experience. How did you go from property 1 to property 2?
Property 1 was just a little 2-bedroom apartment, and property 2 was actually a studio apartment, right?
So you went from shit to shitter.
So no, because the property 1 was like 82,000. We're talking 30 years ago, and then property 2 was about 110.
82,000. This is when Jesus was playing halfback for Bethlehem.
So the second one, the studio apartment, was in 110,000, but in a suburb a bit closer to the city. It was in Ashfield, actually. So look, but in regards to how do you do it? Well, you got to.
Let's talk through it. When did you buy your first one? What age?
I don't know.
You said 18,
19.
When did you buy your second one?
The second one was, we went through this once before. I think it was 3 years later, if that.
3 years later. So you bought the first one 3 years later, which seems like, it's when you're in the moment, 3 years is a lot. If I said to you, Frankie, buy one today and then don't go buy another one now until 2027, you're like, I want to do it sooner. But 3 years.
It goes quick. 3 years goes quick.
Especially when you're out on the town.
Now, there's two ways. There's 2 ways you can do that. One,
just hit thrusting.
You'll get your valuation on the first one done, see what equity you got there and what equity you can release. Hopefully, you can pull a 20% deposit out of it.
And you're young, so your income's increasing, so you're servicing.
And like, what we were talking about before, if you're doing well at work and you're getting pay increases and you're getting promoted.
Teacher's pet, you'll shove someone out of their role.
You've become qualified in something. So, is an issue. As soon as I got my CPA qualification, I remember my pay went from 70 grand to 100 grand. Now, I had to leave the company to do that because they felt, well, you're the same person, blah, blah. And what they didn't understand was that, yes, but now there's a whole lot of jobs out there in different companies that are open to me because they will only hire a CPA qualified accountant. So literally, I said, okay, well, I'm going to resign. And literally overnight, my salary went from 70 grand to 100 grand.
So you had like a 40% increase in salary.
Yeah.
Which
so,
then increased your serviceability.
Of course, yeah. So look, it's things like, if you're in a profession where you are gaining a qualification in that 3-year period, that can happen. You can change jobs, get more income. You've got some equity going here. You've got some savings. You always need to be saving, I say.
That's right.
All those things combined. So an increase in income, savings, an increase in valuation. Put those together and
get you into property number 2.
Get into property number 2.
Just don't buy a studio for your second one.
Not a studio. I don't
for me,
recommend.
very, very similar. 18 was when I bought my first one, just before I turned 19.
Yeah.
Got the first one, property market. That was in 2015 in Sydney, was going really strong. And then I didn't buy my next one until 18 months later. So I turned 19 and then I bought my next one at 21.
Yeah. So how were you able to buy it so quickly in 18 months?
Really strong growth and income growth.
Yeah.
My income when I bought my first one was, 70 or 80 grand. And then, I was working more hours. I ended up...
saving? Were you saving hard over that time?
I was saving, but not like 70 or 80% of my income. Like I was saving, but I knew after I got my first property that the heavy lifting was done.
Yeah.
But for savings in paying the mortgage every month.
Yeah. I was living at home too.
Yeah, so was I. I was living at home.
Living at home, rent free.
Low living expenses.
Yeah.
You would have been getting 17 dishes of pasta every night. Frank, and then, that was it. Income increase, serviceability increase, and property growth over the 2 years. Bang.
Yeah. And you got to make some sacrifices. I didn't buy a car. Well, I was living at home rent free. So
but now you drive a Rolls Royce.
No, I don't. Living at home rent free. So grateful to my parents for that. Utilising their car because they had a car each, so I didn't need to buy one.
So what you're saying, Frankie,
but you need to make
grew up with the silver spoon.
No, definitely not. But you need to make some sacrifices, right? So I sacrificed going out and getting my own car. I'm driving my parents' car. Well, so be it.
You still drive your dad and mum's Lexus, don't you? The hybrid.
No, they don't have a Lexus, mate. So, you've got to make some sacrifices. Maybe go out and get a second job. Drive an Uber at night or whatever it is. Do whatever you can while you're young to get into the property market as soon as you can. That's the thing I say.
Agreed. And I spoke about it with Jeremy Harper on last week's episode around getting into the property market early then makes all of the other decisions that you make financially over the next 10, 15, 20 years less important because that property is going to be ticking along the background. And as long as you're servicing that debt and you buy a half decent property, it will be growing with the market.
Yeah. And
you'll get 10 or 15 years down the track. You could have pissed all your money up against the wall up until that point. And you get to 30, 35 and go, oh shit, I've got a property sitting there. I can sell that down or refinance against it, go again, and you're off to the races.
That's it.
Frankie,
Let's go
always.
to the races.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDFs beforehand. This is a Henderson podcast production.